shifts to Tuesday.
Okay, so Darshan, thank you so much for that. But now let's focus and talk about the much-awaited GST meeting, right? The GST Council is set to meet on 3rd and 4th of September. And we'll discuss the centre's proposal to shift to a simplified two-slab structure of 5% and 18% with a special 40% rate for sin as well as demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities are expected to fall in that lower slab of 5%. Televisions, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc, which are currently taxed at 28%, may move down to 18% slab as well. Now, the proposal also includes a major relief for consumers and industries with life and health insurance premium as well as reinsurance likely to be exempted from the GST. So important in the next 2 days, this GST Council meet and what the update comes in on that front. But on that note, let's just slip into a very short break. And after the break, we'll get to the latest updates from the White House in our special segment, Trump Watch. Thanks for staying tuned into Power Breakfast on CNBC-TV18. Now let's move on and get you the latest on Trump-related developments. We have Dia joining in with us in a special segment, Trump Watch. Good morning, Dia.
Good morning. Now, starting off with a fresh statement from US President Donald Trump about trade with India. Now, Trump has said that India has offered to cut its tariff to nothing. Now, this comes after Washington imposed 50% levies last week as punishment for India's purchases of Russian oil. Now, in a post on Truth Social, Trump wrote, they have now offered to cut their tariffs to nothing, but it is getting late. They should also have done this years ago. Meanwhile, U.S. Treasury Secretary Scott Bessent says the Trump administration is weighing the possibility of declaring a national housing emergency this fall. Speaking on Monday, Bessent said, we are trying to figure out what we can do, and we don't want to step into the business of states, counties, and municipal governments. We may, however, declare a national housing emergency in the fall. And on the global stage, Brazil's President Luiz Inácio Lula da Silva is convening a virtual meeting of BRICS leaders next Monday. Now, according to sources familiar with the matter, the agenda will focus on Trump's trade policy, including the new U.S. tariffs and the efforts to rally emerging market nations in support of multilateralism. Now, that's all for today. Back to you, Vinny.
Okay, Dia, thank you so much for that. But keeping it with the US and the updates that came in there, White House Trade Advisor Peter Navarro once again talked about how India is the Maharaja of tariff and said that India's oil trade with Russia is nothing but profiteering. Listen in.
Problem is that India literally is the Maharaja of tariffs. It has the highest tariffs of any major country in the world, and it's in denial about that. It tries to tell everybody out there that that's not true when it is demonstrably true. So they should engage with us. They haven't done that as Japan, Korea, the Philippines, Indonesia, the European Union has. They simply think they continue having their way with us. President Trump's not going to allow that. Now, Putin gives India a discount on crude. They refine it, sell at premium prices to Europe, Asia, and Africa. It's nothing but profiteering. India cannot stand on the thin reed that somehow they need this oil to run their cars or cool their homes. It's false, just simply false.
Also, Peter Navarro talked about PM Modi's relation with China in the light of conflicts between the two countries over the years. Listen into what he had to say.
It was a shame to see Modi getting in bed as the leader of the biggest democracy in the world with the two biggest authoritarian dictators in the world, in Putin and Xi Jinping. That doesn't make any sense. I'm not sure what he's thinking, particularly since India has been in a Cold War and sometimes a hot war with China for decades.
Meanwhile, India has pushed back against the criticism by the US over its Russian oil purchases in a strongly worded column published in The Hindu. Oil Minister Hardeep Singh Puri said that India stabilized the markets and prevented a catastrophic $200 per barrel shock. Without naming White House Trade Advisor Peter Navarro, Puri wrote, and I quote, "Some critics allege that India has become a laundromat of Russian oil. Nothing could be further from the truth." End of quote. Navarro had claimed that India's big oil lobby and turned the country into a oil money laundromat for the Kremlin. Union Minister Puri also highlighted that India has not broken any rules and its imports comply with the G7's price cap mechanism, which is designed to cap Moscow's revenue while keeping the oil flowing. And let's move on to the top headlines from the SCO summit. What was the update there? A new beginning with Beijing and affirmation of India's decade-long story relation with Moscow. Prime Minister Modi's visit to China's Tianjin for the SCO summit was a significant event on many grounds. Prime Minister Modi's visit to China, the first in 7 years, came amidst India's tariff standoff with the United States government, and the SCO summit also witnessed the newfound emergence of the East as PM Modi, China's Xi Jinping, as well as Russia's Vladimir Putin were seen together in what could be described as a delicate mix of rivalries and shifting power dynamics. This meeting is notable amid the ongoing tussle with the three nations, where the three nations are facing with the US president on Donald Trump on rising tariffs and global uncertainties. We spoke to two former diplomats to get a sense on what the Modi and Xi Jinping meet could mean for the ties between the two nations. Listen in.
From our point of view, if we can maintain peace and tranquility on the border, then we can slowly open up other aspects of our ties in a limited way, so as to keep the relationship stable and also persuade China, and this has always been our case without getting any result, that we must reduce the trade deficit between the two countries.
Prime Minister was very clear that we are not looking at India-China relations through prism of relations with a third country or lens of a third country. Prime Minister reiterated that for normal development relations, you need peace and tranquility to maintain in border areas. Border issue is back to the center stage of the relationship.
Okay, those were the updates that are coming in here right now from the global front, and India stand there. But on that note, let's slip into a very short break. After the break, we'll get you what's happening in the world of commodities. Stay tuned in. Welcome back to Power Breakfast on CNBC-TV18. Now let's talk about the US markets that remained shut on Monday for Labor Day. But stock futures, what are they indicating? They are also remaining, little change that we're seeing, not much of a change there, as investors are weighing the latest development on trade front to kick off a seasonally poor month for the equities. Now, those moves come after the Federal Appeal Court on Friday ruled the most of President Donald Trump's global tariffs that are illegal. So we'll wait out for more updates coming in on that front as well. Now, that is US futures indicating not much of a change there. But let's move on and go across to Manisha, who's here to give us the updates in the world of commodities. Good morning, Manisha. And we are starting off the day with gold again at record highs.
Oh, well, absolutely. It's been some year, 2025, and we're looking at very strong gains continuing for the prices. We are up by nearly 35% for the gold prices this year, and silver is up by 41% in this current year until now. The gold is the one that has hit a new high in the international markets, in the Indian markets as well. There is safe haven demand due to uncertainty of U.S. trade tariffs. The dollar index is trading at a one-month lows, and markets right now are pricing in a probability of an 88% of the U.S. Fed rate cut in the month of September. That really has been very supportive for prices. And then you have seen strong investment demand. The central bank buying has been on the stronger side. The street will now watch out for the U.S. non-farm payroll data that comes in on Friday, and that would give you a further direction in case of markets. But until then, it is a very strong going that we have seen in gold and silver both. In addition to that, the dollar index trading at a one-month lows also seems to be very supportive.
Okay, Manisha, thank you so much for that. So that's the update coming in the world of commodities. Now on to some national updates that we have. The flood situation in Punjab remains grim. So far, 29 people have died from rain-related incidents and more than 2 lakh people have been affected by the floods. Incessant rains and floods have affected almost the entire state, causing unprecedented damage to human lives, crops, livestock and infrastructure. Prime Minister Modi dialed Punjab CM Bhagwat Mann to discuss the situation and assured all help and support to the state. Now, meanwhile, in Himachal Pradesh's Chief Minister Sukhwinder Singh Sukhu has declared a disaster in the state. The Chief Minister told the Assembly 320 people have lost their lives in the last month due to landslides and floods, and he estimated a total damage could cost over 3 lakh crore rupees. Relief operations are ongoing, but several areas remain cut off. The Met Department has warned of more rains and landslides over the next 24 hours. And more national updates coming in. Relentless monsoon showers continue to lash North India. The weather forecast for Delhi today warns of intense downpour as well. In Gurugram, heavy rains have triggered severe waterlogging and massive traffic jams, with reports of a 7-kilometer long traffic snarl. IMD has issued an orange alert for Delhi, Noida and Gurugram regions. Now, the District Disaster Management Authority has advised all schools and colleges and offices to remain closed for today as well. And in some international news that we have coming in, more than 800 people have been killed after an earthquake of a magnitude of 6 struck eastern Afghanistan. As per authorities, at least 2,800 people have been injured. Rescue operations continue, but reaching remote areas remains challenging due to the rough mountainous terrains and harsh weather. As per Taliban government, some villages have been completely destroyed, while many people are feared trapped under the rubble. Now, that's all the update that we have coming in for y'all this morning, and that's all the time we have on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Bhasan Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Tuesday morning, still a very, very rainy city here in Mumbai. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, folks.
Good morning.
Good morning. A very rainy Mumbai and a very angry US president and US administration. I don't think the smiles in Tianjin went down too well in Washington. So lots happening out there.
Are you sensing taco?
Not this time. I don't think so. No, there's too much at stake. Too much optics, I think, at stake. And that's part of the problem. That's why we are at 50%, right?
But I thought maybe less angry.
It's
Based
a
on
disaster, the
it's just a I'm just that's what I want to.
Surabhi, I don't disagree with you too often, but this time I think we are at the
I
opposite
hope
side.
so. No, I hope so. I hope so. I really hope. I hope you're right. And that we get, I mean, eventually there's a climb down. Absolutely.
Absolutely. Let's take it from the top then, right? And that's the question that I want to put out this morning, which is, if you just look at the Truth post yesterday, is it less confrontational? I think it is. Let's see if the market interprets it like that as well. Usually, it's basically a rant. How the tariffs are going to be in place for a long time, etc., etc., etc. But we will not put out the entire thing, but just this part, right? And this is what he said. He said they, that is India, have now offered to cut their tariffs to nothing, but it's getting late. And that's the specific portion that I thought made so he kind of sort of left off at that point, which is that there's an offer for tariffs to be dropped. I think it was always there from the Indian side. The bit about, I mean, of course, he started with the tariffs being high, Russian oil, etc., Russian weapons and oil purchases. But it just seemed to me, I mean, it to be a little less confrontational. We'll see. Of course, I mean, the comments, of course, also come after on the back of PM Modi meeting Presidents Putin and Xi. And, of course, President Xi in China, of course, is the big one in terms of repairing relations, etc. Peter Navarro, that is the top US trade advisor to Trump, also had something to say. And we'll play that soundbite out in a bit. He said, that doesn't make any sense. And that was basically PM Modi meeting with Xi. I'm not sure what he was thinking, what he is thinking, that is PM Modi is thinking. So there is acknowledgement of what has happened with regards to the SCO summit where PM Modi, President Putin, President Xi, of course, have met and have promised to kind of work together. That comment that we are not rivals, both President Xi and Prime Minister Modi. I think all of this has, of course, been taken on board and being watched very, very closely. And that's the reason why I'm saying maybe at the margin, there is, I mean, I read those comments a little less confrontational, but we'll see. Markets will watch headlines to see if these developments are turning more conciliatory. That's the other point. BRICS leaders, by the way, have scheduled a virtual meeting for next Monday to discuss Trump tariffs. BRICS was, I mean, to my mind, if you just look at what's happened over the last few years, non-existent. I mean, there was nothing really happening in terms of big developments, etc. But this grouping has also now been revived in the face of Trump tariffs. This is interesting. U.S. markets, of course, in terms of price action, were closed last night, nothing very much. Precious metals, of course, surged. Silver surged above $40 an ounce for the first time since 2011. Gold, of course, is on track to $3,500. It hit an all-time high. So that's precious metals out there for you. Lots of U.S. data this week. You got ISM data, durable goods, and, of course, towards the end, the most important, which is the jobs number, the non-farm payrolls report, which of course, comes around market open on Friday. Yesterday, of course, we got a nice rally, right? I mean, how much of it is positioning related? I think 60-70% perhaps is positioning reversal of the huge amount of short positions and, just a one-way kind of a market going the other way a little bit. And the indication, the reason I'm saying that, and F&O stats, Nigel will look at in just a bit, but the rupee hardly moved, 88.20. So while the Nifty did decently well, the rupee did not move at all. Auto stocks rallied hard, and we'll talk more about that as we go along. I mean, of course, sometimes what happens is going into an event, which is like something like a GST, stocks remain bid. And post that, it's a different picture. But we'll have to wait and watch. IT stocks also posted decent gains. I'll just leave you with two levels. Supports, of course, are the recent lows, so I'm not going to put them out again. Immediate resistance for the Nifty is the 40-hourly exponential average. It crossed the 20-hourly yesterday, the first level we put out yesterday. So 40-hourly is now moved to 24,670. And then the 20-day moving average comes into focus, which is 24,694, very close by in that sense. For the Nifty Bank, the levels also come out. Again, I'm just going to put out the resistance numbers. Here, the 40-hourly exponential is 54,352. And this, to my mind, is a bit of a major hurdle, which the market will do well to cross from here. GIFT Nifty will give you a quick sense of how we are likely to start. And we'll, of course, pick it up from there. 7 points lower, implied open, so absolutely nothing on it. But, Nigel, the F&O stats, especially with regards to what happened yesterday.
Well, that's right. Actually, I could be horribly wrong, but I'm sensing a little bit of taco. So hopefully Trump eases out on that stance and hopefully the markets can move forward, because that is the single most important factor with regard to sentiment here in the Indian markets. Easing of tariffs is the key cue. Now, in yesterday's trading session, it was a good one, right? But the FIs, they were virtually absent because, yesterday the gross volumes were down by 25 to around 30%. If you compare it with the average of August itself, a little more than 30% actually, but take into account a couple of large trades as well, still the participation from FIs was down close to around 25% in comparison to averages. Remember, today is going to be an important Tuesday because it's the first weekly expiry for the Nifty on a Tuesday itself. It's been a short one. Started on Friday, have two trading sessions and already to expiry. But I'm expecting some bit of volatility, particularly in the second half of trade. We could see a couple of wild swings on this first expiry for the Nifty. So we'll keep that a watch on that. Well, in yesterday's trade, we're talking about the FI participation being down, but institution net figures, that's the FI and the DI, you put it together, well, net buying of close to around 2,500 crores or thereabouts. So that was a good number actually to get from the institutional participation. Moving to what happened with regard to the positioning in the F&O market. Well, the FIs, they are net short. They continue to remain net short. Yes, there was some very, very mild short covering. Some marginal short covering and some marginal long addition is what we saw in yesterday's trade. Though they continue to remain net short, so if you can get past those crucial levels, then you could be bracing for a bit of a short covering bounce. Moving to the PCR, that's one of the key indicators, right? Besides the FIs being net short, that coupled with the PCR at around 0.7 normally spells a bit of a short covering bounce. And that's what happened yesterday, right? We had a bit of a relief rally that played out. Now that PCR has moved up to around 0.87, and the reason that the PCR has moved up, because there was some signs of put writing in an uptrending market. So the 24,550 put, massive open interest built up out there, premium at close to under 100 rupees. However, on the upside, 24,650 call, 24,700 call. Between them, they added close to around 50 lakh shares, which is the important resistance zone. So just to give you a level for today's trading session, well, you have crucial resistance coming in at around the 24,700 odd mark. And going by the options data, this is the crucial support zone, 24,400, 24,450. And the 24,700 mark is extremely important because if you just pull up the 20 as well as the 100 EMA, in that vicinity is where you have that crucial resistance zone. So that's important. One factor, though, that's going to stand out is the Nifty Bank. It's underperformed in the last 1 month or so, and that needs to give up its relative underperformance because that's been the rank underperformer in the last 1 month. That needs to come back to life, maybe get to around that 55,000 odd mark. It's going to be important because you can't have the largest constituent not participating. In terms of stocks that I'm looking at, MobiWick, that's the stock I'm looking at. Massive volumes yesterday. It's been a big underperformer this year so far, if you look at it from the recent highs. And yesterday, there was a clean out trade. So normally, you have seen some of these new age themes coming back into play, a clean out trade as well. Let's see whether or not the stock is good for more. I'll keep an eye out on this one for the next few trading sessions.
Well, indeed, a great pullback by the market yesterday, and one perhaps long overdue and a big sigh of relief for the bulls. The question is, can they build on that? Now, cues this morning across Asia are fairly thin. You don't have a major directional move on any of the markets. When yesterday it was a big down move in Japan and up move in China. Today you don't have that. It's sort of thin trade. And you're seeing the Hong Kong markets, for instance, just about 0.25% on the upside. Japanese equities have also stabilized, which is why that implied open is very, very quiet right now. But let's say we had a trending up day yesterday. So quiet start and maybe a gradual build up could always be a great scenario. Well, we have two equity calls coming for you this morning. Let me take the first one. This is coming in from Rhythm Desai, who of course has been a big bull on the Indian market. Now he's saying the soft earnings growth patch that started with the second quarter of 2025 seems to be ending, but the market is not yet convinced. He says supporting a turn in growth is a dovish central bank, likely GST reforms, a good monsoon season, recovery in consumer confidence, thawing of relations with China, and likely improving capex. It seems, he adds, at least foreign portfolio investors are attaching more importance to the issue of Russian oil imports between the US and India. Rhythm says a final trade deal with the US, more RBI easing, signs of uniform improvement in high-frequency data, and slowing equity returns outside India could act as catalysts. So could we actually come together to a perfect amalgamation of all these circumstances? Rhythm certainly seems to think so. Well, we have another call coming in. This is from Pratik Parekh of Novama, who says that historically narrowing US current account deficit in 2008, 2011, 19 slowed earnings all over and sapped sentiment. Ironically, he adds, domestic cyclicals were worst hit. He says markets revived only after 10-year yields fell and valuations cheapened. Today, he says valuations are high, yields are elevated, and domestic easing is shallow to offset a global drag. He says they have downgraded BFSI to underweight, given rising MSME stress and deflationary dynamics, while they have upgraded IT to an overweight owing to low relative valuations and earnings gap. Novama, of course, has been taking a more cautious view of the market, and that's the call which resonates in Pratik's view as well. Well, before we introduce our first guest on the show, let's just revisit a lot of the further hawkish commentary and talk that's come in from Washington, from the US side. And the US has been watching the SCO summit and the liaison between India, China, and Russia very, very carefully. White House trade advisor Peter Navarro once again talked about how India is the quote-unquote Maharaja of tariffs and said India's oil trade with Russia is nothing but profiteering.
The problem is that India literally is the Maharaja of tariffs. It has the highest tariffs of any major country in the world, and it's in denial about that. It tries to tell everybody out there that that's not true when it is demonstrably true. So they should engage with us. They haven't done that, as Japan, Korea, the Philippines, Indonesia, the European Union has. They simply think they continue having their way with us. President Trump's not going to allow that. Now, Putin gives India a discount on crude. They refine it, sell at premium prices to Europe, Asia, and Africa. It's nothing but profiteering. India cannot stand on the thin reed that somehow they need this oil to run their cars or cool their homes. It's false, just simply false.
Okay, he also talked about Prime Minister Modi's sort of meeting with China's Xi. So listen to that as well.
It was a shame to see Modi getting in bed as the leader of the biggest democracy in the world with the two biggest authoritarian dictators in the world, in Putin and Xi Jinping. That doesn't make any sense. I'm not sure what he's thinking, particularly since India has been in a Cold War and sometimes a hot war with China for decades.
Okay, global politics, never a dull moment. But where does this leave us as far as the markets are concerned? Florian Nito, head of investments Asia at Amundi, is with us. Florian, we have you at a very interesting juncture. Great morning. I don't know if you could hear some of those sound bites that came in from Peter Navarro. But as someone who's managing so much of money out of Asia, these changing political equations, or at least shifting political equations, how much credence are you giving to this? I'm sure you're watching it. But is it impacting your decision-making at all? And, what are your thoughts now over the last couple of weeks in India?
Yeah, thanks for having me. Yeah, well, if we sum up what we heard overnight, it's slightly more conciliatory tone from Trump, in our view. It's the last bit of negotiation, so the pressure is mounting, and we have some hawkish talks, as has been mentioned by Peter Navarro just now. From a foreign investor point of view, investing in India, yes, for sure, you're looking into the level of tariff at the end of the day, and the levies has been up and running now. and it's the highest among the Asian countries. So it's definitely lowering the competitiveness of Indian companies. But then at the end of the day, I think everybody is looking at the GST this week, and GST is a way eventually to offset a bit of those tariffs from a sentiment point of view, but as well from companies. When we look at the foreign flows over the recent, let's say this quarter, you've seen that large foreign outflows, almost $5 billion have been leaving India, despite the fact that domestic equity fund flows remain quite steady. In our view now, we are reaching to a point where the valuation, it has always been one of the headwinds for Indian equity, valuation and positioning is now returning in favor of India. So the RSI, for example, the technical, are approaching oversold territory. So after the GDP, and I think the Q2 GDP is surprisingly high, and I think our economists have been saying we should take this with a pinch of salt. But anyway, when you look at August economic data, they are showing some pickup. So now we are left with GST. And if GST is aligned with what the market is expecting, then it will boost further consumption stocks. And I can drill deeper into the consumption-sensitive stocks. If it's lower than expected, then we will have a retreat on those stocks, those durable goods, those auto, those packaged foods. And on the contrary, those capex-sensitive stocks can perform well. So we are at a juncture where everybody's looking at GST and maybe listening slightly less to what's coming out of the US, while waiting if there is something coming in terms of the level of the tariff for India.
Florian, hi, good morning. Did you start by saying that maybe this is seeming a little less confrontational, President Trump's post? Or did I miss here?
Yeah.
No, yeah, exactly. Slightly more conciliatory tone in our view. Because saying that, well, they offered this, but it's getting late, means that, yeah, they acknowledge that India is at the table of negotiation.
It's late rather than never. I mean,
Exactly. This is how we are taking it as well. But we don't know. Well, we are all sitting at the same on the same spot there and waiting at what's happening. But there is willingness for India to get this down.
No, I mean, that's what I thought. That's what I began my sort of summary of events with as well, that maybe a little less confrontational, that truth social source. But as you said, we don't want to read too much, right? And of course, you can't make investment decisions based on, it's just the vibe of it, which felt a little conciliatory, not conciliatory, but less confrontational. Florian, so where are you said GST is the next big one, right? So the entire consumer sectors will be in focus. And so you said if they are meaningful, what is meaningful, which will help these stocks do well? And where do you think we will get the most bang for the buck from an investor point of view?
Well, I think if you get what is expected in terms of subs, from 25 to 15, for example, and then those companies are grouped in the same, I think it will be a significant change. It will be a great boost to consumption, and then we will dig deeper into those packaged foods companies, into those auto companies that we perceived as the beneficiaries. The Indian consumption stocks of the last 2 weeks have already rallied a bit. When you look into consumption stocks versus other stocks, you see that it's already happening. But on the other side of it, we have as well investment in some oil marketing companies, and those are actually suffering from a bit of headwind right now, because there is the other side of the coin. If we have a reduction in GST tax, then there is tax revenue loss for the central governments, and then if it sticks to its fiscal targets, that is our view, it's eventually the risk is moving to a curve in terms of capex, and those capex sensitive stocks can eventually be negatively impacted. So there will be a very much a juncture between the type of thematic. If GST tax is relatively substantial, then it will be a good boost for consumption sensitive, but the capex sensitive stocks will be a bit lagging behind in our view.
All right, Florian, final question before we let you go. MSCI India has actually underperformed MSCI emerging markets in the last 1 year. If you look at it, we are down by close to 10%, while MSCI emerging markets is up close to around 13-14%. However, in the last 10 years, we have been out and out outperformers. Do you think India gets back to its outperforming ways in the next 12 months?
Well, it's a good one. And I think one of the, how to answer to that is what the others are doing as well. All our investors right now are asking questions on what's happening in Korea, what's happening in China, and they are not asking what's happening in India. So basically, I think China is the hot topic of the summer because it was uninvestable 2 years ago, and it has been now a market you cannot ignore anymore in a strategic asset allocation point of view. The rally we've seen is very much liquidity driven, but it's driven by local retail investors, as India has been driving his rally over the years. Foreign investors have been pouring money in, but actually it has been as well moving a lot because of retail investors. And this is how a sustainable rally is coming. So in our view, India will come back, but it may take further time, depending on how sustainable is the current rally we are seeing in China, because foreign investors are very much underweight China, and they are underweight India, but the structural allocations they have in India over the years has been larger. So they feel that they are missing out a lot of what's happening in China. So if anything, I do believe that if eventually you have a further reallocation from Chinese investor out of fixed income, out of excess saving, out of corporate cash into Chinese equity market, it can be very, very large in terms of free float market cap, and it will become something that investors are looking for. So over the next 12 months, you said, I do believe India will have time to catch up. But over the next 6 months, I do believe that China and the sustainability of the rally will be the main focus point for investors in the region, in the Asian region.
That's very well explained, Florian, and you can't blame investors, right? I mean, the Shanghai Composite itself is up some 18-19%. Individual stocks have done even better in China. So yes, the spotlight is on the dragon, but let's see, elephant maybe catching up as well. Yeah. Thank you so much for joining in, and we look forward to the next conversation. You have a great day. Well, that's a view coming in from Amundi. Let's tell you what else we've lined up for you on the show today. Coming up at 8:35, we'll have Velayan Subaya of Tube Investments speaking from the Motilal Oswal Annual Global Investor Conference. Get a view on the company's business, the outlook for the rest of the year. At 9 o'clock, we'll have Kumar Rakesh of BNP Paribas joining in. We'll talk about the bumper move in auto stocks. Sales have been looking slightly ahead of estimates. And of course, we have the EV players electrified as well. So that's an auto discussion coming up. At 9:20, Rahul Arora joins in. He's from Nirmal Bang Institutional Equities. He's our market master of the day. At 9:30 a.m., we will be in touch with the management of Aadhar Housing, and we'll talk about the company's business outlook. After that, Rahul Sharma, Director and Head of Technical and Derivatives Research at JM Financial Services, joins in. And we look at slightly longer-term charts and what they indicate. Is there a bigger rebound in the making? Towards the end of our show, in the segment, It's the Economy, Lata will be in conversation with Nikhil Gupta of CLSA.
All right, well, time to slip into a short break. Then you come back, we'll go stock specific. We've got a lot of stocks in our top 10 segment. We're looking at Hero MotoCorp, Coal India, NMDC, BEL, Puravankara, Axis Gates, United Breweries, Syrma SGG Tech, Fortis, as well as One MobiWick. All the stocks that we're tracking in our top 10 segment should be reacting to positive news flow. Slip into that break, come back. We'll get into further detail on all of these names.
Well, the cues across Asia have been a little mixed, but there's no big directional move that the implied open is indicating. As of now, when we last saw it, it was about 7 points lower. Let's pull it up. 1 point up. That's what we have. So maybe a very, very quiet start to this Tuesday. And then we'll see if the bulls can build on their form from yesterday. Let's get to the stocks then that we should be keeping on our radar. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Sud's been looking at the hottest sector, auto and all those sales numbers coming in. What about Hero Moto, Sud?
So like all the other auto companies, Hero Moto has come out with its numbers post-market and those numbers look much better than estimate. Total sales have increased by 8%. It has come at 5.54 lakh units versus 5.12 lakh units in the same month last year. Domestic business, which contributes more than 90% of total volumes, that has increased by 6%. Export, while contribution is very minimal, that also has seen a healthy increase. It was up 72% YY. What's going forward? Company is saying that its optimistic market sentiment is anticipated for the festive season, and favorable monsoon, agricultural demand, and likely GST rate cut will aid growth going forward as well. Also, it has launched its new Glamour X125 that company had announced after earnings season. But as far as all sales are concerned, it's looking much better than estimates, and that's the reason I'm going with green.
Green on Hero MotoCorp. Thanks a lot for that, sir. I'll give you company because Coal India and NMDC as well could be reacting to some positive operational update that we've got. Let's focus on Coal India first. The offtake number came in higher by around 7.5%. And the operational numbers actually are good in the month of August. It came on a low base. Remember, in August 2023 itself, the dispatch number is close to around 59 million tons, which in the last year declined sharply. So good recovery on a low base, and in the month of July there was a decline of close to around 6%. So this dispatch number perking up is good. Inventory though is still relatively higher. The street hopes though that the e-auction prices, after the decline that we have seen, they're kind of bottoming out. Though inventory in the system with Coal India itself is more than 90 million tons. Remember, on an average, it's normally around 75 million tons. So inventory levels are a little bit higher, though the hope is that now they'll get back to their growing base, and also e-auction prices have bottomed out. Year to date, it's still negative, but the hope is that there'll be a recovery. Going with green on Coal India. On NMDC, well, the August operational performance is good. Sales are up by close to around 8%. Remember, in the base year, there was lower production, lower sales as well. There was an employee strike. So on that low base, they've delivered good amount of growth. Dispatches, geography-wise, if you look at it, Karnataka is the one that's delivered a 25% growth. And now their EC capacity has moved up to around 65 million tons odd. So it's giving them visibility in terms of the growth path going ahead. Also, pricing of NMDC is still at a discount to landed cost of imports. That normally helps them. So going with green on both Coal India as well as on NMDC. But moving to Ria, she's tracking a bunch of stocks. Ria, take it away.
Well, yes, Nigel, the first stock that we're looking at is Bharat Electronics. They've received orders worth about rupees 644 crores since the last disclosure on the 30th of July. Now, the major orders that have been received include orders for data centers, for ship fire control systems, tank navigation systems, as well as communication equipment, among others. Now, apart from this, the company has also disclosed order inflows worth about rupees 2,754 crores in Q2 so far. And going ahead for the full year FY26, they are expecting orders worth about rupees 27,000 crores, ex of the 30,000 crore QRSAM order, and till date they've achieved about 40% of this guidance so far. Moving on to Puravankara, they have received an LOA for a residential redevelopment project in Malabar Hill in Mumbai with a GDV of rupees 2,700 crores. This is a 1.43 acre project with a development potential of 0.7 million square feet. Now, this is the second major redevelopment project for the company in South Mumbai after the Miami apartments at Breach Candy. And the total redevelopment portfolio in Mumbai now stands at 4.2 million square feet with a potential GDV in excess of rupees 10,000 crores. The last stock that we're keeping an eye out on is Axis Arcades Technology. The company has received pilot orders for cabin interiors as well as retrofit solutions, and the total order value for this is $1.2 million US. And these orders have been received from an aerospace OEM and an aircraft cabin interior company based in Europe and in the US as well. So positive news flow for all of these, and expecting the stocks to open in the green today.
Okay, Axis Arcades as a stock has done phenomenally well over the last couple of years. Thanks very much, Ria, for that. Winnie's here with more stocks and news. Winnie, over to you.
Good morning. So yes, firstly, I'm keeping an eye out on United Breweries. We're expecting the stock to open up in the green after the company has commenced production of Kingfisher in its Iliois brewery in Andhra Pradesh. They'll be around producing 4.5 lakh cases monthly of beer, and this will obviously complement the 12 lakh cases that is already being produced in the Srikakulam brewery in Andhra Pradesh as well. Do not forget, this region has seen very sharp growth in terms of volumes in the recent times as well. So this is a positive that comes in there. Now, Sidma SGS, that's the next time that we're keeping an eye out on, as the company has signed a JV with L Masters. This is a strategic JV where they'll be focusing on giving clients the services for mainly in terms of electric manufacturing in India. This is for railways, industrials is what they'll be focusing on, as well as medical electronics are some of the sectors that this JV will focus on. So green expected here as well. Fortis Healthcare, that's the one we are keeping an eye out on. They're expanding their presence in the NCR region as well. They've entered into a 15-year lease agreement with RR Life Sciences, 200 beds fully operational over there. And they were already in an O&M agreement. Now this is fully, acquisition, not acquisition, I mean in terms of the lease agreement that they've signed here. So they will be taking care of these hospitals, and there's an expansion plan of maybe 250 beds is what they can expand up to. Lastly, one MobiKwik that also we're expecting green here, as Abu Dhabi Investment Authority has exited the company via block deals on Monday. 2.1% stake that they were holding in June quarter, they've sold it completely.
Okay, all right. Viren, got it. Thank you very much for the updates over there. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow would be Hero Moto, Coal India, NMDC, BEL, Puravankara, Axis Cades Tech, United Breweries, Sirma SGS, Fortis Healthcare, and one MobiKwik Systems. We actually don't have anything on the red side, so it's an all-green list today. Well, that's stocks. Now let's figure out what's happening with commodities. Manisha is joining in with the overnight action. Of course, there wasn't much in the US markets, I guess, Manisha, yesterday, but what's top of mind this morning?
Well, can't say that I have any no reds here as well. It's all green when you look at the commodity markets also. And the Asian markets really seem to be buzzing at this point in time. So you have energy trading in the positive because of concerns between Russia and Ukraine, as Ukraine has upped its escalations on Russian refinery and energy facilities there. But what really catches your eye is the precious metal prices, because silver is trading near its 14-year highs. We've seen further gains overnight into this one. Asian markets buying further as well. But it is gold which has hit an all-time highs in the international markets right now. Remember, the previous high was $3,500 an ounce. That was hit in April 2025. But we have seen 3,508 come in the Asian markets right now. So a new high being created here. This is on the back of dollar index trading at a one-month lows, uncertainty because of U.S. trade tariffs, and markets now pricing in an 88% probability of a U.S. Fed rate cut in the month of September. What the street will also watch out now for is the U.S. non-farm payroll data that comes in on Friday. But ahead of that, this is a very, very strong buying that we have seen in precious metal on the back of safe havens. All right,
Manisha, thank you very much for that. So oil and commodities in focus there. Sudarshan is here with the brokerage calls of the day. So good morning again.
Good morning, Prashant. So first one is on Phoenix Mills. Motilal Oswal has upgraded the stock to buy and target. It has given out 2,044. That implies an upside of almost 35% from current levels. It believes that commissioning of new malls will drive growth beyond FY27, and it estimates 21% CAGR in rental income over FY25-27 to reach 2,800 crore by FY27. Even office portfolio, it believes that will surge 3 times, and hotel segment will benefit from strong momentum. Next one is Asian Paints. Nuvama has given a buy call and target. It has given is of 2,935. Some of the highlights that it has mentioned. First one, company's priority is to protect market share with 18 to 20% EBITDA margin in medium term. Second, demand is stabilizing and a gradual revival is very likely. Rural remains strong and even urban areas showing steady signs of recovery. Even competition is rationalizing, and raw material costs are expected to remain benign and will likely remain stable through FY27. So considering all these factors, it maintains buy call.
All right. So thanks very much for that. So a couple of brokerage calls as well for you. We'll take a quick commercial break here. We have Mayuresh Joshi of Mark Smith India for some fundamental stock conversation on the other side. And as promised, we'll also have the conversation with Velayan Subaya of Tube Investment, speaking from the Motilal Oswal Annual Global Investors Conference.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's discuss a few stocks here. Mayuresh Joshi, Director Research at Mark Smith India, who joins us on the show. Hi, Mayuresh. Good morning. Good to see you. A lot of investors are getting a little bit jittery about last 1 year. India is underperforming, but it's a stock pickers market. And ultimately, don't need to look at it as a T20. Test match cricket suddenly came back into play. So I'll draw inspiration from that and, I'll encourage people to build a portfolio for the longer term. That said, let's discuss a few stocks. Coal India and NMDC, they came out with an operational update. Normally not a big mover, but good to see there is growth coming on a low base. What's your view on both or either of these two names?
Morning, Nigel. But let's also not forget that England has baseball, which means that they play momentum cricket in Test cricket as well. However, I think in markets like these, I think you need to have a stock-specific approach. Specifically for Coal India and NMDC, again, I think the kind of output numbers on Coal India specifically are expected to be a tad bit better this year. The evacuation projects that they are probably doing and are underway, I think that should start having results. And the fruition thereof will start getting displayed, obviously in better output. Obviously, I think expectations in terms of realizations, when it comes specifically to e-auction revenues, I think that should show some element of improvement, as well as their core revenues as far as different grades of coal are concerned. So I think the output requirement from a power perspective, the expectations in terms of thermal assets still probably being required for a country like ours. I think that should ensure that there is a stable output and stable realizations going ahead. For NMDC in particular, again, I think the expectations in terms of rationalization of prices, both in terms of lumps and fines, I think that should largely, again, stabilize as we speak over the next few quarters. The downstream operations thereof and the sum of value parts that probably come through are also value addition from a price perspective. Again, let's not forget that the dividend yield for Coal India is significantly higher. And therefore, I think the stock might continue doing well as far as numbers are concerned. But as numbers improve, I think the same will be reflected in stock prices, both for Coal India and others.
Okay, got it. Mayuresh, hi. Auto is the hot space, right? Major buying position build-up happening before the event. Across the board in stocks, including something like Eicher Motors, perhaps, which was up yesterday 3%, though there is a fear there about what happens to bikes which are above 350cc. So, what is your advice? Do you like anything here in large cap auto? And where do the four-wheeler makers fit in? And I'm not saying M&M, but basically stocks like Hyundai and Maruti.
Morning, Surabhi. So we continue holding Hyundai India and TVS Motors, respectively, from the four-wheeler and the two-wheeler space. Our own sense is with rationalization expected to happen, and there are still ifs and buts in terms of what the ultimate prices will be in terms of rates. But what we've seen so far in terms of volume growth has been steady state. Expectations in terms of the festive season and GST rationalization might actually add up in terms of volumes for a few of these auto companies. I think the whole universe will probably benefit. But again, I think from a construct in terms of how ratings and rankings are placed, how the cancelling mechanism is placed, I think Hyundai with the kind of SUV portfolio that they probably got, the expectations in terms of a very strong balance sheet, I think we continue remaining optimistic and holding that stock in our local and global portfolios. Similarly for TVS Motors, I think the EV platform has been doing exceptionally well. They're expanding truly in the rest of the country as well. They're looking at export orders as well. And therefore, I think from a margin profile perspective, the kind of improvement that we've seen in margins for TVS Motors over the last few quarters, our belief is that that might be sustainable and that will reflect positively on numbers. So I think we've got a couple of holds, Hyundai and TVS from the auto space.
Okay, a couple of holds there and more coming up. Mayuresh, stay with us. Good morning. Just coming to you, but I want to play out the special interview. Tube Investments of India says it is too early to talk about the impact of Trump's 50% tariffs on the business. Joining us from the sidelines of the 21st Motorola Oswal Annual Investor Global Conference, Velayan Subaya, Vice Chairman of the company, and of course, he heads up the group as well. He told my colleague, Sudarshan, that supply chains might take a bit of a hit, at least in the near term. Listen in to a slice of that conversation.
Yeah, so I think it's still too early to tell how things will play out. Obviously, kind of, in some of our businesses, there will be an impact, but it's still, I mean, still we have to see how this thing is going to play out and also how long it sustains, right? Because there are clearly conversations going on both sides, right, to improve the situation. So that's something we just have to wait and see, right, how this all plays out.
But sir, if it remains around 50% that US government has taken a call, so overall export contribution to your total revenue, and if it remains at 50%, how much the impact you see in like upcoming quarters?
Yeah, so I think that, you know, so like I said, I mean, this whole question is, it's a bit difficult to kind of fully predict, right? I mean, like we're in constant conversation with our customers, but it's a bit difficult to fully predict because in some businesses it's not easy to switch supply chains so quickly. So we'll just have to wait and see how they basically play out. It's a bit difficult to predict at this stage.
Perfect. So now from global topic to domestic topic. Now, over the last few weeks, one topic that has been making headlines is the expectation on GST rate cut front. So, sir, in the first half of this year, that is FY26, auto volumes have largely been muted. Now, if GST Council goes ahead and reduces GST rates on some of the key items, especially for the auto sector, how do you see this impacting the overall demand?
Yeah, definitely will help, right? I mean, that's fairly standard that if we do have tax rate cuts and it's passed on to the consumers, which it will get transmitted in this case, it will definitely help. So I do see that as an encouraging move from the government's perspective.
Now talking especially about your businesses, especially like I'll start with electric vehicle. So last few quarters, largely it has been muted. So I have two-part questions. So what are some of the levers that if you could talk about, especially for three-wheeler segment, that you are taking steps to take on incumbents in the rising competition situation? And second, if you could give us any timeline of operational break-even for EV segment.
Yeah, so, obviously operational break-even and any numbers like that, we don't have any discussions on it with the exception of what we discuss on our earnings calls. But as far as, on the three-wheeler segment, one of the things we're very excited about is that in the next quarter we'll be coming out with a new product release. It's a great refresh on the existing product. That's something we're extremely excited about. So I do feel like that will definitely help us in that segment specifically.
Now in the core segment, sir, you are expecting margin to improve in Q2 and Q3, and you are expecting to get recovery that you had passed on because of steel prices. And because of that recovery, you are expecting margin to improve in Q2 and Q3. So what would be the recovery level that you are expecting?
So again, we won't comment on anything specific like that. We do see it's the same as what we've communicated in the earnings transcripts.
Any range, if you could talk about, any range?
No, we won't discuss specific ranges and numbers from that perspective.
So are we on track for double-digit growth in standalone business in FY26?
No, in CG, if the question is related to CG will have double-digit growth. TI, I'd say kind of high single digit to kind of high single digit is broadly kind of where we'll be at.
One last question, sir. You are looking to start battery pack manufacturing locally by the end of 2025. Just could you give us some details on that?
No, all we're doing is packing our own batteries for our trucks, right? So for our trucks and for some of the other vehicle formats like our small commercial vehicles, we'll basically be packing. We still buy the cells from outside and we pack them. We'll be packing them in our own facilities. So that will start, in the next quarter.
All right, well, time to slip into a quick break. Up next, we'll focus on all the big movers on the Wall Street yesterday. We'll also get you some technical calls.
Okay, welcome back. Now, autos, of course, were the real toast of town yesterday. The index itself was up about 3%. Large auto names, beaten down auto names, you name it, everything was flying. But let's just look at the data yesterday, the price action, but of course also the delivery stats, the volumes, and of course a bit about the news flow as well. What is positioning now looking like? Sud is here to help us with all this. Sud, over to you.
So as you said, yesterday we saw big gain in all the auto names. Even sectoral index was up 3%. Top Nifty gain, top 5 Nifty gainers were from the auto pack. Name it, Bajaj Auto, Eicher, Hero, all these stocks were higher somewhere in the range of 3 to 5%. So we have tried to analyze the volume and delivery data that we got yesterday in the evening post market. So volumes for majority of the stocks were higher than the 30-day average. From two-wheelers to four-wheelers, all the stocks have seen huge volumes. But if you take a look at the delivery percentage, so it was highest for 3 stocks, and those were Maruti and M&M. Despite these 2 companies reporting auto segment sales, those sales were below estimate. So that means that investors obviously might be playing ahead of GST Council meet. And amongst two-wheelers, the highest delivery percentage was seen for Eicher. And Eicher has been gaining continuously because Eicher is going to be the biggest beneficiary if GST Council announces rate cut. So many people think that most of the vehicles Eicher has are above 350cc, but 86% of Eicher's vehicles do have the capacity of less than 350cc. So along with Hero MotoCorp, Eicher will be the biggest beneficiary if GST Council approves rate cut. Now coming to electric two-wheelers, both Ola and Ather Energy have been seeing healthy volumes, but problem is delivery percentage. Yesterday also, Ola's trading volumes was 4 times 30-day average, but if you take a look at the delivery percentage, it was just 14%. For Ather also, 9x 30-day average on volume front, but delivery percentage just 14%. Now, August says most of the companies have reported sales which were much better than estimates. Outperformers were two-wheelers, commercial vehicle, electric two-wheelers. Amongst underperformers was passenger vehicles. What are the tailwinds going forward? First, likely GST rate cuts tomorrow and day after tomorrow. GST Council meets and is going to likely approve the GOM proposals. Second, monsoon was very good, so we might continue seeing healthy improvement in demand, especially for tractor segment. Third, festive season likely is good for entry-level segments. So in two-wheeler, it might be good for Hero Moto. In four-wheeler, might be good for Maruti. And lastly, some of the companies will be looking at new launches ahead of the festive season.
Okay, that's very interesting, Sud, and thank you for putting those delivery stats up, specifically on Ather as well as on Ola. That's quite something. That's a huge surge in prices and 14% delivery on both stocks.
Well, this, and maybe Sud, if Sud is still there, Sud, the delivery numbers, right? You know, if you just look at the number of lakh shares or whatever, that will still be much larger as compared to, so when you look at percentage, and that's always the old thing, right? Percentage of what? So as you said, I think in the case of Ola, the volumes were 30 times or something you said?
For Ola, it was 4 times 30-day average volume.
4 times. So it is 14% of 4 times the 30-day average. So if you look at the number of shares, it'll be still significantly higher. And I think that's an important point to note as well.
But the fact is that there's also significant amount of pure trading that's going on these stocks.
What happens with these is, the two things, right? Anything which falls 80%, there is always, at some point in time, there is a big lift which happens. And these smaller price shares, when prices are going up, I mean, you know, you got a lot of trading activity, selling, buying, that kind of activity as well. But the point is, I think you should look at the actual number of shares delivered compared to the average, and I think that'll be much higher.
Okay, all right. Well, whether it's a hope rally or hope trade or something more, we'll find out. But let's move on from the auto space. Hormaz is looking at the other big movers, the other interesting delivery data, stats, etc. X of autos. Hormaz, what do you have for us?
Morning, Surabhi. And equally interesting observations, if not more. And Yatra Online is one such name, right? The stock has been on a tear ever since it announced its results a couple of weeks ago. And in the 14 trading sessions since then, the stock is up almost over 65%. Now, take a look at the increased trading activity after the results were reported. Now, prior to the results, the last last 3 months average daily traded volume was around 3.5 lakh shares. That after the results in the last 14 sessions has increased to over 1 crore shares for Yatra Online. And even in yesterday's session, almost 60 lakh shares changed hands. But courtesy of the increase in the traded volumes, that was lower than the 20-day average, which has now increased to 90 lakh shares. And even on the delivery front, though, almost 17 lakh shares were marked for delivery yesterday compared to the 20-day average, which has now increased to almost 13.25 lakhs. So the delivery volumes were higher, but the trading volumes were lower compared to the 20-day average. The other one is Vishnu Prakash Punglia. We mentioned this stock last week as well, but the stock has been on a bit of a free fall in the last 6 trading sessions. Stock is down 20% from 150. The stock has collapsed to 119 in this 6-day period. And take a look at the trading activity in the last 3 sessions as well. 13 lakh shares on the 28th, almost 40 lakh shares on Friday, and 45 lakh shares in yesterday's trading session. And prior to those 3 trading sessions, the average 20-day volume was just around about 4 lakh shares. Now, even in yesterday's session, almost 45 lakh shares, as I mentioned, compared to a 20-day average of just 6 lakh. And the delivery was 22 lakh shares marked for delivery compared to a 20-day average of just 2.5 lakh shares. And the last one is RITES. And it's been a while since we have seen a railway stock getting some traction. They snapped a 5-day losing streak yesterday, the highest trading volumes in a month, almost 17 lakh shares traded compared to a 20-day average of 4 lakh. And even here on the delivery front, almost quarter to 4 lakh shares changing hands compared to a 20-day average of 1.5 lakh. The stock, though, continues to remain significantly below its 52-week high.
All right. Now, Hormuz, very, very interesting stuff. And that's, I mean, essentially the whole gamut of names which moved. Auto is a pack, of course, but Sud earlier. And, what else really moved as well? By the way, we got an auto discussion coming up in just a bit from now. HSBC, in a recent report, is stating that Indian markets' underperformance might soon be coming to an end. Hormuz, it's back to you with key takeaways. I mean, what is it just a tactical kind of a view here, or are they suggesting a more durable turn?
Well, they're trying to look for positive cues for that the tide is actually turning for the Indian markets. They had highlighted 9 key risk factors earlier in their prior note, but now they mention that 5 of those risk factors are now less concerning for them. And among those 5 risk factors include the likes of rate cuts and the fact that we now have a benign inflation scenario. There are tax cuts coming, and as resulting in some fiscal support. The valuations after the recent correction are not as demanding as they were previously. There is the impact of the US tariffs on the listed universe is likely to be muted and only confined to specific spaces, is what they are saying. And the rally that the mainland China markets are seeing, the outperformance that they are seeing, is likely to have very little bearing on our own markets compared to what we have seen in the past. But of course, there are 4 other key risk factors that they are still concerned about. The fact that the risk for earnings downgrades still persist even after the downgrades that we have seen recently. The fact that the new stock issuances are continuing, they might end up outpacing the need for demand, which may lead to an equity oversupply. Private capex continues to remain subdued because of the weak demand, and the growth estimates for 2026 continue to face downside risks. Now, for the consumption bit, they mentioned that these tax cuts that are likely to be announced, that could spur consumption in the near term. But for a more sustained revival, they need to see wage growth. And if only there is a sustained revival is when they would see that the growth estimates could face a lesser risk of a downgrade. So as a result of which, they continue to remain neutral on the Indian markets, because they find very limited upside for the benchmark indices going forward.
Okay, all right. Thanks a lot for that, Hormuz. Well, time to slip into a short break. We'll come back. We'll get pre-opened rates. We'll also be joined by Sudarshan Sukhani and Mitesh Thakkar. Stay with us. Late. Welcome back. We had a good start to the week yesterday. Maybe we bounced from oversold levels, but are we good for more? Well, to help us out with a view on that, we have Sudarshan Sukhani and Mitesh Thakur who join us on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, Sudarshan, you go first. What's the view? Yesterday we had a bit of a bounce, but FIs were virtually absent yesterday. The gross volumes were much lower. However, now we're approaching the first technical resistance mark of around 24,700. Given that we're likely to start flattish, or how would you approach the markets?
Yeah, good morning. Well, yesterday I was cautious and I suggested that maybe we could be looking to go short on a rally. But the rally that came yesterday was slightly different from what I had anticipated, and we must adapt ourselves to the market. We had a trend day yesterday. The market opened at its low and went up throughout the day. That slightly changes the structure of the market. 24,400 now becomes support that held very firmly on, say, Friday and yesterday. So far as 24,400 holds, I would assume that this market may be willing to go higher, and it's the buy on dips market again. And the levels below which we exit is, as I've told you, 24,400. The first targets, if we do go up, could be between 24,750 to 24,800. So the structure has changed mildly, at least. It's now a buy on dips.
Okay, structure is changing at the margin, and look to buy on the dips is what Sudarshan is saying. Gentlemen, good morning. Great to have both of you here. Mitesh, welcome back. And after a break of a few days, good morning. I'm sure you've been watching the markets, though. What's the sense, Mitesh? Where are we at?
Morning, Prashant. So a couple of things. One, I think, we were close to that previous low of around 24,400, and I was keeping an eye on the PCR ratio. Yesterday was around 0.54 something. So very close to oversold levels. I think this is a market which, is oversold at lower levels, therefore will keep getting bounce backs. And the first level which I'm looking at is around 24,810, 820. And beyond that, maybe even 25,100. So broadly, this could be a market which could do some base building within this broader range. 24,400 on the downside, 350, 24,400 is the range on the downside, and the midpoint is around 24,800. And once we cross that, we might even head towards the upper end of the range. But to get a directional signal on the weekly and the monthly charts, that's missing. So therefore, this could be a broad range which we could see the markets trade for the next couple of weeks.
Got that. Let's get stocks and trades out of the way. Sudarshan, what would you recommend?
Well, it's an all buy list for mid caps. Crompton is a buy, the stop under 328. TI India, I think you were having that interview earlier. TI India is a buy with a stop under 3,087. Hindustan Zinc is a buy, Hind Zinc with a stop under 426. And Motherson is a buy. I can never say that name. It's a little tongue twisting. So that's the symbol. Motherson is a buy with a stop under 94. It's an all buy list because the markets, so far as they hold, should be looking only for buy.
Got that. Mitesh, what about you? What are your trades?
So I also have an all buy side list, but a couple of them are conditional buys. So I want to see these stocks get past supply pivots or resistance levels. The first one is Coal India, and the level is 381, 382. I think that's where the stock has peaked out on the last two rallies. So once it crosses 382, buy with a stop at 376 for a target of 395 to about 398. Similarly, the chart of Havells is also on the bullish side, but a breakout happens above 1580, and the stock is closed very near to that at around 1574. So buy about 1580.82. Keep a stop below 1558, which is the 200 average area. Look for a target of 1635 on the upside. Then a buy on Manappuram with a stop at about 268.5. Look for targets of around 295 here. And also a buy call on Blue Star, which made a fresh swing high. So buy here with a stop below levels of 1920 and a price target of around 2010.
Okay, gentlemen, thanks very much for all the trading advice. We'll come back to you a little closer to market opening. Right now, we have the pre-open session that's just kicked off with very, very flat cues. So let's wait for it to settle. Nifty is not even 1 point up or down. Let's give it a couple of minutes and then we'll come back to it. In the meantime, let's put the spotlight on the auto space. Auto sales for the month of August have been largely in line. In fact, some companies have actually even beaten estimates. To talk about this and the fact that everyone's watching out for the big GST meeting, we have with us Kumar Rakesh, India analyst, auto as well as IT at BNP Paribas. Kumar, thanks so much for joining. And of course, we're focusing on autos in this conversation specifically. So, that's the thing that viewers will want to understand and, investors will want to understand, that whether what we're seeing in auto, whether this is a short-term, just a technical, tactical trade that's built up because the sector, a lot of our stocks beyond M&M haven't performed, or whether there's a lot more to it. First, let's start with the sales numbers. I mean, a company like Hero Moto is now at 5.5 lakh units a month. So a lot of those numbers have indeed looked good. But your thoughts?
Hi, good morning, and thank you for having me. What we have seen last month was two-wheeler companies generally have continued to push and build inventory. So while retail sales was up by about 2% we have seen the wholesale numbers growing close to double digit. And there is some level of inventory which has been built up. For some companies, it is much sharper inventory buildup. For the others, it may be slightly lower. But two-wheeler companies generally have built inventory going into the festival season, and also the expectation that the GST rate cut will drive demand higher. We have seen exactly the opposite for the passenger vehicle companies, however, that most of the companies have been far more cautious in any incremental inventory buildup. Rather, some of the passenger vehicle companies have even cut their inventory in the last month. With the upcoming GST rate cut, potentially the existing stock will be sitting with 28% GST slab, while the new rate comes down to 18%. What happens to this? So there is some level of uncertainty, and that is something which passenger vehicle companies are far more cautious, whereas two-wheeler companies are far more aggressive in terms of building their inventory.
So, talking about the GST cut as well and the expectations over there, I mean, the proposal right now says that for four-wheelers, as long as it's below 1200 cc, the rate could go down to 18%. But above 1200 cc, it could actually be 40%. So how could this impact demand, specifically for four-wheelers? And what's your call on stocks like M&M, Maruti and Hyundai?
So for four-wheelers, at least the small cars, we are talking about 10 percentage point reduction in GST. So that, if entirely passed through to the customers, would potentially mean about 8% sort of a on-road price coming down. Historically, we have seen the price elasticity for passenger vehicle is about 2 times. So that suggests that 8% reduction in prices could potentially lead to almost 16% incremental volume growth. What that means is we were looking at low single-digit volume growth for the next year, potentially year after that as well, slight recovery. You add about 15 odd percentage point additional growth to that. So we could start looking at 15 to 20% volume growth, at least for the smaller car segment. For the bigger cars, you spoke about that 40% can potentially become the new GST slab. So we are talking about 3 to 10% price reduction in those cars as well, which currently is 43% to 50%. So accordingly, using similar volume price elasticity, we could see anywhere about 6 to 15% sort of an incremental volume for the bigger cars as well. So overall industry volume growth from here on should pick up at least for the next 1 year. We would see high teens sort of a volume growth for the industry. What it also does, it resets the base entirely for the industry. So now this volume growth comes in, the incremental industry growth thereon would be on a higher base. So we would expect, if the GST rate cut goes through as we are expecting, a sizable earnings upgrade across the passenger vehicle companies. And hence we see passenger vehicle companies pretty well positioned to benefit from the GST rate cut. And accordingly, most of our top picks are within the passenger vehicle space. We like Maruti Suzuki and Mahindra, both of them. Maruti Suzuki, because of its higher exposure to the entry segment, which typically is even more price sensitive compared to higher price segment vehicles, and hence should potentially benefit. Mahindra is a company which has been consistently delivering pretty solid volume growth. They have outperformed in the recent months and quarters, and they have pretty solid model launches ahead, and that is something which excites us about Mahindra as well. We'll have to be a little careful, and we'll have to closely watch what happens on the tractor side, because there is GST rate reduction, but a risk that the input tax credit goes away. So how that impacts the final prices is something which we'll have to watch out in case of Mahindra. But in case of Maruti, it seems like a clean story of one of the biggest beneficiary of this GST rate cut.
Kumar, do you have coverage on Ola or any thoughts on what's happening with Ola? It's up 50% in short order.
So we don't cover Ola. We have definitely seen electric vehicle penetration starting to improve in the recent months. Part of the reason is also that the ICE demand was slowing down much more than what the EV demand was slowing down. We have now started seeing a lot of lower price model also getting launched by the newcomers as well as the existing comers, and we'll see more of that to happen in the coming months. So that will further improve the overall penetration in the EV space. That should help all the EV companies who are primarily in that space, as more product launches at lower price point comes in, should be beneficial. There is obviously a caution if the GST rate comes down to 18% for two-wheelers. The tax arbitrage, which was almost 23% because EVs are taxed at 5%, these ICE two-wheelers were taxed at 28%. So that also reduces. So that's something which we'll have to watch out how the EV demand pans out once the GST rate cut goes through. But a lot of model launches should help with the EV penetration, at least in the near to medium term.
And Kumar, though, of course, there's a lot of lobbying going on against it. And I think the industry is also asking for a uniform rate. I'm talking two-wheelers. But if indeed motorcycles above 350cc get charged at 40% or anything northwards of 28%, what does that mean for Eicher? Because the stock's already run up quite a bit this year.
So bulk of the portfolio is below 350cc, 349cc and some change. So that part is something which should not get impacted. Rather, it should be a beneficiary in line with what we were talking about in terms of price elasticity. We have seen that over the last 1 year when the company started launching new variants at lower price point, they have seen significant expansion in its volume. So there is a clear indication that there is price elasticity in their portfolio as well. And if the price of less than 350cc vehicle comes down, they should benefit from that. Certainly, but it also creates a challenge for the industry in terms of, or especially for the company in terms of pushing for higher premiumization. It could stall the industry premiumization at around 350cc for some time. Till the time there is enough and more base of customers at 350cc who are lesser price sensitive and would still want to upgrade to 500cc or 650cc. Till that time, possibly that portfolio starts becoming more relevant for the international market, where Eicher has been doing reasonably well, while in the domestic market, less than 350cc becomes the main driver for the volume growth.
Excellent insights, Kumar. Thank you very much for joining us, and really appreciate your time here on CNBC TV18. Thanks indeed. All right, well, it's 9:12, so running a little late for the 9:10 call. Sudarshan is here, and Mitesh is back as well. Sudarshan, what do you have?
Well, it's Crompton. Buy Crompton with a stop under 328.
Okay, Crompton. And Mitesh, what about you?
Core India is opening right around the breakout level of 382. So it's opening around 381. If it starts getting past 382, that's a buy with a stop at 375.76 for a target of 395, 390.
Okay. All right. Sudarshan and Mitesh, thank you very much, both of you, with those specific trades. Let's just quickly recap some of the stocks that we put out on the back of news flow from over the last hour or so. So Hero MotoCorp or August auto sales numbers. Let's see where it's left off in the pre-open session. Flattish. We've got Coal India, NMDC, both performance in the month of August. So monthly numbers coming through slightly higher. Auto wins for BEL, Axicades will come up next. And BEL is up about 1, all in that 0.5% to 1%. Axicades is up a little bit more, 3.5%. Puravankara, United Breweries, there are other stocks with news flow. But there's also Sirma, there's Fortis, there's one MobiKwik, which perhaps should be seeing some overhang lifted after a large sale. So all those stocks are coming up one after the other. There you go on your screens. Let's talk about one more name, right, as we get to the market open. Sun TV is what I'm talking about. And here, it's a brokerage call, and it's a positive one. Vamakshi is going to tell us more. Vamakshi, morning.
Well, good morning, Prashant. Sun TV, there's an interesting note that is coming from Avendus. They have a buy rating target price of 680 per share, and what they're actually saying is that they've turned constructive on the company after 5 long years. They're viewing it as a fast-growing sports company rather than a stagnating linear TV broadcaster. And in fact, they're estimating the IPL revenue to grow at 9 to 12% CAGR from calendar year 25 to 27 to almost 15,000 crores. So therefore, they believe that 60% of Sun TV's SOTP value valuation is likely to be contributed by the Sunrisers Hyderabad team. Now they are assigning 40 times multiple to the IPL business and 10 times PE multiple to the core business, and therefore in the next 3 years they've given a target price of almost 840 rupees per share for this particular counter. They have highlighted that this is a company which has the highest listed exposure to IPL among peers, and it offers the purest proxy for investors to participate in India's sports monetization upside. So interesting road coming in from a vendor spark. But also remember that the promoters, institutions and FPIs collectively hold about 91.5% or so in the company, and this shareholding pattern has likely remained more or less constant over the last couple of quarters. So Sun TV for you.
Okay, coming up in just a bit, Vamakshi, thank you very much for that. Right in queue, markets opening. We are opening slightly higher, about 0.15 up on the Nifty. The Nifty Bank also similarly about 0.15 higher. And mid and small cap indices will come up on your screen as well. The Sensex is up, all up, but small up. That's I guess the way to put it. 2:1 right out of the gates, advances to decline ratio. But that'll tend to move around as we go through the first few minutes and then through the course of the day. Nifty heat map coming up on your screens. 50 points, 55 points, 24,681, more up than down, definitely. And you've got HDFC Life on one end and there's Infosys on the other end. But it's more up than down to begin the session. Small cap index is clearly, leading with a 0.5% gain. And the mid cap index is also doing better than large. So broader market's doing better to start this session. Surabhi.
Okay, Reliance is leading from the front. It finally comes out of the shadows. After the AGM, it had a rough day. But this morning, it's up about 1%. By the way, there's a Morgan Stanley call on Reliance. MS is quite optimistic. Their target is 1701. And they say that the anti-involution story and the AI story is going to redefine the destiny for Reliance going forward. So that's a stock in focus and doing very well this morning, helping the overall market. What else? HDFC Life, 1.5% up. Eternal is putting on some weight, 1.3% higher. Coal India, after those numbers came in, production numbers, 1% up. BEL has announced order wins of about 600 odd crores. That stock's higher by about 1% or so. SBI Life along with HDFC Life. So the life insurers are doing well today. Bajaj Finance is up. There's some buying on HUL and Tata Consumer and Titan. So those are some of the consumer names that are doing well. But really, it's a Reliance story, almost 1.5% up on the stock. In fact, we'll put up the details of that Morgan Stanley note for you in just a bit. On the flip side, Infosys is cooling off after yesterday's run-up. There are not too many stocks falling, actually. Axis Bank is down 0.5%. ICICI Bank is taking it easy. Overall, the Bank Nifty is showing a small, slip of red right now. And some auto stocks like Maruti are cooling off, even Tata Motors. So some auto names, M&M also. Auto is cooling off after the recent run-up. Banks are quiet. It's Reliance all the way. That's the large cap story. Nigel?
Well, that's right. I think the stocks actually that are making the big moves today are the sugar-related names. And the update that came yesterday is the government has allowed the production of ethanol from sugarcane juice, syrup and all types of molasses without any restrictions on volumes. I think that's what's got the stocks excited. And, there's this big move that we're seeing across the board. Balrampur Chini, even smaller companies. If I look at Uttam Sugar, I look at Sri Renuka, that's up more than 10%. Shakti Sugars, whatever's left, it's up only 8.5% now. So all those sugar-related names, they are bucking the trend today. That's clearly the sector of the morning. We'll have to see how much of a financial impact will it have. Because as of now, it appears that it's more sentiment in nature, but we'll wait for further clarity on that front. Cross, KROSS, that's up close to 7.5%. Massive move is what we're seeing out there. Ola is saying it's not yet done. Stock continues to move higher as well. That one's moving on very, very large volume. So big up move is what we're seeing on that particular name as well. Hindustan Zinc as well opened in the green. I think we should keep an eye out on that one. A good move is what we're seeing on that stock. So a decent start, up 40-50 points, right in that resistance zone of 24,650 to around 24,700. The Nifty Bank yet again doing a relative underperformance.
40 points on the Nifty, so 24,667 is where we are at right now. We've got, actually it's a lot of sugar, as Nigel was pointing out. MobiKwik is the other one, which is up about 4% or so. Something like a Gokuldas bombed out, right? From 1,200 fell straight to 700, less than 700. 726, about 4% higher on Gokuldas. One of the big textile casualties on the back of course, the Trump tariffs and other stuff coming up as well. as we begin the session. On the downside, actually, it's 3:1 advances to decline. Ixigo is the only one I can see which is with a 3% cut and some volumes as well. Otherwise, I mean, stuff which is down small and not really backed by any significant volumes right now.
On sugar, I just wanted to add that this has happened after a while. I mean, the fact that sugar and molasses, all varieties of molasses will be allowed for the manufacturing of ethanol. And this takes away some of the industry concerns of maybe too much production, because we've had bumper monsoon now for 2 years in a row. So with the diversion being finally allowed, it perhaps alleviates some of those concerns, but we'll have more for you coming up later.
Yeah.
But literally the sector of the morning, I mean, even Triveni Engineering, Balrampur, Triveni, Praj, Sri Renuka, everything, Dalmia Bharat, Bajaj Hindustan. If it's sugar, it's looking sweet today.
Well, that's right. And the other one that's moving along is Mobiwic. The stock is up close to around 5%. Keep in mind, the high that the stock hit earlier this year was around 700 rupees. So actually, the stock had come down to less than a third of what it was at its peak. Now it's moved up because there was an overhang with regard, to that fund, Abu Dhabi Investment Holding, close to 2.1%. That's out of the way. The street was waiting by for that. If you look at it on valuation parameter, well, the stock trades at around 1 times EV upon sales. It has cash in the books, but they're burning cash as well. So the path to profitability is something that the street will track over the next few years. So a relative underperformer, block deal going out of the way, some of these new age themes back in focus and guiding for better times ahead. I think the street is taking note of that, and that's why the stock is up 5.5%. But we'll have to see how much is sustainable.
I remember, I think Nilesh of Envision has been a long time fan. I think so. We've spoken to him on Editors Roundtable, and maybe, I don't know if he'll have a view, but we'll try and get that going for you. Just some more opinion on where this one goes. I mean, it's come off a long way, and sometimes these things, like for example, what we're seeing with Ola, right? Like a one-way 50-60% move, but very, very quickly. Rahul Arora is CEO at Nirmal Bang Equities. He's with us. Rahul, good morning. Great to have you with us here. Thanks very much for your time. So let's just start with, I mean, what are your thoughts on this GST meet from tomorrow, and how is positioning now, and whether some stuff in terms of price gains after the meeting and what is done, will it be a durable move? Is it tactical? Is it already played out? Just your thoughts around this subject.
Morning, Prashant. Thank you for having me on the show. So, of course, there's a lot of anticipation, and I think, there's a lot of talk about deferred purchases once those GST cuts effectively come in. But my sense, Prashant, is that even if it comes in, I don't know how much of it will be structural in nature. Of course, you'll have to look at penetration levels and where things are with respect to durables, electricals, air conditioners, even for automobiles for that matter. So this could potentially give you a one-time kicker over a period of a year, but I don't know how structural it will be from that perspective. And then, of course, this is coming at a time just before festive. I mean, technically, if you want to go back to Raksha Bandhan, we've been in festive for about 3.5 weeks so far. But I think the fact that this is coming right at the bang middle of the festive season, I think there might be some deferred purchases, but it might sort of trickle into the October, November, December quarter. But that being said, Prashant, I think valuations have caught up in some of these places. I think they have been quite sharp after these announcements. Let's not forget that the first quarter results for some of these sectors were not that good. Particularly in the cooling segment, in durables and electricals, there was a price correction, and they've started looking attractive, but I wouldn't buy them purely from a GST cut perspective. I think some of these names like a Havells or a V-Guard or an Orient or a Blue Star look structurally good to us. One-time benefits will certainly help, but I think overall also, Prashant, if you look at the market valuations, they're not all that cheap. Of course, what's happening with the SCO summit is going to help in terms of soothing the nerves, in terms of whether there could be certain trade negotiations over the next 1 month or so. But at 24,500, 25,000, if you look across sectors, buying IT services, I don't think there's too much screaming value that's emerging in the market right now. So specifically to your point, I'd wait and watch. I would certainly expect a pop, more of that probably in the October, November, December quarter. But valuations are looking fairly reasonable in some of those sectors and even beyond that for now.
Okay, Rahul, hi, good to have you in. So that's the question, right? As these cuts trickle through, whether it'll be more than just a bit of a tactical trading pop in terms of stock price, whether you talk about autos or whether you talk about FMCG. I mean, tactically, yes, because the market has been underweight or neutral in best case on this sector for a very long time. Do you see a more material structural shift after the GST cut, or is it just going to be a trading rally at best?
So on consumer, certainly not, Survi, because I don't think you're in an era where, of course, you've had rural that's done well. You've heard that from most FMCG companies that the rural commentary has been better than the urban commentary over the last 3 to 6 months. We're obviously going into a very important state election in about 3 months in the northern part of India. So maybe to that extent, some dole-outs may continue. But my sense is when you're looking at consumer, even if you get these GST cuts, you're not looking at a structural 5% plus volume growth in most of the large mature FMCG companies in India. And this would include foods, barring, say, something like a Nestle or a TCPL, or maybe a Britannia on a case-to-case basis. But if you strip those three out, I don't think you're looking at a structural 5% volume growth or beyond. Now, in that backdrop, to be paying 45, 50 times price to earnings multiples, I'm not so sure. To the point I was making to Prashant a little while earlier, I think if you look at names like V-Guard, Crompton, Havells, Blue Star, these are names that saw a bit of a correction. The first quarter was a washout for these guys. You did have a slightly cooler summer. You did have unexpected rains. But I think if you look at market share gains for most of these players, they're fairly good. I don't think there's anything materially concerning. I mean, let's keep these GST numbers aside. Even without these, we're expecting 15-20% growth in most of these companies over the next 2 to 3 years with some amount of operating leverage and margin expansion. And most of these companies, if you just say Blue Star, on the durables and electricals, if you keep Havells and Blue Star aside, most of these are coming to you between 25 and 30 times. So there's been a bit of valuation reset. The industry leaders are still coming at a premium. We would have to expect moderate returns from there. But I think if you're looking at outperformance, I would probably still look at more on the automobile side, particularly two-wheelers. And I think we're seeing that in the monthly sales numbers as well. iShares is on a different planet. We've been discussing that for a few months now. I think the export side of the business for the other two-wheelers are also picking up, albeit on a low base. And I think the EV numbers are also very heartening. So I think if I was to play GST from all of these, I'd probably play it through some of these electrical players and auto, as opposed to playing it through plain vanilla FMCG.
Electric players and auto. What about the EVs? They have suddenly come back. Ola 40 to 60 in a matter of a few weeks. You have Aether as well that has done quite well. How would you play that theme?
So obviously, Nigel, you've had launches right up to, a day or two back. And, some of the players are talking about 40% EV adoption in the next couple of years. I think Mahindra has been killing it with its EV. And I think the others as well that have put the product out in the market, even the Tatas are doing extremely well. I think the base is very low, Nigel. So the percentages will look higher, but I think it's a theme that's catching up. I don't know as a percentage of total volume how much these numbers will look like in a couple of years from now. But even if you look at the base numbers for most of these players, they're not doing too badly. I think if you look at Mahindra, the tractor numbers are still growing at 8-10%. The rest of the portfolio volume growth is still at about 10-11%. Even if you look at a Hero or a TVS, they're still managing to grow 8-10% without the EV kicker. So I think the base business itself is doing well. This could be the cherry on top. I don't know about that 40% EV adoption number that some players are talking about in the next 2 or 3 years. But it's certainly a space to watch. And I think, on the PV side, I think Mahindras and Tatas are killing it. And I think even on the two-wheeler side, you have some of these new age companies. But I think the incumbents will catch on. I think, both Hero and Bajaj and TVS, in fact, all three of them have been doing work to this effect. But I think it could be an interesting play, but I don't think it will be a material swinger in terms of overall volumes over a 2-3 year period. In this space, our preferred pick would still be, say, M&M on the large cap space in the automobiles. You'd play iShares on the two-wheeler space. And if you're playing it through auto ancillaries, we probably play a proxy on the two-wheelers through something like an ASK Automotive.
Okay, got it. All right. So Mahindra, ASK Automotive and Eicher Motors. Rahul, what about the banking names? Banks have underperformed big time just in the recent past, from being the consensus buy at the start of this year. Now, you have preferred some of these other smaller banks. I think CUB, Federal Bank, AU Small Finance, those are the banking names that you've preferred. Do you continue to maintain that positive stance? How are you viewing the BFSI space? What do you like?
So I think, Nigel, there are 2 or 3 challenges with the banking sector right now. The first being valuations. I think if you look at, say, let's take the large private sector banks in the company, HDFC Bank, ICICI Bank, Kotak Mahindra Bank, all are trading at 2.5 to 3 times price to book value, which was not the case 12 to 15 months back. They were probably trading at much lower valuations. In fact, some of these were even trading at 2.1 times. So one is valuations are a challenge. The second is the CD ratios for most of these companies. They've probably been north of 90%. And you're seeing HDFC Bank is deliberately slowing down its books so that it can manage its CD ratio. So I think that's the other challenge that you have. And third is genuinely credit offtake is very slow in the system. I think if you look at the sectoral deployment of credit numbers that come out, and we just released a report this morning for the last fortnight, you're not even having 10% growth. I think if you look at agricultural credit, services credit, industrial credit, these are all growing at just about 5 to 7, 8%. You have retail at about 10, 11%, but you're not looking at a situation where credit growth is going to be very strong. So valuations, credit growth, and CD ratios are a concern. That being said, if you look at a State Bank of India, whose CD ratio is somewhere around 77, 78%, ROEs of 13, 14%, ROA of about 1.5%, coming to you at less than 1.5 times price to book, that would probably be a screaming buy for me at this point. You alluded to City Union Bank, again, a name that we've liked. I think 14, 15% growth is a certain given there. Also, Nigel, I think we would also branch this out to, say, housing finance companies. I know something like a Home First comes to you at 3 times price to book. But I think if you look at the growth numbers, we're projecting about a 25, 30% kind of growth for a Home First. And the other name, which is not very widely tracked, which is Housing Urban Development Corporation, HUDCO. Again, an 18, 19% ROE business, about 2.5%, ROA coming to you at about 1.5 to about 2 times book. I think that could be a very interesting space. Of course, HUDCO is branching out into other infrastructure projects, but I think SBI would probably be our top pick to play in the banking space, followed by City Union Bank and a couple of these home finance names like HUDCO and Home First. But I think, Nigel, if you're looking at it as a sector overall, you'd have to have slightly tempered expectations given where valuations and CD ratios are.
Okay. Rahul, don't usually ask you a stock-specific question, but this is, the stock is more like, a huge part of the market, Reliance, because there's so much moving on, right? This morning, there's a call from Morgan Stanley. I think the market's taking note of that. The target price is 1,701 on the stock, and they think that Reliance can be a big beneficiary of a move to reduce unhealthy competition, whether it's for their own business here, tariff. We've seen the tariff improvement in Jio, or whether it's overseas. But your thoughts? I mean, Jio's IPO got announced, but then there were concerns about a holding company discount because it may not be a clean demerger. So, what happens from here on? It's a big stock.
It is, Surabhi, and I think the reliance on Reliance, apologies for the pun, will be far more because of what we've discussed about FMCG, banks, and IT services. Because this fourth cog in the wheel makes up about 75% of the Nifty, and I think a lot of the heavy lifting will have to be done. I think the AGM was a remarkable event. I think what they're announcing in terms of new initiatives is trying to decrease the overall contribution, the EBITDA contribution from the oil and gas business. I think Reliance 5 years from now could be a very different company, just like Reliance today is a very different company than what it was 5 years back. And I think the fact that they're trying to decrease the EBITDA contribution from the traditional energy business is a remarkable, testament to their execution capabilities. I think it's not just Jio. So of course, Jio will list, and I think it's practically a duopoly in the market as we speak, or at best, the third player is not a very strong competitor. So I think the valuations will hold out regardless of the holding company discount. But I think if you look at the other businesses, which is retail, and the kind of disruption that it has done to the existing incumbents and not allow new competition to come in. And there are various aspects, Surabhi, that Reliance has not even gotten into. Say, for example, food delivery. It has acquired Just Dial. It has such a large captive base of customers through various businesses, including media, that it has not even entered into the territory of Swiggy and Zomato. So Tira is another, business where you haven't seen a big scale up compared to what Nykaa has done. So I think, and of course, apart from the digital initiatives that they spoke about at the AGM. So I think where valuations are for Reliance right now, it is not an unreasonable place to buy it. Of course, given the changes that are happening in the company, I would say this is a company that would probably compound at about 10-15% in terms of a CAGR of stock earnings over a period of time. But even that for a company like Reliance is going to be quite magnificent given its market capitalization. So I think if I was to look at the 4 buckets of the market that contribute 75% to the Nifty, I think Reliance for me at this point would be at the top of the pecking list, say maybe followed by IT services, banks, and then FMCG.
Okay, the reliance on Reliance, and it's surely working out this morning, because if you remove the move that RIL is contributing 2%, then the Nifty would have been a very, very different picture, because not much else is fired up this morning. Rahul, good conversation. Thank you very much. You have a great day, and we'll look forward to connecting again soon. But yeah, before we move on, talk about more stocks, looking at things, it's Reliance, it's Eternal, and there's actually a bit of a consumption play once again. Nestle, Tata Consumer, HUL took a breather yesterday, but it's back up. So Reliance, some of these FMCG names, not too bad.
Okay, all right. Let's focus on a couple of names then that are moving around. Phoenix Mills, you had a Motilal Oswal note that came in earlier today, and that stock is clearly reacting to that note. Sudarshan joins us to help us out with more details. Sud?
So Motilal Oswal has upgraded the stock to buy, and target has given is of 2,044, implying an upside of almost 35% from current levels. It believes that commissioning of new malls will be driving the growth even beyond FY27, and it estimates 21% CAGR in retail rental income over FY25-27 to reach almost rupees 2,800 crore by FY27. Even office portfolio is going to surge almost 3 times. And for hotel segment, it believes that it's expected to benefit from strong momentum. So stock had started with a gain of almost 3%. Even currently, it's up almost 3% as well.
Yeah, no, absolutely. Sud, thank you very much for that. I just want to highlight what's happening with the sugar stocks once before we sort of take and go further. I mean, you've got about 8, 9 of these stocks which are really charging strong. I mean, it's like a sugar high, right? Renuka will come up on your screen, 13% higher. Dwarikesh, there is Dhampur, there is Shakti Sugar, KCP, Kothari, Balrampur, Bajaj Hindustan, Ugar Sugar, KM Sugar, Dalmia, Triveni, I can go on. Anything between 5% to 20%. Some of them, of course, are limit up, as you saw earlier on your screens right now. So it's a big mover right now. And Ria is here with details on what has happened, what is triggering this move. Ria, over to you. Take it away.
Well, yes, the reason all of these sugar stocks are surging in trade today is that the government has now removed all curbs on ethanol production from sugarcane juice, sugar syrup and B heavy molasses and even C heavy molasses for the upcoming sugar season. Now, the government is going to periodically review the diversion of sugar for ethanol production to maintain the availability of sugar for domestic consumption. Now, remember, these restrictions were earlier imposed in December of 2023 due to rising sugar prices, and now this move is a very significant relief for the entire industry, and sugar mills will now be able to use the lying inventory that they have of B-heavy molasses, and this is also going to help achieve the target of boosting the proportion of fuel in gasoline blends to 20% as per the target set by the government earlier. And in a separate government notification as well, they have also now allowed distilleries to purchase up to 2.3 million metric tons of rice from the FCI for ethanol production. So all of this is positive for the industry, and the stocks are resultantly higher in today's session.
Okay, all right, got it, Ria. Thank you very much for that. So sugar in a sweet spot this morning. Let's move on to our next conversation, and we have Aadhar Housing Finance on our radar. The company did report a fairly healthy set of numbers for the first quarter. It saw strong AUM growth. And of course, it retains its expectations of double-digit growth for the rest of the year as well. Rishi Anand is with us, and we are going to be focusing on 3 main points in this conversation. So let's lay them out for our viewers. Number one, what happens to spreads in an environment where we've seen some interest rate cuts? Will there be more pressure for the rest of the year? Number two, can the strong disbursements in the first quarter act as a proxy for the rest of the year as well? Could it be a better than expected year in terms of AUM growth? And finally, we want to understand what could drive ROA expansion from here on. So let's take it forward with the guest. We have Mr. Anand with us. So Mr. Anand, let me actually start this point with growth, because there you've done so well. I mean, with your AUM, you've still managed, I think, 20% in the first quarter. Your guidance, I think, is 18 to 20%. But how does it look? Because you also have the PMAY, the next tranche being rolled out. And, given the tax cuts that have been announced, whether it's income tax, GST, I mean, generally there seems to be a sense of more buoyancy out there in the market. But you tell us whether you whether you expect even better demand for affordable housing, and what would your expectations be?
Thank you so much, Surbhi, and very good morning. You're right, our first quarter numbers have been better than expected. If you remember, our indication has always been 20 to 22% growth on AUM, 18 to 20% growth on disbursement. What we've given in quarter one is 22% growth on AUM and about 32% growth on disbursement. Numbers were stacked very well. From here on, the industry is doing fairly well. We have very good expectations from the industry. The regulator and the supervisor are putting in all the efforts on the supply side, which will ultimately result on the demand catching up. From an indicative perspective, we will maintain our guidance of 20 to 22% growth on AUM, even on a large balance sheet of 26,500 crores now, and an 18 to 20% growth on disbursement.
So that means that there is a chance, a good chance that your AUM, by the time you end the year, it crosses 30,000 crores?
Hopeful, very hopeful. But from a purely guidance perspective, if you look at our numbers and the kind of indications we've been giving, we should be doubling our numbers in 3 years from now.
You mean the total book doubles in 3 years? That's what you're saying?
3 years, close to 50,000 crores.
You know, just as an aside, Rishi, hi, good morning.
Good morning.
Someone said 15,000 crores, or maybe it's 10 to 15,000 crores is like that level, which is the escape velocity for housing finance companies or NBFCs. After that, it is, to cross that is hard, and then it becomes, it's more of a trot. I don't know if that is the correct way to look at it, but you're past that level. I mean, you left that level behind some time back.
Yes, I remember, Prashant, having detailed discussion with you when I was in your office and that time I remember we were at 11,000 crores of book, and you asked me this question of whether low-income housing finance companies like us will be able to cross 15,000 crores. So did we. Then the question on the table was 20,000 crores. So did we. And we are now 26,500 crores. I don't see any reason why companies which are completely focused on one segment should not grow, because the demand is there, the supply side has been acted on. So we spoke about PMAY, that has been kicked off. We are the fortunate ones to have rolled out the first PMAY to the customers. We've clocked about 11 crores of subsidy already given in the last 1.5 months. So things are looking good, and hopefully we will be the first company to reach the number that I spoke about in 3 years' time.
Actually, within NBFCs, Rishi, I think housing finance is the more durable kind of, steady growth kind of segment, right? Low NPAs and historically speaking. But it's interesting you said companies focused on one segment because now, at least last few years, we've seen the era of sort of kind of sector champions. Everybody's doing everything, but at least from an NBFC perspective. But housing finance, I mean, HFCs are focused on HFCs in that sense, right? I mean, broader NBFCs seem to be in too many segments.
Yes, yes, you're right, Prashant. And within HFCs also, of late we've observed a lot of HFCs wanting to go into multiple segments. So, within HFCs, the segments of prime, affordable, low income, and we've observed that a lot of companies are wanting to get into various segments. And that's where, Aadhar stands out and say, we've always maintained a stand that we will only focus on the low income segment. We will only focus in the EWS LIG. We will not go into other product lines. And maybe that's the reason why we are giving, even on a high balance sheet, we are able to give higher numbers.
All right. Hi, Rishi. Good morning. Good to see you. Let's focus on two aspects. One is on the spreads and one is on the ROAs. The spreads have come down to around 5.8%, hovering around that mark. However, there'll be a reduction in cost because, the bank lending cost as well will come down. So how do you see spreads pan out, say, in Q2 as well as Q3? Point number one. Point number two, on the ROAs, it's at around 4%. You have been guiding a 20 to 30 basis points improvement from year on. So you could tell us the top 2-3 levers that you have with you. Could it be better NIMs? Could it be lower capex, lower credit cost? Comment on both these two.
Okay, so Nigel, morning. On spreads, if you remember and recall our last conversation, I have maintained a stand that we will be a company always for the next 3 years, which will be a spread upward of 5.5. Today we are at about 5.8. The cost of fund, the benefit that is going to come to us over a period of next couple of quarters. The good part is, or I would say the otherwise also, we do not get any serious advantage on reduction of cost because 76% of my liability and coincidentally 76% of my asset side, both are floating in nature. So whatever comes in either ways, rise in cost, drop in cost is passed on to the consumer with a gap of, let's say, 1 quarter because you need a quarter to operationalize things. So I would still maintain the stand that we are today 5.8. Down the line, anywhere 5.6 and upward is what we are going to be maintaining. As regards ROA, you're right. We've been a 4% company. I think stable state, as we move ahead, the company should be an delivery of about 4.2 with an ROE of 18% couple of years down the line. That's the stable state that we would want to maintain. A couple of levers. OPEX obviously plays out, productivities play out. I would not say COF will play out much. As I told you, 76% is in both ways is floating.
All right, Rishi, final question, not so much on the operations, but what about your tenure? I think sometime in the next coming few months, it expires, right? There is some uncertainty among the street. Could you tell us what is the outlook? When does it end?
So my tenure ends in January 27. So I have 1.5 years to go. And hopefully the way things are going, I'm sure, I will be looking at being stable in the organization.
And is there any buzz, Anup Kumar Saha, he moved on from Bajaj Finance. There was some buzz that maybe he could be coming on board to strengthen the management. You want to comment on that?
I don't know. These are
any truth, or is it totally rumors? You could dismiss it, or you could tell us maybe in the works, maybe not.
I would neither want to dismiss, neither want to tell anything on this, but these are market rumors. The management right now is very stable. In fact, I don't know whether you are aware of it or not, that the Blackstone has rolled over its fund from existing Blackstone fund to another Blackstone fund, which gives a lot of confidence to the company that for the next, I would say 3 to 5 years period from now, there is a lot of stability in the company. So I don't foresee any changes that that will happen at the management.
Sure. All right, Rishi, we'll leave it on that note. Thanks very much. It helps clarify that aspect of management stability. So you're around till FY27 for sure. But there's no denial also on Mr. Saha. So we'll wait by and see how things develop. Well, let's quickly move on and address the sugar story again, because the sugar stocks are really, really charged up because the government has taken the decision to now allow a free use of sugar, sugarcane juice, molasses of all variety for the production of ethanol. Deepak Balani, DG at Indian Sugar and Bioenergy Manufacturers Association, and Atul Chaturvedi, Executive Chairman of Sri Renuka, join in to give us some perspective on this. Mr. Chaturvedi, morning, sir, and morning to Deepak as well. Let me open with you, Mr. Chaturvedi. Just tell us what this means in terms of the expected production. I mean, it was supposed to be, I think, a pretty good year for production overall. But now with sugar and molasses being diverted towards ethanol, first of all, do you foresee a lot of diversion? And what will that mean for the price and demand supply dynamics?
No, very, very good morning to you. In fact, last year's crop, which is going to be ending sometime in October now, was practically a disaster, something like about 29 or 29.5 million tons at the gross level. This year's rain gods have been very, very kind to India, and now it seems a little more kind than what we were expecting. We feel, and the whole industry feels, that the production this year is going to be rebounding big time. In fact, ISMA, which Mr. Balani represents, is now estimating that the crop overall could be anywhere between 34 to 35 million tons. And if that happens, there's no reason why diversion of sugar to ethanol, which current year is about 3.2 million tons, should not go up to anywhere between 4.5 to 5 million tons. And the sugar industry is quite capable of supplying to the government. The only request from the industry is that for far too long, we have been denied a price increase, and there's no reason why from maize, they continue to buy at around 72 rupees, closer to that, and from cane juice at around 65. So that is something which the industry has been demanding. And hopefully, the government will this year have the right kind of confidence to take the price up.
Right. And that's a question that we will just come to. But for now, what the government has done, what is the effect? The effect is it keeps sugar prices stable. On one hand, it keeps sugar prices stable and not excess supply of sugar in the market. And of course, I mean, you'll be able to sell more ethanol, which gets absorbed now. Is that the effect, Mr. Chaturvedi, for the industry?
Just look at our numbers. In fact, Indian consumption story is closer to about 28 million tons. And this year, if the production is going to be anywhere between 34 to 35 million tons, plus the carryover, there's no fear as far as sugar inflation is concerned. And to add to that, even if the sugar prices go up a little, there's no fear because our Prime Minister has also been saying that the sugar consumption and the edible oil consumption needs to be moderated. And in Indian context, higher prices definitely help in moderating
consumption.
You know,
my question was not, Mr. Chaturvedi, I was not suggesting that there is a risk for sugar inflation. I was just saying that the effect is, the reason why markets seem to be excited is the fact that, I mean, there is an avenue for this excess sugar production. This year's crop plus last year's carry. That you agree with, right?
No, the last year's carry is going to be much lower than what was anticipated. And secondly, because the crop actually came down to about 26 or 26.2 million tons or thereabouts in sugar terms. So the carry out is going to be relatively lower. So we do not fear any sugar-related inflation as far as India is concerned.
Let's bring in Mr. Balani. Okay, so let's bring in Mr. Balani on exactly some of these points. Mr. Balani, you tell us, what was the, I don't remember exactly the numbers, but I don't remember, if you could just remind us, what was the opening stock? And now, as Mr. Chaturvedi is saying, that this year the production is going to be maybe 32 to 34 million tons. What happens to pricing as we enter the festive season? Earlier, perhaps there could have been a fear of some sort of a oversupply, not glut, but at least oversupply that could have been, pushing prices down. What happens now? Are millers hoping or expecting any price increase this festive season?
Yeah, hi. So we opened the stock of current season with around 8 million tons. And
okay.
Mr. Chaturvedi just mentioned, with around 28 million of consumption, we are hopefully will be closing the season with around 5.2 million tons. Having said that, the next year crops looks very good, and our estimate, the first estimate, is around 35 million tons.
Ooh, so 40 million tons. We're talking 40 million tons then. 35 plus the carryover from last year, if it's not been used.
Yes. So that 35 million ton is also with an upward bias. And we will also be coming out with our second estimate on 11th of September. And the news is that the rain gods have been very kind. And we are getting very consistent monsoon rains in Maharashtra. And
so what about pricing? Absolutely, sir. Rain gods have been very, very benign this year. What about pricing now? Just help us understand this.
See, the domestic prices have been consistent. So, way back in last December, we've seen the domestic prices going way below the cost of production. But because of the export decision which was given by government in January, the domestic prices saw an upward, corrected movement. And we are seeing a stable prices in an anticipation of much better crop and much better sugar production next year. Even though we have around 5 million as a closing stock, I don't see that the market will go higher from here. It may go by 50 rupees, 100 rupees maximum. But I don't see it going very high because of the next year sugar production, which is going to be very good.
Okay, all right. Before we let you all go, gentlemen, Mr. Chaturvedi, just one final question to you. Since these restrictions on ethanol production have come off now, initially, what was the target that you were looking at in terms of ethanol production for FY26? And has that changed a little bit? Will you be looking at upping that guidance?
Let me correct the picture. The ethanol production in the country was not restricted this year. In fact, it was only in 2023-24 that the restrictions were placed on diversion of cane juice into ethanol.
Yes.
Because the government at that point of time was fearing a massive drop in sugar production. So I think overall we feel that the ethanol from the industry should be closer to about 5 million tons this year. 5 billion tons, yeah. So that should be the, and as far as Renuka is concerned, obviously we are one of the large ethanol producers, so it should help better capacity utilization as far as our...
Give us the number, sir, for Sri Renuka Industries. How much, what will the ethanol production be for this year?
Ethanol production next year, we anticipate it could be higher than 20 million tons as far as Renuka is concerned.
Okay. And so final point, and Mr. Chaturvedi touched upon it briefly, that pricing is very important. For ethanol production to be commercially viable for sugar mills, it's all about pricing. So, Mr. Balani, weigh in on this. As an industry body, what would you be asking for in terms of any increase when it comes to whichever category of molasses, I mean, B, C, juice, etc. As this 5 million tons moves towards ethanol production?
Yeah, see, it is very important for the government to maintain a balance of sugar stocks. Since we are going to have a much better production, it is very important that the diversion of almost 5 million tons is to be done so that we have balanced stock. We don't have a surplus stock because we don't want to see the domestic market crashing. At the moment, we also look forward for announcement of certain exports of sugar to maintain a balanced stock. So maybe start with 1 million in October, so that the companies, the mills could also plan the raw sugar production.
And the pricing, sir, what pricing would you seek for, molasses?
Yeah, for the ethanol, see, as Mr. Chaturvedi said, it's almost 3 years. Our prices have not been corrected in spite of the fact that FRP has gone up by almost 17%. And our cost of production for juice is almost 71 rupees. So we at least expect the government to correct the price of juice to around 71, 72 at the level of the maize ethanol prices, and also the B to almost 66 rupees, which is just the cost of increase in raw material, which is the sugar cane. So I think we are very hopeful because this is very, very important aspect to maintain the viability of the mills and also to make sure that the mills are able to pay to the farmers on time.
Yeah, 66 to 71 rupees, depending on the different categories of molasses and juice.
I think it's been a long-standing demand. So thank you very much, Mr. Balani and Mr. Chaturvedi, for joining us and running us through all those details. We'll take a quick commercial break here. Technicals in focus. Rahul Sharma, Director and Head Technical and Derivatives at JM Financial, will be joining us on the other side. Stay tuned.
Welcome back. Well, markets doing quite well. We are virtually at the high point of the day and we're holding above the resistance mark of around 24,700, which is good. And a stock that we highlighted in our morning chat, MobiWik, well, that's up closer to 9%, a rank underperformer. It's finding its way back today post the large trade that took place yesterday. So MobiWik should come up for you on the screen. Now up, I think, close to around 10% after correcting close to around 60% from the top. Rahul Sharma, Director and Head Technical as well as Derivatives at JM Financial Services, joins us on the show. Hi, Rahul. Good to have you on the show. Well, rollovers are relatively higher this time around, and I think you've done some analysis on that. We have the FIs at a net short, and the hope is we see a reversal. Do you think we're due for one?
Yeah, very good morning, Nigel. So in the last 2 years, 2 to 3 years, it has happened that every time Nifty has seen a very high roller of, say, 84%, 83, 84%, the subsequent series has been one where reversals have taken place. Now, this happened the most recently in the expiry of March. So we saw March where there was volatility. Initially, the month began on a bumpy note. And then we saw a very big rally of around 1,500, 1,600 points happening in the month, in the series of March. Now, this time around as well, at least as far as the first 3 trading sessions are concerned, post the previous month's expiry that we have seen, Nifty has sustained the crucial support level of 24,300. Now, there is a very high possibility that this series, which means the September series, could be the month where we see a proper reversal of sorts, at least in the short to medium term. Now, what that translates is we have a very aggressive bearish ratio, long short ratio by FIs. We had a market breadth which was dwindling by the day, and essentially a market which is oversold on most of the parameters that we've seen. So any trigger, whether it could be fundamental coming from the US, or it could be something that probably forces FIs to cut their shorts, that would mean a significant rally can happen from these levels. So there are two cases possible. Either Nifty reverses from here itself. We've sort of, last 3 days somehow sustained 24,300, not broken that. Or alternatively, in case we do breach 24,300 on the downside, then 24,000 is the so-called base for the current series, which means buy on dip is something that we advise to our clients. And essentially, from a sentiment perspective as well, we feel that the markets have hit a recent low, and the risk reward especially is favorable for a short covering rally from here. So September, we are putting our mouth where essentially we are calling that this could be a month where we could see a proper reversal of sorts.
Rahul, just a quick word on the flashes which is important. The Scott Besson comments which we are flashing at the bottom of the screen, and this kind of ties in with what we've been saying since the morning, which is that first that Trump Truth Social comments seemed a little less confrontational, less aggressive in its tone, and now you have Scott Besson, Treasury Secretary, who's always among the sort of top trade negotiators in the US. I mean, I think he's the most reasonable one. But this is what he's saying. I guess he was asked about the SCO meet in China between Prime Minister Modi and President Xi and President Putin. And he said that SCO is a long-standing meeting and largely performative. And it goes on to say India is the most, I don't know if we have the graphics, India is the most populous democracy in the world. At the end of the day, their values are much closer. Okay, I'll come back to this once we have the graphics. But these are, and let's have the flashes back on, please. Rahul is still with us. Rahul, so you're saying just in terms of direction of travel in the near to medium term, more up than down? That's your thinking?
Yes, absolutely. In fact, today's session, it is indicating that, we might very much test the 20-day exponential moving average, which is around the 24,800 area. So in the very short term, anything about 24,800 closing above that should bring in some positive momentum on the markets. And alternatively, even if we slightly zoom out a bit, I think 24,300, 24,000 is the area where you should be looking to buy the dip in case that happens. So, this is the time to cherry pick your stocks, probably start getting into setups which are relatively doing well, and sort of, be more long than short in this kind of a market.
Those flashes are at the bottom of the screen. That's the key part. He's saying essentially that India is the most populous democracy in the world. At the end of the day, their values are much closer to ours than to China's or to Russia's. And I think at the end of the day, India and US will get this solved. So I think he said this, once earlier, recently in the last three or four sessions, that at the end of the day, I'm sure it'll get done. There was a Fox interview, but I think this is now in the light of what's, of course, happening in China. And I think these are important comments to take note of. Adds to, of course, what we heard from President Trump yesterday as well. I mean, it's these tariffs, at least, especially the 25% tariffs, if that gets resolved, I mean, I think that gives a big boost immediately from a market standpoint, but you still will be left with 25% more. But that's kind of more normal, and you're done away with these 25% if it comes to that. We'll see how this goes, but I think you're starting to see de-escalatory kind of comments and voices, etc., from the US side. Rahul, in terms of specific trades, what would you recommend in terms of positional trades from here?
Yeah, so two stocks are looking very good on this, medium-term charts. One is Dixon Tech. Yesterday, we saw a very strong volume-based activity in the same, a big cup and handle formation on the last 3 to 4 months is the pattern where this has been formed. We feel that the stock is, set to hit targets of around 18,500 to even possibly 19,000 on the upside. So this could be one stock which can do very well from these levels. Apart from that, there is a reversal of sorts on the two-wheeler auto space, especially in Bajaj Auto. Now, Bajaj Auto has been the only stock which is underperformed this auto space in a very big way. Now, yesterday's session, we saw a breakout happening above the 8,800 mark. And positionally, we feel that the stock has got long legs all the way up to 9,800 to 10,000 on the upside. So this is one stock that can be considered for a catch-up rally to be had in the auto space. And lastly, on the banking pack, RBL Bank is something that we like at these levels. The stock has defied gravity, stayed above its 20-day EMA. The stock is actually forming a bullish Poland flag pattern on the daily charts. And this is, in an environment where essentially Bank Nifty has taken a beating over the last few weeks. So positionally, we feel 300 is very much on the cards for RBL Bank. One can look to buy at these levels. Maybe have a stop loss placed at 255 to 60 range, or look at bull spread in the same. So these are the top three stocks which we like on the long side, and they have a very good setup in terms of the medium-term charts.
Dixon, RBL Bank, and Exide. Right, Rahul?
Absolutely, Nigel.
All right, Rahul. Good to hear your thoughts. And going against the trend, expecting a good September. Hopefully, by the time we end September, the Bears will be singing "Wake Me Up" only when September ends. Thanks a lot for joining in, Rahul, and giving us that view. For the time being, markets taking note at the high point of the day. Slip into a short break, come back. We'll continue to focus on stocks that are moving around. The markets moved in, an up mode once again, 0.5% up on the Nifty. There's a 100-point rally now, and it's a little broader than just Reliance. So it's again turning out to be a decent morning, very decent morning so far. Let's shift the focus to commodities now. We have Manisha joining in. Manisha, yesterday, I remember this time it was all about the sparkle of precious metals. What are you tracking today?
Well, yesterday was more about silver because we saw newer highs come in for this one. Today is all about gold because, gold had hit all-time highs in the Indian markets. But overnight, we've seen gold prices hit all-time highs in dollar terms and various other currencies as well. So this is where the focus clearly lies now. So we're trading at all-time highs and we have seen $3,508 an ounce off an all-time high in the Asian markets right now. The last previous all-time high was in the month of April 2025 when the gold prices hit $3,500 an ounce. So we have seen stronger stronger gains continuing for this one. We are looking at nearly 33% of gains for the gold prices till time. And there are various reasons on why gold really seems to be doing well at this point. One, it really has been about the safe haven buying that you have seen come in for gold. And this is after uncertainty because of the U.S. trade tariffs. As of now, yes, there are appeals court which is looking at the U.S. tariffs, but we have time till mid-October. Until then, it is going to be quite a choppy market. The second point really is about the dollar index, which is trading at a one-month lows, in turn providing support to the gold prices. The third thing is the markets will be watching out for the U.S. non-farm payroll data that comes in on Friday. The markets also are pricing in an 88% probability of a U.S. Fed rate cut in the month of September. There could be 2 or 3 is what the markets really seem to be talking about. But this is something that seems to be getting baked into the prices at this point in time. And then it has been about strong investment demand coming in from various countries. Chinese buying has been quite strong, whether it is from its pension funds, central bank, and the Chinese gold imports via Hong Kong also saw a jump of around 126% on a month-on-month basis for the month of July. August is expected to be on the stronger side as well. And then you have Vietnam, which is the third largest gold consumer in the Asian markets, and it has licensed commercial banks which are eligible now to produce, trade and manage gold bars. So there is more opening up that we see in sense of gold. Also, when you look at the last 1 year, there has been more gold buying than treasury buying by various global central banks, and that's something that the street is keeping an eye on. This is one thing that I want to keep in front of you. This is the production and the consumption global data when it comes to gold. 23, 24 and 25. This is an estimate, of course. But as you can see, the gold production is higher than the consumption in all of these last 3 years. So if you want to go by the supply-demand data, there's not so much of supporting for gold. But this is something that the gold doesn't always follow. Mining supply for gold, recycling gold of what's happening in the international markets are some of the figures that street does not pay attention on. So as I said, production is higher and the gold consumption is lower. But even with that, when you look at the last 3 years, we have seen the gold prices continue to gain. 15% up in 23, 21.5% in the previous year, and the current year has seen 33% of gains come in for the gold prices there. Interestingly, when you look at the central bank buying, that continues to be very, very strong. It was an all-time high buying at 1,082 tons in 2022. And since then, we have seen central bank buying quite consistent above 1,000 tons there. This year as well, lesser than what we've seen in last 3 years, but 1,000 tons of central bank buying is perhaps on target here as well. And this is about global banks. When you look at RBI as well, the last financial year, the last calendar year, we've seen stronger numbers coming in from RBI also. The Reserve Bank of India started buying in 2017 and since then has been buying every single year. The last plate should come in on your screens, which tells you on the gold share in the Indian forex reserves. It used to be 6.9% in 2021, has doubled by the time it's 2024 at 11.3%. And remember, RBI is buying this year as well. So if banks are buying and investors are buying, retail investments can't be far away.
All right, Manisha, thank you very much for that. I wonder how much space does 1,000 tons of gold occupy? Is it a room? Is it a small space, Manisha? 1,050 tons last few years, 1,000 plus.
I'm guessing the kinds you see in the Bond movies. Waltz. Okay,
all right. Yeah, absolutely. Let's take that break. It's our special segment. It's the economy. Lata in conversation with Nikhil Gupta of CLSA with his thoughts on where we stand as an economy. Lots happening. GST meeting tomorrow and beyond. So we'll talk through all of that in just a bit.
Welcome to It's the Economy. Today we're going to discuss something we discuss very little, the balance sheets of Indian households. Now, CLSA's economist Nikhil Gupta has put out a rather important, well-researched report pointing to a difficult development in India's household finances. He says since 2010, personal income growth in India is slower than personal consumption growth. Personal income since FY21 is growing at a CAGR, compounded annual rate, of 10%, but consumption is growing at 10.6%. This has led to households drawing down their savings and increasing debt. And this is now showing up in the form of slow FMCG sales, higher retail unsecured loan NPAs for banks. To understand more about this very little discussed problem, we are joined by the author of the report himself, Nikhil Gupta, the India economist at CLSA. Nikhil, good morning and thank you very much for joining me. I, of course, summarized it in a sentence. Can you tell me what is your real worry about Indian household finances getting weaker?
Good morning, Lata. Thank you very much for having me on the show. So as you mentioned, Lata, what we are highlighting is when we talk about household finances, there are various segments that we need to be aware of. Of course, at the center of the entire household finances lies the income growth. Then we look at the spending patterns. We also need to be aware of savings and borrowings distribution, as well as the financial balance sheet. That is all what we have discussed in this note. Now, over the past 10 to 15 years, what has happened is consumption growth of household sector has outpaced income growth. Okay. Now, if your spending growth is more than your income growth, it can happen only and only if you are drawing down or saving less, if you're drawing down your savings or you're saving less, and if you're adding more to your leverage. Both of these trends have been true in case of India. Household savings, total savings according to our estimates, was at 27-year low in FY25, and household debt at 55% of income or 43% of GDP was at all-time high. Now, the issue is, when we started this trend of consumption growth outpacing income growth, when it started, we had a very high level of a very comfortable level of savings, and our household debt to GDP or household debt to income ratio was very low. So when we started, it was not a problem. But when this has continued for 10 to 12 to 15 years, now we believe we have reached a stage where this kind of outpacing consumption growth over income growth is unsustainable. And this is very clear over the last 2 years. So what we have seen over the last 2 years is debt growth has come off, which started when the RBI proactively started putting constraints on unsecured loan growth. And we have also seen a reversal in the net financial savings. So net financial savings of households was at 47-year low of less than 5% of GDP in FY23. And now in FY25, 2 years, for the second consecutive year, we saw a recovery in NFS to almost 6% of GDP. Now, if these trends continue, we hope these trends continue over the next few years as well, by which I mean debt growth remain constrained and net financial savings continue to improve, then unless income growth picks up, it is very difficult for consumption growth to be anywhere close to what we have seen in the last 5 or 10 or 15 years. And that is where our concern comes in.
No, the point is taken. We're running your table of income growth in the various decades, and clearly one can see that personal disposable income, what we are discussing as income is PDI. It's available in the MOSPI website as personal disposable income. Now, Nikhil, while that point is taken that income is growing slower than consumption, if you actually look at the PFCE, personal final consumption data in the GDP, it was very bad in FY24. I agree with you. It was 5.6% or something. But last year, FY25, it was like 7.2. The number that came earlier this week, last week, was 7%. That consumption is not looking bad.
Right, Lata, when we talk about GDP from expenditure side or from PFC, GFC investment side, we must always remember that we do not have very robust data. We get GDP data from the GVA or the value addition approach. That is why there is no concern on the headline GDP. But when we talk about the components of GDP from expenditure side, especially on a quarterly basis or 1 or 2 years, we have to be more cautious because the share of discrepancies can be much, much higher. And we know it has been very high over the last 2 to 3 years. In one of the years, it accounted for as much as 50% of GDP growth, real GDP growth. And that is why I always speak about these, especially PFC. When we talk about this from GDP data, we have to be extremely cautious. It is very likely that these numbers will be revised. And since we have not had a base revision for a long time, that would also have an impact on PFC. We do not know how the surveys that were used in 2011-12 base to arrive at the unorganized sector has changed, not only in the last 15 years, but especially after the pandemic. So I'm hoping when we get the new base next year, early next year, we will see much probably slower growth in PFC in 25. And hopefully we will have much better understanding of where the consumption growth or household spending has been doing.
Yeah, I take your point. We are all waiting for February 2026 when the MOSPI has announced that they will give us the new series. Now, anyway, the most newsy part is the 7.8% GDP. We have news from the NSO that not everything is current prices deflated. Some of it is actual constant prices, agricultural produce, mining, metals, electricity. They have the constant volume growth. So to say that everything is because of a low deflator is not working. 7.8 is a good number. It is not looking like a country troubled by consumption.
You're right. So if you look at the breakup of GVA, Lata, which is the basis for GDP growth, there are definitely some portions which are available in both constant terms and current prices. So we cannot blame GVA deflator or lower inflation that has boosted real indicators of those segments. But our calculation suggests that almost 45% of GVA, which primarily includes manufacturing, trade and transport, and public administration and defense, these three big segments, all these segments are first available on nominal basis, and then WPI heavy deflator is used to arrive at real. And it is not a surprise that all these three segments have actually surprised on the higher side in first quarter of FY26 when the number was much higher than what we were expecting and what the general consensus was. So definitely this deflator has played a role. I mean, we have seen private final consumption expenditure, as you mentioned, doing much better in real terms, not as good as it was in Q4, but if you look at trade and transport. So deflator has played a role. I am totally in line with the fact that not 100% of data is first available in nominal terms and then we arrive at real using deflator. But all these three big segments which have surprised us on the upside, I think deflator has played an important role.
Okay, got it. No, that part, I looked up the NSO worksheet, and as you say, those items are first arrived at, from the BSE, NSE corporates, and then deflated. Okay, let me come to your worry that, people are taking more loans and consuming, and that is the problem with households. Can that not be seen positively? We have not reached organized formal sector credit to many sections. Now, because of fintechs, NBFCs, Jandhan accounts, we are able to give credit to larger sections. That is why borrowing has increased. As consumption increases, more production will happen. Consumption-driven growth can come, isn't it? Why should we worry about it so much?
What you're saying is possible, Lata. Now, as an economist, when I look at the macro or aggregate numbers, I do not have the details to be aware of what is the income profile of the borrowers that are there, how much loans have one borrower taken. And that is why I look at what the regulators are highlighting through their various surveys and what they are doing via their actions. So what we know for sure is that almost 2 years ago, the RBI started highlighting some concerns on the unsecured debt growth. Since when, we know that unsecured consumption-based loans growth has come off. It used to be in excess of 25% before September 23, September 23, when the RBI came out with these measures. And since then, our calculation suggests that it has now come off to 14 to 15% as of March 2025. Now, 14 to 15% is definitely much lower than what it used to be a couple of years ago, but it is still much higher than the income growth. And it is still the fastest growing segment within the household debt, except gold loans, which is still a very small portion. Right. So we do not, I mean, it is almost impossible for an economist like me who is sitting on the outside and do not have disaggregated data to know whether we have reached the inflection point, what is the income profile. Without that data, it is almost impossible to answer the question you're asking.
Yeah, we are getting the personal income with a lag. So, yeah, we are not able to identify whether income is also grown at the same time.
It is very clear, income growth, even it has picked up, it has not picked up to 14-15%. I mean, it was close to 10% the last year. We expected at best close to 10%. So it is still weaker than the
growth in consumption. Fair point.
My debt to income ratio is still going up.
Okay, let me try to quickly squeeze in. Do you think that there are two things which are going to help consumption? One is GST cuts and the other is low inflation. Should not that alleviate the problem? The households will be better off.
All right, I take your second point first. No inflation when you say. So we know that the primary factor for driving down headline inflation has been food inflation. Right? First, food inflation is very volatile. And second, food inflation may benefit the consumers of food, but the producers of food, which is a rural segment of the agriculture sector, it's a realization for them. So it is not necessarily true that lower food inflation is good for the economy. Especially if it's sustained, we can see some kind of stress in the agricultural sector. Second, now coming to your first point, you mentioned about GST cuts.
GST cuts.
Definitely, there is no doubt when the GST cuts come into place, we will see a boost to consumption. However, that is only one side of the story. We also need to know what would be the exact kind of stimulus that the government has given. What would be the fiscal cost of these GST cuts? What would happen to the compensation cess? Will this continue till October, till December, till March? Will the new 40% slab that they have told us, will that slab attract any further cesses, or will that be the maximum GST rate on any goods? Because if that is the case, there are a lot of motor vehicles at this point in time, and some of the same goods, or the demerit goods as we call them, they have a much higher rate than 40% at this point in time. So are we actually looking at lower GST rates on those items? Is the government sacrifice in terms of GST receipts going to be a big kitty? How much will be the distribution between center and states? What kind of impact would it have on spending ability or spending growth of the government? All those questions need to be answered before we know the overall impact on the GDP growth.
Okay.
Having said that, there is no doubt that from consumption perspective, GST cut is a positive thing.
Okay. Well, actually, I'm not going. I won't have time to concentrate on an important point that you have in your paper. That upper category, the K-shaped upper part of the economy is consuming very well. It is the lower part that is struggling. I don't have time to analyze that. But if you can quickly tell me this very important point you're making, that if the stock market were not to perform, the government also suffers a lot. We always thought that our household net worth goes down because we are invested in the market. But you're saying even the government will suffer if markets slip.
Right. So since we do not have time, I'll make it very short. What our analysis suggests is that almost the entire surge in personal income taxes that we have seen in the post-pandemic period. So we know that personal income taxes in FY19, FY20 was close to or less than 2.5% of GDP. It was 2.3% of GDP. And now we are at 3.7% of GDP. What we have done, we have looked at the contribution of equity market to personal income taxes collected by the government. And when I say equity market collection, we have three components. We look at the taxes on dividends, we look at the LTCG taxes, and STT, security transaction tax. Okay. When we look at the aggregate impact of these three items on PIT, we found that almost 90% of the surge in PIT from 2.3 to 3.7 is on account of these three factors, which is equity market contribution. If I exclude this equity market contribution, PIT is broadly closer to 2.5% in FY24, FY25, only slightly higher than in the pre-pandemic. And that is where we are highlighting that if equity market does not do good, if there is, let's say, 10-20% correction in equity market, it will not only hurt the household sector, household balance sheet, but it will also hurt the government tax collection, especially the personal income taxes, which has been the key driver of overall tax growth in the country in the post-pandemic period.
Okay, but it's good to know that the government is on your side. They want stock markets to do well. Thank you very much, Nikhil. I agree it's a many-sided report and requires a lot more detailed reading and understanding. But thank you very much for giving us a jhalak of your report on household finances. Importantly, if the stock markets don't do well, then STT, LTCG, dividend tax, all these incomes also for the government go down. We have to remember that. Well, with that, we'll wrap up this edition of It's the Economy. After a break, it'll be time for Chartbusters.
Market trades near days high. Nifty crosses the 24,700 mark, led by gains in FMCG, realty. Broader market trades in line with the benchmarks. The Nifty above that 24,700 mark, above important technical levels too.
Sugar stocks surge and trade after the government removes curbs on producing ethanol from sugarcane and sugar syrup.
Shares of Reliance gain on the back of a Morgan Stanley note. They have an overweight call on the stock, target price of 1,700 rupees, expecting AI adoption and China's anti-involution policies to be key tailwinds for the company.
Sun TV trades high after Vendis buy call on the stock with the target price of 680 rupees. The brokerage turns constructive, positioning the company as a proxy for investors to participate in the monetization of sport. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Manglam, and it's a good-looking screen. We had a good start to the trading session yesterday, And we are seeing some follow-through buying today as well. So Mangalam, it's looking quite good.
Straight off the bat, a 100-point up move is what we've seen on the Nifty. It is a century, as you can see at the top of the screens. The only thing I'm watching out for, Nigel, is when will Nifty Bank participate right now? You know, because over the last 10 days or so, the Nifty Bank has not been participating with as much gusto as the Nifty has been doing well. The Nifty is now above important levels as well. What has led the rally so far? We've seen some traction come from the IT stocks yesterday. Today, it's Reliance, which is doing well. But across the board, we've seen some purchase in the FMCG stocks. The street believes that the second half of this year likely to be a lot better as well than the first half of this year. And talking about FMCG itself, the index is at the high point. We have Marico. I spoke to the management and started on asking about their food portfolio and how they're targeting growth in their overall business in the very near and the medium term as well. Let's hear out what Saugata Gupta had to say.
We started, if you look at our Saffola journey, it was, towards making a heart-healthy India. And then I think the entire Saffola journey has been on designing better for you foods. Better for you foods means, if you look at it, having healthier grains like oats and millets instead of maida, not having any palm oil in most of the formulations we develop. At the same time, having a balance this one. And we also have two other brands in our portfolio today, which is Plix and True Elements. True Elements again is a brand which is free from all nasties. It is in breakfast cereals. It's in nut seeds. Plix is in the area of nutraceuticals, and I think nutraceuticals is something which we believe is a very, very high potential category in India. I think one of the tasks, of course, is to make it much more affordable and available as a category. And if you look at nutraceuticals, it can cover the entire gamut of weight management, heart health, diabetes, bone health, gut health, stress and sleep. And I think that is something which, if you really look at it, is something which will, as a category, it will certainly has huge potential to grow. At the same time, of course, fortification, whether a fortification with vitamin, fortification with minerals, fortification with omega-3 and others in our core categories is a continuous journey for us.
So in that case, could you give us a size of the total addressable market here? And what proportion of that is Marico, aspiring to garner?
Still very small, and I think there's enough opportunity to grow. Having said that, I believe what is happening is that consumers are increasingly choosing healthier eating options. If you look at the kind of consumption occasions, one is of course breakfast, one is the main meal, which is which of course people still prefer home cooked meals. Of course, there's a huge kind of a proclivity to order food, given today it's far more accessible and available. But there are also in between meals occasions, which are snacking occasions. And what we intend to do through our offerings is ensuring a share of wallet in that occasion. Because I think people, while they want to indulge, they also want to have better for you foods. And of course, if you really look at India today, the packaged food industry, there are two vectors of growth. One is unbranded to branded. Branded is far better in terms of quality, in terms of hygiene. And the second one is, of course, having food which are better for you. And the runway for growth is tremendous. And I think the packaged food industry, with also all the government incentives that are coming in, I believe this is one area in the consumer goods space which has tremendous legs for growth in the years to come.
All right. Speaking about the consumer space itself, in the very near future, we are expecting, GST rate rationalizations to come through, as the Prime Minister was speaking about it. For your business, what do you think could be the benefits immediately? Would you be, looking at, seeing an increased volume because of the price benefits that you will have to pass on to the consumers?
I think one of the things is rate rationalization is something which I think is a tremendous opportunity to drive consumption, and it is happening not only in consumer goods, it's expected in things like auto and durables, which will definitely catalyze. It's a very, very bold move by the government, and the entire simplification and rationalization, it will definitely catalyze consumption in the country. As I said, that in India, a lot of categories have low penetration, and affordability and availability are the two drivers of growth. And I'm obviously each one of us will pass it down and across industries so that to fill up consumption. This is a right time actually to drive consumption in this country. And this is coming on the back of some of the tax savings which have been given by the government. So I think the combination of this is that a multiplier effect will be very good.
All right, we last spoke after your first quarter numbers. A little more than a month has passed since then. In that month, is there anything particular that has changed or anything that has happened for you to call out when it comes to input prices, when it comes to volume offtake, when it comes to the near-term outlook?
I think there has been a marginal drop in input costs, which will obviously then benefit as we move towards the second half of the year. This is something we were expecting. I think consumption and the entire continues to remain steady. We expect a gradual improvement in consumption to happen in the second half of the year.
So a couple of quarters of double-digit revenue growth, double-digit volume growth you had called out for earlier. You still hold on to that, right?
So what we said, we will aspire to touch double-digit in a couple of quarters, and something which we will still aspire to, yes.
And not happening in the second quarter for sure.
I think it's, as I said, it's too premature to give anything. But as I said, that we have experienced sequential uptick, and today we have moved to a stage where we have delivered now high single-digit growth. And somewhere during the next couple of quarters, it will be good to touch double digits.
And the margin pressure is waning. You said that there has been incremental decline in raw material prices, so we can expect margins to normalize soon?
So there is as I said, that there is a marginal decrease in input costs. It will take some time, obviously, and we will see how it pans out in the second half of the year.
All right, and your trigger will also be the operational improvement of some of your diversified portfolio, your new age businesses. Case in point, something like Plix, True Elements, and all of them, as they scale, they will start to contribute operationally as well. If you could give us a sense on the operational breakthrough for all these companies, the operational break even that is, and are you looking at any more acquisitions after the ones that you've made already?
Plix and Beardo has broken even, and Beardo is on the around double-digit EBITDA. And this part of the business, we will drive aggressive growth and continue to ensure that they will help in achieving our aspiration of delivering a 10% or EBITDA for this digital part of the business over the next 2 years. The other two, True Elements and Just Herbs, we have a slight burn, which we are aggressively driving break even over the next 18 months to 24 months.
All right, and any acquisitions? Because Zydus Wellness just made an overseas acquisition in the nutraceutical space itself, in the vitamins, minerals, and supplements space. Are you looking at the VMS space, as they call it? Any domestic or international acquisitions on the anvil?
We believe that our entire strategy in terms of acquiring some of the digital brands and filling up some of the adjacent spaces will continue. And as and when an opportunity arises, which is a strategic fit, which has the right valuation, we would be certainly exploring it.
All right, always on the lookout for some acquisitions, says Marico. There has been improvement in consumer sentiment, with GST being the next big trigger. The stock at the high point. Take a short break, come back, focus on the management that we have lined up for you. We have Genius Power. The company joins in for a quick business outlook.
Welcome back. Let's focus on GNSPA. That's the next management on our radar. We have Mr. Jitendra Kumar Agarwal, the joint MD, who joins us on the show. Hi, Mr. Agarwal. Good morning. Thanks a lot for joining in. Well, let's get a couple of numbers out of the way. You've had a very strong start to the year, delivering nearly around 1,000 crores of revenues. You know, in FY24 or even before that, you were doing 1,000 crores in the full year. So it's been a very good start to the year. Earlier, you were guiding, I think, for around a mid-20% growth on the revenue front. Now, that clearly will have to be revised going by the run rate that you've started at. So for the year, what kind of a revenue growth are you looking at? How many installations of meters, if you could give us the volume number and margin outlook? 3 numbers, sir. Revenue, volume, margins.
Good morning. It's always a pleasure coming back to your show. So this year I've been giving the guidance of 4,000 crores. So definitely we are going to do that. And with a margin of 18 to 20% on the EBITDA side. So we continue to maintain this guidance, what we have given earlier. So there is absolutely no problem in these numbers. Rather, we are confident that we may cross these numbers. In terms of number of meters, we will do 13 to 15 million. We will manufacture 13 to 15 million meters in this financial years. So on margin, number of meters and
all right, so 13 to 15, that we get that point, 4,000 crores this year's revenue, and you are confident of surpassing that number as well, and 13 to 15 million meters. What about margins? You said you are likely to see improvement in margins as well. What is the number that we should be working with?
We have been maintaining the guidance of 18-19%. We continue to maintain that.
Okay, because first quarter you did about 21%, which is what made me ask you about that 18-19% mark itself.
So, yes, first quarter we did 21%. But there have been some ups and downs because the projects are taking shape over the period of time. So that is why we are maintaining this guidance. But yes, maybe we come out with a new guidance by the end of this calendar year.
All right. So, you know, the other problem is the street is very excited about this smart meter opportunity. But there has been some kind of a slowdown with regard to tendering is what we understand. Your order book is healthy. Could you tell us what is in the pipeline? What is the total bid book, if you could call it that? What is your success ratio normally? And if you could talk about the states from where you expect to get business.
So just to give you a heads up on that, in RDSS, total 23 crore approx meters were approved by the central government. Out of those 23 crores, 13.5 crores to 14 crores has been ordered. So remaining 10 crores has to be ordered over the period of time. Right now, 3 large tenders are going on, 2 in Delhi, BRPL and BYPL, and 1 from Tamil Nadu, which are 6 projects. So all these 8 projects has been quoted by Genus, and I am pretty confident within this month or by next month we'll start flowing the orders again in the company.
All right.
What is the total, if you could quantify, sir? 3 large projects is what we're talking about. Delhi, Tamil Nadu,
and 2 in Delhi and 6 in Tamil Nadu. In total, these are 3.5 crore meters.
3.5 crore meters, got it. And if I had to put a value to it, roughly it would be what?
You can always take a benchmark value of 10,000 rupees per point. So 35,000 crores.
35. And your success ratio will be what? Normally, how much is it? 20%, 10%? You know, if you could tell us roughly.
So generally, we have been getting good orders. We are one of the largest AMIS players in the country. So we are confident we continue to maintain our.
So, of the 35,000 crore bid, how much are you confident of winning, at least going by your past run rate?
So, definitely, I'm confident that we will achieve the past run rate, but it is very difficult to put a number on that.
What is the run rate, sir? Normally, okay, could you tell us, as of now, what is your market share?
So, if you say currently, total around 3.5 crore meters has to be done by Genus in total, what we got as a market share. So, out of 14 crores, 3.5 crores has been won by Genus.
All right. So out of 14 crores, it's roughly about sub 20%.
Yeah.
All right. And that is the likely run rate from the bidding that you would get as well. We will do those calculations at the back end. Just final question before we let you go. You know, there were a lot of news pieces that came by, which was with regard to the Rajasthan projects. There was impact of tariffs imposed by USA. You've clarified on all of that, including the one that was blacklisted in Goa as well. You said you were never technically blacklisted by the Goa Electricity Department. It was the internal memo, which you have challenged already. Has there been any resolution on that? Has the High Court come back?
No. So just to clarify it further, there was an internal memo from the Goa Electricity Department, which we challenged. It was 1 year back. So the internal memo, it came to our knowledge on 5th of September 2024. On 24th of September 2024, High Court quashed that order, and on 3rd October 2024, Goa Electricity Department withdrawn that internal memo. So Genus technically has never been blacklisted, and whatever the non-technical blacklisting, that also was cleared by 3rd October 2024.
Okay, all right. So if I look at it, 14 crore meters have been installed, 3.5 crore by Genus. So you're actually a little more than 20% of the total market as of now. Fair to assume that number?
So yes, as an AMISP, fair to assume that number.
All right. And what about your JV partner? They have a stake in the listed entity as well. Yeah. And there was that, report that suggested that they wanted to sell some stake. Have you heard from them, or do they want to hold on?
I want to make it clear again, which I made it last time also on your show, that there are two entities from GIC. One, the platform created between Genus and GIC, which were continuously, all these new tenders are also quoted together under that JV platform only. And the other entity, which takes the stake in the listed company, only a very small portion of that total stake, because that is the way they work. Then when they have got a good upside, they will sell some stake in the market. This is how they work as a GIC. So I don't see any problem between Genus and GIC. Rather, we are becoming more and more stronger in the times to come.
So there is that pending block maybe in the listed entity, but you're saying the partnership continues in the JV that you'll have, where I think you have 26% and they have the 74% stake.
So that is and that is a much larger investment for GIC than the investment in the listed company.
Appreciate you joining in, sir. We look forward actually to chatting up with you in the second half of the year, because by then we'll have clarity in terms of the order wins. We'll also want some clarity on the working capital days. But appreciate you joining in, sounding extremely confident for FY26. We'll track you on all these numbers. Take that break, come back, continue our focus on stock-specific action. Well, the GST Council is set to meet on the 3rd and the 4th of September to discuss the centre's proposal for simplified two-slab structure. Timsy joins us to fill us in with all of those details. Timsy?
Prime Minister Narendra Modi's vision in his Independence Day speech on next generation GST reforms could soon be a reality. The GST Council is set to meet on 3rd and 4th of September to discuss the centre's proposal to shift to a simplified two-slab structure of 5% and 18% with a special 40% rate for sin and demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities such as soap, shampoo, medicines, hair oil, toothpaste, biscuits, namkeen, bhujia, footwear and apparel below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in the lower category of 5% or even in certain cases exempt. Aspirational goods such as television, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc, which are currently taxed at 28%, may move down to 18% slab. The proposal also includes a major relief for consumers and industry with life and health insurance premium, as well as reinsurance likely to be exempted from GST. While the centre is confident of a smooth passage, states have raised concerns over possible revenue losses. They have sought assurances of revenue protection, pointing out that they are not opposed to the rate rationalization but need compensation to meet their financial obligations. Also, a mechanism to ensure that the rate cuts are passed on to the end consumer and not result in any windfall gain for any of the companies. The September 3rd and 4th Council meeting is expected to be a crucial one, with the potential to usher in a new phase of GST, simpler, consumer-friendly and aligned with the Prime Minister's reform agenda. Something that we'll have to wait and watch for the Council as to what finally passes through.
Take that point, MC. Thank you for that. With that, we'll wrap up on this edition of the news that the Nifty is up 110 points, a little more than 10 points higher than when we started the show, 100 points higher from the morning itself. Take your leave. Trading Hour comes up next.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Fatakia. Good morning, Hormuz. Second day running, we are seeing opening gains that have come by. 110 points higher on the Nifty as we speak. Mid-caps are outperforming as well. 0.6% higher there. And across the board, if we talk about sectoral movers, all of them are in the green today. So yes, some of them are outperforming, but all of them in the green right now. Specific stocks that we'll speak about in greater detail later as well. But Sugar Pack, that continues to soar higher, and that is one story that we'll discuss in greater detail through the course of the show as well, later in the show actually. So Sri Renuka, Dwarike Sugar, Dhampur Sugar, all these stocks are higher in trade as we speak. But if we talk about what's happening in the Nifty pack, some of these power stocks are doing well. We have the CPSE index, which is one of the biggest gainer as well. Reliance Industries higher 2%. We'll discuss why. We do have Nestle India, which is higher in trade by 2% as well. And on the losing side, we have some of these auto names. M&M is lower, Maruti Suzuki is lower. But do remember, the auto sector has outperformed so far in the week gone by as well. But let's get stock specific now, because Hormuz has gone across the big wall. He will put spotlight on top movers in the market. Hormuz, tell us more.
The broader markets are outperforming indeed. And as you mentioned, the big story of the day is sugar stocks. Of course, we'll get on to the news and the fundamentals behind it in just a bit. But take a look at the volumes already in just the first hour and 3/4 of today's trading session. And I listed these stocks out because these are the ones that are seeing double-digit gains. At least these are the ones with high volumes. Look at Sri Renuka, 6.5 crore shares traded, 20-day average of just 7.5 lakh. Dwarikesh, Dhampur, Bajaj Hindustan has had 4.5 crore shares traded. The 20-day average is just 20 lakh shares. It will be interesting to see what kind of delivery volume emerges from these. But for now, all of these sugar names gaining at least in double digits on very, very strong volumes. The other one that has been moving over the last few days has been Samman Capital. And ever since the stock has entered the F&O segment from the start of the September series, the stock has been on an upward move, 7.5% today as well, almost 15% now in 3 trading sessions, and it has had more than 1 crore plus shares traded every single day since it began trading as an F&O stock. Even in today's session, we've already had in excess of 2 crore shares changing hands in the first couple of hours of the trading session compared to a 20-day average of 35 lakh shares. And courtesy of this up move, the stock has now broken above its 200-day moving average, which stands at around 131.90. But despite this move though, stock has been an underperformer, still down 12% for this year, and has had negative returns in 5 out of the last 6 calendar years. And the last one on the list is Avanti Feeds. And of course, this has been in the news for all the tariff-related announcements and so on. The stock has alternated between gains and losses for the last 6 sessions. But in today's session, this 10% move is coming on the back of almost close to 10 lakh shares now being traded compared to a 20-day average of around 1.5 lakh. And the stock is still trading below its 50-day moving average, which is closing in on right now. The next important level to watch on the upside is 695, which is the 50-day moving average.
All right. Some interesting names there in data as well. Thank you so much, Hormuz, for telling us all those names. But, we spoke about how Nifty is edging higher, and a lot of it is courtesy Reliance as well. We did see those updates come by in the AGM, and we do have a note which has come in from Morgan Stanley today. They have a view that AI will redefine Reliance Industries' equity story from here on. The stock is higher by 2%. They say it is the largest beneficiary of China's anti-evolution focus across energy and solar supply chains as well. Now, remember, they had spoken about their targets, specific targets in the new energy business, and that is something which the streets seem to like as well. They say Reliance self-anti-evolution in consumer retail and telecom is also bearing fruits. They gave targets in terms of how they want to be one of the biggest FMCG companies in the country as well. Overall, this adds $20 billion in NAV and also 17% to FY28 EPS. This is something they are very positive on. They raised new energy NAV estimates by 20% to $25 billion by FY27. This largely because in their AGM, they gave a lot of targets, specifically with new energy, when the next set of capacity addition would come by, and specific targets overall for the EBITDA as well.
contributing almost 30 points to the index upside is Reliance Industries. So 2% higher on the stock, 1380 is where the index big boy is. But Sonal, you also have something on Phoenix Mills. That's another stock that's doing well today after the upgrade from Motilal Oswal.
Oh yes, there's an upgrade that has come by and it is upgraded to a buy. The target is 2044 on the stock. The stock is higher by 3%. The brokerage says that the company continues to diversify and expand their portfolio. They are on an adding spree when it comes to new malls as well. So they remain optimistic about the long-term performance. The growth will be driven beyond FY27 for the company. They estimate a 20% CAGR in their retail income over the next 2 financial years, which will reach 2,800 crore rupees by FY27. Their office portfolio is expected to surge by 3 times. So they have hospitality, office and retail portfolio. All 3 of them will see growth according to Motilal Oswal. The company also acquired an 11-acre land parcel in Thane. This will help their hotel segment because it will triple their hospitality portfolio to over 1,800 keys from the current levels. The company is also acquiring remaining 49% stake in Island Star Mall Developers, which was a JV with Canadian Pension Fund. And they say this is an EPS accretive transaction that the company has undertaken. It will strengthen their high-quality retail asset portfolio and add to the earnings as well. So all the portfolio is expected to do well because they are on a capex spree. They will be adding a lot more portfolio, which will aid their earnings as well.
Indeed, upgrade coming in from Motilal Oswal, projecting a 35% upside from yesterday's closing level. So 1562 on Phoenix Mills, still, well, quite a distance away from its 52-week high, which is around 1968. So still, 2044 price target coming in from Motilal Oswal on Phoenix Mills, 3% higher on the stock. Take a short break. On the other side, we put the spotlight on the crypto markets. Lily Liu from Solana Foundation joins in on the other side. Welcome back. 24,740 is where the index stands, comfortably above the 20-day moving average as well as the 100-day moving average now on the index. And a part of this up move that we have seen over the last couple of days also comes from India's GDP print, which came in on Friday after market closing hours. That's scorching 7.8% figure, which raised some issues around the deflator. But the NSO sources have told CNBC-TV18 that worries of a low deflator are overstated. Now, this comes the day after many economists and media reports said that India's higher than expected GDP figure of 7.8 compared to estimates of 6.8 may have been because of the deflation method. Lata is here to break this down for us. Lata.
Well, I spoke in detail to several top sources in the National Statistical Organization, the NSO, and they say that their calculation method is not at all incorrect, and in fact it is endorsed by the IMF year after year. It's among as good as anywhere. Now let us address the worry itself, which is what I asked them. The analysts' worry is that India's Q1 real GDP is at 7.8 and nominal GDP is 8.8. Normally nominal GDP is real GDP plus inflation. So this gives a very low inflation or deflator of just 0.9%. This is the worry. Now, NSO sources first said that, it is not as if we collect all the goods and, value addition of all goods and services at the nominal rate and then deflate it. That is not the way it is done, which seems to be the misunderstanding. They say for a large number of the products, like at least 50-55%, for instance, agriculture, mining, electricity, the consumer durables, they have the volume of goods. Just like last year, this year, you have amount of crops produced, amount of electricity generated. So it is at constant. The value added is a constant. And to that, you add the CPI or the WPI, more likely, and get the nominal GDP. So it's not as if you're deflating it from the current prices. You have the constant volume produced. That is in the case of public sector mining and all those. Where is it that you get the current prices, nominal GDP, and then deflate it? These are the sectors. Private mining. Private sector mining, you take it from BSE, NSE data and then deflate it. Then likewise manufacturing. Manufacturing companies also you take BSE, NSE data and corporate. That's basically corporate data and deflate. Trade, retail trade, again you have to go with the company data. Real estate, you go with the corporate data. Finance, like, RBI releases deposits, credit data. Public administration, you have what the CAG releases or the Ministry of Finance, revenue data, services tax data. And even health, education, what you do is you take services, the service tax paid on education, on health, and then you deflate it. So there, how are you deflating it? WPI or CPI? That becomes an issue. And so, there is no wholesale price for education and health. You have to take the WPI, which is a manufacturing-based WPI. So, there can be an argument, but what is the option? Some of the countries use PPI data, that is Producer Price Index. What is the Producer Price Index? It is different from WPI in the sense, it is the price at which the producer is getting the inputs. There, the transport, logistics, warehousing is already included. So some of the services is accounted for. In India, we don't have that PPI data. So you may argue with that manufacturing, with some of the inputs as not being deflated adequately. Likewise, there is double deflation applied in some countries. For instance, in manufacturing, they deflate the input prices, output prices separately, and then get the value added. In India, the NSO only deflates the output prices. So there is an argument that if the input prices are very low, you're probably overstating manufacturing. Many economists have said that about the Q1 GDP. So, it is only for about 45% of the inputs that this argument of deflating from current prices comes. It doesn't come for a larger part, about 55% of the data, NSO sources told me. And they also saying that February 2026, the revamped GDP, revised GDP is going to come in. There, they're going to address the PPI issue. They're also going to address the double deflation issue, which in any case, they're saying in many countries, it's not as if they do double deflation of all the companies. They do of a sample companies and extrapolate. So they're going to do that as well. Also, the CPI basket is going to be recast to have more services. The current basket was designed in 2012, when the average Indian household didn't consume so many services. It largely consumed food. Now people are better off. We are consuming services. So the CPI basket from 199 service items is going to have 400 service items. And therefore, a much better CPI basket is in the works. The issues are minor, are smaller for a small part of the GDP. And therefore, we should not cast too many aspersions on the GDP data.
Well, that's a lot of clarification on GDP coming in. But moving gears then, what we are going to talk about now is the Crypto Corner. And we are joined by Lily Liu, who's president of Solana Foundation. Lily, hi, thank you so much for joining in. And I want to start with GDP as well, but this time around with the US GDP, which has started to be published on blockchain now. It continues to be published in other ways, but now on blockchain. So while we have seen this being happen, that blockchain is made use of by various government agencies to start putting in their data. But would you see this as a big step when the US GDP starts coming in on blockchain?
I think this is just one more step in the future that we've seen for quite a while, which is where a whole range of financial assets and also data are going to be natively on chain. And why is that important? Why is that helpful, it's because what blockchains do is they make money into data, data into money, and they also create the shared global financial infrastructure that anyone on the internet can access. That's been the value proposition of blockchain from the very beginning, this idea that you have shared financial rails that 5.5 billion people can access. That also means that the liquidity of 5.5 billion people can all be realized in the same infrastructure in the same way that we do with content today. So it's one more thing. There's so many things going on as people, as financial markets and people around the world really understand the power of this technology as financial infrastructure, and this is just one of the latest things.
Oh, well, absolutely. Lady, how would you also look at the way stable coins really seem to be working in right now? Of course, markets are awaiting that we see more regulations going forth. Would you say it seems quite divided right now because stable coins laws, and then we're looking at a lot of stuff happening with Bitcoin in sense of reserves, etc. And then there are altcoins. Too many rules, regulations, and form?
There are many different cryptocurrency assets, but I think one way to break it down pretty simply is that there's blockchain, which is technology that can be used in two major ways. One is blockchain as an asset, and that's Bitcoin. Now, a lot of people are familiar with the idea that Bitcoin, digital gold, store of value, there's only 21 million of them. And that has really taken the world by storm over the last couple of years. So there's blockchain as an asset itself. And then there's blockchain where this technology is financial infrastructure upon which you can create stablecoins, create all sorts of different cryptocurrency tokens that have their own use cases and their own roles. And so there's quite simply, there's Bitcoin as the asset, and then there's Solana, which is going to be global financial infrastructure. And so when we talk about this whole world of crypto, and everyone's heard of one coin or another, those are the two easy ways to break it down. Is this coin going to be a long-term asset? Or is this coin really, the core purpose of it is to be used as financial infrastructure around the world?
You can't separate the two clearly. But Lily, since you spoke about Solana and that is what you're heading, what is it that we can expect from Solana Foundation going forward? I mean, I do understand that there have been a lot of scaling up. There are a couple of ETFs already in works, and US is awaiting. We are awaiting the US clearing it too. So what really can be expected for the rest of 2025 from Solana?
Sure. Well, Solana, the protocol, is always open source tech and it is being used by thousands of developers around the world and millions, tens of millions of users around the world. Solana is the most used blockchain, more transactions every day than all of the rest of blockchains combined, and then times two. So we're going to continue trying to build the best technology, the best infrastructure to power financial markets. To sort of bring the future of the future of capital markets onto the internet. That's why we always talk about internet capital markets. So some of the things that we're really focused on is certainly stable coins. Why is that helpful? Why is that important? Why should people care? Well, because in the age of the internet, we're so used to things moving instantly around the globe. And that's one way you can do that natively with stablecoins to actually have really efficient 24/7 internet scale and speed and availability money movement. So that's a really obvious one that I think is now really top of mind for people. And then beyond that, what we started to see is putting real world assets, different funds, for example, money market funds on chain. And that trend, I think, is really only going to accelerate as people understand that if you take these assets, put them on chain, then what you have is you have taken these assets and enabled the possibility to distribute them to, at the maximum, all of the people on the internet, 5.5 billion people on the internet, and there's no distribution for capital markets, which is ever going to be larger than that market.
Oh, well, absolutely. How are you looking at the adoption numbers as well? Because, you know, there are some countries which are way ahead when it comes to crypto and blockchain adoption, and there are some which are still struggling with their rules, regulations, even taxes for that matter. And I can add India to that list too.
Yeah, certainly. Well, blockchain lives natively on the internet, and that means it is available in every country equally at the same time, and it is up to those countries to think about, understand, and have a strategy as to how they want to incorporate that, the future of digital finance into their economies or not. And what we've seen is blockchain over the last 15, 16 years that it's been in existence is something that moves very fluidly throughout the world. And for example, in a very short time, the UAE here has become a global leader, one of the 2 global hubs of the blockchain industry, and was able to do that very quickly. So that's true that amongst the various countries and governments, there's many, many different regulations, but I think there are a few that understand this is about financial innovation, digital innovation for the future, and really see that as an opportunity.
Lily, would you say that the markets really seem consolidating right now after that 15, 16 years since it has been around? There is some consolidation, more credibility. There are more better rules, regulations being put out. Institutions, family houses, banks, brokerage is also talking about it now.
Absolutely. I think there's been a tidal wave of institutional interest coming into this industry, in particular over the last couple of years, as I think the use cases have been developed and have been scalable around payments. And people see very clearly that this really is a better way of moving money around the world. Now, there's still work to be done, the underlying infrastructure, on and off ramping, various institutional integrations for sure. But people now see this as let's say, email versus sending snail mail. And the value proposition of that is just so clear, night and day for people. And then also similarly, bringing tokenized assets on chain, that is also something where the value proposition of that is just so clear. For example, watching analog TV versus being able to stream on the internet. So the value of this is self-evident to so many people that have started to pay attention. And also as the user experience infrastructure has also matured over time, which has also been a necessary part of it.
Oh, well, absolutely. It's quite evidently and mostly, put out as an example that you can send pictures from Asia to Europe faster than you can do with money. But if the blockchain is adopted stronger and faster, we perhaps would be breaking that too. Lily, thank you so much for joining us here at CNBC TV18. Appreciate your time. And with that, we'll go for a short break, come back with more news and updates on the other side.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. You're still tuned into Trading Hour. Let's get our first corporate conversation from the sidelines of the 21st Motilal Oswal Annual Global Investor Conference. We are now joined by Jairam Sridharan, who is the MD and CEO, Retail Lending and Pyramal Enterprises. Jairam, good morning. Thank you so much for joining in and patiently waiting by as well. You know, the big talking points that we want to be discussing with you is, will AUM growth pick up pace from here? Is drag from legacy portfolio fading away? And the asset quality trends in car loans and MSME improving or not? And of course, the big story that we have been tracking, and that's the possible GST cuts that would come by as well. So, Jairam, I would like to start with that first up. If there will be some impact on credit growth, because sales are now getting postponed till the time some clarity comes in. So, will there be an impact on credit growth? And if the cuts do come by, what kind of macro impact will you see on consumption and rates overall?
Yeah, good morning. Thanks for having me. Your point is right that so far the GST announcement has had a negative effect on credit growth and on growth of the underlying products, because everybody's waiting for clarity to emerge on which products are going to be in which category. One hears that there might be something coming up later this week when the GST committees meet. So let's see what happens there. But so far in cars, for sure, you're seeing people postponing purchases, and in multiple other categories where people have a feeling that a boost might come in the form of a lower GST. Postponement of purchases is very much happening, and so far impact has been negative. Now there will be all this negative will go away, and kind of a revenge buy situation will happen the moment the final announcements come in. But on the net, will it result in a sustainable increase in and a steady increase in overall demand? One hopes so. I would hope for a 10% kicker in overall demand for these products if GST does indeed go in the direction that people are expecting it to. But let's wait and see. Like so far, it's been a bit of kind of waiting for the bride, unfortunately.
Indeed, Jairam, good morning. Thank you for joining in. One of the major segments, of course, with regards to this GST has been the automobile segment. And in your earnings call prior, you had highlighted that vehicle loans and MSMEs, there is a bit of stress that you're witnessing. And both of these segments, correct me if I'm wrong, is almost a third of your book. What are the trends that you are currently witnessing right now on ground, now that we are almost 2/3 of the way into the second quarter as well? Do you see those concerns rising, and as a result of which the GST impact may come in later on, but for now, for the second quarter, do you see credit costs going higher for you as a company?
Right. Let me start with this last part and then I'll pivot to the others. No, we don't expect to see that. Credit costs are holding on pretty steady. I don't think there's going to be any noticeable delta in the unfavorable direction. I think we are largely okay. The point you made about car loans kind of having a negative risk impact in the first quarter is absolutely right. After about, I want to say 12 quarters of being in the 90 to 100 basis points range, 90-day delinquencies in car loans shot up to 130 basis points in the first quarter, which surprised us a little bit. And we called that out in our earnings call, and we said that, hey, there's something going on in the car loan segment, which at the moment we're not fully understanding, but it looks like risk has gone up a little bit, right? However, things have not gotten any worse from there. Things have been kind of steady at that level. So I don't expect to see any deterioration. We are 2 months into the quarter. Doesn't look like a lot has changed on that front. Between car loans and MSME, and by the way, when we talk about MSME and kind of risk issues in MSME, that's all in the MSME unsecured space. The secured MSME space, or the lab space, has actually been quite good. There has actually not been any risk deterioration there at all. So between MSME unsecured and car loans, we have about 12% of our book. There, yes, we have seen risk deterioration in car loans last quarter. MSME risk deterioration was more concentrated in the previous year, but it has stayed at those high levels, has not actually gotten better since then. So those are two segments we continue to watch closely. Neither of those two segments has worsened from quarter one levels, but neither have they improved. So I would say about both of them that they are steady at relatively high levels of risk.
Okay, so we are in the wait and watch when it comes to these two segments. Jairam, I wanted to understand what the cost of funding environment has been like since we are in a rate cut environment. There is possibility of more. What's your take here?
So the rate cuts have shown more life and more pass through in the capital markets. So if you're trying to look at the debt capital markets, the rupee bond market, for example, we have been able to raise money at about 45 basis points lower than what we were doing at the same time last year, right? So that's the level of transmission we have seen in the bonds market. However, in the loan market, we are actually not seeing that much transmission yet. Very few banks, if any, have cut their MCLRs, and those that have cut have probably cut by like 10 basis points or so. So I'd say on average, we are seeing maybe a reduction of 5 to 10 basis points in the loan market, but about 40-45 basis points in the bond market.
Jairam, the other bit about the company has been your merger with Pyramal Finance. So what we get to understand is that you're still awaiting merger approval from the NCLT. And based on what you have mentioned earlier, it's supposed to be completed by the third quarter of FY26. Are you on track for that? And once that happens, how much of that do you see benefiting from the merger in terms of your balance sheet?
Right. So yes, we are on track. The NCLT order has been reserved for judgment, which essentially means that they just need to read out the order now, which could happen over the next 10 days or so, or it could be a little bit more than that. But we are talking days now rather than weeks or months. So once we get the approval, and then we will file with the ROC for merger, and effectively our merger will be completed. And once the merger gets completed, our listed stock today, which is Pyramal Enterprises, will be delisted for a period of about 45 days, and Pyramal Finance, which is the bottom co, our shares will get listed as Pyramal Finance at roughly 45 days after that. So that's broadly what to expect from here. It should result in much simpler company structure for investors to understand, one balance sheet for both lenders and equity investors to look at. But fundamentally, from an economic standpoint, nothing should really change. Our economic fundamentals remain exactly the same pre and post the merger.
Take that point. Jairam, last question before we let you go. We did see that reversal of risk-weighted lending that we saw coming in from banks to NBFCs, but still banks are cautious in lending to NBFCs. Can you explain what's happening here and why it hasn't picked up meaningfully the way it was expected to?
Yeah, it has picked up a little bit. Like, I wouldn't say that it hasn't picked up at all, particularly with public sector banks. Things have picked up, and the appetite of the banks towards NBFC lending have indeed changed. With some of the other parts of the banking sector, there have been a few other challenges. Like there have been a credit to deposit ratio challenge outside of the public banking sector, which has actually weighed heavily, and that hasn't changed. Even as the NBFC sector weightage has moved, the CDRs haven't necessarily come into more happy territory for some of the other banks. So there, we need to see more deposit growth before you start seeing some of this credit growth to happen.
Thank you very much, Jairam, for sparing time and joining us today on the sidelines of the Motilal Oswal Annual Investor Conference. Wish you good luck for the rest of the year as well. The management of Pyramal Enterprises on the awaited merger with Pyramal Finance, the impact on the company, and of course, what goes ahead for the business. But the big story of the day that we've been tracking since the morning has been the surge that we are seeing in all of these sugar names. And Rhea is here to tell us why are these sugar stocks having a very sweet day today, Rhea?
Well, yes, the reason that all of these sugar stocks are surging in trade today is that there has been a very significant relief for the sugar industry as a whole. India has removed all curbs on ethanol production from sugarcane juice and syrup, and from B-heavy and C-heavy molasses for sugar mills and distilleries in the sugar season 2025 to 26. And the government is going to periodically review the diversion of sugar for ethanol production to maintain the availability of sugar for domestic consumption. Now, remember, these restrictions restrictions were earlier imposed in December of 2023 due to the rising sugar prices, and now sugar mills will be able to use the inventory that is lying with them of B heavy molasses. So that is a big positive for all of these companies. This will also help achieve the target of boosting the proportion of the fuel in gasoline blends to 20%, the target that has been set by the government. And also in a separate government notification, distilleries are now allowed to purchase up to 2.3 million metric tons of rice from the FCI for ethanol production, and this is going to help enhance ethanol production from dual feed distilleries.
All right, so that's a big news for the sugar industry overall. But let's talk about the stock performance now, Ria. How have they performed? What are the valuations looking like across the board?
Well, yes, just before we come to the stock performance, let's also take a look at the impact on some of these key companies in terms of the contribution from ethanol to the overall revenue contribution. It stands at about 30 to 37% for these key companies. And for profit contribution, it stands at about 43% for Triveni Engineering and for Dalmia Bharat Sugar on the EBIT level. For Balrampur Chini, it is the highest at 63%. Now, coming to the valuations and the stock performance, for some of these key companies, most of them, Balram Chini, Triveni Engineering and EID Parry currently trade above their 3-year average Ps, and Dalmia Bharat Sugar is slightly below its 3-year average. The rest are trading around 17 to 22 times PE. And lastly, in terms of the stock performance, most of these stocks are down anywhere between 3 to 45% over the last 1 year, and EID Parry has been the outperformer, up around 37% over the last 1 year.
Still trading above their 3-year averages despite the decline from their recent highs. Ria, thank you for that. Now, earlier we did speak to Deepak Balani, who is the DG at the Indian Sugar and Bioenergy Manufacturers Association, and Atul Chaturvedi, who is the executive chairman at Sri Renuka Sugars, on the potential impact of this move. Listen to what they had to say.
There's no reason why diversion of sugar to ethanol, which current year is about 3.2 million tons, should not go up to anywhere between 4.5 to 5 million tons. And the sugar industry is quite capable of supplying to the government. The only request from the industry is that for far too long, we have been denied a price increase, and there's no reason why from maize they continue to buy at around 72 rupees, closer to that, and from cane juice at around 65. So there's no fear as far as sugar inflation is concerned.
All right, that's the big story that we're tracking. But for now, we'll take a short break. Up next, we'll discuss the market fundamentals with Anirudh Garg from Inva Asset PMS.
Welcome back. Still 110 points higher on the index. Good time to get in a quick chart check as well. Sneha Sethi from Angel One is joining in. Sneha, good morning. Thank you for joining in. Well, yesterday's move was attributed to a technical bounce, but now that we are above a 20-day and the 100 DMA, do you see this as a sustainable trend back towards that 25,000 mark? What's your call on the index and your stock calls as well for the morning?
So very good morning. If you see the index specifically from yesterday, we have seen a very strong up move, and today's follow-up buying is an interesting thing. However, if you look at the banking index, it has not been performing, and any participation from this space would be very interesting. So I believe for Nifty, if you look at the options activity as well for today, 24,750, 24,800 is the resistance zone, and we are seeing decent pile up in today's session. So any move above this would be very interesting. And in case of banking index, I believe any buying interest coming in and banking index heading above the gap zone, which is created around 54,400, 500 zone, that would be a very positive development. So one should be keeping an eye on banking space as well and the levels which I mentioned. Overall, the chart structure looks good. Now, if you look at the individual counters, I have a 2 buy call. First one is on Ashok Leyland. If you see, the chart structure is very strong. The counter has been forming higher top, higher bottom structure. And I believe the counter is poised for a move above the resistance zone, which is placed around 134, 133 zone. So I would suggest buying this counter with a stop around 128, and the target expected will be around 137. Apart from this, I believe the next counter which I'm liking is Dabur. Here, if you see the chart structure, the counter has given nearly 4% move in today's session. The counter had a very strong resistance placed around 535, 537 zone, and this zone should be acting as a support for now. So keeping a stop around 535, it's a buy, and the target expected will be around 565.
Okay, all right, Sneha, thank you so much for joining in with those levels to watch out for on the markets and individual names as well. From technical, let's go to the fundamentals of the market. Anirudh Garg from Inva Asset PMS joins us now to discuss market fundamentals. Anirudh, good morning. Thank you so much for joining in. I wanted to quickly ask you and get direct to any specific names that you're liking in the market right now. Is it a top-down approach that you're following, or is it very specific to particular companies?
Hi, thank you for having me. Unfortunately, I won't be able to share names, but let's discuss about the sectors and the overall theme of the market, if you permit me. So I think we at Invasset are very, very clear that we are in a structural bull market. And all these chaos and confusion which have been created in the last 1.5 months post the Trump tariff of plus 25% kicking in, I think these are the things where market, particularly bull markets, they form their basis. I believe that if we see history, all the bull markets that have been there have arisen, were born out of chaos and confusion. And the more the chaos and confusion, the better it is. And I think that is a classic case right now. So first of all, we believe at Invasset that markets, our technical desk says that, and we believe that 26,300, which is the all-time high of the Nifty, we should bypass it, not even only retest it in the next 2 to 3 months. When it comes to sectors, okay, so we believe that the last run, the leaders of the last run, particularly CAPEX and PSUs, should not be the leaders of this run. Saying that, in CAPEX, we believe all those, and among PSUs as well, all those companies which are fundamentally very, very strong are doing something which is very, very essential for the nation, for which CAPEX cannot stop. They will continue striving upwards. All these sectors like defense, railways, infrastructure, power, they don't end overnight. It's just that the euphoria ends and the companies which are stronger will continue to do well. Apart from that, maybe I'm answering all your questions in one go, but it's just a flow going on. So apart from that, we also believe that the two biggest relative changes out there are the tax cuts that have been there, the GST cut and the income tax cut. A lot of income has come to the hands of the people. And when you have income, it's generally consumption plus savings. So any person, any company who can extract either through consumption or through savings should, I think this should be the sector where the leaders for the next bull run should come from.
Quite a lot of insight there, Anirudh. But, the flavor of today has been sugar. And it's not something that gets spoken about as it used to be a couple of years back when sugar was set to be a theme. But now with these latest restrictions that have been lifted, the sugar stock is getting a bit of a lift. Do you see this as a tactical play, or you may just want to avoid it and saying that this might just be end up being a one-off because it might just not end up shifting the fundamentals too much on ground and look for other opportunities in the market?
I think the biggest trigger for sugar, as the gentleman from Sri Renuka Sugar was saying, that India has its inflation under control now. So the long due hike, which is required, actually very, very essential for sugar, can now come through. And the government will also be more comfortable in giving it now. So we believe that sugar companies from here should do well. Uh, will they be the leaders for the next run? That is what we hope for when we invest. I don't think so, because they're cyclical companies. They are as much as a commodity as you can get. And you have the only way to play commodities is you track their inventories, you track how the inventories are being depleted. We are seeing the diversion towards ethanol. So fundamentally, things are not bad for sugar from here. But when you have to play them, you have to be very, very cautious, because there's a lot of volatility. The beta is very, very high. So you have to keep your stop losses. You have to make sure that you run them technically once you know that the fundamentals are in place. So if we go for sugar anytime in the future, we don't have to hold sugar right now. But if we see that there are breakouts happening in sugar, or we see some fundamental policy change coming, then surely we will play them, but only and only with a technical understanding, and not for a long-term horizon, not a very long-term horizon.
Oh, that goes for all the commodity names, right? But Anirudh, right now, if there is any commodity-driven sector that you're looking at, which you think could do well technically, of course, you won't give technical answers there, but fundamentally, you think this could be the time for that particular space. So which one would that be?
Okay, so I feel especially for chemicals, specialty chemicals, what had happened in specialty chemicals was that a lot of capacity was set up till 2021. Post that, as China also relaxed its rules, there was a slump in chemical prices, and now we are again seeing that all over the world the chemical prices have started going up. The use of chemicals over the years have increased, is what we have seen. So now we believe that especially specialty chemicals is a space where you should not be bearish. I think the worst period for specialty chemicals is over. Also, I believe that one of the biggest fundamental changes that has happened in the markets is the distrust, a global distrust that has happened post the election of before. Now I can rely on anything for a company which is not very essential to me. But for things which are very, very essential, I have to make sure that I build capacities and I support my producers. So somewhere I believe that the fertilizer space should also be in focus going forward.
Indeed. Anirudh, there has been a lot of talk about electric mobility. Actually, before we get to that, the last couple of days or the last couple of weeks, we've seen a common theme. A lot of these bombed out names have done really well from lower levels. Paytm was a case in point from last year onwards, from levels of around 300 at the start of 2024. The stock is now 1200 plus. Even for names like Ola, from sub 40 levels, the stock has now gone up to 60. Even for MobiKwik now, of course, it's down almost 65% from its post-listing high. For people who wanted to accumulate such names at lower levels, is this still a bet that you would want to take, or you would want to move on to other ideas?
I think there's a huge potential in these companies. See, they are wonderful companies. Getting an app downloaded and then is a very big thing. We have tried it in our company, but overall, all these companies, they are wonderful, wonderful businesses. They have an ability to scale. They have very, very good managements. Whatever the euphoria was has been, taken down from the few years. Yeah, they have run up a bit, and I think they are contenders of buying on dips for sure.
All right, take that point. Thank you so much for joining in. With that, we'll slip into a break. When we come back, we'll put spotlight on one of the stocks which is under the lens, BGI Energy Systems, in our new segment, Under the Lens.
Welcome back. It's 24,730 on the index, 100 points higher, still holding on to those levels of around about that 100-day moving average. As Neha said, was also just highlighting in the previous segment that 24,750 to 24,800 band is the one that is that resistance zone for the index. A couple of movers that have sprung up in the last few minutes. Greaves Cotton is one of them. And now the stock is up 12% as we speak. At last check, the stock was up 7.5. So a double-digit advance for Greaves Cotton. Take a look at the move that you've seen post 10 o'clock on that stock. So 12% higher on Greaves Cotton. The other one is Genesis International, and that too trading gains of around 7%. Another one that has seen a sharp spike in the last few minutes of the trading session. Take a short break. Back on the other side in just a bit. Welcome back onto our special segment Under the Lens. Sonal has hopped over to the wall to talk about a stock on her radar, and that is BGR Energy. Sonal.
Thank you so much for that. Yes, the stock under the lens today is BGR Energy Systems, a stock that's been on a remarkable rally. Shares have jumped nearly 85.5% in last 1 month. But behind that surge lies a company weighed down by weak financials and mounting debt. BGR Energy, it is in the business of supplying systems and equipment as well as turnkey projects or engineering projects contracting. But the operating environment for the company has been far from smooth. On 23rd July, the Tamil Nadu Power Generation Corporation terminated a contract worth 2,600 crore rupees, a major blow for BGR Energy. Now let's break down the financial. That's where the real picture is. Revenues have been on a steady decline, falling from 1,221 crores in FY22 to 1,012 crores that we saw in FY24, and further down, slipping to 452 crores in FY25 and only 89 crores in the first quarter. Profitability paints an even starker picture. EBITDA, which was a positive 130 crore rupees in FY22, has since then turned negative into heavy losses, 270 crores in FY23, 325 crores in FY24, and 566 crores of EBITDA loss in FY25, and in the first quarter at 105 crore rupees. The bottom line has also worsened from a net loss of 178 crores in FY22, ballooning to 981 crores in FY25, and a fresh 266 crore loss in Q1 of FY26. On the balance sheet side, the stress is evident. As of June 2025, cash credit outstanding from banks is around 3,800 crore rupees, and with that, the defaults alone are 3,700 crore rupees. Total borrowings in the company is at around 4,247 crore rupees, while operating cash flows remain deeply negative at 1,857 crores. The company auditors have also issued a cautionary note. They say, and I quote, this is as per their report, "The assumption of the company as a going concern made by the management continues to be inappropriate." And finally, looking at ownership, where promoters hold 51% of the company, but nearly 59% of that holding has been pledged, signaling further concerns for investors. So we thought we'll put a spotlight because the stock has seen a massive surge in last 1 month.
Surge, but with conditions apply and with concerns as well. Sonal, thank you for that spotlight, with that Under the Lens on BGR Energy. With that, we call time on this edition of Trading Hour. From Sonal and me, thank you for watching. Halftime report on the other side.
Stocks add to gains with midcaps continuing to lead amid conciliatory comments from Trump and his team. Utilities, realty and energy lead gainers while financials and healthcare lag.
Stocks of sugar mills surge after government says it will not impose any restrictions on production of ethanol in the coming season. November to October, industry experts see this increasing diversion of sugarcane to near 5 million tons from a little over 3 million tons.
Spot gold scales to a new high of $3,508 an ounce, even as COMEX gold races up to around $3,557 an ounce. Safe haven demand and uncertainty over tariffs and expectations of a rate cut in the US fuel demand.
US Treasury Secretary Scott Bessent tells Fox News that India values are much closer to the US than to China and Russia, and that America will get the trade rift solved.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Bangla Malu as well as Vinny Motiwala. Well, it is turning out to be a session where we are building on gains from yesterday, so that's definitely a thumbs up. We have the Nifty, which is at around 24,725, up around 100 odd points, and we have the Sensex, which is up close to around 300 points as well in today's trading session. We have a good marginal outperformance, you would have to say, for the broader market. So currently the mid-cap index is up around 0.7%. The advanced decline ratio holding in positive terrain. Lot of stocks in focus today, so we're going to kick off the show with that. But we do have the likes of Reliance Industries, the entire sugar pack, which is buzzing, along with a couple of brokerage calls on the likes of Phoenix Mills, which is keeping a couple of these stocks buzzing. Hi, guys.
Hi, take that point. You know, it's been a very good week so far for the markets. Do not want to say it too early, but yesterday was a good trading session. We ended at the high point of trade today as well. We're building onto those gains and climbing on important levels for the Nifty from a technical standpoint too. The good part is all of this is, bedrocked upon a solid mid-cap rally that we're seeing. So we do have, way more stocks advancing than the number of stocks which are declining. And the advancing stocks have actually crossed yesterday's gainers as well. So we have around 2,100 stocks which are in the green for just about 600 in the red. A few notable mentions. We have, the FMCG stocks which are doing well. Dabur, for instance, up around 4.5%. We've seen some traction come by in Nestle as well. And then, obviously, Sammaan Capital is the other one, which ever since its inclusion in F&O, re-inclusion in F&O, has continuously rallied up around 10% today. In the last 3 sessions or so, it is up over 18%. So that's a big move that we're seeing on that counter. And because of the rally that we've seen in the auto pack, even the auto ancillaries, tires, for instance, are picking pace. So MRF has crossed the psychologically important milestone of 150,000 on the stock. So that's what MRF is trading at right now. You have Sept and Apollo Tyres doing extremely well too.
Absolutely. Good afternoon, guys. A good day coming in. And do not forget, today is that first Tuesday where we're seeing the Nifty weekly expiry now coming in for Nifty as well as Nifty Bank. And all sectors today are trading in the green as of now. But let's move on. And we have Vamakshi, who is joining in with us to take us through some of these stocks that are moving around in trade. Vamakshi?
Well, Vinny, let me first start off with the Greaves Cotton. Now, this is a stock that had been beaten down all throughout, the past year. In the last 2 sessions itself, the stock is up almost 15%. And in fact, today it's seen the biggest single-day gain since December of 2024. The company managed to hit a 52-week high of 319.5 in December. But since then, it has corrected almost 30% or so from that particular level. And the gain today is coming on the back of very strong volumes as well. The volumes today are almost 5 times as compared to the 20-day average volumes. MobiKwik is the next counter that is on our radar today. Keep in mind that ADIA has sold its entire 2.1% stake in the company. So, that sort of overhang has gone away and the stock is celebrating. It's up almost 12% or so. It's up almost 19% plus in the last 2 sessions. And despite the kind of move that we've seen, it is still below 60. It is almost 62% below its 52-week high of 698. The average volume in the last 2 days is also extremely healthy of around 2.7 crore shares, almost 30 times higher as compared to the previous 20 sessions. ITI is the next stock that we're watching out for. The company is seeing the biggest intraday advance since May 28th of this year itself. The move is coming on the back of extremely strong volumes. 31 lakh shares traded so far, almost 3 times the 20-day average. Now, apart from that, the company did manage to recover from the lows that it saw in the month of May. But despite that, it's still 20% lower as far as 2025 is concerned. And lastly, take a look at Apollo Micro. The stock has managed to hit a fresh all-time high. It is up almost for the third consecutive sessions. And in the last 1 month itself, it's seen a stellar rally up almost 65%.
Okay, all right. Thanks very much for that. So that's Vamakshi giving us a whole list of all of the buzzing stocks at this point in time. We need to take a short break with the news that the markets are in steady state. And as we do that, a reminder for our viewers as well, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. You're watching us here on Halftime Report, doing well for the market itself. Now, Puneet Chatwal, who's the MD and CEO of Indian Hotels, joins us from the 21st Motilal Oswal Annual Global Investor Conference. Our discussion will be focused on the important following points. The impact of the GST rate changes on the hotels business, the industry that is, the impact of weather conditions on occupancy in the second quarter, and the outlook on overall growth for the sector itself. Mr. Chatwal joining us from the conference. Thanks a lot, Mr. Chatwal, for joining in. You've promised and you've delivered, and the share price has, shown that in terms of the kind of move that we've seen as well. Now, the next trigger that everyone's waiting for is the GST rate changes. From a hospitality sector on the whole, I'd like your thoughts on, what the impact of this could be, because it's with or without the input tax credit. That could be a big game changer, right? Because 7,500, below 7,500 is where a lot of the rooms, the mass priced rooms are. If it goes without ITC, will that make a change in terms of the profitability and earnings of hotel?
Absolutely, and I think that 7,500 ceiling was created 8 years ago. It's not been even adjusted for inflation. So I think given that the sector is the highest multiplicator of jobs, it is in the best interest of the nation to change that ceiling and bring it to the 5% bracket. So it's not an unreasonable request from our side, and I think let's see, time will tell if that change happens or not. But should that happen, yes, it will be extremely positive.
What is the industry's ask as of now? Because what we gather from our sources, what Timsy has been picking up, is that rooms sub 7,500 will move from 12% with input tax credit to 5% without input tax credit. Will the industry be fine with that?
I think so. I think why not? It'll be more transparent, and also it will put especially the restaurants in a lot of hotels on par with the restaurants which are outside the hotels.
Okay. Mr. Chatwal, hi, welcome to the show. This is Ekta. Specifically, how would it impact your business if in case this GST change does come through?
You know, let's not just look at GST. I know that change is going to happen very soon. But generally speaking, hospitality is very highly taxed with very little incentives. Any kind of change in the tax structure, any kind of change in the status, whether you get infrastructure status or you get industry status in the state level, or you get a GST realignment or adjustment, all that is supposed to be positive, and we are looking forward to that. Some of that is already in motion, especially the 50 new destinations announced by the Honorable Finance Minister in her budget speech to be developed in mission mode. So I think there is a lot happening, a lot of positive situation is there for the sector, and that's why the sector has grown very well on the domestic front.
Absolutely, Mr. Chatwal. Good afternoon. Sir, what we also want to understand is that in the recent times, obviously, you've increased your presence or come into the mid-scale size as well, right, by acquiring some stake in Clark's Hotel. Is that the strategy maybe the company will focus on going forward? And if you could highlight some targets coming in for FY26 for Ginger, Cumin, what are we watching out there?
You know, we have clearly articulated in our strategy, which is called Accelerate 2030, that we'll have 700 hotels by then, of which minimum 500 will be in operation. And the majority of the growth will come through the mid-scale and other newer brands and upscale like the Gateway. And Ginger is very well positioned now to get to a portfolio of 250 hotels in 12 to 18 months' time. And the presence of Ginger as a mid-scale product would be relevant in all the district capitals of India. So I think that positioning with the latest acquisition that we have done has happened. Now the other brands will help the growth. But one thing which is clear is that the backbone of the company is, and the focus will never be off Taj. Taj is really the most important brand that we have. And it's not just the crown jewel of our group, but also of the nation. So Taj will continue to grow, and we have some very exciting new openings happening with the Taj. 2 happening in Bhutan in the next couple of months, and another one in Udaipur, and ultimately the Taj in Frankfurt in Germany, our first foray into continental Europe. So a lot of exciting news on the Taj front. Ginger only on domestic front, very relevant and in line with the growth of the middle income group in India to address their needs and wants, which could be a population equal to 500 or 600 million in 5 years from now.
Okay, Mr. Chatwal, it sounds extremely tempting what you've laid out in terms of the Taj plans and the hotels that you all are coming up with. But just on Ginger specifically, what is the growth rate that you all are anticipating within that mid-market segment? And you have targeted revenue of around 1,000 crores within that segment, as well as EBITDA of around 350 crores. When do you expect to achieve that by?
See, we are already at 850 to 900 crores in revenue with an EBITDA of 350. But more interestingly, if you look back 5 years ago, the total revenue of Ginger was lower than the EBITDA. That's how we presented it at the time of the Clark's press presentation. We were around 220 or 240 crores of the total top line of Ginger. So that has significantly evolved, and I think this brand will scale up rapidly, as it has done. 2018, it was a portfolio of 35 hotels, and as I just now mentioned, it could be 250 by next 12-14 months. So that's a significant scaling up, but that's also needed. So in a mid-market brand, scale is absolutely essential for brand awareness, profitability, as well as getting those dots on the map in terms of keeping the customer within your brand. So we are very pleased with the growth of Ginger as it has happened.
Take that point. In the very recent past, the first quarter obviously was impacted by some of the geopolitical disruptions, and you had stated that out in your first quarter as well. But the second quarter as well, over the last 2 weeks or 3 weeks, there has been incessant rains, a lot of flooding, a lot of damages around the country as well. Our heart goes out. From a business standpoint, has there seen some cancellations? Have there been any disruptions?
Absolutely, there have been cancellations, there have been disruptions. As we speak, Mumbai has a lot of that movement which is happening since a few days and is expected to last for a few more days. The rains have created traffic chaos in many parts of the country, including in the national capital. So I think those challenges are there, and it's actually not good for the people. As you said yourself, our heart reaches out to anybody who's suffering. But at the same time, all kinds of headwinds coming in the way of this sector is the best test of the resilience of the sector. Does it bounce back from every low? The answer is yes. Did it bounce back after Pahalgam attack? Yes. Is Kashmir getting to see more and more people going there? The answer is yes. Did it bounce back after Operation Sindoor, where 50 plus airports were shut down? The answer is yes. The only problem is those 7, 8, 10 days that go away, they cannot come back. But having said that, we still maintain our guidance of a double-digit growth for the current financial year.
All right, and a final question to you. On the one hand, any sort of policy push could do extremely well for the hospitality industry. You are a high employment sector. You've been asking the government to increase the impetus on tourism and, give you better status, etc. as well. But one faction believes that luxury should be charged higher prices, and that is something that is worrying the street. Is there a possibility that while, GST for hotels which are under 7,500 would be capped at about 5%, but higher rates for some of your crown jewel properties as well could come by, and could that be a deterrent from, say, 28% if goes up to a higher level, 40%?
I would not like to speculate on the tax point. I think we have been in a good space in the last few years. The sector has benefited from the spends in infrastructure development, whether it's highways or it's train stations or it's airports. I expect that trend to continue. It will be counterproductive to tax it more or higher. But should that be the case, again, the resilience factor would come in. I think luxury is less sensitive to price, but I think if we have to stay competitive within Asia and especially within Southeast Asia, we are already taxed the highest. There is no other country which pays 18% on upscale, upper upscale or luxury when compared to India.
Okay. All right, Mr. Chatwal. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Indian Hotels maintaining its double-digit growth estimate or guidance, and also estimating that Ginger Hotels should probably hit that 1,000 crore revenue mark soon enough. On that note, we'll take a break with the news that the Bank Nifty is in fact slipped into the red, so just about lower by around 12 odd points. Do watch out for that. And additionally, remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. Well, steady for the market. So the Nifty is up around 104 odd points. Like I mentioned, the Bank Nifty is seeing some amount of profit booking from the top. So the Bank Nifty chart should come up for you just about 10 points higher at this point in time. It's just about moving between red and green, as you can see, flattened out currently for the Bank Nifty. If you're talking about specific stocks within the Nifty space, when it comes to financials, we have ICICI Bank, which is in the red. So that stock is down around 0.5%. Axis Bank, Kotak Mahindra Bank, both these stocks are down anywhere between 0.2 to 0.3%. So a little bit of profit booking, which is coming in there. Other stocks which are seeing some amount of deceleration is in fact Dr. Reddy's, which is down around 1% from the pharmaceutical space, and Asian Paints, which is down around 0.7% as well. But let's get in some market perspective then. We have Varun Sharma, who's the fund manager at Motilal Oswal Asset Management Company, joining in now from the 21st Motilal Oswal Annual Global Investor Conference. Our discussion will be focused on the following points, which include their focus in terms of driving growth and transformation in the digital space, digital versus IT services, and how the digital ecosystem is probably differing in countries such as the US and India. Varun, hi, welcome to the show. Thanks very much for joining in. Well, let's start with your thoughts on digital innovation. If you want to play that from an Indian market equity perspective, how does one do that?
See, the idea is very clear. We continue to focus on growth. And what we are seeing is that the Indian digital ecosystem is in its nascent stages in India. It's become fairly big elsewhere in the world when we specifically look at the US or China. And this is the opportunity. We are seeing a multi-decadal opportunity for digital in India. Now, there are companies that span across multiple types of business constructs, whether it's direct to consumers or B2B or B2B2C. And we are finding opportunities in almost all these areas.
Right, Varun. Good afternoon. Also, if you could just specify where maybe is this opportunity coming in for an investor in terms of any stocks that one is looking at, anything there that you could highlight?
See, digital as a theme is a diversified theme. It is penetrating various industries, be it retail or food tech, or even in the financial services across various subsegments, whether it's lending or whether it's payments or wallets. And we've seen this in areas like insurance as well. In certain other industries like logistics, navigation, travel, again, we are seeing many companies that are coming up, smaller companies today that can become big in future. So we are seeing opportunities almost everywhere. Wherever digital has a role to play, it's playing.
All right.
Okay, all right. But Varun, just coming to IT services in specific, there's been a clear underperformance which has taken place for the IT index this year. It's down around 17% odd. From that perspective, do you think that this is a good time to approach IT stocks?
See, what we believe is that IT services has become mature in the country. It's had its run. We are almost close to a quarter of the global IT services industry, and when we look at it from headcount or the volume terms, we are far bigger now. It's the usual life cycle of any industry. When it becomes too big, it's very difficult for the industry. Now, when I'm saying industry, I'm talking about Indian industry, Indian IT industry, to grow way faster than the global industry. And the global industry has always grown at low single digits, at best mid single digits, and that is where we would expect Indian IT services to converge to gradually, and it's been converging. Now that industry has become so big, we are not finding opportunities in larger companies simply because it's a base issue, much larger revenue base. We are finding opportunities within IT services only in select niche companies which have very differentiated strategies, because it's a large market out there, may not be growing fast, but it's a large market. So we are finding opportunities there, but if one were to look at IT services as an industry all put together, we don't find it to be growth, we find it to be X-growth now. And we will not be surprised if these revenue growth pressures continue for a very long time now. So we do not advise this industry for investment as such.
All right, you say this is X-growth, but some are also seeing this as value right now, given the sort of correction that we've already seen, and perhaps the tailwind of a US rate cut of nearly 100 to 150 basis points over the next 12 to 18 months, and that could increase their base valuation. Be that as it may, one of the reasons why the Indian IT stocks or the Indian index has also underperformed vis-a-vis the globe is that because we've not had any AI/chips related play in India, as against the Nasdaq, which was supported by, say, something like an Nvidia, or we had the Chinese indices, which were buoyed by some of the chip makers, so to say. What do you think could be some of the places in which or via which we can play this entire AI/chips sort of theme? Would there be investable ideas here in India?
Yes, see, eventually they will come, because the Indian chip making ecosystem is also developing. But pertaining to the question around IT services, yes, there's an opportunity that growth rates may increase marginally here, but the whole idea of going back to double-digit growth for the industry is completely unimaginable, because as I told you, the base is very large now. But when it comes to other aspects of technology or other aspects of digital, yes, they are becoming bigger, and that is where we are finding opportunities.
Sure.
You are right. When it comes to AI, most of the market is taken by some of the US giants. So we will have to wait and watch and see if something can emanate out of India.
Okay. All right. Varun, just before we let you go, and briefly, if you could just stack up your top sectoral bets for us at this point.
When we look at the technology or digital ecosystem, we are finding almost these opportunities almost everywhere. But we are finding more opportunities when it comes to retail, because retail is a very, very large market. We are finding opportunities on the travel side as well, especially because there's a discretionary environment. Travel discretionary environment is quite strong all over the globe. So there are several opportunities over there. There are certain opportunities, as I told you, emanating out of the financial space as well. So we are finding opportunities over there, especially in the insurance side as well as on the payments and lending side. So these are the areas that we find quite attractive when it comes to the digital and technology ecosystem.
Okay, Varun, thank you so much for that, highlighting some of those important sectors, importance in terms of digital AI, where we should be keeping an eye out on, as well as your views in terms of the IT sector as well. But on that note, we're going to slip into a very short break. But here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store, Google Play Store, or you can just scan the QR code on your screens. Welcome back to a halftime report on CNBC TV18. Let's just pull up the rupee, because we're seeing a bit of an appreciation that's come in on that front. And look at it right now, right? 87.90, 0.3%, 0.30 is what we're watching out for in terms of an appreciation. That's coming in the last few minutes as well right now. So that is a big move that we're just seeing in the last few minutes. So that's something that we're keeping an eye on.
Yes, in fact, the rupee has been hitting those record lows because of the trade tariff tensions. So the rupee in yesterday's trading session, the intraday low was 88.3. And even in today's trading session, the rupee, in fact, hit around 88.16. So on an intraday basis, there's been a sharp appreciation which has taken place on the rupee, currently currently above 88. So currently at around 87.9, around a 30 paise appreciation which has taken place for the rupees. So let's see whether that sustains, but we do understand that maybe there could have been some amount of, statements with regards to trade. So that should probably come up for you soon enough. But that's the rupee for you, a bit of an appreciation which has taken place. Let's see where that goes. Currently 87.9. The intraday low, I think, was around 88.16 in today's trade.
Absolutely. But, on that note, let's also talk about something on the commodity front, right? We're seeing gold, silver prices, which are at highs. Now, silver prices have gained 40% so far in 2025, outperforming recent highs. Jonathan Barrett, CIO at ETO Markets, tells my colleague Manisha that silver prices will soon touch 2011 high of $49, per ounce that we were seeing that time. Listen in to that conversation.
Yes, absolutely, even more so. A lot quicker, actually. I think when you look at that $50, I think the market's got that in its sights. There is no real reason as to why it can't get there. I mean, silver has two roles, as we know. Silver is a store of value, similar to gold, but it's also got an industrial use. And I think when you look at where that industrial use is placed, and China is obviously the main buyer, that particularly for its solar panels, I get a sense that we haven't got the right amount of supply to meet that current demand. And if China's saying March on solar is where it has to be, and then that requires that demand for silver, then I think you'll see that $50 breached this side of Christmas rather than further out. So I'm sort of remaining quite bullish on silver.
And, a lot of people, of course, are holding into gold and silver. But, Jonathan, if somebody wanted to buy it fresh, do you think this is the right time as well?
Yes, I do. I think when particularly on silver, when we broke through 39.50, that was a key technical point for us. Then, you've got to ask yourself, when do I get in the silver market? Have I missed the boat? And I think the key is that if you do want to get into silver, then just take a small amount at these levels, and when that gets in profit, start to trade up into the position. So it's always hard when you're on these record highs, when to buy, and have you missed the boat. But if you take 100% of your normal position, just take on 10 to 15% to start, make sure that's in profit, and then average up into the trade as it goes higher.
Interesting, as you say, Jonathan, that gold, of course, seems to be gaining, but that would be, of course, because of dollar index decline. Silver, of course, is a different story altogether. Deficit market, strong industrial demands, value, and then we're also looking at very strong investment demand coming in for this one as well, from retail, on ETFs, and etc. So if you really had to divide a portfolio between gold and silver, how would that ratio look like for you?
Firmly weighted with silver. And I think in my mind, when you look at it, gold will always be that store of value, but it has reached record highs. Silver hasn't, so you've got to be weighted towards silver in that ratio.
Are you going to make it 30-70, 60-40, 80-20?
No. I think you can be a 60-40 on that. But once again, it's all about how you average up in your position. If silver starts to move, which is a lot more volatile than gold, the tendency will be to average higher, which will then push your weighting towards silver over gold, because gold hasn't yet reached those record highs, but there's more volatility in silver. So your return will be higher in silver than it would be gold to start with.
How are you also looking at the tariff situation? Because the markets do believe that it would perhaps take a couple of months, if more, for the situation to settle down.
I'm nervous, to tell you the truth. I'm nervous as to what can actually occur, because if the tariffs are voted as being void, then the tariffs that have been collected could have a problem with the US Treasury, because that's about $159 billion that has been collected. They'll have to pay it back, and I think that will be a major concern. I think that it's an issue that, well, hopefully we'll get some read on sooner rather than later. But I think it's something that'll go on for some time, and hopefully that'll quieten the volatility. But as we've got uncertainty out there at the moment because of the tariffs and whether or not they will be void or not, it's been a complete mess. And if it's a complete mess, the market's not going to like it. So I'm hoping that time will actually add as a bit of a panacea to calming the market down.
Jonathan, what is your sense also on the metal prices? Because we've seen some support come in for copper, also for the ferrous metals. Steel and iron ore seem to be doing well. That is, this is after China has put a kind of a cap on steel production there. But when you look at the latest Chinese data, that hasn't been any support.
Correct. I mean, when you look at the latest, the NBS data that came out, we're not in growth phase. We're still in contraction phase. That is a worry. I think we always look for more stimulus, from the PBOC. So I get a sense that we're not going to get it. But remember, as we know with copper, we've had quite a huge sell-off. It makes sense for it to recoil some of that. Let's see how the bounce occurs and whether or not the economics behind it will support it. I think China continues to be in that growth phase, and as correctly pointed out with iron ore, etc., we are getting a little bit of support at the moment. That could be just dollar-related weakness, but I would like to think that China has capacity to stimulate the economy, and she'll continue to do that, and that should underpin any price decline.
What are you most bullish on when it comes to overall metals within ferrous and non-ferrous, both the segments?
Oh, it has to be silver, I'm afraid. But I think silver is something I've been passionate about for most of the year, and I'm waiting for it to hit the record highs.
Welcome back to a half-time report on CNBC-TV18. As of now, Nifty managing to hold on to 24,700, 0.5% of gain. Day's highest point is what the Nifty is trading at. But we have Rajneesh Narang, who is the Director of Finance at HPCL, joining in with us from the 21st Motilal Oswal Annual Global Investor Conference. Our discussion will be focused on the following points. One, has HPCL received its LPG compensation? The second point that we'll be discussing is what is the percentage of Russian oil is sourced currently from Russia is what we're watching out for, as well as an update on Pyramal and Vizag project is what we'll be keeping an eye out on as well in terms of the discussion points. Hello, sir. Good afternoon. Thank you so much for joining us. Let's start by talking about the first point, that is the LPG compensation. Now, the government has finally announced LPG compensation of overall 30,000 crore rupees. How much will HPCL actually receive the same, and has anything that has come in Q1 as well?
Yeah, good afternoon, viewers. As regard the LPG compensation, you are aware that government has announced a compensation of 30,000 crores. HPCL market share in LPG is around 27%, so we expect around 27% of this 30,000 crores, which would be coming to HPCL. Now, as regards the final details of the same, we are yet to get the letter from the ministry. So as of Q1, we have not considered any compensation in our accounts. As and when we get the letter from the ministry as regard the compensation, the same would be suitably accounted in the books of accounts.
Right. You know, the overall industry's under recoveries were close to around 41,300 crores. So we wanted to know what your overall under recovery has been, because the government has approved 30,000 crores. So going by the 27% that you're talking about, you should get closer to 10,000 crores. What have your under recoveries been, and would this 10,000 crore be enough to mitigate all those losses?
See, the under recovery for HPCL was around 11,000 crores, and out of 30,000, if I take the 27%, it would be around 8,000 odd crores, which HPCL would be getting it out of it. While it may not fully compensate the full under recoveries, but yes, to the extent of what the government has approved the compensation, we will get our legitimate share out of it.
Believe that there could be another package coming soon as well, or do you believe that this is just a one-time thing and you'll have to take a hit on the other under recovery that you have?
No, it ultimately depends. The under recovery depends upon the LPG prices. If you see over the past few months, the LPG under recoveries have come down, and even this current month, the LPG under recoveries have significantly come down. So it depends upon how the under recoveries fare over a period of time, and in case the need be, then definitely we will seek compensation from the government in future.
So how much are you anticipating LPG under recoveries to be for the entire year, Mr. Rajneesh? Any kind of visibility that you might have now?
No, it keeps on changing with the change in the LPG prices for butane and propane. Now, if I see the current year, in the current month, the under recovery is less than 50 rupees per cylinder. So it depends how the prices will fare in the near future, and the same would be accordingly calculated. Last year we had around 11,000 crore. The first quarter was around 2,000 odd crore. So it will keep on varying depending upon the prices of these two products here.
Okay, fair enough. Just give us a sense in terms of the Russian crude oil imports. Overall for India, the Russian crude oil imports stand at around 34-35%. What is it for HPCL? And give us a sense in terms of the price differential between Russian crude and other crude.
See, as regard the sourcing of Russian crude is concerned, Russian crude has always been in our crude basket. It's not that we started purchasing Russian crude only after the Ukraine war. Primarily, the sourcing of the crude is decided, it's an economic decision which is in which we run through an LP model, and whichever crude gives us the maximum value is what gets sourced out. Now, last year we had processed almost 32-35% of Russian crude. The first quarter we had taken around 13%. So depending upon the crude prices which are prevailing, we source the crude, and that's what makes the difference to us as regards the product worth of crude, product worth. What we get out of the crude is the decisive factor as regards the sourcing is concerned.
Mr. Narang, if you could just talk to us even about your marketing margins. Right now, given that crude has remained below that $70 per barrel approximately for this quarter, what are we expecting in terms of margins there? Also, in terms of any possibility of fuel cut is something that we could watch out for. Fuel prices cut.
See, the last government had increased the excise duty on the motor fuels, that is MS and HSD, that was in April, and there was no change as regards the end prices to the retailers are concerned. And more or less the prices have remained range bound, except a few occasions when because of geopolitical tensions, the crude prices and the product prices had gone up and down. So we expect that the prices would remain in these range only, and accordingly the prices have been priced in the market. The product prices have been accordingly priced in the market.
Right. Just to go back to the Russian crude point, you said 13% was sourced in the first quarter. How much more profitable is Russian crude versus others? We just want to understand what the possible hit could be were the government to decide on lowering purchase of crude from Russia. We're just trying to, hypothecate a situation out here, largely because that's what brokerages are expecting as well.
No, there was a time when there used to be significant discount as regards the Russian crude is concerned. Later on, as the discount levels came down, and we keep on evaluating the options with respect to the various alternate crude. And as I said earlier, it's an economic decision, and a crude which gives us the maximum value is what we source, and accordingly the sourcing decision is taken. So it varies upon what is the discount and what is the product worth which we extract out of the crude, which is the decisive factor. So to clearly give you an indication as to what the differential may not be the right parameter of it.
Okay, all right, Mr. Rajneesh. Thanks very much for joining in and speaking with us. So that's HPCL talking about the under-recoveries. Yes, there's a total LPG compensation of around 38,000 odd crores, and HPCL has received around 8,000 crores from that. We need to take a short break, but on the other side, we'll get you a lot more stocks which are buzzing. Stay tuned. Welcome back. Well, for the mid-cap index, up around 0.7%, so it's picking up a little bit of pace. Bank Nifty still lagging. We have Mangalam now to tell us what he's tracking on the F&O space. Mangalam.
It's a good-looking screen if you're a bull. For the second day running, the market's been trading higher levels, and through the day, it's been a bit of a trending day. So at any point in time, if you went long on the Nifty, you would be making some sort of money in the last two trading sessions. So you have the Nifty, which is doing well, the mid-cap index doing a shade better. The only thing that is conspicuous by its absence is the Nifty Bank, which has actually not performed very well over the last 10 days or so, at least the way the Nifty has gained. So the top contributors, we've been taking turns. Yesterday it was the IT space, and today it is Reliance. So the intraday chart of Reliance comes up for you, along with the 45-point uptick that we're seeing on the Reliance stock, which is nearly 30% of the gains that we are seeing on the Nifty. And with this gain that we've seen on the Nifty itself today, it's above important technical levels, above the 20-day moving average and above the 100-day moving average. Closing above these will be extremely crucial. But as the market has moved higher, so have the put writers gotten fairly aggressive as well. Today is the weekly options expiry, so 24,700 put, and almost 6 crore shares written out there for a premium of 10 rupees, telling you that 24,700, the 20 and 100-day moving average, extremely crucial support zones. But at the same time, 24,750 call writers haven't, given up their positions as well. Close to 4 crore shares in open interest for there, around 25 rupees. So the put call ratio at higher levels. 24,750 call writers still active, with a lot of aggression shown by the 24,700 put writers. If the market does break this range, then maybe we could see a further downtick. Or if we cross past 24,775, we will see further short squeeze coming by for our markets. A lot of individual stocks on our radar. Samman Capital, definitely one of those stocks of this series, entered the F&O trade once again in September series, and that stock's doing extremely well, fairly well built too. Dabur and Punjab Housing Finance, PNB Housing Finance are the others which are seeing a fair amount of long positions being added too.
Okay, Mangalam, thank you so much for that. We'll be keeping an eye out on all these names in the world of F&O as well. But on that note, we're absolutely out of time on this edition of Halftime Report, leaving the Nifty at 24,740 levels. Thank you so much for tuning in. Up next, a Business Snatch.
Stocks at gains with midcaps continuing to lead amid conciliatory comments from Trump and his team. Utilities, realty and energy lead gainers while financials and healthcare lag. Stocks of sugar mills surge after government says it will not impose any restrictions on production of ethanol in the coming season, November to October. Industry experts see this increasing diversion of sugarcane to near 5 million tons from little over 3 million tons. Spot gold escalates to a new high of $3,508 an ounce, even as COMEX gold races up to $3,557 an ounce. Safe haven demand amid uncertainty over tariffs and expectations of a rate cut in the US fuel demand. US Treasury Secretary Scott Bessent tells Fox News that India's values are much closer to the US than to China and Russia, and that America will get the trade rift solved. Well, hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Doria and it's only the second day of this week, but the index is up and away in trade today. The bulls continue to march on. The Nifty for now is up almost 115 points. The mid-cap end of the market is also doing extremely well, up almost 0.7%. But what is not actually contributing to the gains is the Nifty Bank Index, which is rather flat but is trading in with a slightly positive bias. Largely, the advance decline ratio is in the positive, is in favor of the advances. We have approximately 2,000 stocks advancing for almost 700 stocks that are declining in trade today. Now, as far as sectoral movers are concerned, Nifty Energy Index is the one that is actually leading the gains. We have several power stocks as well as, stocks from the energy space overall that are buzzing around. Torrent Power is one such name, up almost 3%. Yesterday as well, the stock did quite well. Today, up another 3% for Torrent Power. In fact, in the last 1 month, the stock has not done much. So, big gains on this counter. IGL is the next counter we're watching out for, 3.2% higher. CG Power also did well yesterday, continues to do well today as well. Apart from that, Nifty Media is doing well. There's a brokerage that came in from Sun for Sun TV. That stock is also flying high in trade today. But what's actually buzzing around are the sugar stocks. Where if you look at some of the stocks that are moving around in trade, Sri Renuka is up almost 13%. Dhampur Sugar is up almost 12%. Dwarike Sugar, all of these sugar counters are flying high, and that is nothing but our big story of the day. Ria is here to tell us why are these sugar stocks surging. Ria?
Well, yes, Vamakshi, there's been a significant relief for the sugar industry. India has removed all curbs on ethanol production from sugarcane juice and syrup, and as well as B-heavy and C-heavy molasses by sugar mills and distilleries in the sugar season 2025 and 26. And the government is going to periodically review the diversion of sugar for ethanol production to maintain availability of sugar for domestic consumption. Now, these restrictions were earlier imposed in December of 2023 due to the significant rise in sugar prices during that period. And now, after this new move, sugar mills will now be able to use inventory of B-heavy molasses, and this is also going to help in achieving the target of 20% ethanol blending that has been set by the government. And in a separate notification, distilleries have also now been allowed to purchase up to 2.3 million metric tons of rice from FCI for ethanol production, and this will further enhance ethanol production from dual feed distilleries. Now, resultantly, all of these stocks are higher in today's session, but quickly looking at the valuations and the stock performance over the last 1 year for Balram Chini, Triveni Engineering and EID Parry, these currently trade above their 3-year average PEs, and Dalmia Bharat Sugar is just slightly below its 3-year average PE. In terms of stock moves over the last 1 year, most of these stocks are down anywhere between 3 to 45%. Only Shriram, DCM Shriram is up around 9%, and EID Parry has been the outperformer, up by around 37% over the last 1 year.
Well, thank you so much for that, Ria. That explains the moves on all of these chemical counters. But earlier on, we also spoke to Atul Chaturvedi, who is the executive chairman at Sri Renuka. Let's also listen into what he had to say.
There's no reason why diversion of sugar to ethanol, which current year is about 3.2 million tons, should not go up to anywhere between 4.5 to 5 million tons, and the sugar industry is quite capable of supplying to the government. The only request from the industry is that for far too long, we have been denied a price increase, and there's no reason why from maize they continue to buy at around 72 rupees, closer to that, and from cane juice at around 65. So there's no fear as far as sugar inflation is concerned.
We opened the stock of current season with around 8 million tons. We are hopefully will be closing the season with around 5.2 million tons. Having said that, the next year crops looks very good, and our estimate, the first estimate is around 35 million tons. The domestic prices saw an upward, the corrected movement, and we are seeing a stable prices in an anticipation of much better crop and much better sugar production next year.
Well, moving on then, the GST Council is set to meet on the 3rd and 4th of September to discuss the centre's proposal for a simplified two-slab structure. My colleague Timsy is bringing us all of the details. Timsy, over to you.
Prime Minister Narendra Modi's vision in his Independence Day speech on next generation GST reforms could soon be a reality. The GST Council is set to meet on 3rd and 4th of September to discuss the centre's proposal to shift to a simplified two-slab structure of 5% and 18% with a special 40% rate for sin and demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities such as soap, shampoo, medicines, hair oil, toothpaste, biscuits, namkeen, bhujia, footwear and apparel below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in the lower category of 5% or even in certain cases exempt. Aspirational goods such as television, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc, which are currently taxed at 28%, may move down to 18% slab. The proposal also includes a major relief for consumers and industry with life and health insurance premium, as well as reinsurance likely to be exempted from GST. While the centre is confident of a smooth passage, states have raised concerns over possible revenue losses. They have sought assurances of revenue protection, pointing out that they are not opposed to the rate rationalization but need compensation to meet their financial obligations. Also, a mechanism to ensure that the rate cuts are passed on to the end consumer and not result in any windfall gain for any of the companies. The September 3rd and 4th Council meeting is expected to be a crucial one, with the potential to usher in a new phase of GST, simpler, consumer-friendly and aligned with the Prime Minister's reform agenda. Something that we'll have to wait and watch for the Council as to what finally passes through.
Well, thank you so much for that, Timsy. But moving on then, India's scorching 7.8% GDP print raised some issue around the deflator, but NSO sources tell CNBC-TV18 worries of a low deflator are overstated. This comes a day after many economists and media reports said that India's higher than expected GDP at 7.8% versus market estimates of 6.8% may have been because of the deflation method. Lata is here with more.
Well, I did reach out to NSO top sources in the National Statistical Organization and in Finance Ministry. And the NSO sources clearly said that the Indian methodology, the NSO methodology, is comparable to the best in the world, and IMF or international bodies have no problem with the way we calculate. Now, let's first state the worry. Analysts say that the real GDP has come at 7.8%, higher than last year's 6.5%. Nominal GDP has come at 8.8%. Lower than 10.8 last year. So the difference between the two has narrowed to just 0.9%, which is the deflator, which looks very low. The analysts and media worry is that the NSO calculates all goods and services at current prices and deflates it with the WPI, which is very low because it is negative in the last 3 months. NSO says that is not their methodology. For a large number of products, more than half the products, they actually look at the volume growth. They're not going with prices, you know, how much agriculture, the value add was last year, how much crops produced this year, metals, mining, electricity, how many watts of electricity is produced. So it is in constant prices only. And then having calculated the extra production, they add the WPI of the relevant product, as the case may be. So for agriculture, mining, electricity, construction, transport, communication, all these are measured in volume, in constant prices. But there is a segment where you don't have volume and where you measure it in current prices from the BSE, NSE corporates that announce results. Those are private mining companies, manufacturing companies, trade, retail trade, real estate companies, finance companies, that is RBI data on deposits and credit loans, public administration, government's revenue numbers, and other services like health and education. These are measured from companies where you only get the current prices and then you deflate them with the appropriate WPI or CPI, as the case may be. So over there can be a feeling that on years when the WPI is very low and negative, maybe the deflator is too low and therefore it is overstating the real GDP. But that is only for maybe 45% of the total products. The NSO also said that there is no wholesale price for health and education, so they have to do it. They have to take the general WPI. There's no other option. They point out that there are some countries which use the PPI. Now, PPI is Producer Price Index. It's a little better than WPI because in WPI you take, say, the LME price of steel. But PPI would be when that steel comes to the producer and the cost. So there some logistics, transport, etc. are included. Services are included. So those are a little cleaner. But even what the NSO source told me was that even in foreign countries, it's not as if all products they do in this fashion. The other charge is double deflation. In many foreign countries, they deflate the input price and output price separately and get the value add. In India, the NSO only deflates the output price. So that may lead to some overstatement in manufacturing. Again, the NSO says that this double deflation is not indulged in all products abroad. They do it for some products and they extrapolate it. How is the NSO going to address this? February 2026, the new GDP series is coming. Most of this PPI, double deflation, all are going to get addressed in the new one. Also, the current CPI, which is used, has very little services because this was designed in 2012. At that time, a typical Indian family had more money spent on food. But now, 13, 14 years later, the family consumes more services. So the new CPI, instead of the 199 service items in the last CPI basket, will now have 400 items. So services will be better represented. We are in for, therefore, a healthier, more representative methodology.
All right. Thank you so much, Lata, for explaining that to us in such simple terms. But, let's move on and let's also get you an exclusive on the insurance sector. Sources are telling CNBC-TV18 that the Bima Sugam initiative and IRDAI proposed marketplace for insurance sales, servicing and claims could now be rolled out without the involvement of the IRDAI. Yash is here with more details. Yash?
Well, what we've been given to understand from our sources is that Department of Financial Services, or DFS, is not, in favor of having any involvement of the regulator, the insurance regulator, that is IRDAI, with respect to the operational responsibilities or taking up roles or having any, operational role as far as the insurance marketplace Bima Sugam is concerned. What we've been given to understand from our sources is that DFS may ask the insurance regulator to pass on all the roles which it has taken with respect to, conceptualization and rollout of Bima Sugam to the industry, that is the insurance industry itself. What also our sources tell us is that the launch of Bima Sugam itself could be delayed by another 12 to 18 months. This should have happened by now, but the launch of the insurance marketplace Bima Sugam could itself be delayed by about 12 to 18 months. What we've been given to understand is that straight away this delay which could come about as far as the launch of Bima Sugam is concerned could be a positive for Policy Bazaar, that is PB Fintech, because this was expected to be a competitor as far as PB Fintech and Policy Bazaar is concerned, but the launch could be delayed by about 12 to 18 months. Now, the reasons for the delay are coming out very evidently as we speak to our industry sources. Not being a priority for the industry, being on the back burner, no clarity that the industry has with respect to investments, form and shape of Bima Sugam. And finally, as far as the road ahead is concerned, the industry still has a lot of questions without any answers to them as of yet.
Well, thank you so much for that, Yash. But, before we slip into a very short break, take a look at some of these chemical counters like SRF as well as PI Industries. Now, just a short while ago, we did see some flashes at the bottom of your screen, which indicated that there was a relief for chemical exporters. The export obligation period for QCO products has been extended. QCO products are nothing but quality control orders. The export obligation for these products have been extended from 6 months earlier to 18 months. And this essentially provides support as well as flexibility to exporters that are dealing with chemicals as well as petrochemicals. So, big relief for them. So, SRF, as you can see, has recovered from the day's lowest point. PI Industries also seeing a brief recovery. But moving on then, a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists along with curated studio tours, e-learning sessions and masterclasses and curated lifestyle benefits. Welcome back. You're watching Business Lunch on CNBC TV18. Now let's actually put the spotlight on the world of semiconductors. PM Narendra Modi today inaugurated Semicon India 2025 in New Delhi. Now speaking at the event, he pitched India as a leading chip manufacturing destination to investors. He said India's Semicon journey began in 2021, adding that at least 10 projects have been cleared so far. Now these projects have attracted investments worth over $18 billion. Let's listen in to what the PM had to say.
एक बार फिर भारत ने हर उम्मीद, हर अपेक्षा, हर आकलन से भी बेहतर प्रदर्शन किया है। एक तरफ जब दुनिया भर की इकोनॉमीज में चिंताएं हैं, आर्थिक स्वार्थ से पैदा हुई चुनौतियां हैं, उस माहौल में भारत ने 7.8% की ग्रोथ हासिल करके दिखाई है। ग्रोथ की यही दिशा है तो भारत को थर्ड लार्जेस्ट इकोनॉमी बनाने की तरफ तेजी से बढ़ना पक्का हो चुका है। और जो हमारा डिजिटल इंफ्रास्ट्रक्चर है, उसका आधार क्रिटिकल मिनरल्स है। इसलिए भारत आज नेशनल क्रिटिकल मिनरल मिशन पर काम कर रहा है। हम रेयर मिनरल्स की अपनी डिमांड को अपने यहां ही पूरा करने में जुटे हैं।
Well, those were some comments made by PM Modi. But moving on then, Ashmit is also here to take us through some of the key takeaways from the summit. Ashmit, take it away.
Well, we're here at Semicon India 2025. It's a marked development as far as the India Semicon journey is concerned. Bear in mind there are over 33 countries represented here, over 50 large companies, the likes of ASML, Lam Research, Applied Materials. They're all here, present here. They were here for the inaugural session as well, marked by the Prime Minister's speech. There were three key takeaways from that speech that we need to bear in mind. Number one, he began with the punchline saying that if oil is gold, then, well, these chips are digital diamonds. And to that end, he went on to say that it's a $600 billion market for semiconductors across the world. It will soon turn into $1 trillion, and that India is aspiring to be a major chunk of that $1 trillion market. Takeaway number one. The second takeaway, and this is with respect to the government support that is being extended. Bear in mind, Semicon Phase 1 had an outlay of 76,000 crore rupees. Here, today, he gave an indication that going forward, ISM 2.0, the second phase, where there will be extended outlays, is something that is around the corner. Sources tell us it's only a few months away. By the end of December is when we can expect the contours of ISM 2.0, and that is a key aspect that a lot of large players who are visiting Semicon India 2025 will be watching out for, to understand what the government's fiscal support program for the industry looks like going forward. That's takeaway number two. And takeaway number three, and this is of course more optics, the first made in India chip under the semiconductor program, which is made by the CG Power plant in Gujarat, was in fact today released. It was put out, was presented to the Prime Minister. He in fact clarified that this is the first of many to come, that there is a case of growing capacities. Cairns will be soon coming out with their own made in India chip from their pilot line. Commercial production is likely to begin soon. So clearly the Prime Minister pitching India as a destination, saying that in a world of uncertainty, in a world of geopolitical tensions, India presents a stable option for investors, for companies, as well as for the larger semicon ecosystem.
Well, thank you so much for that, Ashmit. But take a short break then. More news and updates follow on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC-TV18. Well, the markets, on this expiry day, which is the first of, the Nifty's Tuesday expiry, has taken a sharp knock, almost 70 points lower from the day's highest point for the Nifty. And, the Nifty Bank actually was trading rather flat, but it has now taken a turn for the worse, of almost 270 points from the day's highest point. The mid-cap end of the market too was earlier, when we just started the show, was trading with a gain of around almost 0.7%. That too has seen a cool off. The mid-cap index is also off almost over 200 points from the day's highest point. And actually the fall on the Nifty is being led by a couple of stocks. Pull up the chart for Adani Enterprises rather. That stock has also cooled off about 1% or so from the day's highest point. Down. It was actually in the green. It has now taken a turn for the worst, trading with a cut of almost 0.2%. Coal India, Shriram Finance, Adani Ports are just some of the other counters that have also cooled off from the day's high. But with that, that's all we have on this edition of Business Lunch. Don't go anywhere. Midcap Radar will take the action forward.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Fatakia. And at this point in time, markets are off the highs, almost a 60-point cut from the highs of the day, still in the green. But yes, there is some selling that we are seeing from the top. Mid-caps have come off. Banking index in the green right now. So these are banks which are putting some pressure. But a lot of stocks on our radar today.
A lot of stocks indeed. And it's, of course, the first NSE Tuesday expiry as well. That's being a bit of a factor here. The Nifty Bank is continuing to be the pain point for the index. Slipped into the red now, as have the broader markets too, have slipped significantly from the highs of the day. But before we move on to the markets, here are the headlines we're tracking at 1:30 this afternoon. The market falls significantly from the highs of the day, dragged by banking and financial stocks. The Nifty Bank slips into the red, while the Nifty now is exactly at the 24,700 mark.
Stocks of sugar mill surges after government says it will not impose any restrictions on production of ethanol in the coming season, November to October. Industry experts see this increasing diversion of sugarcane to near 5 million tons from a little over 3 million tons.
Sun TV has risen today after Avendus Sparks' buy recommendation on the stock with a target of 680 rupees. The brokerage has turned constructive on the stock after 5 years, positioning the company as a proxy for investors to participate in the monetization of sport.
It's a third straight session of gains for Sammaan Capital after the stock enters F&O, up over 11% in trade today.
And MobiKwik shares have also seen double-digit gains in today's session after the Abu Dhabi Investment Authority sold its remaining 2.1% stake in the company via block deals. The stock is up over 14%, but is slightly off the highs of the day.
Okay, all right. Those are the top headlines that we are tracking. But for the Nifty, it's a 76-point gain that we are seeing right now, but it's off 60 points from the highs of the day. That is courtesy Bank Nifty. So that is one index which is in the red currently, 87 points lower on the Bank Nifty at the day's low as well. We do have the mid-caps, which were surging almost up more than 1% at a point in time. This index is up 0.5% right now. So there is some recovery which is underway, a wee bit of recovery, but we'll have to see which way things go because it's the Tuesday Nifty expiry as well that we have been talking about. But the show is all about mid-caps. We have to talk about mid-cap movers. Hormuz has gone across to that wall and will take us to the mid-caps that are moving around in trade.
Well, at the start of the session, it was a sweet start, continuing from where we left off in yesterday's session. And sugar stocks are leading that charge, although some of them are off the highs of the day, but still holding on to gains of anywhere between almost 7% to as high as 14% for stocks like Sri Renuka Sugars. A segment that has been doing well today is the entire PSU basket, and two of the most prominent names within that PSU basket. One of them is the defense names, and the defense names are at the highest point of the day or closing in on that. Apollo Micro, another 9% surge in today's session. Cochin Shipyard, Mazgaon Dock, HAL, all of them are seeing healthy gains in today's session. The other major segment within the PSU basket are the railway names, and they too have surged to the day's highest point. Look at RVNL, Railtel, Ircon, Rights, all of them seeing gains of anywhere between 3 to 6% in today's trading session. So it is the PSU basket that is contributing significantly to the gains in the broader markets. Stocks that are doing well on the volumes front, and is led by another PSU, that is ITI. 8% higher on that stock. Nalco, Indian Overseas Bank, continuing with that PSU trend, and tire stocks are doing well today. Apollo Tyres too is up nearly 5% on very strong volumes. And lastly, some newsmakers of the day. We just mentioned about MobiKwik, and that stock is still up 12%. Sun TV after that positive brokerage note, and Sammaan Capital, third day as an F&O stock and is up for the third straight day, another 10% on the stock, of course significantly lower than its 52-week high, Sonal.
Okay, all right. Some interesting names there. Thank you so much for all those details, Hormuz. Let's welcome Shrikant Chauhan for a technical check on the market. Shrikant, that fall from the highs, what is it suggesting? Will we see volatility till the last 1 hour of trade as well? Okay, Shrikant, you're on mute right now.
Good afternoon, Sonal and everyone. So for Nifty, it is very clearly indicating us that it is heading higher. But yes, because of the extended rally that we saw from yesterday's low, we are of the view that we may see some cool-off in the second half. Close to 24,650, 24,600, the market is having next leg of support. So in case if we see the market is dropping around those levels, there we should look for creating some long positions. But broadly, we are of the view that the market is going to remain in a broader range of 24,800 and 24,400 before taking any meaningful activity in the market. So we need to do
Shrikant.
more and more stock specific.
Shrikant, good afternoon. In the stock specific ideas, what are you recommending to your clients?
Good afternoon, Armos. See, like few semiconductor related stocks, they are showing good amount of buying strength in the market. In that specifically, we like CG Power, which is around 739, 740. Since last 2 days, the stock is buzzing and it is crossing all its important levels. While looking at its entire formation, I am of the view that the stock is under a pullback mode and it is heading for the levels of at least 800, which will be the lower high as compared to its previous high. So at current levels around 739, 740, it's a very strong candidate to buy with a stop loss close to 715. The other stock which we like is Park Hotels. And today we saw some buying interest in hotel stocks. But in that, Park Hotel looks really good because it is in the range of 170 and 140 for a longer time. And now it is again heading for the levels of 170. So it's a buy at current levels around 153, 154 with a stop loss close to 145.
All right. Thank you so much for joining us with those names, Shrikant. With that, we'll do one thing. We'll slip into a break, but a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and master classes, and curated lifestyle benefits.
Welcome back. Slightly off the highs of the day is where the index is now 24,690s, whereas the Nifty 65 points higher on the index. That resistance zone of 24,750 to 24,800 coming into play in today's session. But putting the spotlight in today's mid-cap spotlight special, Ria is here to tell us more about Axis Technologies and why is that stock our mid-cap spotlight for the day, Ria.
Well, yes, Hormuz, Axis Gates Technology has hit an upper circuit of 5% today after receiving a major order yesterday. But first, looking at what the company actually does, they are an engineering and R&D services company. They provide these solutions for global manufacturers across sectors like aerospace, defense, automotive, energy, electronics, and heavy engineering as well. Now, the key clients for the company include Airbus, Boeing, Safran, as well as the Indian Ministry of Defense. The promoters of the company is Rajiv Chandrasekhar-backed Jupiter Capital Private Limited. The current holding is at around 58.2%, which is actually down over the last 8 quarters from around 66.2% in June of 2023. Now, coming to the order that the company received yesterday, they have received pilot orders for cabin interiors as well as retrofit solutions with a total order value of $1.2 million US. They've received these orders from an aerospace OEM and an aircraft cabin interior company based in Europe and in the US. Coming to the guidance of the company for FY26, they're expecting a 40% year-on-year growth in the core domains in FY26. These are the aerospace, defense, and the AI domains of the company. They're also expecting 19.5% EBITDA margins versus just about 14% that we saw in last year. Going forward in H2 of FY26, the revenue and profitability of the company are set to accelerate significantly with a significant ramp-up in the defense segment as well, which currently contributes around 24% to the revenue of the company. The defense revenues are also set to grow by around 70 to 75% in FY26 versus the 300 crore revenue that the segment had pulled in FY25. And by FY30, the company aims to achieve rupees 9,000 crores in revenue. This is versus an FY25 revenue of just about rupees 1,030 crores with EBITDA margins of 14%. So in terms of the stock moves, the stock has gone up around 100% on a year-to-date basis. It is up over 10% over the last 3 years and up over 21% over the last 5 years as well. Just quickly coming to the valuations, the 1-year forward PE is at 64 times versus its 3-year average of 43 times.
Okay, all right. So that is about Axis Gates Technology. The stock is in focus today. Thank you, Ria, for joining us with all those details. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and the impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
investing.
Welcome back. Well, further fall from the highs on the Nifty. It is up 26 points. When we started the show, there was a gain of around 60 points and there's been a sharp fall from those levels as well. The Bank Nifty too is down 0.3% and the mid-caps too have come up from the highs. So just watch out for what's happening in the markets. The gains are not contained. We're seeing that continuous fall that's happening from the highs as well. Bank Nifty, by the way, is at the day's low as well. But let's get stock specific now and talk about Max Estates. Nitin Kansal, the CFO at the company, is joining us from the 21st Motilal Oswal Annual Global Investor Conference. Our discussion will be focused on the following points: pre-sales booking value and annuity rental income trajectory, commercial projects in operations, and indicative growth pipeline in the near term. So these are some points we'd like to discuss with the management apart from the other questions. So let's get started. Nitin, good afternoon. Thank you so much for joining in. Well, there's 6,000 to 6,500 crore pre-sales target that you have in FY26. What is the pipeline for this guidance that you have? And will it be all luxury projects? Will it be a mix? What kind of price points are you focusing on?
Thank you. Thank you so much for getting me on the show. So in the current year, what we are planning to do is a launch of close to 9,500 crores across the key markets of Delhi NCR in Noida and Gurgaon. This is across 3 projects. Against this 9,500 crores, we're expecting to do a sale of 6,000 to 6,500 crores. These projects are expected to be launched in the second half of the current financial year, and these would be more in the price range of 20 to 23,000 rupees a square foot, in line with what we have done in these micro markets earlier.
Nitin, good afternoon. Thank you for joining in. What would be your rental income projection as well? You have a rental potential of 725 crore. Where do you stand at currently, and by when do you expect to reach that mark? And what would that do to your consolidated debt? What is that number like right now, and does that trend down as the year goes forward?
Yeah, so as we speak, we are currently in a rental run rate of close to 150 crores. What we have projected is by FY29, we would have a complete rental portfolio of close to 723 crores. We expect these numbers to be gradually scaled up in FY28 and 29. In our commercial portfolio, currently we have got New York Life Insurance Company as a 49% partner. This rental is currently operating at an EBITDA margins of 90 to 95% spread across Noida and Gurgaon.
Okay.
The current debt which we have on the books is around... Yeah, the current debt which we have on the books is on 30th June is approx 1,500 crores. This is predominantly on account of commercial assets. Of this, around 900 crores is towards lease rental discounting, and the balance is towards the construction and the finance. The important point to note over here is, against this rest of 1,500 crores, we are having a cash balance of close to 1,650 crores, resulting in a net cash positive of close to 150 crore.
All right. Are you expecting any more investments coming in from New York Life, Nitin? Is it something which is on the cards? And this 725 crore of potential that you're seeing in your lease assets, what kind of portfolio will you be seeing? What will the size of portfolio be in that case?
So we would be looking at a total portfolio size of in the range of 6 to 7 million square feet once this entire project is completed and delivered. New York Life, as we speak, has already committed a total capital of close to 1,800 crores with us, of which they have already deployed close to 1,600 crores. They have been our partners in all our commercial assets, having a 49% shareholding, and they are also our shareholders at the holding company, holding 21% shareholding. They evaluate each project on an individual basis and deploy accordingly.
But Nitin, we are almost 2/3 of the way into the current quarter as well. How has the demand situation been on the ground? And I particularly ask you this question because of these global uncertainties that we are currently surrounded by, and that would or may impact certain sectors. We have also seen layoffs being announced by a few major companies in the country. What does that do to demand on ground, especially within your commercial portfolio?
So although it does have a negative sentiment bearing in case we see layoffs happening in the tech sector. But what we have seen in our portfolio currently is we have not seen any impact. Our rental portfolio currently stand at 100% leased with a strong demand coming from the GCCs. As we speak today, our rental portfolio entirely is leased, getting a premium of 30 to 35% over the micro market. What we believe a quality product is able to command a premium remains kind of neutral to the demand vagaries at this point of time.
Got it. Nitin, this is about the quality products that you would be providing in the commercial portfolio, right? But the other problem that has been happening in the NCR region, that's where your majority portfolio also is present, is the pricing premium. The fear is that pricing premium would go down. You will not be able to, or the builders will not be able to take price hikes the way they have been. What's your take on that? And secondly, while you can build a quality product, the infrastructure may not be that great, because whatever we've been seeing with rains across Gurgaon and Noida, even across flats which are ranging 50 to 100 crore rupees, but the infrastructure is not supporting that. What happens to pricing and demand in that case?
See what happens, infrastructure does pose a challenge. As you would have seen, yesterday's rains kind of exposed the infrastructure challenges at Gurgaon. But having said that, there has been a significant progress which is being made on the infrastructure side. But as far as our demand is concerned, what we believe is that we are able to provide a significant value add to the customer, which kind of protects the demand which comes to us. Furthermore, we have also been able to segment the market in the senior living and the normal residential market, which kind of helps us and protects our prices and demand both.
So based on all of this, Nitin, how does FY26 shape up for you? Is there a collection guidance figure that you have zeroed in on? If you could tell us more about that.
Yeah, sure, Homas. In the current year, we have given a guidance of a collection of close to 2,600 crores. This 2,600 crores is made up of two components. We have a component of the inventory which we have already sold, for which we are expecting a collection to be in the range of 1,500 crores. And as we speak today, we have already made a collection of close to 450 crore against that. We are expecting another collection of 1,200 crores to come from the new sales. Since I previously mentioned, we have a guidance of 6,000 to 6,500 crore rupees for the year, and we do an equally distributed collection plans. We are expecting 1,200 crores to come from the new sales, which is expected to come in the second half of the current financial. So all told, we are looking at a number of 2,600, of which we have already collected close to 400 crore rupees.
All right, Nitin. Thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. Nitin Kansal there of Max Estates joining us from the sidelines of the 21st Motilal Oswal Annual Global Investor Conference. By the way, the market has taken a complete nosedive from the highs of the day from where we were at the start of the show. The index has now slipped into the red. And let alone 24,700, we are now under threat of breaking 24,600 as well on the index. So it's a 150 point downtick from the highs of the day. Not only has that 24,750 to 24,800 range turning out to be a point of resistance, but even the 20 DMA, which was around about that 24,700 range, could not be sustained. Of course, it's the weekly expiry of the Nifty 50 contracts. We need to keep that in mind as well. But for now, the broader consensus is that the 24,700 to 24,750 mark is a barrier, and the index could not sustain at those levels. And just as we speak, the index has also slipped below the mark of 24,600. What is contributing to this fall to the downside? ICICI Bank is one of them. Bharti Airtel has also slipped to the lows of the day. That is a contributor to the downside as well. Mahindra & Mahindra, Kotak Mahindra Bank, Larsen & Toubro, the five major contributors to the downside on the index currently. But what has also been a major contributor to the downside has been the cool-off seen in Reliance Industries. At one point earlier in the day, the stock was up 2.5%. That has now cooled off from the highs of the day, has almost halved from its intraday high. So from around 2.25% gain, the stock is now up only 1%, and that too has had a bearing on the market. So that's how the index has shaped up. As of now, we go into the final 90 minutes of trade with the index at the lowest point of the day. We call time on this edition of Midcap Radar. From Sonal and me, thank you for watching. MF Corner on the other side.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me as always is Vinny Motiwala, and today we'll put spotlight on consumption-oriented funds. Has the money moved to consumption from capex theme? Before we get started with the discussion, you have some interesting data.
Absolutely, Sonal. And you know what we've been seeing over the last few years, that capex was that story, right? The push that came in from the government. Now, our point is that now will we see consumption coming into play, given that there are so many impetuses that are coming in from the government side, and a GST, that is a possibility that comes in that would benefit consumption. Now, let's look at what's happened in the past, right? Nifty consumption in terms of a performance in the last 6 months and 1 year, we've seen overall the performance that we're seeing on a total basis is for Nifty consumption 18% up. While long-term average for that was around 6.8% in the last couple of decades. Similarly, when you're looking at it in terms of the move that's coming from FII and DII, and this was a data point that, Feroz also has mentioned today, that is in terms of last 2 quarters when you're looking at it, FIIs, their holdings have moderated coming in consumption. Now, overall, DIIs, they're particularly continuing to be buyers. We've seen that trend go on as well. Now, in terms of funds also, a lot of increase that has come in terms of the number of funds that are there for consumption-related funds as well. Currently, there are almost 20-odd active consumption funds that we're watching out for, with almost 41.3 thousand crores that is there in terms of AUM over there. Capex story. Now, on the other hand, when you're looking at Capex, the growth in the last 6 months for Capex and returns has been, Nifty Infra is what we're talking about, has been at 16%. So, obviously, consumption has started doing better, specifically in the last 6 months. Now, obviously, in terms of FIIs, again, FIIs overall also have been selling in Indian market and in Nifty Infra also, and overall infra stocks, they've seen a reduction coming in there. DIIs continue to be buyers. Now, key to watch out for is going to be that when you're looking at it, and this is the data that I've picked out from Value Research, that the top performers that in terms of these funds, consumption funds and Capex and infra funds, when you're looking at consumption funds, we're just comparing the top performers. Kotak as well as HSBC managed to see good returns in the last 1 year of 3%. Versus, why good I'm saying, because versus when you're saying infra funds, that is ICICI Pru Infra, which was among the top performers, as well as Canara Robeco, those have seen negative returns and these were the best performers. So you look at it in terms of the move that has come in as well, clearly seems like, maybe there is going to be some shift that one is seeing coming in from Capex to consumption, given that we are watching out for a lot of points coming in over there. Now, let's bring on board our guests for today. We have Feroz Aziz joining in with us, as well as Tarun Birani. Feroz, as well as Tarun, good afternoon, and thank you so much for joining us. Feroz, I want to start by talking about the consumption versus Capex funds. How have they performed? We've given some data points on that front as well. Past performance in terms of AUM growth, and now what are we watching out for here in both these stories? Afternoon.
Good afternoon, Winnie. Like you were actually throwing up very, very interesting pieces of information and data. I just want to take a step back and explain to the viewer what is consumption. What happens is, I was over the weekend hearing a couple of oncologists talk to each other, and it sounded so much like Greek and Latin that I got intimidated. So let me first break it down into consumption. What is consumption and what constitutes consumption as a theme? Because it's second nature for us in the industry, but for an outsider, it looks a little more intimidating. So consumption is any kind of a sector which directly supplies to households or individuals. B2C businesses are largely consumption. There, if you have to actually narrow it down to subsectors, 6 subsectors: FMCG, auto, apparels, telecom, travel and tourism, and healthcare. These are the 6 subsectors one has to remember, because all of them actually are directly supplying their goods or services to a consumer, end consumer, and those are not B2B businesses. For example, IT is largely B2B, a business supplying to another business in India or globally. So that's consumption, and 6 subsectors constitute consumption. Now coming to how the AUM of these consumption funds have moved, it has not moved dramatically. Of course, in percentage terms, it has moved reasonably because from 10,000-11,000 crores post-COVID in FY21 to where we are at 35,000 crores, that's almost 3 times. And I think the number of schemes have definitely more than doubled from 13 to 27. That's a large shift. What is happening is, in the asset management industry, in 2018, SEBI clamped down on the number of schemes an asset management company can have in several categories. It cannot have 2 large cap funds, it can't have 2 mid cap, but this thematic category, you can make anything a theme, right? A theme of MNC companies, theme of four sectors could combine to make themes. So what asset management companies started doing is looking for themes to expand their product bouquet, which is the right thing to do from their perspective. But consumption, number of funds went up from 13 to 27 because the rest of the conventional sector categories had a limitation of launching new NFOs. And I think consumption, the good part, Vinny, is consumption has still not rallied. Like the performances you showed, that's very interesting. Generally, when consumption, a theme becomes popular, the performance is behind us. That's the unique thing on the timing of the show. I really respect that because it's not that the performance is stupendous and then we are saying consumption is a good theme to look at.
Okay, all right. So we'll watch out for what kind of returns we see from here on. As you pointed out, there's still a lot of steam left, and we've just started talking about what possible triggers could come by for the consumption theme overall. Tarun, let me get you in the conversation as well. Given the deceleration we are seeing in capex growth, and we're seeing renewed policy support for consumer sectors, would you suggest it is now prudent time for average investors to reallocate some of their holdings from capex to consumption themes?
Right. So good afternoon. I think Firoz did touch upon a lot of pointers, but I think couple of things which I want to talk about specific to the question is 2025 union budget. I think it reduced the allocation to capex from 11 lakh crores to 10 lakh crores. Some data points I am sharing, and we have seen a 1 lakh crore of tax benefit given to and I think that is going to spur the consumption. That was one thing. And you have seen sectors like FMCG, auto, all these retail and consumption, all these consumer section has got a lot of positive outlook after that. Again, we are witnessing a very subtle as well as meaningful shift in the India's growth narrative as I see right now. The capex momentum, while very strong, is tapering to my mind right now. The gross fixed capital formation is down, which used to be in double digit, is at 7%. But the private consumption as we talk is growing at 7.2% growth rate in FY25. And this quarter also the growth has been very strong. So I think the consumption theme from that point of view look very strong. But I feel the real thing is coming is from the upcoming GST overall, where we are going to see two rates of 5% and 18%. And I see a lot of revival of a lot of sectors like auto, electronics, white goods. All these things will get a lot of push, and the stimulus is calculated at around 1.9 lakh crores, which is like 0.6 to 0.7% of the GDP. To my mind, this is going to really make things much stronger for consumption. Again, India is if you look at India, is a 60% is a consumption economy. The GDP constitutes 60% of consumption, and we are growing at 7%. So I think we are the fifth largest consumption market. Again, the tailwind plus from a sustainability looks very strong because we have themes like premiumization. Everybody is going to upper grade. Urbanization, we are talking about digital adoption, we are talking about formalization. Again, most of the like jewelry sector, it is formalizing. So all these things are going very strong, but at the same time, I am not a very strong believer of sectoral funds. I feel one should look at flexi, multi-cap or a diversified category because themes keep changing. And I feel from a long point of view, a structure is more important rather than going sectoral.
Absolutely. A structure is more important than sectoral is what you believe is the best way to go forward. Feroz, would you like to comment on that front, right? What if someone is actually holding some capex funds? Is it time maybe to redeem that and invest that money coming into consumption funds? Is that a story that one should watch out for? And are there any other economic indicators that one should keep an eye out on as a mutual fund investor to, maybe participate in this theme?
Capital expenditure or capex, capital expansion also. What is it? It's nothing but any sector which benefits from large-scale investments, in which there are three things. One is manufacturing, infrastructure, and maybe some degree of energy. So these are capital expansion beneficiaries in terms of subsectors. In energy, you have so many other sectors, subsectors. So to get to your point, whether if somebody is holding a capex theme as a fund, does he need to move out? To my mind, the answer is no, not so much. The shift of capital from capex to consumption is not apparent to naked eye. If you look at the top 10 stocks in both these sectors, both these themes largely, in NSE 500, there are about 6 stocks in consumption where FIIs have sold out of the 10. Domestic institutions have gone lighter in 3 out of the 10, like especially the auto. So point I'm trying to get to is there's the flight of capital between these two sectors has not been so apparent over the last couple of quarters. Now in the capital goods or capital expansion theme, if you look at the top 10 stocks, the number of stocks which FIIs reduced their ownership in terms of free float ownership, you again see 6 stocks where they have actually gone lighter. And DIs have also gone lighter in 4 out of the 10 stocks. So the flight of capital is still not apparent to naked eye. So if you're sitting on a capex theme fund, that implies, like you, Vinny, rightly pointed out, they've not made money last year. So will I wait for the turnaround? The answer is yes. Capital formation happens from 3 sources. One is household capital formation, private corporate capital formation, and public sector corporate formation, capital formation. The public sector capital formation has seen a 12% capital expenditure from government side in budgets 4 years back to 22% today. But in the private corporate side, there was 5.5 lakh trillion rupees of capital formation that came down to 4.97 lakhs. So that's one thing which should revive because of several counts. One is GST rationalization. The other is the rate cut, which we've been waiting for 2 years, and finally it came in this calendar year. You also see a lot of new credit offtake. There is so much financialization happening, like Tarun Saab also said. That's the third thing. And the fourth, household consumption will also get a push because of the new tax regime. So to answer your pointed questions, don't panic if you have a capex theme. It might not be the largest, strongest narrative. Play the contra play. You've not lost too much or made too much last 1 year. You've almost done as much as Nifty. But I would not panic because capital expansion will happen in the private side, and that will take forward the capital formation over the next couple of years.
Got it. So Tarun, in that case, how do you think should investors balance cyclicality and valuation risk between capex and consumption funds if there is a diversified portfolio and they're planning to do this in the coming year itself?
Right. So my strong suggestion is 90% of your return comes from asset allocation. Again, the sectoral play, the stock picking skills, all these things doesn't add up to the long-term returns. Long-term returns comes because of the structure and the asset allocation. And anybody who is focusing on that part, I think will be able to benefit from that. To your specific question between cyclicity and the valuation risk, what we are seeing between capex and consumption, I think investors should avoid aggressive sectoral bets. Instead, opt for diversified fund, look at flexi cap structures. Again, because there the fund managers has the ability to keep changing the stance based on the market environment. So I will be more comfortable looking at that because it limits the combined exposure to the consumption and capex theme, not more than 10 to 20%. Avoid chasing peaks. Again, a lot of time because of FOMO, just because it has gone up. So again, that need to be like, just look at the QSR theme, right? QSR is 3 lakh rupees with Zomato and Swiggy put together have 3 lakh crore of market cap today. I think a lot of FOMO factor in the market. So I think we need to be mindful that whether we are looking at just investing or making long-term returns, that is more important. And again, preserve the capex exposure because I think capex is a long-term story for India and will continue to be positive.
Okay. Okay, point taken, Tarun. Preserve your capital capex exposure as well. Avoid chasing peaks. That's a word coming in there. But on that note, we're going to actually slip into a very short break. Don't go anywhere. We're going to be continuing this conversation after the break as well. Welcome back to MF Corner on CNBC-TV18. We still have with us Tarun Birani, founder of and CEO at TBNG Capital Advisors, as well as Feroz Aziz, joint CEO at Anand Rathi Wealth. We're discussing consumption funds. Are they going to see a pickup versus CapEx funds? Is that story over? Tarun, you were talking about allocation coming in as well. I just want to understand the portfolio allocation strategy that you would suggest to an investor right now in this consumption story if they want to participate in that, as well as overall, what is the approach that they should have? Should it be more in terms of a phased managed approach or quickly shift allocations if that's the situation?
So if you ask me from a market perspective, I look at 3-4 parameters from a price to earning, price to book value, market cap to GDP, yield gap. I feel market is in a neutral zone. It's neither very expensive and neither very, very cheap either. So from that perspective, I feel the current environment is not ripe for lump sum investment. The market is good for staggered investing, into small and mid caps through a longer staggered route, and looking and sectoral bets again a long staggered route, and maybe large cap and flexi cap and multi assets are something which can be looked at from a lump sum perspective. So that is the approach. But again, from a allocation point of view, as I mentioned before also, I'm a very strong believer of diversification and diversified funds. I don't favor sectoral funds because I feel it brings a lot of tactical nature in the investing part. And the long-term compounding happens because of you staying on course with the investment, right? And investor doesn't have the wherewithal to change the portfolio time and again, right? So diversified is recommended, but again, nonetheless, for the ones who want to venture out and want to take risk, maybe core and satellite is the right approach, where the core part of the portfolio stays intact for a longer term, and the satellite portion is where maybe 10 to 20% you can look at building up the strategies which you are very bullish on. Like we are talking, it's a real theme for India. Next 10 years, yes, it's a decade opportunity. So one can play that.
Got it. So we are out of time, but I have to ask you this question because it helps the retail investors as well. Feroz, let me start with you. Which mutual fund categories or schemes are set to benefit the most? And do you see a sustainable outperformance for consumption funds from here on?
So, I'm sorry, but I would definitely want to comment on the asset allocation. I think India has only 6.7% of its money at household level, 940 lakh crores, only 6.7% is in equity, both mutual funds and direct equity. If asset allocation, we recommend 60, 70, 80% for long-term monies, India is nowhere close to that. So if you're not in equity, up to 70% for 5-year plus monies, which is very likely because we are talking to Indian viewers, please move your 70, 80% of your money to equity. Do it lump sum is my one thing which I disagree. Of course, asset allocation is very, very crucial. That's what I agree with Tarun. One thing is do lump sum because you've got a 1-year time correction, you've got a 6% price correction, you've got 11% earnings growth, and the stock Nifty is down 11 almost about 8% now from the peaks of last September. So you don't get too lucky. You get a 1-year time correction, do lump sum as long as you can tolerate 10-12% of market falls, which is what is the second age of the market. Coming to consumption, I think if there is a fund manager who's sharp in the consumption cycle, which is reasonably certain over the next 3 years, I wouldn't be surprised the Nifty consumption index beating Nifty by about 3 to 4% per annum for the next 3 years. If you're getting into this sector, be patient. It's just because you buy it, it will not start moving from tomorrow. So if you're ready to go into a sectorial or a thematic scheme, at least hold it for 3 years, especially if it's a theme and not a specific sector. And consumption is a very wide theme. Get a sharp fund manager so that he can move it around. Inside consumption, I had rattled out 6 different subsectors. So that's what I would give as a sharp reco to your viewers.
Okay, thanks for that. And Tarun, a quick word from you as well in terms of, mutual fund categories or schemes maybe that you are looking at in terms of our consumption story.
I would again recommend diversified funds which have the to pull up into the consumption funds, but there are a lot of ETFs, index funds tracking consumption, which are available at very low cost. That also could be looked at this point of time. There are a lot of satellite themes, a lot of active consumption funds also available in the market. So that again can be looked at. Yeah.
Okay, all right. Feroz and Tarun, always a pleasure speaking with the two of you. This time it was an interesting topic because we've been seeing that move. And as Feroz mentioned, usually the stocks run up and after that we see all the craze. But this time, this is not something that has happened. So we'll watch out for the moves that we'll see in this particular space as well. But with that, we are completely out of time on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
Beyond market headlines, to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Australian index, that's also a bit muted. It's flip-flopping between the red and the green.
So 40 hourly is now moved to 24,670, 0.15 up on the Nifty. The Nifty Bank also similarly about 0.15 higher.
I think overall also, Prashant, if you look at the market valuations, they're not all that cheap.
The sugar industry is quite capable of supplying to the government.
Second day running, we are seeing opening gains that have come by 110 points higher on the Nifty as we speak.
Ginger is very well positioned now to get to a portfolio of 250 hotels.
थर्ड लार्जेस्ट इकोनॉमी बनाने की तरफ तेजी से बढ़ना पक्का हो चुका है.
For the Nifty, it's a 76-point gain that we are seeing right now.
Well, that was the day so far. The gain has turned into a loss, so the momentum in the market has fizzled out. Perhaps it's to do with the weekly expiry, but as we speak, the Nifty has slipped nearly 200 points from the top of the day. We're down 85 points in the Nifty. The Sensex is lower by close to about 300 points. The midcap index is holding on to the green line. But again, fatigue has set in from the higher levels, and banks today are underperforming. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema, with me is Nigel, and Surbhi is at the Motilal Oswal conference. Hi.
Well, that's right. It's that sort of a day, right? It was looking good, but then the markets did see some kind of profiting. I think a host of factors are playing out. One is that weekly expiry, the first one on a Tuesday for the Nifty. And also Mr. Trump, he's scheduled to address the press. So the street is a little bit nervous ahead of that. But Surbhi, you're the lucky one who's at the conference. What's the mood like out there?
I have a chair next to me that's empty. Nigel, I'm missing you here in action, you and Reema. But I'll tell you this, the fall in the market and whatever's been going on, that hasn't dampened the mood here. I spent the last 1 hour or so, talking to a bunch of people. And from digital, looking at digital companies, to looking at bhujia companies, just met the founder of Haldiram as well, to looking at different pockets of growth, really. There's a lot of buzz here and a lot of anticipation. Investors are talking about it. Everyone's talking about this GST cut and waiting for the final numbers, which we will know only by the 4th of September. So Thursday we'll have the final picture. So that's one talking point, big talking point. And then, yes, let's face it, Mr. Trump and his advisors and aides, they never go out of the conversation, even though the conversation here is about moving on, doing what India can do. But yes, there is this edginess, there is this nervousness. We don't know what's coming today, whether it's going to be some sort of, sanctions on purchase of Russian oil, official sanctions, whether it's going to be something else. And this tariff piece, basically conversations here also talking about what India can do. I'll tell you one thing, guys, that in general, the mood I pick up is a mood of a lot of support for the measures we've seen so far from the government and the RBI. And the investor community and the people I'm speaking to over here, they're saying that it's great because it's at least all hands on deck. It's all guns blazing when it comes to supporting the economy. And the hope and the optimism is really palpable that by the time this year ends, things should be definitely better off.
Well, indeed, the first half of the year, markets haven't done too much. So let's hope the second half of the year is better. But let's tell our viewers what we've lined up for you. In the next 1 hour, it's been a volatile trade so far on expiry day. We've seen the markets give up gains, which we held on since morning. The Nifty now, as we speak, is below 24,550 as selling returns to the street. Sugar stocks are the big movers today, surging as the government removes all curbs on ethanol production from sugarcane juice and sugar syrup. Brokerage house Avendus issues a bullish note on Sun TV, terming it to be a proxy to IPL and an opportunity for monetizing India's sporting opportunity. All right, let's also quickly take stock of some of the movers in the market. And let me just tell you on the way up and on the way down. On the way up, you have Power Grid with a gain of about 2% Nestle, Hero MotoCorp are higher. Couple of these steel names, Tata Steel deserve mention. NTPC is a gain of about 1.25%, which is why, because you've got names like an NTPC, Power Grid holding up on the green line, the overall PSU index is one of the top performers. That Nifty PSU index should also come up. On the way down, Adani Enterprises, Ultratech Cement, banks have been struggling. HDFC Bank, Kotak Mahindra Bank have given up gains. How should you position yourself in the last hour of trade? Mitesh is now with us for some more. Mitesh, it almost felt like a tale of two halves. Still about 132, markets were comfortably in the green. And then, come this selling pressure. Is it on account of expiry, that weekly expiry? Is it more? And what do you expect?
Good afternoon. So I think, expiry does play a part. I think, we do see some volatility and different movement. Two, I think what is important is that the financial names or the Nifty is slightly turning weak for me. And that is a worry. I think the Bank Nifty today's high was around 54,160 and 54,250, 280 is the level of reversal on the upside. If we would have conquered that, I think it would have been much stronger. But failing to do so means that the Bank Nifty could be more under pressure, and going forward, that could in turn affect the Nifty as well. So with that, I think there will be some volatility. But broadly, the Nifty index looks to be range bound, and therefore, I think around 24,400, 350. I would believe that the downside might be capped, and it may not be a bad idea to look at some long ideas when these stocks are showing good breakout patterns. So one of them is Dabur. That's, getting past the earlier swing highs of 535, 536. So buy here with the stop below 534.5. Look for a target close to about 560 on the upside. And amongst the metal names, while they're looking good, Hindustan Zinc is very interesting. It seems to be a stock which has bottomed out. but it's failed to clear the 200-day average, which is around 442, 443 mark. So we'll keep a conditional buy here. If it starts getting past today's high of 444.2, by then with a stop below today's low of 438, and 458, 459 should be the first target.
All right. Thanks, Mitesh, for that. By the way, keep an eye out on Mahindra & Mahindra. My colleague Timsy will be joining in shortly. But what the reports are indicating that the EV tax for vehicles that are priced between 20 to around 40 lakhs could potentially move up from 5% to 18%. Timsy will join us in a bit to give us what is she picking up with regard to what is the proposal and what it could mean. But the notable name that comes under pressure will be Mahindra & Mahindra, but going by what the reports are indicating as of now. So we'll have to keep an eye out on that one. Well, let's move then to the big story of the day. Sugar stocks, they're the sweetest things today, all of them doing quite well. Ria joins us to explain us exactly why. Ria.
Well, yes, Nigel, a lot of these sugar stocks have been surging in trade today, and this is because there's been a significant relief for the entire industry as a whole. India has removed all curbs on ethanol production from sugarcane juice and syrup, and also from B-heavy and C-heavy molasses by sugar mills and distilleries in the sugar season 2025 to 26. And the government is going to periodically review the diversion of sugar for ethanol production to maintain the availability of sugar for domestic consumption. Now, these restrictions were earlier imposed in December of 2023 because of the rising sugar prices at that point of time. And now, after this move, sugar mills will be able to use inventory of heavy molasses, the inventory that is currently lying with them. And this is also going to help achieve their targets of boosting the proportion of fuel and gasoline blends to 20%. Apart from this, there's also been another new notification. Distilleries are now allowed to purchase up to 2.3 million metric tons of rice from FCI for ethanol production, and this is going to enhance the ethanol production from dual feed distilleries as well. Quickly coming to the valuations for all of these sugar companies, Balram Chini, Triveni Engineering and EID Parry are currently trading above their 3-year averages, while Dalmia Bharat Sugar is slightly below its 3-year average PE. In terms of the stock moves over the last 1 year, most of these stocks are down anywhere between 3 to 45%, with only DCM Shriram that is up around 9%, and the outperformer has been EID Parry, which is up around 37% over the last 1 year.
Thank you very much for that. You can see that sugar rush in stocks, double-digit up moves in so many names even now. So despite the markets coming off, Sri Renuka still up about 13%, Dwarikesh, Dhampur, Rana, Bajaj Hindustan. Most stocks are holding up quite smartly. Big gains seen over there. Earlier today, we chatted with Atul Chaturvedi, Executive Chairman, Sri Renuka. Listen in to his comments.
There's no reason why diversion of sugar to ethanol, which current year is about 3.2 million tons, should not go up to anywhere between 4.5 to 5 million tons. And the sugar industry is quite capable of supplying to the government. The only request from the industry is that for far too long, we have been denied a price increase, and there's no reason why from maize, they continue to buy at around 72 rupees, closer to that, and from cane juice at around 65. So there's no fear as far as sugar inflation is concerned.
We opened the stock of current season with around 8 million tons. We are hopefully will be closing the season with around 5.2 million tons. Having said that, the next year crops looks very good, and our estimate, the first estimate is around 35 million tons. The domestic prices saw an upward, the corrected movement, and we are seeing a stable prices in an anticipation of much better crop and much better sugar production next year.
Okay, so that's the big story of the day, and sugar stocks have been quite excited on the prospects of now sugar and molasses, sugarcane juice being allowed for ethanol production as well. Dharmesh Kant is with us to take a couple of questions on the market this afternoon. Dharmesh, good to have you on. Let's actually start right there. How much of this excitement in sugar stocks do you think is justified? Because the numbers that we got from the industry heads today, they're very big. I mean, 35 million tons of total production. Even if 5 million tons goes towards ethanol, and provided they get the right pricing, that's the other point, only then will the ethanol business with sugar, make commercial sense. And you still have an oversupply in the market. So I don't think sugar prices are running away in a hurry anywhere, and they acknowledge that. What would your take be and your advice be on looking at names like Bajaj, Hindustan, Balrampur, etc.?
Yeah, good afternoon, Survey. The advice is simple: stay away from sugary stuff. So it's not sugary at all. It may be a 1 day, 2 day kind of a prop-up kind of a move, which tactical kind of a move which we are seeing in the market. But look at the sugar industry per se. I mean, sugar production is dependent on rainfall. If the rainfall is good, you are getting a better production. The sugarcane prices are controlled by the government of India. Sugar prices are controlled by government of India. Ethanol prices are again controlled. So there is no free market for sugar business per se. It's all dependent on or interrelated to the government policies in place. And in the year in which the rainfall is not good enough, you will have again the cuts coming in and the new regulations coming into the play. Secondly, we are almost there at 20% kind of ethanol blending is almost there. So not much leeway out there as well. At the same time, any blending above that, I mean, flex fuels we are talking about, but that needs the entire ICE engine, recalibration. The engine should be sufficient to take in the above quantity of ethanol blending in place. Otherwise, the engine goes for a toss and your mileage per liter goes up. I mean, the cost goes up because the average comes down because of the ethanol blending. So all these things are into play. I think it's just a, knee-jerk kind of a reaction for a couple of days. Inventory clearance is what should be, good for sugar companies because at least that much of loss can be avoided. The wastage of sugar. Other than that, I think 1.5% is the consumption growth, and which has been coming down as the population is not growing that much, and the sugar intake itself is coming down. So I don't see a much kind of a game changer or new drifting trade out there. So it's a void for us.
By the way, just take note of Mahindra and Mahindra. That stock is slipping. In fact, even SML Isuzu, as a ticker team, is pricing out. I think Timsi is learning from her sources that the government panel has proposed a steep hike in luxury EVs, which means if your EV is priced between 20 lakh to 40 lakh, okay, there is possibility that currently EVs are taxed at about 5 lakh and that 5%, sorry, the tax on that is 5% and that could go up. So the street is clearly worried. Mahindra and Mahindra, we should pull up Tata Motors also. That's the other major EV player. Let's find out if that's taking a bit of a hit. And most of these companies have a huge SUV pipeline also, where the pricing could be on the higher side. Tata Motors, not the immediate fall that you're seeing in an M&M, but Tata Motors too is sort of grinding lower. Dharmesh Kant, head of research, Chola Securities, is still with us. Dharmesh, M&M, darling of the market, big wealth creator, but if the way the government is going to go about taxation on the GST reform side is that low-end consumption gets boosted, but on the luxury side, things which are expensive are going to get dearer. How will that impact M&M's upcoming portfolio? Because you can see the market getting a bit nervous.
Yeah, good afternoon, Rima. I mean, I'm a bit confused because how do you define luxury? Is it a price point or, the variant point? I mean, EV 20 lakhs to 40 lakhs, anything about 20 lakhs, if it is luxury, then all the Hyundais and Marutis of the world who are selling vehicles above 20 lakhs should also fall under the luxury segment. So I don't think that should be the criteria when they will define the GST rates. It would be more on the price points and anything, to my mind, anything above 40 lakhs would be qualifying as a luxury item. So this entire thesis that, on EV vehicles which are above 20 lakh of price, the GST prices are going to go up. I don't buy that. So this fall which is coming, if this is the thesis for the fall, then it's a good buying opportunity for M&M because we have seen how the volumes have been, stacking up for all the variants, be it farm equipment or the other segment of the vehicles. In fact, people are waiting for the GST rollout to come through. And if there is a significant cut, then we can see a sales, a perk up coming for the next couple of months. So we are in the camp which we believe that price point would be the defining for, luxury segment. And there, I think such kind of a fall is an opportunity to buy quality stocks.
All right. So you're saying dips and weakness in Mahindra and Mahindra actually should be looking to get in. Okay, Dharmesh, we'll have to keep that in mind. We're waiting though for clarity with regard to what could the potential GST rate come out at, and if there is a price band as well on the vehicle, we'll have to wait for that. So clarity is awaited on that front. That said, let's focus on one of those actually big underperformers of the last few years, a company that owns an IPL team. They have a good amount of cash in their business and promoter holding as well is relatively high. But yet the stock has been languishing. Today, however, Sun TV is soaring up. Vamakshi joins us to explain that to us. Vama, take it away.
Well, the sun is shining bright on Sun TV, Nigel. You know, there's an interesting note that came in from a vendor earlier today, and they have a buy rating on this counter, target price of 680 per share. Now, what they're highlighting is that they've turned constructive on this stock after 5 long years, and they now view this company as a fast-growing sports company rather than a stagnant, linear TV broadcaster. In fact, for IPL, they are estimating the IPL revenue for the current broadcaster to grow at 9 to 12% CAGR in the next 2 years. That is from calendar year 25 to 27 to almost 15,000 crores. Now, that given 60% of Sun TV's SOTP value is likely to be contributed by the Sunrisers Hyderabad. Now, they've assigned a 40 times PE multiple to the IPL business, a 10 times multiple to the core business, and that in turn is leading to a 3-year target price of almost 840 rupees for this particular counter. Now, what they also highlight is that this company has the highest listed exposure to IPL amongst its peers and offers the purest proxy for investors to participate in India's sport monetization upside. So, you know, an interesting note coming in from Avendus Spark, and just to highlight the shareholding pattern as well, it has been rather, constant. FPI promoters, mutual funds, as well as FPIs own somewhere around 91.5% in the company, and they continue to do so over the past couple of quarters. So, interesting note from Spark, and Sun is shining in trade today.
Thank you very much for that. I was just looking at the 10-year compounded sales growth. You know, this was the play on the TV broadcasting medium space. The 10-year compounded sales growth is just 5%, and the profit is up 8%. And in that period, the stock price, the 10-year stock price CAGR is just a mere 3%. So as the vendor said, it has gone through, it's languished for a very long time. But now it's time to look at the company as more of a sports play, with the big bets being played on IPL. Dharmesh, would you concur? Is it time to shift the narrative on Sun TV?
Yeah, Rima, one is to, wait and see how things pan out. This narrative may play out eventually for Sun TV because it has its own merits. But we are not bullish on the entire space, and particularly on the media space, because if any media company you look at, they have not done well in the last 10 years, despite several promises being out there. So we are staying away from the media space. Sun TV, let's see. This narrative may hold, looks like.
Okay, all right. Actually, the markets have seen a good recovery from the day's low, actually. Just pull up the Nifty. We started off the show. We had breached the 24,550. There was some nervousness, but we have pulled back pretty quickly and pretty swiftly, actually. Good pullback to the high point, towards the high point of the last 1 hour or so. So we're down now only around 20 points. The Nifty Bank, that's the one that continues to be a worry for the bulls. Well, Dharmesh, one final question before we let you go. Any view on the metal stocks? NMDC is doing well today. They came out with a good update. Nalco is bucking the trend. One would say it's up on high volumes at around 200 rupees, but the recent high was 260. And from there, it did pull back. And Coal India, after months of degrowth, finally grew. Your view?
Yeah, good afternoon, Nigel. Good to see you back. I think your prayers as a minister has been answered at Golden Temple. The market is better off now from the time you left. Having said that, metal stocks does look attractive. It's for the brave to be invested into it. And Coal India and NMDC numbers were quite encouraging going into the clear weather season now from September onwards. I think they offer deep value. If you look at the balance sheet, they are all cash-rich kind of companies. At the same time, dividend yield is around 6-7%. So that's protection already is there on the stock price. Even at steady state, even if 3-4% kind of a compounding growth is there on the profitability, I think 10-15% upside for both the companies, Coal India and NMDC, looks likely on the card. However, we are bullish on more on the pure metal plays like Hindalco and JSW Steel.
Okay, all right, Hindalco and JSW Steel. Well, Dharmesh, thanks a lot for joining in. And as you said, Amritsar is always special. My third visit in the last 10 years because I've been married for 10 years as well. So, I enjoy going out there, offering prayers, and the food is something as well that you can't miss. Thanks, Dharmesh, for joining in.
Thank you so much.
Well, a quick reminder for all our viewers, though, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists along with studio tours, e-learning sessions and masterclasses and curated lifestyle benefits.
Well, recovery is afoot, but let's see whether it has more legs. For now, we've come to levels of 24,600. So we managed to trim about 50 points of losses in the last 10-15 minutes. And it's courtesy the consumer name. So Tata Consumer has been strong since morning, but now it's gained some more traction, 2.1% on that. Eternal is another big mover, and ITC. So basically, it's some of these consumption names which are helping in that intraday pullback. But Hormus is now at the big wall with all the buzzing stocks at 3 o'clock.
Extreme volatility on the final few minutes of today's trading session, but there are of course names that are bucking the trend, and we'll give you some highlights of those. Greaves Cotton is one such name that has survived this broader market sell-off, and you can see the 10% move today, the biggest single day gain that we have seen since December of 2024. It also comes on the back of very strong volumes, the highest in a month. But if you take a look at the absolute number, that will give you a picture of how the stock has moved on very strong volumes, with over 2 crore shares that have changed hands in comparison to a 20-day average of just around 18 lakh shares. And the stock has now broken above its 50 and its 200-day moving average, which is placed at 207 and at 219 rupees. But despite this, the stock has been an underperformer. It's still down 30% from its 52-week high and around 18% so far on a year-to-date basis. The other big mover in today's session is JK Tyre, and tyre stocks are doing well in today's session in general. It's the second straight day of gains for the stock, but what stands out is the volumes picture that JK Tyre is moving on. Is Tuesday's gains. Today's gains have come on much higher volumes compared to Monday's trading session. And Monday's trading session was just around about 4 lakh shares. Today, around 21 lakh shares have already changed hands compared to a 20-day average of just around 3.5 lakh. And this stock too, courtesy of today's move, has broken above its 50 and 100-day moving average. Both of them are at those levels of 343 and 344. But still another underperformer this year, down around 10% on a year-to-date basis. The theme of the day has been sugar stocks. And if you take a look at the volumes at which these stocks have moved in today's session, take a look at this. Sri Renuka, almost 15 crore shares traded, 20-day average of 15.5 lakh, and Bajaj Hindustan, 11 crore shares traded compared to a 20-day average of just around 40 lakh shares. And the others too, like Dwarikesh, Dhampur, Balrampur Chini, all of them have moved significantly higher on very strong volumes. It will be interesting to see the delivery data that comes in as to how these stocks have panned out on the delivery front, which we will know tomorrow morning. But on the flip side, while the advances have been on very strong volumes, take a look at these names. Lumax Auto, La Travaneus Tech, which is Ixigo, and Godfrey Phillips. All of them are declining anywhere between 5 to 8% today. But the fall that these stocks are seeing are not on volumes as significant as the gains are. Now, the following table will show you why. Because Lumax Auto is declining on volumes that are less than its 20-day average. Ixigo 2 is declining on volumes that are almost at par with the 20-day average, as is Godfrey Phillips. So while the advances are moving on very strong volumes, the declines not so, and that is perhaps what has been the trend of today's trading session.
Okay, Harmaz, lots and lots of movers and shakers on your list as always. Thanks so much for that. Well, I have with me Ajay Khandelwal joining in from the Motilal Oswal conference. He's, of course, a fund manager who manages not one, not two, three, actually 4 funds, right, at Motilal Oswal AMC. And all of them put together, we're talking about assets of about 25,000 crores that he's managing. So, Ajay, you tell us, is this, I mean, the market has been consolidating, so I guess it's actually a good time for fund managers like you, right? Because its stock prices are not running away before you can catch them. So, you know, how has your approach been in the last, especially 2-3 months? Have you undertaken any major shifts in your portfolios?
Yeah, thanks for having me. So I think markets are at a very interesting juncture. On one hand, you have all these challenges, tariff-related, slower consumption, and recently also in terms of financials, there's been some stress. At the same time, when we look at on the other hand, you have these GST tax cuts which are expected. Also, you know, if you look at the recent data, whether the GDP numbers, two-wheeler numbers, they are strong. So I would say market has been selective in its approach, how different sectors and stocks have performed. I can give you an example. Given how tariffs are behaving, within the same sector like IT, the BPO companies are doing well, where they have higher dependency on US. At the same time, some of these sectors, IT companies, where the dependency on discretionary spend is higher, they are not doing so well. So I think market has been fairly selective in its approach. We have changed our portfolio according to where we see that earnings will continue to play. So I think our focus has always been on operating performance, and our portfolios are placed accordingly.
So, you know, markets have not been easy when it comes to picking stocks and making money, right? That's why we need your help. We were just discussing this in the break with Ajay as well, that a lot of your key sectors where you've so far had your focus and overweights on would be consumer discretionary, right? You've been looking at manufacturing as well. Now, let's start with this whole GST business, because we'll probably have the announcements in the next 48 hours or so. And the street has been wondering how to play it. Autos, for instance, great rally building up. Let's start there. Autos, do you think the rally is sustainable? It's also very volatile. I mean, right now this afternoon, M&M, for instance, is slipping because there's suddenly fear that maybe on a certain category of EVs, the tax could be raised higher. What is your outlook and approach there?
So, see, again, as situation plays out, I think one thing is clear, because last almost 8 quarters, the discretionary demand has been weak, and especially with urban consumption. And auto is one sector. I mean, if you look at the last cycle, between 2003 to 8, the two-wheeler sale number, I think they were fantastic. And that gave a lot of confidence, because it cut across the India, you know, in terms of if autos are doing well. We understand that the demand is good across India. So I think these are very important factors. considering how, let's take the case of EV, for example. I think now it is in the base numbers when subsidy numbers are out. So now we are seeing that some of these companies where they have gone through different cycles, now the service levels are improving. And
Ola Electric. I'm hearing Ola Electric in my ears because it's been phenomenal, right? The way the stock has come up. And I'm glad, and this is not a stock call, I mean, that's a disclaimer that always goes out. But yes, the market has been wondering what has changed for some of these EV two-wheeler makers that suddenly, from being absolutely down in the dumps, and you're seeing a stock up 40-50%.
See, without again talking about specific stock, but I think what's happening is that adjustment that is happening where almost 4 quarters we have seen the weak numbers, and now finally we are seeing that in two-wheeler industry, for example, demand is coming back. When we have done our channel checks, we see the liquidity situations improve. Before festival, I think the inventory levels are also managed that way well, and the ground report suggests that things are improving at certain company levels also. So that way, I think market is, as I said, is extremely discerning. They are reacting to how businesses are behaving.
So let's talk about now the best way to play a pickup in consumption, because there's GST boost, there's festive season coming. Discretionary space you've already liked. What else are you looking out for? What else is looking a little exciting? Maybe there's a turnaround, perhaps, that you sense ahead.
So, as I said, the higher price point discretionary has been holding up for last, I think, 8 odd quarters.
Already done well,
But the real pain was in this low price point discretionary consumption, whether it is QSR, footwear. I think that category of customers, and if you add it up with how financial sector which lend to this category, they are also seeing pressure. So when you put these two together, you see that this category is not either there is inflation which is hurting, increase in rent. Some of these factors now are kind of subsiding. If you look at the inflation number, inflation has been fairly benign. So I think when we speak to lenders, we believe that this category will start seeing improvement next 3 to 6 months. So lower price point discretionary, I think some of those businesses will start seeing improvement.
Very, very interesting. I was just chatting with the management of Haldiram Mujhe, veterans in that field, and sounding so optimistic on their business. Absolutely. Okay, one other piece is manufacturing, because you look at that side of it as well, and you've been overweight. It's a very large sector. Where are you on the debate about this whole drop in government capex? So the GDP numbers, I mean, a lot of the boost came in from a pickup in both states and center spends. But what in manufacturing have you been adding through this phase of consolidation?
So here also, if you look at last 2 years, the nature of government spend has changed. I mean, started with railway, and now with all the initiatives that were taken to improve the water situation. Now I think the spend is shifting, and now we see going more towards capital goods, grid modernization, because now some of those things are already addressed. So I think, with the recent news flow, I think the 2H spending in capex could be a little lower from the government side. But we believe the balance sheet, again, and if you look at the some of these numbers, I think we are in a space where in next 6 months to 1 year, both the private consumption, private capex, and some of these government capex numbers will improve. So this is an interesting time where you have these macro challenges, but I think when we talk to companies, we get the sense that, some of these things will play out in next 3-6 months, and once you step away from the noise, once dust is settled, because what happens is during such uncertain times, you try to delay most of these large commitments. But I think 6 months things will settle down.
Okay, so last thoughts. Now, if someone asks you, saying, please help me, Ajoy, I mean, I have like 10 lakh rupees to invest or 15 lakh rupees to invest. From here onwards, putting fresh money to work, give us 3 ideas, top 3 ideas. I wish you could name stocks. Come on, give us one, like Nimesh has been also saying, right? Give one stock name. But if not, give us some clues at least. Top 3 clues to deploy money and hopefully get good returns, at least over the next 1 year or longer.
So I would say, again, these are the times which, as investors, we always look for, where you get these good businesses, strong balance sheet, strong return on capital businesses.
You got to be a little more specific.
At a time where things are not in your favor. So for us, we believe some of these large sectors, for example, specialty chemical, building material. So, and not just sectors which are going through trouble. Some of the sectors which are still doing well, and we believe they will continue.
Capital markets as a house, you're very, very optimistic on capital markets.
I was coming to that. Capital markets, for example, the numbers have been fairly strong. And I think the structural changes that are happening, I think in capital goods and manufacturing, some of these businesses will continue to see strong order flow and execution. So I think this is where market will continue to do well.
All right, thank you very much. Lots of ideas over there. We have to look through the noise, keep our head down, stay invested, and you've given us plenty of food for thought and some, highlight sectors as well that you can perhaps watch out for. Let's head back to the studios, and I think Nigel is standing on the F&O wall with the latest. Nigel?
Well, that's right. The problem today is yet again the Nifty Bank. That's underperformed from the word go itself. And as we speak as well, the Nifty Bank is down more than 0.5%. So that clearly is not getting its act together. And if the Nifty needs to move up, we need some participation coming in from the Nifty Bank. So we have to keep that in mind because that 54,000 odd mark we conquered, but we need to get closer to around 55,000 odd. And the shorts are heavily stacked in the Nifty Bank. Moving to the options data, just take a look at the 24,600 call. The premium out there has crashed. From the top, today it's come down to almost zilch because there has been aggressive writing. Even when the markets were holding up, you did see that on that particular strike, at times you're not making money. That was telling you there was aggressive writing at that level. However, on the downside, the 24,550 put, that as well as seeing aggressive writing. And that's why from the lows of the day, we did see a bit of a bounce. So for the time being, it appears that the day's low of around 24,525 approximately, that seems to be the level that the bulls will want to defend. While on the upside, any kind of move to around 24,630 odd, that's going to be met with some resistance. So that's the broad band for the final few minutes of trade. Stocks that are moving around, Saman Capital, the street is sniffing there's going to be an announcement out there. And the open interest built up today is more than 30%. So fresh buying is what we're seeing on that counter, as is the case with Nalco, a stock that's seen a correction from around 260 all the way to around 170. Now it's pulling back, open interest built up. So, you have fresh buying out there as well. But on the other metal counter, NMDC, out there you're seeing a short covering bounce because the stock is moving up. There were shorts in the system, and it appears just looking at the screen that those shorts are scampering for cover in today's trading session, as is the case with Torrent Power. For the second day running, that stock is doing quite well. So there is a bit of a short covering bounce that's playing out here. In terms of stocks that are seeing a big amount of open interest built up, RBL Bank comes into my mind because the series has just started. Open interest has moved up. If you look at the open interest as a percentage of MWPL, the last I checked, it was at around 88%. When it goes to around 95%, that's when a stock goes into the F&O band. So I think we need to watch it for maybe the next 2-3 trading sessions. That's a probable stock that moves into the F&O band in the coming days. We'll keep an eye out on that one. Back to you, Rima.
Well, thank you very much for that. Get into a short break on that note. On the other side, we'll get you a few BTST calls, and we'll also tell you what the dealing rooms are saying today and doing in D-Street Chatter. Stay tuned.
Welcome back. We're coming to you from the Motilal Oswal Annual Investor Conference. And as always, it's time for D Street Chatter. And our D Street Chatter man has been very busy. Usually he's working the phones, but today he's meeting people and working the phones and picking up the vibes from the conference. So, Nimesh, overall, what's the pulse here that you picked up in general sense of, because look at the market. Market unfortunately sold out.
I spoke about a bit of sentiment from the conference yesterday as well. You know, I'll tell you broadly from an FIR perspective, the good part is they are not negative on the market, especially when they're sitting outside and looking at India. They believe that second half could be quite strong, and there are a lot of tailwinds which can help the markets to do well. I guess broad feedback seems to be that this is a time correction which is happening in the Indian market after good performance in the last few years. So nothing wrong into it. You know, there were some reasons as well for us not to do well in the very short term, and that's playing out. But again, you know, from a domestic perspective, because there's so much of money which is still getting poured into the mutual funds, they seem to be quite active. But again, you know, the one interesting feedback that I picked up here, Subi, was that the domestic mutual fund force has become so strong.
Oh, yeah.
They actually now dominate the price of IPOs, the price of QIPs and everything. So that's a big force to reckon with. So that's broadly the sentiment point of view. Coming to today's market, I guess we're sharply off the day's high. A couple of reasons for it. This is the first Nifty expiry, weekly expiry after the swap, right? Yep. I mean, from Thursday to Tuesday. So that's having a bit of an impact. But also globally, there were some news which had a bit of impact on the Indian markets as well. I guess from a flow perspective, it's a mixed day of trade. Again, metals has done well today for some reason, and for that matter, there's a bit of selective buying in the financial names as well. Not everything in financial is doing good, but selective financial stocks have done well in today's market. Yeah. Again, the other sector or something which is well bid seems to be the consumer names. And I've been saying this for a while now that there is a bit of shift happening from capex to consumption that's playing out. Even in today's market, the flows are quite strong. And I guess GST will be a big trigger to watch out for. Yeah. The feedback here seems to be quite mixed because nobody knows as to what's going to come. But I guess a lot of people are hopeful. So if the government do what the street is anticipating, you might see a further rally. So that's the overall feedback from a sector perspective.
Absolutely. Even today, some large banks falling. That's been a bit of a bummer. Reliance has been, of course, helping counter some of that. But let's come to the juicy part, the stocks. What's on the chatter list?
Okay, so in terms of individual names, the first stock on my list is Aadhar Housing. That's been consolidating in a narrow range of late, but I understand there could be a large block deal in Aadhar very soon. The PE investor could be a potential seller there, so that's the first buzz. The second name is Edelweiss. I've been covering for a while now about the Edelweiss blocks as well. Recently, we saw a large block where Abacus bought. But I understand the stock has been buzzing also because the supply seems to be largely getting over. I understand there could be a clean-out trade from a domestic mutual fund in Edelweiss very soon. So that's the second name. The third stock is Saman Capital. That's been buzzing ever since the stock got added to the F&O in this series. And good volumes as well. Again, for Saman Capital, there is a long-awaited anticipation of a new person joining in. So that's a buzz there. But also, apart from that, the street is anticipating some corporate development as well in Saman Capital very soon. So that's the third name. And the last one is PNB Housing Finance. Again, for PNB, the stock has fallen sharply from the recent highs, but has been seeing a bit of accumulation now. The flows have picked up, is what I understand. Last week, there was massive selling from one of the long-only funds. That got cleaned out, and now some domestic funds are buying as well. And for PNB Housing, the very near-term trigger with the appointment of the new CEO. That can come in the days to come. So that's the trigger as far as PNB Housing is concerned.
Okay, all right, Nimesh, thanks very much for that. With that, let's quickly head back to Mitesh for some final advice. Mitesh, so it's been a bit disappointing. We would have loved to see another follow-through on a strong day like yesterday. But anyway, for what it's worth now, final 20 minutes. What's the call?
So I have a BKST call and a STVT call. On the buying side, I would go with Nalco. I think, just talking metals. Nalco is something which has managed to get past the earlier highs. So buy here with a stop just below levels of 197.5 and a target of 204 can be looked at. And on the STVT side is, about weakness in financials, and Kotak Bank comes on the radar. I think it's making a fresh swing low. So Kotak Bank is a STVT with a stop at 1955 and a target of around 1920.
Okay, thank you very much for that. Jay Bala of Cash the Chaos is also with us on the show. Jay, today, not very disappointing, a bit disappointing. The Nifty slipped a bit from the top of the trading session, but we made higher lows compared to yesterday. I mean, how are you reading the market performance over the last couple of days, and what does it tell you about how we're likely to trend?
Yeah, hi Rima, good to be here. The fact that markets have clocked a higher low to 24,337 And until midday, it looked like a follow through for the higher low. But the second half of the market has given up a little bit. Let's see where the markets close. As long as 24,337 holds, the signs are bullish for the market. If 24,337 were to break, that can get a bit boring for the markets from the rest of 2025 perspective. That's not my primary case. I still believe 24,337 that it registered in early August, that will hold. That might be the case. I would like to see the markets race back about 25,153 that registered a few weeks ago. So let's watch. Markets are a bit of a crossroads. I'm positive on the market from a medium term. Even if the markets were to break 24,337, it just delays the bull market from resuming. The April low will still remain intact very comfortably. That's the thesis with which I'm working.
All right. Jay, hi, good afternoon. Good to see you in. Jay, September is my favorite month. I'll tell you why later. But in the next 12 months, what's the probability we see a big, say, a 25% return from here, 20, 25%? 12-month target on the Nifty.
Yeah, that's what I said. In my last sentence, I said, even if you were to break 24,337, it'll just bore the market for the rest of 2025. There'll be pockets of outperformance. 29,000 remains my objective for the rest of 2026. So that's a 12 months perspective. So that still remain unimpacted. The question is what the markets does over the next 4 or 5 sessions. That's going to be very crucial for the short term. But from a 6 to 12 months perspective, the 29,000 objective remains unchanged.
29,000. Got it. Jay sounding quite bullish on that space. Got it. What about autos? That's the sector that's come back to life. You have fundamental news as well that's coming in there. What's the view there if on the index, on a couple of stocks, if at all?
Yeah, Nifty Auto Index, I'm seeing fresh 52-week highs come through for it. My expectation is for Auto Index to continue cracking higher. 28,500, 30,600 is the objective for the Nifty Auto Index. Today, we have a huge breakout on Bajaj Auto. And we discussed this a couple of weeks ago too, and a few weeks ago too. That's possibly aiming for Rahul Bajaj's objective from here on. This needs to spread on. See, auto index is the only one that's doing extremely well. We need one more sector, either banking index or Nifty energy index or capital goods or one other sector needs to give a lifting hand for the auto sector. Autos alone can't do the job. We need a breakout from one more sector.
Got that. Jay, we'll come to your individual stock calls in just a bit. For now, the other big talking point is the GST Council meet. That's all set to meet tomorrow and day after. So the decision will be known to us perhaps only 4th September evening. And this will be to discuss the proposal of a simplified 2-slab structure plus that 40% tax. Timsy joins in with the details, expectations. Timsy.
Prime Minister Narendra Modi's vision in his Independence Day speech on next generation GST reforms could soon be a reality. The GST Council is set to meet on 3rd and 4th of September to discuss the centre's proposal to shift to a simplified 2-slab structure of 5% and 18% with a special 40% rate for sin and demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities such as soap, shampoo, medicines, hair oil, toothpaste, biscuits, namkeen, bhujia, footwear and apparel below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in the lower category of 5% or even in certain cases exempt. Aspirational goods such as television, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc, which are currently taxed at 28%, may move down to 18% slab. The proposal also includes a major relief for consumers and industry with life and health insurance premium, as well as reinsurance likely to be exempted from GST. While the centre is confident of a smooth passage, states have raised concerns over possible revenue losses. They have sought assurances of revenue protection, pointing out that they are not opposed to the rate rationalization but need compensation to meet their financial obligations, also a mechanism to ensure that the rate cuts are passed on to the end consumer and not result in any windfall gain for any of the companies. The September 3rd and 4th Council meeting is expected to be a crucial one, with the potential to usher in a new phase of GST, simpler, consumer-friendly and aligned with the Prime Minister's reform agenda. Something that we'll have to wait and watch for the Council as to what finally passes through.
Thank you very much for that. We've been getting in all corporate expectations through the last couple of days. Listen in to Indian Hotels and Marico and what they believe will be the impact of the GST rate rationalization in their company and industry.
Absolutely, and I think that 7,500 ceiling was created 8 years ago. It's not been even adjusted for inflation. So I think given that the sector is the highest multiplicator of jobs, it is in the best interest of the nation to change that ceiling and bring it to the 5% bracket. So it's not an unreasonable request from our side, and I think let's see, time will tell if that change happens or not. But should that happen, yes, it will be extremely positive.
I think one of the things is rate rationalization is something which I think is a tremendous opportunity to drive consumption, and it is happening not only in consumer goods, it's expected in things like auto and durables, which will definitely catalyze. It's a very, very bold move by the government and the entire simplification and rationalization. It will definitely catalyze consumption in the country.
Okay, well, there are two big themes which are dominating the markets. One, of course, is GST rationalization. We listen into Tim C's opinion, corporate opinion on that. And the other one, what's happening on the geopolitical front. And here, referring to Prime Minister Modi's meeting with Russia's Vladimir Putin, the US Secretary, Scott Bessent, called the gathering long-standing meeting and largely performative. He said India's values are much closer to the US and China than that of Russia. He also expressed confidence in resolving the trade concerns with India. However, he voiced his concern on India's Russian oil imports and said that the US will be examining additional sanctions and measures against Russia this week. All right, this, of course, remains the big talking point, and we'll have to see how this evolves. But for now, let's get back to the markets. 10 minutes to go. It's been a bit of a volatile session, particularly in the last 30 minutes. Jay Bala is still with us. Jay, you were earlier telling us that markets are headed higher. There may be a little bit of volatility now, but we're headed higher. And one sector other than autos needs to perform very well. What about individual stocks now? Which stocks are you looking at in terms of a trade?
Yeah, see, there are a couple of picks today, and you need to keep the position sizing on medium and conservative, not very aggressive. So with that in mind, read this Reliance Industries. The Nifty Energy Index from its June high to August low has come down in a corrective fashion. And that's very close to 50% Fibonacci retracement of the April-June move. And Reliance Industries being one of the top contributors in the Nifty Energy Index, I'm expecting that to be, giving a lift for the energy index if it were to move higher. And I consider Reliance itself as a separate sector. So that being the case, if Nifty were to get bullish, this is another reason for to be slightly positive in the short term for Reliance Industries. The stop loss at about 13.25, objective of about 14.95. If you look at tire stocks today, MRF, Sept, JK Tires, all of them are doing well. So if tire sectors had an index, I'm sure that will be showing some positive signs. So my pick, second pick for today is Apollo Tires. It's got a bullish move from the March low to June high, and it's corrected from there on. So the recent low of July is exactly the 61.8 Fibonacci retracement, and we are getting a higher high from there on. So I'm positive on Apollo Tires from a short-term perspective. Stop loss of 440 with an objective of 555.
Got that. Stay on. We'll talk about more sectors, markets. For now, break. And remember to tune in to our all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts, their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime, 12 noon for the Global Reset, 1 p.m. Big C, 8:30 p.m. for the Global Lens.
Well, last 4 minutes of trade, but let's go across to Jay Bala. He's got a couple of stocks that he wants to tell us about as well. Jay, could you name them? Which are the stocks that are on your radar that could do well from here on?
We already discussed Reliance and Apollo Tyres, Nigel. But rather than that, we might want to keep a focus on SBI. But it's a conditional move. It has to break out above 837. If that happens, the markets get overall bullish. And from a sector perspective, you might want to keep your focus on capital goods names. We have a BSE capital goods index that's looking quite positive. Choose your own stocks from here, and you might want to keep focus on something like Schaeffler India, which is all need to break out. It's still a breakout is pending in many of these names. So keep a focus on BSE capital goods as well as some select stocks in the realty space.
The problem for the Nifty right now is we take on board that point that you're saying that the Nifty could still run away from here on. The problem is a star batsman. The Nifty Bank, that's not performing. And that has to find its form if you have to move up. Well, how are you viewing the chart out there?
Spot on there, Nigel. That's been the drag for the market. And that's been the Achilles heel for the overall market trend. The Nifty Bank needs to put on some runs. And that's the reason why I was pointing to SBI. SBI, if it crosses 837, 840, that will lift the banking sector. There's a short-term head and shoulder breakdown for the Nifty banking index. So that needs to get negated above 56,100. So let's see. Probably when 837 gets crossed for SBI, this will automatically get negated. But at the moment, we need to stay cautious within the banking system. But Nifty PSU Nifty PSU index, that's putting a very interesting short-term low here. Let's see if that can consolidate. So, these two can coalesce. We can have SBI give fillip to the banking index as well as the Nifty PSU index.
Okay, all right. Just one stock I think we should pull up actually from the broader markets is SBFC. There's a big 1 crore volume trade actually on that one, around I think 103, 104 rupees. Just pull up SBFC. The big, large volumes is what we're seeing on that particular name. So just keep an eye out on that. Jay, we can squeeze in one more strategy. Gold, that's been twinkling. All the ladies at home, they're saying that we told you so. I think gold is up 40% in the last 1 year, while the Nifty is actually flattish. What do you have to say? Is it good for more?
Definitely, Nigel, but I think it's only a short-term move. Like we discussed last week, it's been on a tight consolidation for 12 weeks. I'm speaking about London gold, and it crossed 3440 yesterday, that level for the consolidation to confirm that it's a breakout. We have a short-term bullish potential for about 3650, and like I pointed out last week, silver is slightly more bullish than gold. It has potential to scale about 42.5 to 44 on the bullion silver, the spot London fixing. So watch out for it. So I believe it's post that it's coming to a important cycle high. But from a very short-term perspective, definitely higher highs to come through for both gold and silver. Silver is slightly more bullish.
Okay, thank you very much for that. Jay, we'll come back to you for now. We've got about 2 minutes left. So just quickly wrap out today's trading session. Closing in the red. For a greater part of the trading session, markets were firmly in the green. There was optimism about India-US deal coming through. The Nifty went on to hit levels of 24,750. But from there, in the last 1.5 hours, markets came in for some amount of profit booking and ultimately closing in the red and below the 24,600 mark. Banks were a key drag in trade. ICICI Bank, Kotak Mahindra Bank, HDFC Bank all under pressure. Axis Bank adding to the gloom. And overall, the Nifty banking index was down close to about 360, 370 points. Other losers included Dr. Reddy's, Asian Paints, Cipla, Tata Motors, Trent. These are stocks with notable losses. On the way up, you have PSUs batting, holding up in the greens. Power Grid, NTPC deserves mention. Consumption continues to remain a dominant theme. Nestle, HUL coming in for buying, and Reliance Industries, after 2 sluggish days, came back in style. Reliance Industries up nearly about 1%. The midcap index outperformed, ending in the green, but again, off from the day's high, though the advanced decline ratio was positive.
Well, that's right. But today was a day when you had many stocks in the broader markets actually that were up and about in trade. MobiWik, the stock was up 20%. Massive move out there. Vimta Labs, stock up another 20% in today's trading session. Big move is what we saw in that name as well. Jacob up 15%. Greaves Cotton up close to around 10%. Saman Capital, Street is sniffing the corporate action out there. That stock as well went home with a massive gain of close to around 10%. So in the market actually, where you saw that the Nifty ended with a cut of around 50 points. In the broader markets, plenty of winners out there. Vishal Mega Mart came in for some profit taking. Paradeep Phosphates, that's been doing quite well. That came in for some profit taking as well. And HFCL as well fell on rather large volume. So the Nifty unable to conquer the 24,700 odd mark. Today really was the day of two halves. We had the first half that belonged to the Bulls, and the Bears fought back in the middle of the trading session. We'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting by.
Market ends in the red after it fails to hold on to early gains. The Nifty back below the 24,600 mark. Financials, they underperform as banking heavyweights close in the red. Sensex falls close to 200 points and the Nifty down about 50 points. Broader markets remain in favor of advances.
Stocks of sugar mills surge after the government says that it will not impose any restrictions on production of ethanol in the coming season. Industry experts see this increasing diversion of sugarcane to near 5 million tons from just over 3 million tons.
Reliance Industries gained after Morgan Stanley's positive note says AI will redefine the company's equity story further, initiates overweight rating. Phoenix Mills as well surges on the back of bullish brokerage commentary coming in from Motilal Oswal. Good evening. You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day while reliving today's trading session as well. I'm Manglam Malu, with me Hormaz Fatakia. Very interesting day of trade today, Hormaz, right? We were doing extremely well for most part of the day. At some point, the Nifty went ahead and crossed the 24,750 mark as well. And lo and behold, just as we moved towards the weekly options expiry, we saw one sharp fall down for the Nifty, and that was led lower by the Nifty Bank, an index that has not been powering the Nifty ahead. In fact, yesterday's up move was led by the IT index. Today's top contributor was Reliance. So the Nifty Bank not doing too well, always had everyone jittery, and right now as we speak ended about 0.2% lower, led by heavyweight banks. But Hormaz, you have a lot of the buzzing stocks as well. We'll tell you all those, but here's what we've lined up on the show today. We start with the top movers and shakers that Hormaz will tell us. Sugar stocks as well. They surged as the center lifted curbs on ethanol production, while Reliance Industries too gained on the back of Morgan Stanley upgrade. Phoenix Mills too rallied on a ratings boost coming in from Motilal Oswal Financial Services. But last but not least, we'll also tell you about the key events to watch out for in tomorrow's session. Let's talk about the movers and shakers then. Hormaz.
You mentioned about sugar names, and of course they are the ones that had a sweet day today, and sweet on very strong volumes as well. You take a look at most of those names, though did come off slightly from the highs of the day in line with the market sentiment. But take a look at the gains here. Double-digit gains for Sri Renuka, Dwarikesh, Dhampur, Awadh and Balrampur also having a very good session today. So it'll be interesting to see what kind of delivery data emerges for these stocks later in the day. A pocket that did well today was the PSU stocks, be it the defense names, be it the railway stocks. All of them saw very healthy gains, anywhere between 5 to 7% today. RVNL, NMDC, of course, on the back of that strong production update that it gave out. IRCON, BEML also seeing good gains in today's session. What also did well were the tire stocks, and almost every tire stock that we speak about did very well. Take a look at MRF, 6.25% higher on the stock on volumes that were the highest since August of last year. So on very strong volumes as well on MRF, and most of the others too seeing gains of anywhere between 4 to 7%. The newsmakers of the day, well, Sammaan Capital continues to move higher in its entry as an FNO stock, but MobiKwik was the highlight of the day, 20% higher on the stock after ADIA's exit, and with this, the stock is also back above its IPO price of 278 rupees. D-Development, of course, after an order win, and Axis Gates too building on the gains, and Sun TV after a positive brokerage note coming in from Avendus Sparks. But some of the high-flying stocks of yesterday's trade saw some profit booking today. Lumax Autotech was down 10, Ixigo was down 6, Godfrey Phillips and VST Tillers also seeing some profit booking, but not on volumes as strong as were those seen by the gainers in today's trading session, Manglam.
Those were a bunch of movers, more advances than declines, but it was the sugar stocks that Hormaz started with the surge in trade today. So let's take that story further. The government says it will not impose any restrictions on production of ethanol in the coming season, giving a boost to the prospects of sugar companies, because ethanol obviously is better margins for them, higher realizations as well. And with increased ethanol production, chances are that the prices of sugar itself increases. Ria joins in to tell us how the sugar industry benefits.
Well, yes, Manglan, this was a very significant boost for the sugar industry. India has removed all curbs on ethanol production from sugarcane juice and syrup, as well as from B-heavy and C-heavy molasses. This is by sugar mills and distilleries for the sugar season 2025 to 26. Now, the government is going to periodically review the diversion of sugar for ethanol production to maintain the availability of sugar for domestic consumption. And remember, these restrictions were earlier imposed in December of 2023 because of the rise pricing sugar prices at that point in time. And with this new moves, sugar mills will now be able to use the lying inventory of B-heavy molasses, and this is also going to help achieve the target of 20% ethanol blending. In a separate government notification, the government had also said that distilleries are now allowed to purchase up to 2.3 million metric tons of rice from FCI for ethanol production, and this is also going to enhance production from dual feed distilleries. Resultantly, all of these stocks are much higher in today's session, as Hormuz was highlighting earlier. Just coming to the valuations for some of these stocks, for Balram Chini, Triveni Engineering and EID Parry, they are currently trading above their 3-year averages, while Dalmia Bharat is slightly below its 3-year average PE. In terms of the stock moves over the last 1 year, most of these stocks are down anywhere between 3 to 45%. Only DCM Shriram is up around 9%, and EID Parry has been the outperformer, up around 37% over the last 1 year.
Ria, thank you for that update. Let's take this conversation forward with our guests on the show. Jay Bala of Cash the Chaos and Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, are joining in. Gentlemen, thank you for sparing time and joining us on the show today. Sudeep, you know, sugar stocks were the flavor at least a few years earlier when this entire ethanol story started to play up. But now they are lost in the reckoning. And with this move that the government has announced, do they get back into the reckoning? Do you see a major fundamental change, or do you just see this as a tactical play till the story plays out?
Well, I think, honestly, I believe this is a tactical play till the story plays out, and you're absolutely right. I think, ethanol blending and up to 20% ethanol blending was as a policy which the government has announced, but there were roadblocks, and government obviously monitors the sugar prices on the market, and they can't let this happen if the prices are going up. And now, because we are comfortable with the prices in the market and there is a sufficient production, government has allowed this. But I think the whatever had to happen has already happened, and today's up move was a consequence of this particular order which came. I don't see too much excitement, further on this account. Fundamentally, I think sugar stocks have a potential to do well. Also, their performance will depend on how much export is allowed on a yearly basis, and that keeps varying again. So there are multiple factors which do affect sugar stocks, and one has to remember that if you are buying in sugar stock, be prepared for the volatility.
All right, we take that point, Sudeep. So that's the view coming in on the sugar stocks. But let's get in Reliance as well. Reliance was buzzing in trade today, an outperformer after Morgan Stanley upgraded the rating on the stock. The firm projected an optimistic outlook, raising the stock's valuation to overweight, rather rating to overweight, with a target price closer to 1,700 rupees. Sonal joins in with the details on that one. Sonal.
Well, Reliance Industries has been in focus since the time AGM took place, and now there's an interesting note coming in from Morgan Stanley. They say anti-involution and AI will redefine Reliance Industries' equity story. They are the largest beneficiary of China's anti-involution focus across energy and solar supply chains. In this AGM, they spoke a lot about specific targets for new energy business, the entire value chain, and that is what the streets seem to like as well. They say they are also seeing a lot of focus on consumer retail and telecom, which is bearing fruit, and that's why the involution would add $20 billion in NAV and 17% to FY28 EPS as well. They are raising their new energy estimates in terms of NAV by 20% to $25 billion, which will happen in FY27.
Sonal, thank you for that update. Reliance among the contributors to the Nifty gains, at least in the initial part of the session. Get your chart check as well from Jay. Jay, what are the charts for Reliance indicating right now? It's been a bit of an underperformer in the last month or so. And at around levels of 1380, 1400, do the charts indicate some value for further upside?
That's right, Hormuz. The stock was doing pretty well up till July, and from there on, it's been underperforming. No wonder Nifty has been mimicking its move. The zone of 1340 to 1325 is extremely important. And I think there is a possibility that yesterday's low was an important turning point for the stock. So as long as the stock can hold about 1325, it's got a bullish potential to scale back to at least 1495, if not take out the July highs. So if we have a follow through tomorrow, I think there's a reasonable possibility that the stock will proceed at least to 1495 to July high, so about 1550.
When does the Nifty Bank start participating, Jay? That's point number one. And secondly, Nifty Intraday did cross important levels, 20-day moving average, 100-day moving average. Did not close above that. Why is that?
Yeah, the main drag for the banking sector has been the private sector banks, but SBI is coiling up in a narrow range. As long as it can hold about 790 to 800, I think it's a positive consolidation. The breakout, though, comes only above 837, 840. I think it's a bullish consolidation, but that will get negated only below 790. So I think once it crosses 837, that will change the picture for the banking sector. So we'll wait and watch for it. Don't want to preempt the market.
All right, we take that point. Sudeep, we'll come to you for a stock. Before that, let's talk about that. It's the brokerage commentary that is coming on Phoenix Mills, which gained after a bullish note coming in from Motilal Oswal. Sonal joins in once again. Sonal.
Motilal Oswal is bullish on Phoenix Mills. They have upgraded the stock to a buy. The target price is at 2,044 rupees a share. What they like is the fact that they're adding new malls, and this is something which will start seeing results from FY27 itself. They continue to diversify, and this could add around 2,800 crore rupees in terms of rental income overall by FY27. That would mean a 21% CAGR in the retail rental income. The office portfolio, the other part of their business, is also expected to surge 3 times. Now let's talk about their hospitality business, because they have been expanding there. They bought an 11-acre land in Thane. This will add 3 times the keys that they already have and take it to 1,800 keys by FY27. The company also acquired the remaining 49% stake in Ireland Star Mall Developers, and this will strengthen their high-quality retail asset portfolio. This will also be earnings accretive from year 1 itself, and that's what they are very bullish on.
Sonal, thank you for that update. Phoenix Mills ending 3.5% higher. Sudeep, Phoenix Mills among the real estate plays, considering the fact that it has a diversified portfolio of assets, be it commercial, malls, hotels, office spaces. Is that one of your preferred bets within the real estate space, or would you choose to go for proper pure play real estate developers?
Armaz, we have been positive on commercial real estate for quite some time, and Phoenix is typical play on commercial real estate. They have the malls, they have the office spaces, and a little bit of hospitality, and they're expanding pretty well. And the demand for curated, customized office space has significantly gone up post the GCC boom, and Phoenix is definitely one of the beneficiaries of that. So absolutely, there is no doubt about the potential of Phoenix over the next 2-3 years, and this report actually highlights that. I'm not sure about immediate benefit, tangible benefit to the company, but yes, if you're looking at a 3 to 5 year kind of a time horizon, I think definitely Phoenix Mill is a good bet.
All right, we don't know whether there's an immediate tangible benefit or not, but speak about immediate tangible benefits, it could perhaps come in the form of the GST Council reducing rates. The 2-day meeting starts tomorrow to discuss rate rationalization. We have a quick peek into what the expectations are this time around, what's on the agenda, where the rate cuts could be. Tim C joins in to give us a quick refresher. Tim C.
Well, Prime Minister Narendra Modi's vision in his Independence Day speech on next generation GST reforms could soon be a reality. And as you rightly mentioned, the GST Council is set to meet on 3rd and 4th of September to discuss the centre's proposal to shift to a simplified 2-slab structure of 5% and 18% with a special 40% rate for sin or demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities such as soap, shampoo, hair oil, toothpaste, medicines, biscuits, namkeen, bhujia, footwear and apparel below 2,500 rupees, footwear below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in the lowest category of either 5% or in some cases even exempt category. Aspirational goods such as televisions, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc capacity of engine, which are currently taxed at 28%, may move down to 18% slab. The proposal is also to include major relief for consumers and industry, especially apart from that on life and health insurance premiums, including reinsurance, which is likely to be exempt from GST from current 18%. While the centre is confident of a smooth passage, states have raised concerns over possible revenue losses. They have sought assurances of revenue protection pointing out that they are not opposed to rate rationalization, but they need compensation to meet their financial obligations at the states. The September 3rd and 4th Council meetings is expected to be a crucial one, especially as it has the potential to usher in the new phase of GST, simpler, consumer-friendly and aligned with Prime Minister's reform agenda. So we'll have to see what happens finally in these 2 days of the meeting, what all gets cleared, what all is actually the way forward and the consumption boost that is aimed with this GST reform.
Timsy, thank you for that curtain raiser ahead of the GST Council meeting. Sudeep, there is a lot of chatter with regards to the rate rationalization, be it with regards to automobiles, to consumer durables, but does that really reflect a tangible benefit that, okay, if there is a rate cut, people will actually throng and consumption will increase? Because I was reading a note today which said that wage growth is the actual underlying factor that needs to happen for a more sustained consumption boom. What do you make of this? And do you believe that with the run-up that these stocks have seen, after the news, do you book some profits here?
Well, Hormuz, I think, definitely this will be a fillip. Wage growth is definitely a very critical factor. Unless you have money, how do you go and buy? But, we are heading into a festive season. Interest rates have been coming down. Monsoon has been good. Rural income has improved. So under the circumstances, if you have a GST rate cut, which will bring down the prices of some of the consumer durables and all that reasonably to a certain extent, definitely that will incentivize purchase. The demand for consumer durables as well as demand for consumer durable financing loans both will go up. That's what our belief is. Long term, yes, wage growth is critical to sustain demand, but we will see definitely a blip upward as far as demand is concerned for all these stocks.
All right, Jay, Sudeep, thank you so much for joining in and giving us your views on the markets, individual stocks and the way forward. Thank you, and we will hope to connect with you soon as well. Take a short break, get you all the top corporate voices along with the key market events to watch out for tomorrow.
You're still with us here on Markets Forward, and on to some top corporate voices that we had through the day. First up is Indian Hotels. The management says the hospitality industry would be happy with a 5% GST without input tax credit for rooms costing below 7,500 rupees. Other than the GST, the management also highlighted its growth plans. It said that majority of the next leg of growth will come from mid-scale hotels, and added that the brand Ginger is well positioned to have 250 hotels within the next 12 to 18 months. And that's not all. The hospitality chain maintains its double-digit growth guidance for FY26.
Right, next up in the line is Marico. All the FMCG stocks have been doing well lately. The company aspires to touch double-digit volume growth coming in the coming quarters. Further expects to see 10% EBITDA margin in the digital business in the next couple of years as the burn reduces. Management also believes that affordability and availability are the two drivers of growth coming in for their nutrition portfolio. In particular, consumption has remained steady while input costs has seen a marginal decline, and that the GST rate rationalization itself is a great opportunity to drive consumption. That's not all. The company too has sub-brands which are focused on nutrition. They expect to continue in that journey, which is largely driven by consumers increasingly choosing healthier eating options.
We also had the management of Genus Power on the show, and the company maintained that it was never blacklisted technically by the Goa Electricity Department. It was an internal memo which was issued last year, which Genus had challenged, and the Goa High Court had passed an order in the favor of the company. And that's not all. The company was also confident of winning a large share of orders worth 35,000 crores that is up for bidding, maintaining its revenue guidance to be at 4,000 crore rupees and the margins to be in the range of 18 to 20% for the full year.
All right, and with that, we do not wrap on this edition of Markets Forward. In fact, before we wrap, we'll go across to Ria, who will give us all the key events to watch out for ahead of trade tomorrow. Ria.
Well, yes, taking a look at the events to watch out for tomorrow. First up, in terms of economic data, we have the US jobs data coming out tomorrow. From UK, Europe and from India, we have the global services PMI, so keep your eye out on that. In India, some board meetings to watch out for. IIFL Finance, Saman Capital as well as Suraj Estate Developers will hold board meetings to consider fundraisers. For Rolex Rings, they are going to consider a stock split as well as a bonus issue. Vikrant Engineering also lists tomorrow, so watch out for that as well. Some other events, the two-day meeting of the GST Council will begin tomorrow, and Union Finance Minister Nirmala Sitharaman will chair the meeting at New Delhi. The second day of Semicon India 2025 is tomorrow, and PM Modi is going to participate in the CEO's roundtable at Semicon India. Motilal Oswal's 21st annual investor conference continues through the 5th of September. And lastly, looking at the Fed in the US, St. Louis Federal Reserve Bank President Muzalim speaks on the US economy, and Minneapolis Fed Reserve Bank President Kashkari speaks before the Minnesota Women's Economic Roundtable tomorrow.
Ria, thank you for those updates. With that, we call time on this edition of Markets Forward. From Mangla Minmi, thank you for watching. News and updates continue on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking this evening: the Sensex and the Nifty end with marginal cuts, giving up gains in early trade. Financial stocks drag the market today. The Nifty drops below 24,600. The rupee remains flat against the dollar, but above the 88 mark. There's no stopping the gold rally. Prices of the yellow metal soared to record highs amidst hopes of a US rate cut. Silver prices also hit a record once again. US Treasury Secretary Scott Bessent expresses confidence in resolving the tariff standoff with India, says India's values are much closer to the US than to China and Russia. This comes as President Trump calls the relationship with India a one-sided disaster. This after Prime Minister Modi's meeting with Russia's Putin and China's Xi Jinping in Tianjin. India is in dialogue with the US for a bilateral trade agreement, says Commerce Minister Piyush Goyal. Adds the situation is getting back to normal with China as the border issue gets resolved. Also says talks with the European Union over a trade deal are at an advanced stage. Long pending rate cuts on the cards as the GST Council gears up for a two-day meeting starting tomorrow. The centre remains confident of a smooth passage even as states raise concerns over possible revenue loss. Indian Hotels bats for a 5% GST rate without input tax credit for rooms with tariffs below 7,500 rupees. Oil may be black gold, but chips are digital diamonds, says Prime Minister Modi as he inaugurates the latest edition of the Semicon Summit in New Delhi. Ashwini Vaishnav presents the Vikram 32-bit processor, touted to be India's first made-in-India chip, to the Prime Minister. Companies remain hot on India but express concerns over geopolitics impacting the semiconductor supply chain. Nestle fires its global CEO for an undisclosed romantic relationship with a direct subordinate in breach of the company's code of conduct. The dramatic removal comes just a year after he took charge as the first outsider to lead the multinational. Punjab is reeling from its worst floods in over 3 decades. Over 1,000 villages submerged, close to 3 lakh people displaced. Schools, colleges and offices remained shut in Gurugram after heavy rains in the district led to traffic snarls. The Met issues a heavy rain alert for Delhi and surrounding areas. South Mumbai remains paralysed as the Maratha reservation protests enter day 5. Mumbai police issue a notice to the leader of the agitation and protesters to vacate Azad Maidan after finding repeated violations of the conditions laid down by the police and the High Court. Afghanistan's Taliban government appeals for international help as the death toll after the earthquake crosses 900. Authorities say the death toll could rise as many people are feared trapped under the debris. Well, let's start with the day's market action. The bulls failing to hold on to early gains on the large street. The Sensex finally closing over 200 points lower. The Nifty is back below 24,600. Financials were a drag today. The Nifty Bank lost about 340 points and the Nifty midcap, though closing in positive territory, up by about 150 points or so. But a flat close there for the Sensex and the Nifty. The markets coming off their intraday highs. Nigel is standing by to wrap up the market action for us. Markets off their highs, Nigel, today.
Well, today was a day of two halves, actually, because the first half of trade, the bulls would have feel quite confident. However, the Nifty went to around the 24,700 odd mark, which is a bit of a resistance zone. We have the 20 DMA as well out there, and it did correct from there. Now, today was the weekly expiry that played out, being a Tuesday. So now you have the Nifty contracts that expired on a Tuesday, and that was another factor that led to some kind of selling, particularly in the last 2 hours of trade. The Nifty Bank, that's the sore point. It's unable to find its form, and that continues to underperform even in today's trading session. Now, for the month of September, there's going to be two big triggers. One is, will there be some kind of easing on Trump's tariffs? And the street awaits clarity on the GST front as well. And because there is some speculation on this GST rates, we had Mahindra & Mahindra was a stock that actually came under pressure because, there is some kind of talk that maybe there could be proposed higher GST on vehicles in a particular price band, or EV vehicles as well, which currently enjoy around a 5% GST rate, which could move up. So because of that, Mahindra & Mahindra was one of the top losers. Giving it company on the downside was Dr. Reddy's. That stock as well went home with a cut of more than 2%. But from the Nifty pack itself, there were a couple of sectors or themes that did do well. So the power-related stocks, Power Grid, your NDPC, both of them were higher in trade. And the consumption basket does continue to see some good amount of buying. They've been underperformers, but now with the last few sessions, we're seeing that the bulls are going in there and they're buying. And today, Nestle as well as Tata Consumer, for majority of the trading session, did outperform. But you look at the headline index and you'll say the Nifty ended mildly in the red. The biggest story, though, is playing out in the broader markets, because even today, the number of stocks that were advancing were way more than the number of stocks that were declining. And there were select stocks that did do well. The sugar space got a bit of a boost with regard to ethanol. And that's why you had stocks like Balrampur Chini as well as Sri Renuka Industries. Both of them were up and about in today's trading session. And a couple of stocks actually that have been ranked underperformers. Sammaan Capital as well as MobiKwik. Well, both of them were up between 10 to around 20%. On Sammaan Capital, there is that speculation that there could be a new boss at the helm. So we'll be keeping an eye out on that. That stock was moving high in very, very high volumes. And MobiKwik, the stock that's down to close to around a third of what it was at its peak. Well, there was a clear out trade yesterday. And the street is getting a little bit positive on some of these new age themes. So that stock as well did do well. Short point being in the near term, the market is fixated on Trump's tariffs. And we need to see some easing on that front or some kind of breakthrough for the markets to move higher from here on.
All right, Nigel, many thanks for joining us. That was the stock market action. In the money market, the rupee remained largely flat against the dollar. $1 is now worth more than 88 rupees as the dollar index continues to gain strength. The 10-year yield softened marginally in trade but remains above 6.5%. In the commodity market, there is no stopping the gold rally. Prices of the yellow metal hitting a new record high amidst hopes of a rate cut in the US. Gold prices in India have rallied 35% so far this year. Silver prices have also hit another record high. In fact, silver has outperformed gold so far this year with 40% gains. But the top story this evening, US Treasury Secretary Scott Bessent has expressed confidence in resolving the tariff standoffs hours after President Donald Trump slammed trade ties with India, and I quote, as a totally one-sided disaster. Now, Trump's statement came after Prime Minister Modi met Chinese President Xi Jinping and Russia's Putin in Tianjin over the weekend. This was the Prime Minister's first trip to China in 7 years, coming in the midst of a tariff standoff with the Trump administration. However, Bessent criticized India yet again for its purchase of Russian oil and accused the country of, and I quote, financing the war in Ukraine. Now, reacting to Prime Minister Modi's visit to China for the SCO summit, Bessent told Fox News that the meeting was largely performative. He said, and I quote, India is the most populous democracy in the world, and at the end of the day, their values are much closer to ours than to China's, than to Russia's, end of quote. Meanwhile, White House trade advisor Peter Navarro telling reporters that the show of unity by Modi, Putin and Xi did not make sense. Navarro referred to Prime Minister Modi as a leader of the biggest democracy and Putin and Xi as the two biggest authoritarian dictators in the world. Petroleum Minister Hardeep Puri has responded to Navarro's earlier comments where he referred to India as an oil money laundromat for the Kremlin. In a column in The Hindu, the minister wrote, and I quote, some critics allege that India has become a laundromat for Russian oil. Nothing could be further from the truth, end of quote. Commerce Minister Piyush Goyal has said that the situation with China is getting back to normal, with the border issue being resolved. He added that India is in dialogue with the US for a bilateral trade agreement. Take a look.
It was a shame to see Modi getting in bed as the leader of the biggest democracy in the world with the two biggest authoritarian dictators in the world, in Putin and Xi Jinping. That doesn't make any sense. I'm not sure what he's thinking, particularly since India has been in a Cold War and sometimes a hot war with China for decades.
We already completed Mauritius, Australia's first tranche, the four-nation EFTA bloc, UK, UAE. Lots have happened, lots more to go. But all of the US, we are in dialogue with them for a bilateral trade agreement. This was an SCO summit where all the SCO members participated. We had a problem in Galwan due to which we had a blip in the relationship. As the border issue got resolved, I think situation getting back to normal is a very natural consequence. We have reached a very advanced stage in our FTA with the European Union. Commerce Secretary, as we speak, is in meetings in Brussels with his counterpart, the DG of EU. Their team is coming down later this week and will be in active negotiation with us. The Minister, Trade Commissioner, Mr. Maros Srkovic, is coming down on 12th of this month. And we are making very active and significant progress.
Well, that is the Commerce Minister Piyush Goyal. China's President Xi Jinping held a bilateral meeting with Russia's President Putin in Beijing today. Both nations have signed an agreement to build a new pipeline to send natural gas to China via Mongolia. The Russian president described Chinese President Xi as a dear friend and said ties between both countries are at an unprecedented level. Now, Russia is set to increase supplies of gas to China, while Beijing is set to offer visa-free travel to Russians on a year-long trial basis. North Korean leader Kim Jong-un has crossed the border into China in a private bulletproof train. He's scheduled to watch the parade commemorating the 80th anniversary of the end of the Second World War. Russia's President Putin would also attend the parade. This is the first time leaders from North Korea, Russia and China have gathered for the same event. Back home, Prime Minister Modi has said that while oil is black gold, chips are digital diamonds. The Prime Minister inaugurated the Semicon India 2025 and expressed confidence that the world is ready to build semiconductor in India. The IT Minister Ashwini Vaishnav presented the Prime Minister with India's first indigenous 32-bit processor named Vikram, as well as test chips of 4 approved projects. Developed by ISRO for space launch vehicles, Vikram is expected to help cut import dependence. The chip is qualified for use in the harsh environmental conditions of launch vehicles.
Friends, semiconductor की दुनिया में एक बात कही जाती है, oil was black gold, but chips are digital diamonds. 21वीं शताब्दी की शक्ति छोटी सी चिप में सिमट करके रह गई है। ये चिप भले छोटी सी है, लेकिन इसमें दुनिया की प्रगति को बड़ी गति देने की ताकत है।
See, the foundation that we have laid is excellent. The entire world today believes in us, and the process, entire process, all the ecosystem partners in the process, they are with us today. You have seen in the exhibition. So, for example, how is a chip made, right? So it all begins with the silicon sand. This sand is molted, it's melted, and then comes the ingot. This is the ingot of pure silicon. This ingot is then sliced into wafers. What you see here, the wafers, this is a plain wafer. Then you have the fabricated wafer. Then you basically design the entire chip on a wafer. So then each and individual chip is taken out and packaged. So what I wanted to share is the entire process now, all the ecosystem partners are in India. Practically all the equipment manufacturers are here. So the confidence of people is huge. The gas manufacturers, you heard from Merck, 500 chemicals. They are all setting up their units here. So the entire ecosystem is coming to India.
How strongly are we progressing in terms of enabling talent? India is known for its large talent pool. How close are we meeting to that 85,000 target that you had set for 2030?
Oh, 85,000 was for 10 years, but we have already achieved 60,000 out of that. We have 278 universities where the students are learning semiconductor manufacturing. And probably this is the largest talent development program in the entire world. And out of those students, many have actually designed their chips, taped them out, manufactured them, and today we presented 20 such chips to Honorable Prime Minister.
Well, that's Minister Ashwini Vaishnav there launching India's first indigenous chip, the Vikram. Sugar stocks, including Sri Lanka Sugar's Dhampur sugar mills, recording strong gains in trade today. This after the government removed all restrictions that curb ethanol production from sugarcane juice, sugar syrup and molasses for 2025-26 sugar season. Sugar mills will now be able to use inventory of B-heavy molasses. There won't be any quantitative restrictions. The curbs were imposed in December of 2023 on account of rising prices. The government is likely to ask insurance regulator to hand over all responsibilities of creating a unified insurance portal to the industry. Sources say the Department of Financial Services do not want IRDAI to have any involvement in Bima Sugam, which is a marketplace for insurance sales and service claims proposed by the regulator. The launch of Bima Sugam has also been delayed by 12 to 14 months. Market regulator SEBI has approved the initial public offer of Boat's parent company Imagine Marketing. This is the headphone maker's second attempt at listing after shelving its plan in 2022. The company filed papers under SEBI's new pre-filing route in April, which offers firms more flexibility in timing and pricing. It also allows the company to withhold public disclosure of details until later stages. Shares of One MobiKwik Systems up 12% in trade today. This after the Abu Dhabi Investment Authority exited the company via block deals on Monday. ADIA sold 2.1% equity in deals worth 39 crore rupees. The 56th GST Council will meet tomorrow. The Centre's proposal of a simplified two-tier tax structure and a special rate of 40% on some items will be on top of the agenda. Timsy standing by now to recap the kind of relief that consumers can expect. Timsy, the all-important, crucial GST meeting kicks off tomorrow.
Prime Minister Narendra Modi's vision in his Independence Day speech on next-generation GST reforms could soon be a reality. The GST Council is set to meet on 3rd and 4th of September to discuss the Centre's proposal to shift to a simplified two-slab structure of 5% and 18%, with a special 40% rate for sin and demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities such as soap, shampoo, medicines, hair oil, toothpaste, biscuits, namkeen, bhujia, footwear and apparel below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in the lower category of 5% or even in certain cases exempt. Aspirational goods such as television, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc, which are currently taxed at 28%, may move down to 18% slab. The proposal also includes a major relief for consumers and industry with life and health insurance premium, as well as reinsurance likely to be exempted from GST. While the Centre is confident of a smooth passage, states have raised concerns over possible revenue losses. They have sought assurances of revenue protection, pointing out that they are not opposed to the rate rationalization but need compensation to meet their financial obligations. Also, a mechanism to ensure that the rate cuts are passed on to the end consumer and not result in any windfall gain for any of the companies. The September 3rd and 4th Council meeting is expected to be a crucial one, with the potential to usher in a new phase of GST, simpler, consumer-friendly and aligned with the Prime Minister's reform agenda. Something that we'll have to wait and watch for the Council as to what finally passes through.
Timsy, many thanks. And of course, track all the action here on the GST Centimeter right here on CNBC-TV18. And speaking of the GST, Indian Hotels MD and CEO Puneet Chhatwal has asked the government to raise the GST threshold for hotel accommodation above the current ceiling. He argues that the existing 18% GST rate for rooms above 7,500 rupees per night needs to be updated to reflect inflation and today's market dynamics.
I think that 7,500 ceiling was created 8 years ago. It's not been even adjusted for inflation. So I think given that the sector is the highest multiplicator of jobs, it is in the best interest of the nation to change that ceiling and bring it to the 5% bracket. So it's not an unreasonable request from our side. And I think let's see, time will tell if that change happens or not.
Well, that's Puneet Chhatwal there of Indian Hotels. Let's see what the GST Council finally clears. Now, globally, Nestlé has fired its Chief Executive Officer, Laura Frischie, after a probe into an undisclosed workplace affair with a direct subordinate. The company said the relationship violated Nestlé's code of conduct. The Swiss FMCG company has named Philipp Navratil, head of the Nespresso coffee brand, as his replacement. Frischie's exit extends the management's turbulence at the world's largest food conglomerate after Mark Schneider's surprise exit last year. President Donald Trump's family generated up to $5 billion in paper wealth after the trading debut of a new digital currency. The digital token was launched through their crypto venture, World Liberty Financial. The family holds just under a quarter of all the tokens. According to a report, trades worth around $1 billion took place within an hour of listing. World Liberty says that tokens owned by founders and team members remain locked for now and can't be cashed out. European regulators have issued a sweeping ban on a chemical that's used in gel nail polish called TPO. Now, the chemical is linked to fertility problems, reproductive health risks, and even skin allergies. Starting today, TPO can no longer be sold, imported, or used in cosmetics across the EU. Nail salons and retailers have to dispose existing stock, and those who fail to comply could be hit with fines of up to 22,000 euros. Remember, gel nail polish has been the rage across the world, and this is now a ban coming in the EU. Let's see if other jurisdictions follow suit. We will head into a break, but up next, Punjab reels from its worst floods in over 3 decades. Schools, colleges, offices remain shut in Gurugram after heavy rains. That and more when we return. While the flood situation across North India remains grim, Punjab is battling what state authorities call the worst flood in 3 decades. 29 people have been killed so far. 12 out of the 23 districts in the state have been submerged in flood waters. All schools, colleges and universities are closed till tomorrow. More than 160 people have been killed in Himachal Pradesh in over a month as heavy rains and landslides ravage the state. The Chief Minister has declared a disaster and estimated losses of over 3,000 crore rupees. The state has been hit with 45 cloudbursts, 91 flash floods and 105 major landslides since the 19th of June. Heavy rains continue to lash Uttarakhand. At least 8 people have died in recent landslides and rain-related incidents, including 2 pilgrims killed in the Kedarnath route. Floodwaters have submerged major highways and a bridge near the Indo-China border has also collapsed. The government has postponed the Char Dham Yatra till the 5th of September. In Jammu and Kashmir, more than 130 people have died. 33 remain missing due to flood-related incidents. In the past month, Union Minister Amit Shah visited flood-hit areas, reviewed damage along the Tavi River. Traffic has been partially restored on the Jammu-Srinagar National Highway, bringing relief to commuters stranded for 6 days. The Vaishno Devi Yatra remains suspended for the 7th day after a landslide killed 34 people. Schools, colleges and offices remain shut in Gurugram after heavy rains in the district led to traffic snarls last evening. The Disaster Management Authority said over 100 millilitres millimeters of rainfall was recorded between 3 p.m. and 7 p.m. yesterday. The Met Department has issued a heavy rain alert for Delhi and the surrounding areas. And South Mumbai remains paralyzed as the Maratha reservation protest enters the fifth day. The Mumbai police issued a notice to Manoj Jarange Patil, the leader of the agitation, and protesters to vacate the Azad Maidan and other key locations after finding repeated violations of the conditions laid down by the police and the High Court. Santya reports from outside Mumbai's busiest railway station, the Chhatrapati Shivaji Maharaj terminus.
Fifth day of Maratha reservation protest today. Finally, Bombay High Court said that the protesters, including Manoj Jarange Patil, will have to evacuate not just other parts of South Mumbai, but Azad Maidan as well. Mumbai police in the morning denied permission to Manoj Jarange Patil to continue his protest at Azad Maidan. The angle to this story is that because of these protests, people have stopped coming to South Mumbai, and because of that, local businesses are suffering. A Retailers Association have told CNBC-TV18 that in the last 4 days, traders have incurred losses to the tunes of 200 crore rupees. 80% business is down despite this being the peak Ganpati festive season. Will Mumbai police be able to successfully evacuate Azad Maidan? That remains to be seen. As of now, the focus is on the CST area and area outside BMC and outside Azad Maidan.
Well, that's our colleague Santya Gora reporting there from South Mumbai. In international news, the death toll after an earthquake in Afghanistan has now crossed 900. More than 3,000 people have been injured. Most casualties were reported in the Kunar province, where steep river valleys and rugged terrain have hampered rescue operations. Thousands of mud brick homes were destroyed, trapping many people under the rubble. The Taliban government has made an appeal to the international community for help. A landslide in Sudan's Darfur region has destroyed a whole village and killed over 1,000 people. Sudan Liberation Movement in a statement said that one person survived the landslide and the village was completely flattened after days of heavy rain. The rebel group has appealed to the UN and international aid agencies to help recover the bodies of victims. Well, devastating news there coming in from around the world, and of course, India grappling with the onslaught of floods across many states. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. There is no stopping the gold rally. Prices of the yellow metal have soared to a record high globally as well as in the Indian markets amid hopes of a rate cut by the US Fed Reserve this month. Well, silver prices also have hit a record highs in India, and globally the gold prices have surged to about 33% so far this year. Silver seems to be outperforming gold with a 40% jump in prices so far this year. So where are these prices headed from here? What are the things to watch out for? What is it that the dollar index can do? And what stance will the US Fed take? To get answers to all of those questions, we have with us Max Layton. He's Global Head of Commodities at Citi. Max, hi, thank you so much for joining in. First of all, your sense on gold, because for the longest time in the last 3 months, basically, we saw a lot of consolidation happening for gold. And then suddenly, just like that, we've seen 3,500 takeaway. Are you looking at higher highs going forward for gold?
We sure are. Thanks for having me on the show. We're very bullish in the near term on gold. We think that the US economy is going through a period of absorbing the largest tariffs that have been imposed in a century. And that is going to obviously raise uncertainty. That's been a big part of the driver of this year of the gold bull market. And that's going to continue over the next 3 months or so. So in early August, around a month ago, we've been bullish on gold for a couple of years now. We kind of went neutral around 3-4 months ago, and we've been kind of range trading gold, but we decided to increase the range of our base case price forecast in early August to 3,300 to 3,600, and we raised our near-term price target up to $3,500 an ounce. And it looks like, as you mentioned at the start of the show, we're already there.
Yes, we are, Max. A lot of reports do seem to be suggesting that if we can take these levels and stay above this consistently, then perhaps 3,800 or 4,000 is not too far away. Are you willing to go as high as that?
Yeah, I think part of the reason we haven't gone that high and we've got the range at 33 to 3,600 is that the world is already spending a phenomenal amount of money on gold. So if you look at the flow of gold, the value of the flow of total gold consumption or production, we're annualizing at a pace of around $500 billion, which is around 0.5% of global GDP. And that is the highest in around 50 years. And so we're already spending a colossal amount of gold, and that reflects, I think, broadly speaking, two things. One is fear of or hedging the downside risks in especially US asset prices, but also global growth downside risks. So there's fear about the impact of tariffs and a want to hedge that. But there's also no actual recession. And so globally, income growth is relatively strong, particularly in India, particularly in China, and in dollar income growth is decent. So jewelry demand has been super resilient. So you've got the investment demand that's strong, the central bank on the de-dollarization narrative, and you've got the still, very resilient jewelry consumption because income growth in dollars in India and China is strong. So all of these things are combining to have the world spending the most that it spent on gold in 50 years. So everything's going right at the moment. And look, we expect that to continue the near term, but it's done a lot of work. I mean, the other way you can look at just this gold price in historical context, one is to look at the value of the flow, which I just mentioned, which is super high. The other way is to look at the value of the stock of gold above ground as a share of household wealth. So if you look at the stock that households own of jewelry, of bars and coins, and you take that as a share of household net worth, you've basically gone to 50-year highs as well. So, households on average now are holding 3% of their wealth in gold, up from less than 1.5% 3 years ago. So, the world has put on this trade in aggregate and is relatively long gold. And that's part of the reason for us being perhaps less bullish than some of our peers. And then the final reason I would just say is that we're quite confident that President Trump, that a kind of President Trump put, U.S. growth put is in place. So if things do deteriorate, whether it's President Trump or the Fed, is there with lots of room to respond to get U.S. growth to rebound through 2026. So those factors kind of mean that we see a very shallow downturn in U.S. growth and actually strengthening growth next year.
I get your point, Max. There's no actual recession here, but even with that, you've shared some overwhelming numbers with us. You've said $500 billion, which is the highest in 50 years, seems to be flowing into gold right now. I mean, that's like huge number there. But that's about gold, Max. And what is really bothering silver? Not bothering really, but the kind of run-up that we've been seeing in silver in the last couple of months, it's clearly outperforming gold at $41 an ounce, almost there. How are you looking at silver prices in the foreseeable future?
Thanks. Yeah, that's been our big call over the summer that silver would do well. We've got a near-term target of $43. We think silver speaks to both it's partly driven by the bullishness in the gold market, but it also has its own supply-demand balance outside of the investment component, which is still very strong. Although there's a lot of headlines about solar weakness in China and more broadly globally, actually the output of solar panels is still going strong, and the substitution isn't particularly large. Anyway, silver's in deficit. It's a deficit market, and you basically need to incentivize stockholders to sell their inventory of silver, and they're requiring higher and higher prices and to do that. And that's essentially what's going on in this market. It's a combination of fundamental tightness and investors wanting some kind of leveraged exposure to gold. Gold by historical standards is not cheap. Silver was cheap, is getting less cheap. But it has a historical upside up to $50. We haven't gone all that way, but we think we're going to rise another 5 to 10% from here in the very near term.
Max, what is also your sense on the dollar index? Because that would really define going forward on how gold and silver behave. At this point in time, it is under tremendous pressure. And if the US Fed would start cutting interest rates, would you say further support here? There again are some banks and brokerages calling dollar index at 95 and 92, and some of them have been as bearish as 87.
Wow. Look, our house view is moderately bearish the dollar in the near term. So over the next 3 months, they do expect the dollar to depreciate, certainly against the euro and also more broadly. And that is going to be supportive for gold, no doubt about it. I think it's also going to be supportive for silver. And, a lot will depend on why the dollar's going down. The house view is that it goes down because US growth, the labor market slows down, and that the Fed cuts as a result of that. And so our house view has quite a few more Fed cuts than I think consensus. All of that speaks to higher gold and silver.
So what is Citi's sense then? How many rate cuts? One, and what is the view on dollar index as in sense of a price point?
So our house view is consecutive rate cuts through March of next year, taking us down to 3 to 3.25%. So significant cuts is the house view. I think if that happened, that would be probably more in line with our bull case on gold, and you would see higher than 3,600 in that world.
Max, gold and silver, both with the kind of run-up that we've seen here, and the central bank buying has been strong as well. So for gold, we understand 1,000 tons perhaps here or there. But with silver central bank buying, especially coming in from Russia and Saudi Arabia, are you reading a lot into that?
Sure. Yeah, so in the gold space, I would say the central bank narrative takes a huge amount of investor mind share. It works out that actually central bank demand is only about 25% of mine supply, so it's only absorbing 25. Perhaps it's taken 80, 90% of the mine share, but it's a quarter of the story. In silver, there is a lot of interest in central bank buying. Unfortunately, the data is super opaque, even more so than it is in gold. So it's very hard to tell exactly how much is going on. Obviously, silver is silver is you have to store a lot more volume of silver to get the same dollar exposure. So central banks haven't traditionally moved in a major way into silver, and frankly, I don't expect that they will. So it's supportive, but probably not a big driver of the silver going forward.
Sure. Max, also, when it comes about central bank buying gold, and you just talked about those numbers, if you look at the last 1 year data, and this has been collated by various agencies which say that in the last 1 year, or perhaps more, the gold buying has been way more than the dollar treasuries, the US treasuries, that is. Have you seen that pattern, and do you see it growing further?
Sure. So the numbers that I were quoting were volume numbers. So the volume of gold buying by central banks, it's been running at about 1,000 tons a year. We produce around 4,000 tons of gold mine supply. So they've been absorbing about a quarter of the mine supply. That hasn't changed. What has changed is it's changed a little bit. There's a little bit less buying this year. It's come off a little bit from 1,000, but what has changed is the gold price. So essentially, investors have come in both through ETF, also ultra high net worth family office. They've come in, bought a huge amount of gold this year. That's contributed to the big rally in the price, certainly this year. And that has raised the cost of buying that 1,000 tons that the central banks have been buying for the last 3 years. And obviously over the last 3 years, that price of gold has doubled. And that means that they're paying double to buy the same volume.
Yes, they are.
And that's where it's coming from. So this talk about how they've increased gold as a share of their foreign reserves is actually coming entirely through the price action.
It sure is, and perhaps that is leading to all of this price action as well. But Max, since we have you with us, what is also your sense on the base metal prices? Because there is this, the run-up that we saw in copper and then that profit-taking, it seems to be now consolidating, but there is some support here. So when I look at the markets this week, copper, zinc, iron ore, steel, everything seems quite supported. What are your targets going forward for some of these?
Yeah, sure. So, on the one hand, the tariffs and the still high US interest rates are bearish for growth. On the other hand, that impact on the supply-demand balance and on sentiment on base metals, that negative impact is being largely offset, if not wholly offset, by the weaker dollar and by the prospect of an eventual kind of recovery and moving once the tariffs are absorbed and, the One Big Beautiful Bill Act kicks in and rates are cut globally. People are kind of looking through the tariff impact and these factors are kind of netting out with prices doing essentially nothing in base metals over the last few months. Going forward, we're essentially cautious on the base metals until the worst of the tariff impact on growth and inflation is past. So we're kind of rolling cautious on base metals near term, but very, very bullish on, in particular, aluminium, but also copper on a 12 to 24-month view. So heading into the midterms and with lower interest rates globally, we do expect a pickup in global growth. They've got a lot of exposure to decarbonization as well as AI and data center related demand. And they have practically no supply growth, these markets, copper and aluminium. So they're set up for when the global economy turns, they're set up for super bullish markets, but just not yet.
Super bullish. I like that word, Max. Just before I let you go, would you want to give us some numbers then in copper, aluminum, both? What are you looking at in 12 to 24 months in sense of prices?
Sure. Yeah. So, copper, you can be talking about on that kind of time frame, $11,000 to $12,000. Aluminium, you can be talking about easily $3,000 plus.
All right, very, very bullish cues coming in, not just in case of metals, but gold and silver as well. And there's just so much to watch out for the international markets there. Max Layton, as always, thank you so much for coming by and making sense of what really is conspiring in the international markets and what can we watch for. We appreciate your time here at CNBC TV18. On that note, it's time for a break, but don't go anywhere because the sugar mills get a boost after government says it will not impose any restrictions on production of ethanol in the coming season, November to October. We discuss this with Ravi Gupta, who's ED at Renuka Sugars. It's on the other side. Welcome back. You're watching Commodity Champions with us here at CNBC-TV18. And the other important news clearly is about government permitting unrestricted ethanol production, this time around from juice, syrup and molasses. This is for the season 2025-26. It clearly has brought in a cheer about in the sugar stocks that we have seen. But what does it really mean for the industry on a longer term basis? And is this because we're looking at a bigger crop in the coming season? Let's decode all of that. Joining us for that is Ravi Gupta. He's ED Renuka Sugars and chairman also of the Sugar Bioenergy Group. Ravi, hi. Thank you so much for joining us here at CNBC. First of all, your reaction to this. I mean, this is something that the industry has been wanting. The grain, rice, maize guys clearly not cheering those so much, but the sugar industry is, would you say?
Thank you, Manisha, for having me here. And so the government today wrote to all the sugar mills that they can unrestricted use the sugar syrup or bee molasses for making ethanol. It is in context of because the next year we are seeing a good sugar season in terms of production. Monsoon have been bountiful, area is good, and the yields are going to good. So government has pretty much good confidence that we should maximize diversion of sugar into ethanol. So it clarifies that through a letter. But as such, after 23-24, there was no restriction on diverting sugar for ethanol. But this letter is basically in context of clarifying that there is no restriction on using sugar for producing ethanol. It's a very welcome step.
Ravi, what is the diversion that you're anticipating now with this notification for the next season?
See, different association have come out with different estimates, which is, let's say, average being 35 million tons. And we assume our consumption to be 29. So we will have 6 million ton extra. And all of that can be diverted into ethanol. And that is what we should try to do, because last year sugar had a setback as compared to grains. Sugar share in ethanol was only 35% as compared to 65%. But this year, with our bumper crop of sugar, we can aspire to divert 6 million ton of sugar cane for making ethanol. And that would be ideal because we'll have that much of sucrose available with us.
So from last year's 35% contribution, where would you see the numbers growing for 25-26 as a season?
See, we would aspire to bring it to 50%, which was also the plan under the roadmap of ethanol blending, that 50% will be supplied by grains and 50% will be supplied by sugarcane ethanol. So that is what we should be looking at.
Well, a cheer clearly, but Ravi, would you say that what is also a miss as of now is the price revision as far as ethanol goes? I'm assuming you would be having a lot of conversations with the regulators and the ministries, relevant ministries, that is. Where is that conversation standing as of now?
Manisha, to be honest, it's like, submitting our request, and we would have been doing it since last 2 years. There has not been any revision, but it is high time that the government revise the sugarcane ethanol prices, because the FRP has increased in this last year continuously. Next year also the FRP has been announced, which is an increase of 4%. So I think this year we are very, very hopeful that the government will increase the ethanol prices, because last 2 years it has not been done. And there is a high time that revision is done for the larger interest of the ethanol blending program and as well as sugar industry.
Ravi, coming on the E20 itself, and while that, of course, has been a big cheer and a pat on the back that we've seen for the industry, for the government as well, the whole scheme worked out very well. But the recent, whether it was about a PIL, the way we saw it all exploding on social medias, etc., has it all been put to rest now?
So, Manisha, of course, now we can look forward and backwards. And I will only tell you from this channel that, this 20% ethanol blending was a very well thought of policy of the government, which was declared in 2021 under the roadmap for blending. So everything was done gradually from 5% to 10% to 15% and 20%. It is not that it was just suddenly decided to do it as 20%. And it has helped everyone in the sector, including our farmers, industry, and including doing the energy security and environmental benefit. And I think the ethanol program is the right program for the country, and it has done well. And I'm very, very glad that now all these things have passed us, and we can look forward for the new season with better ethanol prices and better sugarcane ethanol into our vehicle.
Ravi, with the kind of numbers that we're dealing with right now, with E20 done, there are conversations and perhaps a roadmap in making for E27 and beyond. How are those conversations panning out?
I think the best step now we can take is just to give you a perspective that India has ethanol production capacity of around 1,700 crore liters as compared to 1,100 crore liters requirement at 20%. So now the time is apt that we should introduce the flex fuel cars in India, which is what Brazil has done. Today, 85% of the new cars sold in Brazil is flex fuel cars. Flex fuel cars can run either on ethanol or petrol. I think it is the high time that we introduce flex fuel cars in India, which gives the optionality to customer whether he wants to put ethanol into his vehicle or petrol into his vehicle. And the good part is that the government is coming out with GST rationalization. In my optimism will be that in this GST rationalization, government will encourage green technology-driven vehicles like what they have done for electric vehicles. There is a lower GST on electric vehicles as compared to the internal combustion engine. So I hope that in this GST rationalization, government also encourage the flex fuel cars in the same manner as they have done for electric vehicles. That should be a path breaking, and I think it will be very, very good for the country to have a continuous ethanol blending program and higher.
Ravi, we have to speak to you on prices as well when it comes to sugar going forward. Any sense on that? Any forecast that you're putting forth for international markets, raws, and for India?
So the markets are pretty much stable globally as well. Brazil production is doing well, and India is looking to be, producing more sugar. So prices as such, it does not seem to have any concern. I think it will be stable to slightly firmer as we go in the end of the crop. But from Indian perspective, I will say that if you look at the prices, Manisha, on an average, the realization of the sugar mills has been close to 3,670 per quintal. Right, because in October, November, December last year, we sold sugar at a very low prices, and this is something which is a worrisome situation because while FRP is increasing year on year, but the sugar prices are not for taking that pace. Just to give you an example, MSP was revised in 2019, and after that, FRP of sugarcane has increased by 27%, but there has not been any increase in MSP. So for the next year, I think this is some task in hand for the policymaker to increase the MSP in line with FRP, also increase the ethanol prices in line with the sugarcane cost. So that is something which we are looking for the next season.
I'll wind down this conversation, Ravi, with one final question. So while you've given us your sugar price expectations here, what is it that the industry is anticipating in sense of ethanol price revision? Third year in a row, rather, where we haven't seen a price revision. What is it that the industry is looking at?
See, clearly, 4% has been the increase in FRP this year. Last year also very similar. So the increase should be commensurating with the FRP, and that is which we will aspire for and want. And rest we expect the government will take the right decision because the cost of raw material has actually gone up. There is no doubt about it. And it is something which is in public because the government declares the FRP prices. So all we need is that whatever the increase in the FRP has happened in last 2 years, the ethanol price should be increasing in that proportion.
Fair point then. So an expectation as well coming in from the sugar industry there, while of course it's a big positive of what we've seen with government permitting unrestricted ethanol production when it comes to cane, syrup and molasses there. But a price revision is something that is still awaited. And with E20 done, E27 is what the market is setting its eye on. Ravi Gupta, as always, thank you so much for joining in and with your sense on sugar and ethanol and of course the prices going forward. And that's all the time that we have on this edition of Commodity Champions. Thank you for watching.
Hello, welcome to News Centre. I'm Parikshit Luthra. The automobile industry is calling for a uniform GST rate ahead of the Council's meeting on September 3rd and 4th. The auto industry has urged the government to rationalise rates and also take a decision before Navratri so that the remaining festive season is not impacted. Automakers, including Royal Enfield's parent company, Eicher Motors, have voiced concerns over a possible GST hike on premium motorcycles. The Centre's proposal includes reducing GST on certain categories of cars, bikes, auto parts to 18%. It has also proposed raising GST on racing cars, motorcycles above 350cc and larger passenger vehicles from 28% plus cess to 40%. Currently, motorcycles up to 350cc share 86% of Royal Enfield sales and 95% of Hero MotoCorp's volumes come from commuter bikes under 350cc. I'm now joined by Rajiv Chaba, CEO Emeritus at JSW MG Motor India, and Dinesh Thapar, CFO at Bajaj Auto. Gentlemen, thank you very much for joining us. Dinesh, if I were to come to you, give us a sense of whether you foresee an immediate uptick in sales as a result of this GST reduction on motorcycles and two-wheelers under 350cc. And is this going to be a sustained growth that we are going to see, or will this be a one-time uptick?
Thank you, Parikshit, for having me on the show. At the outset, let me say that the reduction of the GST rate from 28% to 18% for two and three wheelers is a very welcome move. It's been a long-standing request of the industry for the government to consider a reduction of rates, given how integral two and three wheelers have been in enabling personal mobility, employment, and enhancing livelihood. So to that extent, this is a very welcome move. And even though the reduction to the 18% as it is being envisaged, and we'll wait and see what comes through in the council meetings of tomorrow and day after. But even though at the 18% is higher than, let me say, what comparable economies with large two-wheeler economies across the world are, which are fundamentally in the range of between 8 to 15%, the reduction from 28 to 18 is absolutely the right direction of change and very, very welcome. In terms of what this will do to industry demand, I think we're very optimistic. The whole industry was very optimistic about the upcoming festive season. And the last couple of weeks, ever since the intent was announced to reduce GST rates, we've obviously seen some slowing down of retail. Obviously, as customers have picked up news of an impending GST reduction and therefore a reduction of vehicle rates or prices as they were, once those were notified. And so there's been some deferment of demand that we have seen in these last couple of weeks, which we hope will get made up and recouped, once there is clarity of rates, once it's notified and announced and brought into effect. But that said, August and September are big months for the industry, because clearly there is a lot of front loading in of inventory into the pipeline in anticipation of a big festive. And the festive season for the industry has only become larger and larger with each year. And so therefore, in anticipation of a large festive, a lot of that has been going in. And we therefore hope that this deferment of demand that we've seen or offtake that we've seen from customers in the last couple of weeks gets made up through an even bigger festive season that we start to see later towards the end of September and as we get into October. From a long-term perspective, I think this should provide a boost clearly to consumer sentiment for the two-wheeler customer, a reduction of anywhere between 6,000 to, let me say, 12,000, 13,000, depending on the CC, but really in the belly of the market between the 100 to the 200 CC. That is fairly relevant given the profile of the two-wheeler customer. And therefore, we think that this reduction in the GST rate as it is passed on in lower pricing to customers should help stimulate some demand. And I can only hope that this entire benefit flows to customers and it's not offset by any of the states, let's say, increasing, let's say, state roads taxes or any other cesses coming in and being bought to really make up revenue across the state. So the entirety of the benefit flowing through, I think...
Dinesh, when you speak about long-term benefit and demand, could you once again tell us what is the engine capacity where you expect the demand to come in from the consumer on a sustained and long-term basis?
Parikshit. So I think there's a nuance to that because, about half the market, 47% of this market sits between the 100, 110 cc, very, very price conscious customer out there, very value conscious. Clearly, that 5,000-6,000 rupees is going to make a big difference. But there are two nuances that I wanted to call out from a longer term perspective. I think first is that for the customer, a saving of between 6 to 12 or 13,000 will also help stimulate a thought to uptrade. And uptrade a customer who is looking at maybe 100, 110 cc to start looking at an early 125 cc. Someone sitting at a baseline 125 cc model, looking at a slightly feature-rich 125, a 125 looking at a 150, and potentially because the gap across some of these ranges between 10 to 15,000, a saving of anywhere between 6 to 12 could really prompt customers to look to uptrade. So I think in some ways, in addition to the demand that we're looking at, you could also see the possibility of a relative premiumization that this entire move could stimulate. So that's one important piece. But to your question, I think you will see a rushing in demand that we will see in this upcoming festive season, because festive seasons are in any case meant to be much larger. They are anywhere between 60 to 70% higher than the normal run rate for the rest of the year. And then with clearly deferment of offtake having happened in the last couple of weeks and possibly in the next couple of days till such time rates are notified, this should make it a much bigger festive season as we look forward. Having said that, I think there's one
Anish,
more
I'm going to come back to you. I'm just going to come back to you. Let me also get in Rajiv Chaba on the sentiment for cars, especially the industry is divided on as to how larger cars, larger EVs, hybrids should be treated. Mr. Chaba, welcome to the program. What's your sense? This is a big move, and these rate rationalization exercises are not easy. They're happening after a lot of deliberation. The Prime Minister has announced GST reforms from the ramparts of the Red Fort. We're looking at a 5% rate for EVs, 18% for small cars and cars and motorcycles under 350cc, and a 40% rate for luxury cars. How do you see this as something that will benefit electric mobility and clean mobility in the long term?
Right. So thanks, Parikshit. I think in general, it's a very welcome move that the government has decided to rationalize the duties and especially reduce the duties on the smaller cars. And that was the basic idea what was announced. But after that announcement, a lot of speculation is going on that what will happen to small cars, big cars, and some of the other issues which you mentioned. Let me just say for the context that actually there used to be excise duty structure which was based on the size of the car and the CC, the engine size. That's how it was started, and then GST grandfathered that without much changes. At this point of time, when we are talking about reforms and Viksit Bharat and for future, I think it should not be just based on size of the car and the CC of the engine. Life has changed, things have changed, technology has changed, world has moved on. So I think, in my opinion, it's a great opportunity for India that we need to really see the holistic thing in view of what's good for environment, what's good for country, and what's good for consumer, and then what's good for OEM in that sequence. So from that perspective, the car's pricing should be seen as good price for consumer and the right technology for consumers. So from that perspective, in small cars, as an example, because that was the starting point of this GST thing. So small cars, when the GST gets reduced, as an example, which is what speculated is that from 28% to 18%, which I think is a great idea, but then EV is 5%. So it means relatively you are making EV cars disadvantageous versus the ICE cars. So in that case, I think because EV penetration still is only 2% or 3% based on various segments of the car, then EV should be made 0%. So that there is no disincentive for the consumer to buy a small EV. So that's for the small car. Now, when we talk about the bigger cars, and again, I think everything is speculated right now that it may be 40%, but in some cars, as you know, right now the duty with cess is 46% to 48%. And then we are talking about, some guys talk about hybrid technology, what should be the GST structure on that. But there are new emerging technologies which are very much prevalent and widespread as transition to EV, like plug-in hybrid and and the REEV, which is range extender. So I think then this is a great time for India to rationalize not only the duty structure, but also bring the right technology at the right price to consumer to set the tone for our auto industry.
All right, that's an important point. Let me get in Dinesh Thapar once again. Dinesh, we've seen how Siddharth Lal, the chairman of Eicher Motors, has gone on record to make an urgent appeal that we should not have a differential rate for motorcycles, and we should not have a high rate of 40% for motorcycles above 350cc because you're going to hurt the middleweight segment. Of course, Royal Enfield is a leader there, but companies like Bajaj Auto, TVS, Honda, Hero Honda, Honda motorcycles, they are making forays into that space and want to gain a big market share. What would be your appeal to the government, especially as far as the GST proposed rates for bigger bikes are concerned?
We've been very clear, and we've called out clearly a situation where we would like a unified rate structure across all of motorcycles, irrespective of their engine displacement, right? So the whole piece that we've been hearing about moving the taxation up to 40% for upwards of 350cc really has no plausible reason. It's 1% of the industry at this point of time, and that's the part of the industry that all of us as OEMs are just about foraying into. Clearly, a lot of technology going in over there, a lot of portfolio expansion, a lot of innovation happening in that space. Let's not forget that, the domestic or the Indian two-wheeler industry is very successful worldwide and globally, and in many ways a shining example of the Make in India, purely because there was a large domestic industry that was built over here which allowed for scale and cost competitiveness that could then get translated to the world over. And therefore we ourselves export across to 100 countries. Now that was because there was clearly a large domestic business that allowed for investments in innovation and technology and building the ecosystem. And so therefore to really bring in a differential rate for the 350cc upwards is really going to create unnecessary complexity. It's going to distort customer choices. We should leave the choice to the customer depending on the product that they want, what's right for them and what's right for their need, and not really distorted by the tax structure which forces them to look for, let's say, an under 350cc vehicle when they very clearly could have afforded a 350cc in the past regime. And then, of course, in many ways, it could end up stifling investment because then the 350cc upwards relative to what will move down from 28 to 18% starts to become very uncompetitive. Scale doesn't build, investment gets stifled. And that's really the part of the industry that the Indian two-wheeler industry at this point of time is looking to tap into, to build both a large domestic base as well as an international presence. And that clearly is a segment which is very relevant to global markets. A lot of the markets the world over is where you see motorcycles which are upwards of 400cc in that space. And that's the one where the Indian OEMs really need to really participate in that part of the opportunity. We've been tremendously successful, whether it's across Asia, Latin America, South Asia, or parts of Southeast Asia. Those are largely in motorcycles between the 100 to 200cc because we've been able to build domestic scale with a very stable tax regime. And I think that's something we need to do with the 350cc. And lastly, I think the fact that the 350cc up today, the segment is all of 1% of volume. So there's really no plausible reason why it should be put up into the 40% tax bracket. It's not going to get significant additional revenues for the government. It's going to stifle industry and investment. And lastly, to put it into the 40% bracket is to give it the color of luxury. It isn't luxury. A 400cc motorcycle today is very much adopted across the country by people who go to work. We've got a bunch of folks who come into office and come into workplaces riding a 400cc speed in a scrambler. And that's definitely not luxury. It's a necessity. It's very much part of their daily commute and in many ways part of their livelihoods and employment. So really the reason for it to get classified into 40% is neither plausible on grounds of it being luxury nor on account of revenue, being a sizable pool of GST because it's all 1% for the industry.
Okay.
But to retain a uniform tax structure allows OEMs like ourselves and the rest of the industry to really be able to invest in the cutting edge technology and to really build that segment, not just domestically, but once we build it domestically, we're now at that tipping point to then extend this out to the rest of the world where the 350cc upwards is very, very relevant.
All right.
So,
Dinesh, we've completed our time, but my last question to Mr. Rajiv Chaba. Mr. Chaba, what would be your appeal? Now, the GST Council will be meeting tomorrow and day after. Decisions are likely to be taken very soon ahead of Navratri. What would be your final appeal to the government? For example, MG Motor is coming out not just with EVs, you're coming out with luxury EVs, which should be above 50 lakhs. You're looking at hybrid, strong hybrid cars as well. What would be your appeal to the government at this stage?
So frankly, from my perspective, I would not say really GSW MG only, from my perspective as an industry veteran here and being an oldie in the auto industry, I would say a government needs to, the purpose of the government is to increase the size of the industry, increase the revenue, and also, give that fillip to the auto industry. And they want to generate demand by reducing the GST. Their idea is not segment substitution, that the guys shift from high-end cars to mid-end cars to low-end cars. Idea is to increase the pie. If that's the objective, and I'm just requesting government that combine the objective of the right technology also at the right price, because right technology, government has already stated that EV is the desired goal, and that's what is the direction from the climate perspective and the long-term perspective from India too, to minimize the carbon footprint. So the request to the government would be, keep it simple, do not mess with the structures of various segments. Let consumers choose that. But when you are reducing the GST duty on a particular segment, the relative duty across the segment should be maintained, and the advantage to EV or the forthcoming technologies, which are kind of transition technologies to EV, like plug-in hybrid and REEV, should be maintained. So that's what I would tell the government. Keep it simple. Don't confuse customers by making some artificial barriers in their choice.
Right. Thank you so much for joining us, Mr. Chaba. And Dinesh Thapar, very important views ahead of the GST Council meeting. Let's see what happens now. We're taking a break on the program, but on the other side, Gurugram is down on its knees after barely 4 hours of torrential rains, raises questions about the city's so-called developmental model. I speak to prominent Gurugram residents Sohail Seth and Advaita Kala on the other sides. Welcome back. What you see on your screens could be mistaken for thousands of night bulbs illuminating a path. It is not. This is a snapshot of a mammoth traffic congestion in Gurugram, the direct result of hardly 4 hours of torrential rains. The visuals alone are a grim reminder of what Gurugram, once touted as the Millennium City, has come to represent. As per district authorities, Gurugram received over 100 millimeters of rainfall in just 4 hours last evening, leading to flooded highways, widespread waterlogging and traffic snarls stretching up to 7 kilometers. Exasperated citizens took to social media to share details of what many called a nightmare. Many social medias users claim that they were stuck on the road for anywhere close to 6 hours. These bring us to some very basic questions. Why does a city which houses some of India's super rich and boasts of an IT hub come down on its knees year after year with barely hours of rain? Now, joining us are two very prominent residents of Gurugram, Sohail Seth and Advaita Kala. They need no introduction. Let me go across to them straight away. Sohail Seth, your view on what's happening. You know, it's unfortunate that we have these discussions year after year, but it's sad. Why can't we take a long-term view on this situation? This flooding is not going to go anywhere. Clearly, there is a drainage problem in Gurugram.
Because we have a bunch of jokers running the government. We have irresponsible people. The citizens are equally vacuous by electing these jokers term after term after seeing the rubbish that they do. So we are in a, I don't blame the government. The stupid people are the ones who actually elect these jokers. This is a third-term BJP government. The Prime Minister has gone on record. His first ever public program in 2014 was Swachh Bharat. And these people have ignored that very simple directive. You tell me, does it take rocket science to clean the drains? Does it take rocket science to maintain sewage systems? No, it doesn't. Don't we know that there's a monsoon which is an annual feature? What are we surprised about? We are surprised because the nexus between builder, government, municipality has been existing even before the BJP. So, when the Congress jokers say that, oh, actually, it's a BJP issue. It is a political party builder nexus issue which has been playing for ages. Everyone is in denial because it's a bloody cozy club. You scratch my back, I scratch yours. Right now, you can't even scratch your back because you're underwater. So the reality is, until we speak up, no one will do a damn. On July 18th, in a program, I went to town and I said, Gurugram is a national shame. I've had to amend it. It is an international shame. You have some of the largest companies headquartered here, both MNCs and domestic. You have some of the most important CEOs and influential people staying here. And this is what you give them? What do they tell their principals in Atlanta or in Dallas or in Chicago? Sorry, we couldn't go to work because we would have to otherwise wade through flooded waters. You have absolute no empathy. These are a bunch of scoundrels who are running this government. They need to be arrested. They need to be behind bars. The judges don't care because the judges live in fancy homes. Their homes don't get flooded. The day a judge's home gets flooded, watch what happens. The day a chief minister...
Sohail, I'm going to come back to you. Those are important points of a citizen, of course, who's very, very upset with the situation.
I'm not upset. I'm very logical.
Year after year.
I'm not upset.
Yeah.
I know this nonsense repeats itself.
Absolutely, absolutely. Advaita, if I can get you in, there have been a lot of residents who've been stuck. They've been putting across their experiences on social media. Now, what do we do for a long-term basis? Because this needs proper planning. Gurugram, everyone says, has been built without proper planning as far as the drains are concerned, as far as where the water will go during monsoons. How can we start working on a war footing to correct all of this? Does there seem to be any way out?
If Congress created this mess, BJP has done a fine job of maintaining it. That's the bottom line. And frankly, at this stage, we're so frustrated that even turning to the government doesn't seem like a viable option because we've done this repeatedly year after year. Every time that we encounter this issue, we have raised our voices. We've done these debates. The media has stood by the citizen and highlighted these issues, but nothing seems to move them. Nothing at all. They're just waiting for the rain spell to get over and people to move on. I mean, it was so embarrassing. 2 weeks ago, we had expats who live in this town take to the streets and start cleaning garbage, picking it up. This is the desperation that we have reached now, and no one seems to be listening. A month ago, when we had a similar kind of deluge, 2 people lost their lives, one because of electrocution. Still, there's no action. There's nothing. I mean, a month ago this happened. You would think that they would have enough common sense to plan in advance, to warn in advance, to give all their advisories in advance. None of it happened. Yesterday, I went to Delhi. I canceled a meeting and came back early because I realized it's going to start raining. Today, on the news, I found out that my area where I live is one of the 3 lowest lying areas of Gurgaon and is expected to get flooded today. I'm finding out through the news. Where is the administration? Where is the understanding? Yesterday, you're saying 4 hours of rain. When I was heading back, it started raining heavily and it was only half an hour in. And on Golf Course Road, which is the artery of this town, which is so high profile, your water levels were till your bumper already, half an hour into the rains. So we don't even need 4 hours of rain to have this kind of situation. It's reached a point where now people are just disgusted. And I think there is a tendency in the political class of Haryana across the board wherein they don't consider Gurgaon as being part of Haryana. They think of it as Delhi +1. And that's the way they treat it, because most of the people who live here a lot of them are from different parts of the country, probably have votes in different areas of the country. So these people just don't even look at us as a voting bloc, just a bunch of urban people who have access to social media and TV and who will keep quiet once the rains pass. So they're going by with this and they're getting away with it year after year after year. We're just waiting for some sort of epidemic to strike because of the stagnant water and garbage. And then there'll be other excuses for that.
Absolutely. Sohail, what do you think is now the way out? You know, considering there has been so much of construction, so many buildings which have been made over the last 30 years, over successive governments, it's very difficult to start correcting what's going wrong. It will probably need a very strong political direction. And if the political direction is not coming, do you think the courts now need to intervene? Do you think citizens like you have to approach the Supreme Court with a public interest litigation saying that please set up a committee, get things going to correct this in the long term?
So you're a young man, Parikshit. There's an old saying, there are no statues of committees in any parks. You set up a committee, you'll kill the whole goddamn thing because they will then take refuge of the goddamn committee. I'll tell you what needs to be done. Number one, the Prime Minister needs to sack Manohar Lal Khattar from the Union Cabinet and Naib Singh Saini as Haryana Chief Minister. That will send a signal to the bureaucracy. See, to be fair to Naib Singh Saini, it's a year that he's taken over. The essential rot was Huda followed by Khattar. Khattar, by the way, for screwing up Gurgaon, has got a promotion. He's now in the Union Cabinet, so now he can screw up the whole country. This is how beautifully we work. Now, no one is blaming Khattar because Khattar will, he's in the Union Cabinet. But let me tell you, the Prime Minister is not, he may seem silent, but don't think he doesn't know. And he will crack the whip, and he will crack the whip with immediacy, as he should. Number two, the bureaucracy. Let me tell you, the heroes last night were the ones from the Gurgaon police. Whether it was the traffic police or whoever it was. They were the ones out. IS officers, absolutely useless to my mind. The DC of Gurugram sends out a tweet saying, there have been rains and there have been floods. There'll be more rains and there'll be more floods. So please stay at home. Wow. As if we are blind. Obviously, it has rained and obviously it has flooded. Are you telling us post facto? A, B, what happens to the daily wager? What happens to office goers? Forget every goddamn thing. These are a bunch of insensitive scoundrels. Gurugram has 6 hospitals. What if there are emergencies? What if people need to go to a hospital? What will you do with ambulances? These chaps should be skinned alive. If I were running this country, I would skin them alive. Because this is what these people have done. They're a body blow to shame and they're a body blow to empathy. They have none. You tell me, tomorrow someone dies. Advaita talked about 2 citizens who passed away. Is there any accountability? I'm not saying IAS officer 1 is wrong or 2. And by the way, the same Indian Administrative Services people, whether it is Lucknow or Indore, are doing a stunning job. Why can't they do one here? Why is Gurugram only seen as a repository of making money? Every guy who comes to Gurugram comes as a pauper, goes away as a billionaire. I'm talking about the services. Why?
Right.
Who's responsible? Naib Singh Saini has not bothered to come here. He comes to Delhi, holds up in Copernicus mark in the goddamn guest house of the state. Why has he not come here? This is why.
Sohail, we can understand what you and Advaita are trying to say, that we now need to really sit up as citizens and take a long-term view
You need
of
to
things.
crack the whip. Forget sit up. You're being polite. I'm telling you, catch them, arrest them, make demonstrable examples of these jokers. That's the only way.
All right, we've run out of time, but thank you so much, Sohail, for joining us with your views, and to Advaita as well. It's definitely a terrible moment, and of course, it's quite shameful what we're seeing in Gurugram year after year. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Hello and welcome to another episode of the Global Reset here on CNBC-TV18 Prime. We are focused on one of the most important corporate trends underway in India. I'm talking about the rise of global capability centers, or GCCs as they are commonly referred to. Now, global capability centers, if you're unfamiliar with the term, GCCs are offshore units established in India by MNCs to perform designated operations and deliver support services exclusively for the parent company, hence the word captive. These centers manage a variety of operations such as information technology, research and development, human resource, customer support, financial and accounting services, data analytics, etc., etc. The numbers tell their own story. India already hosts more than 2,000 GCCs. By 2030, by some projections, they're expected to generate about $100 billion in annual revenue and employ nearly 30 lakh professionals. So why are GCCs booming in India? What's driving this surge? And what needs to be done to sustain it? And are there risks policymakers and companies should be watching out for as well? These are questions that we'd get answers to from two people who know the space inside out. In a bit, Shalini Pillai, India leader for global capability centers at KPMG India, will be joining us. Manoj Marva is Financial Services, GCC Consulting Leader at EY India, who will be with us as well. But before I get in Shalini and Manoj onto the program and sort of start with the Q&A, let me just sort of, set things up for you with a quick overview, state of play in terms of where things stand right now. India has quietly become the world's GCC powerhouse. Over 2,000 global capability centers already operate here. By 2030, that number is expected to contribute more than $100 billion in annual revenue and employ nearly 30 lakh professionals. What started as basic payroll and call center functions has evolved dramatically. Today's GCCs are brain trusts of multinational companies, driving everything from artificial intelligence, digital transformation, and of course, research and development as well. So why India, right? I mean, that's the question. The reasons are clear. We've got the world's largest STEM a talent pool, which is science, technology, math, a cost-effective workforce, and of course, infrastructure to boot as well. A stable, resilient economy that has attracted MNCs looking for scale and reliability. Now, the policy environment has also been supportive. The union government allows 100% FDI in IT and R&D, and of course offers tax breaks through SEZs and STPI schemes as well in the latest budget, which was announced. A national framework to push GCCs into Tier 2 cities has also been something which has been talked about. States are in the game too. Telangana has already attracted over 355 GCCs. Karnataka wants to reach 1,000 centres by 2029, and Gujarat's Gift City is offering a 10-year tax holiday to make itself a financial GCC hub. And that sets up a fascinating race between cities. Bengaluru remains, of course, the tech epicenter. Hyderabad offers lower costs with deep IT and life sciences talent. Mumbai, of course, is the BFSI, that is Banking Financial Services Nerve Center. Meanwhile, cities like Chennai, Pune and Ahmedabad are stable, cost-competitive alternatives which are fast emerging as well. Companies are also experimenting with how they set up shop. Some will go for fully owned and operated. Others use the build, operate, transfer model. And increasingly, we are seeing hybrid approaches like virtual captives for joint ventures. But of course, it's not without some risks. Complex tax and transfer pricing rules are sometimes cited as pain points. Data protection obligations under India's new Digital Data Protection Act is another one. And of course, a maze of labor laws, which of course remain challenges, not just for this industry, but for across the board. Global firms must navigate all this. Yet the opportunities are undeniable. Indian GCCs saw a 42% jump in patents filed last year, especially in biotech, automation, and deep tech. As these centers take on more strategic roles, IP structures become more critical. So what next? Experts say India needs a national GCC policy, sharper focus on talent and ESG, and new ideas like sandbox environments and incubation hubs. Done right, India won't just host GCCs, it could define the next generation of global corporate innovation right out of this country. Well, that's the setup, right? I mean, I hope, that was short enough, but useful as well. As promised, let me now go across and take this conversation forward with two experts who are with us. Shalini Pillai is India leader for Global Capability Centers at KPMG India. Manoj Marva is Financial Services GCC Consulting Leader at EY India. Shalini and Manoj, great to have both of you here. Thank you very much for joining us. Shalini, if I can come to you. Sorry for that preamble, but just wanted to set things up for our viewers. We talk about IT services all the time. We speak with all the companies. Most of them are listed, of course, the larger ones. But with regards to GCCs, I mean, there is conversation. It's building, but we don't do enough of it. So I thought, why not sort of, just put the state of play in terms of where things stand. Shalini, just give us your own thoughts. I mean, how has the space evolved? Where are we at now as you see it, and where are we headed?
Okay, super. And by the way, that was a fantastic preamble. It summed up where the industry is today. Thank you for that. Pleasure to be here today. And absolutely, like you rightly said, the GCC environment in India is super exciting as we speak. With over 2,000 GCCs poised to grow to over 100 billion in the next few years, there is a whole lot of action happening in this space. As we speak and as we look at the talent market, and it's really India's digital demographic dividend that's really has us poised to take advantage of this. I'd like to talk about a few other things which kind of help and actually are pivoting to the GCC opportunity. And some of that, what we need to recognize is really a wider enterprise modernization wave. And this is actually a global trend. If you look at it, something that started through COVID and has actually only increased, where global organizations have actually looked at their data platforms, looked at core platforms, looked at AI programs, and there is a frantic pace at which we're seeing the adoption of emerging technologies. That's another big reason and why the GCC model is seeing growth, because it is a proven model. You're actually seeing some of the large GCCs continuing to enhance what they're driving out of India. If you look at the geopolitical environment, and you touched upon it briefly to say that there are certain headwinds, but India, again, at one level has maintained a relatively neutral stand. Secondly, well poised to take advantage of the context that we have in a China plus one environment, supply chain digitalization that we're seeing, the regulatory infrastructure being geared to actually enable and make this even easier going forward has a big role to play. So we are seeing the GCC environment continuing to be further enabled given where we are today. One of the things that perhaps I'd like to call out is if you look at the technology ecosystem, today every large tech player is also looking at the GCC model and very focused on it. A lot has been spoken in media. In fact, it's known that most of the large MSPs have also set up their GCC business, focused on how they can take advantage of this. But when we look at where this is headed, in my mind, there is clearly a pivot to build and to look at the GCC model to fuel growth going forward. Some of this has to do with, it's far from just cheaper delivery, but it's really sustainable, durable productivity. While enterprises go global, look at the digitalization agenda, they're keen to build for the future, to build deep capabilities out of India. And that's a large part of what's driving this next wave of growth. So an interesting combination of hybrid, but with GCCs playing a big
Shalini,
part.
that $100 billion number, revenues by 2030, sounds reasonable? It's on the lower side, higher side, or is it okay?
I believe it's more than reasonable. In fact, one could argue with some of the new models emerging, it may be slightly higher even because today there are BOTs that are pivoting or ODCs pivoting to GCC. So it could be even higher.
Okay. Manoj, first thoughts from you. I mean, how do you see, this space evolving and, how many of these sort of centers, how many inquiries do you guys get? Manoj, if you want to tell us. And what's the pace of new people coming in every month or whatever, every quarter? If you can give us some sense. And has that picked up?
No, absolutely. I would say, adding to what Shalini said, I think we are seeing a tsunami of GCCs. I think right now, if you look at the stat, I would say there are 2 GCCs being set up per week in India. So you can just look at the numbers out there. So it has been, I would say, a bit of a viral movement. And I think Shalini mentioned there's been a confluence of multiple factors. From also, I would mention the demographic challenges which countries outside of India, the Western world, has been facing, the lack of digital transformation talent, wherein India has played a wonderful role to step in. And also, if you look at some of the other aspects, I think if you step back, starting from COVID onwards, you looked at how the GCC model established its resilience. If you look at I think the great wave of resignation which happened in 2023, I think GCC stood very tall to say they could attract good quality talent and sustain that. Or right now, if you look at the agentic wave or the transformation wave which is coming in, which also makes GCC a very successful recipe because you have organizations, operations, technology, data, all sitting together, allowing these companies to unleash the weave of transformation or benefit from it right now.
Manoj, what's just some basic questions, right? What's the size of some of these? What's the average size of these GCCs in India? I'm assuming some are very, very large and some are super small as well, right? But is there a way to?
Yeah. I think if you segment it, I think today itself, you would have some maybe 100 plus GCCs would be there, which have 5 to 10,000 plus people. So you would have, out of this base of 2,000, you would definitely have a long tail. I would believe maybe 60 to 70% of them are less than 1,000 people. Then you have a bit of a middle around 20, 25%, which is 1,000 to 5,000. And then you would have 10 to 15%, which is 5,000 to 10,000 plus. Some of the big ones, like especially from a banking financial services perspective, you have GCCs which have crossed the threshold of 65 to 70,000. And also what's very pertinent out here is that now these GCCs house literally 30% of your global headcount. So if you look at these large Fortune 500, especially for banking, financial services, and even healthcare insurance, literally 1/3 of your global headcount. And if you further slice it to tech and ops, you literally have 60 to 70% of your technology and operations sitting here. And that is what is causing. So when you have 70 or 80% of your tech sitting here, and as Shalini mentioned, you're having this wave of digital transformation where every company wants to become like a Google, Facebook, or Apple, deliver that kind of experience. That is where this talent is coming together to drive it. And also global roles. I think the other notable aspect out here is, if you look for some of the large organizations, you literally have CIO roles or CIO -1 roles, or product or platform owner roles, which are sitting here. So if you look for a large bank, their entire financial stack or their entire platform ownership for a product like a Oracle or SAP is something which would be sitting here.
You know, I was talking to a friend who works with one of the Microsoft out of Seattle, and saying that, I mean, and his network of friends and colleagues, etc., saying a lot of R&D work, even for some of the top chip makers in the world, happens out of India.
Absolutely. I think we had the Mercedes CEO making a famous statement that every Mercedes which walks out anywhere in the world has a bit of Bangalore into it. So I think you're absolutely right. Whether you look at a large, maybe aerodynamics company like a Lockheed Martin, or you look at a chip company, or you look at a large bank, their customers, their products are all being built out here, which is fantastic.
Is there any way, Shalini, to estimate, or Manoj, if you have the number, core deep R&D work, right? Is in terms of value of output, what percentage would that be?
See, if you look at, and I would request Shalini to also pitch in, I think if you look at if you look at this number of, 100-odd billion, literally 25-odd billion is what we call engineering, research, and development GCCs. So this is where you have the large tech companies, the chip companies, the automotive companies, the defense companies, which are actually doing hardcore industrial engineering work, like developing a spark plug to developing a chip. And then the remaining 70% is more around your services and operations, where banks, healthcare, retail, finance, HR sits in. So it is a sizable segment.
So around 30% is core, hardcore R&D, is how would you estimate it?
Yeah, hardcore R&D. Yeah.
Wow, and it's. I mean, we complain here and complain about lack of deep R&D work. But of course, it's happening for these companies, right? That's the whole point. But it's happening, nevertheless. There's talent here, at least that points to that direction. Shalini, you want to add to that?
I would just say that I think it will only increase here on, because one of the shifts that we should also recognize in the GCC space is it's increasingly getting more and more core to the business. So what GCCs are increasingly doing is looking at some of the core business processes, core product development, the engineering R&D side, and that's going to see a big shift. So it's not just about technical and technology skills, but increasingly about techno-functional domain areas. And hence, as we see GCCs moving up that so-called value curve, doing more of what's core to the business and core to the product, we are actually only going to see this increasing. And the tech adoption, if you even look at the role that IoT is playing in this space, it's quite phenomenal. Today, a lot of GCCs run what they call their digital twins for their organizations out of here. Yeah. There are global assets and networks being monitored and managed from here. So if you look at the role one is playing, you can almost imagine a digital twin of your global enterprise sitting here and playing a role in every part of it. Manoj gave a great example of the Mercedes story, which is well known. Yeah. But if you look at it across sectors, there are many more just adding to this list of players who are doing their core platforms, core engineering from here. So that's only going to rise, actually.
Yeah, no, I hope absolutely, and one hopes that is the case. Manoj and Shalini, I'm going to take a quick commercial break here, so allow me to do that. I'm going to come back and continue this very interesting conversation. we're talking to Manoj and Shalini about, of course, the explosion of GCCs in India. Shalini, of course, is with KPMG India. Manoj is with EY. Thanks for waiting, both of you. Manoj, a couple of more simple, sort of, layman type questions, because we want to learn more about it. How do these GCCs on an average pay as compared to the IT services industry? I mean, for IT services, it's been the long complaint, right? Starting salaries have not risen, et cetera, et cetera, et cetera. But for comparable roles, how do they pay?
See how to look at it, and you're right. I think if you look at the GCC stats, one way to look at definitely the benefits which GCC employees get, and the very fact that GCC attrition rates are maybe ranging from 4 to 8 percentage point lower for similar skills vis-a-vis IT companies, because I would say from a compensation perspective, also from a total employee value proposition perspective, I think GCCs have been able to position themselves well. Like Shalini was pointing out, how GCCs are becoming core to the enterprise. So given people get that sense of ownership, that they are part of the mothership, they are able to connect front to back, and they are not a vendor, they are not sitting at a ODC, they are co-located front to back. The fact that they are able to run global roles sitting from India, they have a reporting line straight into the headquarters. So I would say it's not only about compensation, that definitely is one factor out here, but it is the complete employee value proposition. What has literally pivoted GCCs, if you look at some of the big MBA engineering colleges, GCCs now get day zero slots next to marquee consulting firms. So that shows how the value proposition has pivoted because of compensation and other factors.
Yeah, no, absolutely. And I think some fantastic points there that you make. Now, when you have, I think both KPMG and EY offer one-stop solutions for firms which want to come in, set up shop. So one phone call, Manoj, to you, one phone call to you, Shalini, and everything is taken care of. Shalini?
Yes, absolutely.
And I'm told that you guys sort of figure out where to get. I mean, everything from identifying real estate to all the way in. Is that correct?
So it's a really well-organized machinery. Sorry, Manoj, you want to go first? Go ahead.
No, Shalini, sure.
I was just saying that besides what firms like ours do, the ecosystem today is very well oiled and ready to actually bring in and help these new GCCs set up. So when you look at the wider ecosystem play, whether it's real estate, whether it's staffing services, whether it's looking at the whole administrative setup, all of that is today, India is ready with a nice, neat plug and play model for the new GCCs coming in. You referred to it in your opening in terms of the models available and at play today. It's come set it up yourself, come do a build, operate, transfer, do an assisted build, do a virtual model. All of those are options depending on readiness of players. And yes, firms like ours, among many others, offer some of those end-to-end services, making it really easy for global organizations who may not be as familiar with the environment, need that initial handholding as they come in and set up.
Manoj, you want to add to that?
Yeah, absolutely. I think as Shalini said, we've seen a complete sort of a Uberization of GCC. So you literally have a full buffet laid out. You want it end to end. You want to pick and choose. You want to do something, because what also happens is some of these organizations already have some domestic presence here. They already have third-party presence. So I think now this optionality which is available is also one of the big reasons that you're seeing an avalanche of GCCs being set up, because earlier setting up a GCC used to take literally 12 to 18 month cycle. I think all these providers coming in has literally squeezed it down to 6 months. And while you take care of all these extras and ancillary, I think the large part is, which Shalini also mentioned, the core build, operate, transfer. Because when you have literally 100 GCCs coming in, and out of the 100, you mentioned Hyderabad is getting the lion's share, your ability to attract talent, given you don't have a local brand here. So how these providers are also being leveraged to piggyback on the brand a big force carry out here to attract core talent, to attract senior roles, is literally, I think, giving that comfort onshore that you can literally switch it on in 6 months.
plug and play, Uberization, really explains it. Well, just are states offering incentives as well, Manoj, briefly?
Yeah, there is a whole. I think one thing I would say is that finally GCCs have been, the soft power of GCCs has been recognized within India, outside India. So literally, I would say last year you had 9 state governments announcing incentives. I think there's a tough competition, literally a ramp walk happening where everyone is inviting states. And now with the national framework, I think that's a big leap by the central government to see we not only position our states, so it's not only Hyderabad, Chennai, Pune, Delhi, you literally start positioning India. Because while India has a good 70% share of this market, I think we should also be cognizant that other countries, whether it's Eastern Europe, whether it's Philippines, Latin America, are vying hard. So you're now seeing, I think, states have been in it, but now I think a big welcome step is with the central government stepping in and let me saying, how do we use the firepower of India, whether it's Indian consulates, diplomats, everything, to start positioning it, India as a destination holistically.
But so far, it is the bulk of it is in these cities, right? Chennai, Hyderabad, Pune, Mumbai, Bangalore, etc. These are the main kind of centers, right? And Hyderabad, of course, has got the lion's share so far. Any other cities which you think are emerging, Shalini, apart from these?
So I'd like to just add to the first comment before I answer your second is, yes, there are a whole lot of state incentives, but 2 key factors. One is the talent continues to drive the decision making.
Yes.
So the quality, the vastness and the depth of talent continues to actually be the single largest decision point for organizations as they look to make their decision. Couple other factors that influence, of course, are things like infrastructure connectivity.
Sure.
And I would say the the ecosystem play, because the GCC model continues to be fueled by the ecosystem. So whether it's the technology landscape around the vendor base, we know GCCs who've come and set up shop close to where their current vendor base might be. And simply because they want to build an interesting hybrid where they will actually leverage the vendor base while setting up their own shop.
Yeah.
So those are interesting factors, and they will actually also influence the choice of tier 2 for those who choose to then look at a tier 2 location. So it's a combination of not just fiscal tax incentives and policies, but some of this wider ecosystem that will play a role. Lots of states looking at it just now. We're seeing some interesting models emerge and some GCCs already setting up. Gujarat, for example, is a state that continue to attract a few players. We're seeing cities like Jaipur, like Vizag, like Coimbatore actually see GCCs moving there. Most of them end up being the second hubs or in the hub and spoke model. They're the second centers, not necessarily the first, but we're going to see a lot more action in the tier 2 as they prepare and gear up for this next wave of growth.
No, absolutely. Manoj, would you say, I mean, America, of course, American companies are the largest, right? In terms of, I mean, they are the largest by size, of course, but also they are the largest within the GCC pie in India here. Would you say the really big ones, what you said, right? 10-15% are between, or the total are in terms of headcount, 5,000 to 10,000. There are some financial services which are, of course, tens of thousands. The really big ones, just by sheer numbers, are already here? And now it's going to be more, I mean, medium to slightly smaller. I'm not, of course, defining value by that, but just purely sheer numbers.
No, absolutely. I think if you look at right now, say the 100-odd companies which are setting up, you would see literally 60 to 70% of them are organizations which are sub 10 billion. So you're seeing not only, and I think the other interesting point, the second part is it's not only America, while you're right, historically North America has had a 70% market share. But if you look at the sheer number of Japanese organizations, where English is not a native language, just because the dearth of technology talent is making them take a leap of faith and come to India. If you look at Western Europe as a geography, which historically hasn't looked because of language reasons coming in. So I think one is there is a new segment which is opened up, and like Shalini mentioned, because it's become so easy, it's become plug and play to set up a GCC, a small to medium enterprise doesn't feel that, okay, I'll have to have 1,000 people, I'll have to 2,000 people out here. I have a provider which can do it for me. And second is new market segments. And third, I would say sort of a big trend out here is that historically people thought that I can't set up a GCC for less than 500 people.
Yeah.
How would I provide them career paths out here? Now you're seeing a trend where you're setting up GCCs for very niche core skills for just 100 people. And given that GCC is front to back connected to the mothership, and people have the opportunity to manage global teams, location and size becomes agnostic. So India is literally, I would say most of the large enterprises have even dropped the usage of term GCC. They're calling it their India office, and the employees say, I'm sitting out in India. So that's the next trend, that we'll even stop using this term out here.
Yeah, I wanted to talk about a few other things, but I'm completely out of time. Will AI and the fast adoption of AI impact the growth of these captives here in India? And second, of course, I mean, the question which I don't think we have anybody's answers to, which is President Trump, right, and his policies. Will it be limited to goods, or will services at some point? I hope not. But I think that's for another conversation. As I said, I'm out of time. Shalini and Manoj, thank you very much for joining us. Real pleasure. I learned a lot. I hope our audiences did as well. And we'll have you back on as we continue to track the pace of growth in this exciting space. Thank you very much.
Thank you.
All right, well, that's it on this episode of the Global Reset here on CNBC-TV18 Prime. Stay tuned, more coming up on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking this evening: the Sensex and the Nifty end with marginal cuts, giving up gains in early trade. Financial stocks drag the market today. The Nifty drops below 24,600. The rupee remains flat against the dollar, but above the 88 mark. There's no stopping the gold rally. Prices of the yellow metal soared to record highs amidst hopes of a U.S. rate cut. Silver prices also hit a record once again. U.S. Treasury Secretary Scott Bessent expresses confidence in resolving the tariff standoff with India, says India's values are much closer to the U.S. than to China and Russia. This comes as President Trump calls the relationship with India a one-sided disaster This after Prime Minister Modi's meeting with Russia's Putin and China's Xi Jinping in Tianjin. India is in dialogue with the US for a bilateral trade agreement, says Commerce Minister Piyush Goyal. Adds the situation is getting back to normal with China as the border issue gets resolved. Also says talks with the European Union over a trade deal are at an advanced stage. Long pending rate cuts on the cards as the GST Council gears up for a two-day meeting starting tomorrow. The centre remains confident of a smooth passage even as states raise concerns over possible revenue loss. Indian Hotels bats for a 5% GST rate without input tax credit for rooms with tariffs below 7,500 rupees. Oil may be black gold, but chips are digital diamonds, says Prime Minister Modi as he inaugurates the latest edition of the Semicon Summit in New Delhi. Ashwini Vaishnav presents the Vikram 32-bit processor, touted to be India's first made-in-India chip, to the Prime Minister. Companies remain hot on India but express concerns over geopolitics impacting the semiconductor supply chain. Nestle fires its global CEO for an undisclosed romantic relationship with a direct subordinate in breach of the company's code of conduct. The dramatic removal comes just a year after he took charge as the first outsider to lead the multinational. Punjab is reeling from its worst floods in over 3 decades. Over 1,000 villages submerged, close to 3 lakh people displaced. Schools, colleges and offices remain shut in Gurugram after heavy rains in the district led to traffic snarls. The Met issues a heavy rain alert for Delhi and surrounding areas. South Mumbai remains paralysed as the Maratha reservation protests enter day 5. Mumbai police issue a notice to the leader of the agitation and protesters to vacate Azad Maidan after finding repeated violations of the conditions laid down by the police and the High Court. Afghanistan's Taliban government appeals for international help as the death toll after the earthquake crosses 900. Authorities say the death toll could rise as many people are feared trapped under the debris. Well, let's start with the day's market action. The bulls failing to hold on to early gains on the large street. The Sensex finally closing over 200 points lower. The Nifty is back below 24,600. Financials were a drag today. The Nifty Bank lost about 340 points and the Nifty midcap, though closing in positive territory, up by about 150 points or so. But a flat close there for the Sensex and the Nifty. The markets coming off their intraday highs. Nigel is standing by to wrap up the market action for us. Markets off their highs, Nigel, today.
Well, today was a day of two halves, actually, because the first half of trade, the bulls would have felt quite confident. However, the Nifty went to around the 24,700 odd mark, which is a bit of a resistance zone. We have the 20 DMA as well out there, and it did correct from there. Now, today was the weekly expiry that played out, being a Tuesday. So now you have the Nifty contracts that expired on a Tuesday, and that was another factor that led to some kind of selling, particularly in the last 2 hours of trade. The Nifty Bank, that's the sore point. It's unable to find its form, and that continues to underperform even in today's trading session. Now, for the month of September, there's going to be two big triggers. One is, will there be some kind of easing on Trump's tariffs? And the street awaits clarity on the GST front as well. And because there is some speculation on this GST rates, we had Mahindra & Mahindra was a stock that actually came under pressure because, there is some kind of talk that maybe there could be proposed higher GST on vehicles in a particular price band, or EV vehicles as well, which currently enjoy around a 5% GST rate, which could move up. So because of that, Mahindra & Mahindra was one of the top losers. Giving it company on the downside was Dr. Reddy's. That stock as well went home with a cut of more than 2%. But from the Nifty pack itself, there were a couple of sectors or themes that did do well. So the power-related stocks, Power Grid, your NDPC, both of them were higher in trade. And the consumption basket does continue to see some good amount of buying. They've been underperformers, but now with the last few sessions, we're seeing that the bulls are going in there and they're buying. And today, Nestle as well as Tata Consumer, for majority of the trading session, did outperform. But you look at the headline index and you'll say the Nifty ended mildly in the red. The biggest story, though, is playing out in the broader markets, because even today, the number of stocks that were advancing were way more than the number of stocks that were declining. And there were select stocks that did do well. The sugar space got a bit of a boost with regard to ethanol. And that's why you had stocks like Balrampur Chini as well as Sri Renuka Industries. Both of them were up and about in today's trading session. And a couple of stocks actually that have been ranked underperformers. Sammaan Capital as well as MobiKwik. Well, both of them were up between 10 to around 20%. On Sammaan Capital, there is that speculation that there could be a new boss at the helm. So we'll be keeping an eye out on that. That stock was moving high in very, very high volumes. And MobiKwik, the stock that's down to close to around a third of what it was at its peak. Well, there was a clear out trade yesterday, and the street is getting a little bit positive on some of these new age themes. So that stock as well did do well. Short point being, in the near term, the market is fixated on Trump's tariffs, and we need to see some easing on that front or some kind of breakthrough for the markets to move higher from here on.
All right, Nigel, many thanks for joining us. That was the stock market action. In the money market, the rupee remained largely flat against the dollar. $1 is now worth more than 88 rupees as the dollar index continues to gain strength. The 10-year yield softened marginally in trade but remains above 6.5%. In the commodity market, there is no stopping the gold rally. Prices of the yellow metal hitting a new record high amidst hopes of a rate cut in the US. Gold prices in India have rallied 35% so far this year. Silver prices have also hit another record high. In fact, silver has outperformed gold so far this year with 40% gains. But the top story this evening, US Treasury Secretary Scott Bessent has expressed confidence in resolving the tariff standoffs hours after President Donald Trump slammed trade ties with India, and I quote, as a totally one-sided disaster. Now, Trump's statement came after Prime Minister Modi met Chinese President Xi Jinping and Russia's Putin in Tianjin over the weekend. This was the Prime Minister's first trip to China in 7 years, coming in the midst of a tariff standoff with the Trump administration. However, Bessent criticized India yet again for its purchase of Russian oil and accused the country of, and I quote, financing the war in Ukraine. Now, reacting to Prime Minister Modi's visit to China for the SCO summit, Bessent told Fox News that the meeting was largely performative. He said, and I quote, India is the most populous democracy in the world, and at the end of the day, their values are much closer to ours than to China's, than to Russia's, end of quote. Meanwhile, White House trade advisor Peter Navarro telling reporters that the show of unity by Modi, Putin and Xi did not make sense. Navarro referred to Prime Minister Modi as a leader of the biggest democracy and Putin and Xi as the two biggest authoritarian dictators in the world. Petroleum Minister Hardeep Puri has responded to Navarro's earlier comments where he referred to India as an oil money laundromat for the Kremlin. In a column in The Hindu, the minister wrote, and I quote, some critics allege that India has become a laundromat for Russian oil. Nothing could be further from the truth, end of quote. Commerce Minister Piyush Goyal has said that the situation with China is getting back to normal, with the border issue being resolved. He added that India is in dialogue with the US for a bilateral trade agreement. Take a look.
It was a shame to see Modi getting in bed as the leader of the biggest democracy in the world with the two biggest authoritarian dictators in the world, in Putin and Xi Jinping. That doesn't make any sense. I'm not sure what he's thinking, particularly since India has been in a Cold War and sometimes a hot war with China for decades.
We already completed Mauritius, Australia's first tranche, the four-nation EFTA bloc, UK, UAE. Lots have happened, lots more to go. But all of the US, we are in dialogue with them for a bilateral trade agreement. This was an SCO summit where all the SCO members participated. We had a problem in Galwan due to which we had a blip in the relationship. As the border issue got resolved, I think situation getting back to normal is a very natural consequence. We have reached a very advanced stage in our FTA with the European Union. Commerce Secretary, as we speak, is in meetings in Brussels with his counterpart, the DG of EU. Their team is coming down later this week and will be in active negotiation with us. The Minister, Trade Commissioner, Mr. Maros Sefcovic, is coming down on 12th of this month. And we are making very active and significant progress.
Well, that is the Commerce Minister Piyush Goyal. China's President Xi Jinping held a bilateral meeting with Russia's President Putin in Beijing today. Both nations have signed an agreement to build a new pipeline to send natural gas to China via Mongolia. The Russian president described Chinese President Xi as a dear friend and said ties between both countries are at an unprecedented level. Now, Russia is set to increase supplies of gas to China, while Beijing is set to offer visa-free travel to Russians on a year-long trial basis. North Korean leader Kim Jong-un has crossed the border into China in a private bulletproof train. He's scheduled to watch the parade commemorating the 80th anniversary of the end of the Second World War. Russia's President Putin would also attend the parade. This is the first time leaders from North Korea, Russia and China have gathered for the same event. Back home, Prime Minister Modi has said that while oil is black gold, chips are digital diamonds. The Prime Minister inaugurated the Semicon India 2025 and expressed confidence that the world is ready to build semiconductor in India. The IT Minister Ashwini Vaishnav presented the Prime Minister with India's first indigenous 32-bit processor named Vikram, as well as test chips of 4 approved projects. Developed by ISRO for space launch vehicles, Vikram is expected to help cut import dependence. The chip is qualified for use in the harsh environmental conditions of launch vehicles.
फ्रेंड्स, सेमीकंडक्टर की दुनिया में एक बात कही जाती है, oil was black gold, but chips are digital diamonds. 21वीं शताब्दी की शक्ति छोटी सी चिप में सिमट करके रह गई है। ये चिप भले छोटी सी है, लेकिन इसमें दुनिया की प्रगति को बड़ी गति देने की ताकत है।
See, the foundation that we have laid is excellent. The entire world today believes in us, and the entire process, all the ecosystem partners in the process, they are with us today. You have seen in the exhibition. So, for example, how is a chip made, right? So it all begins with the silicon sand. This sand is melted, and then comes the ingot. This is the ingot of pure silicon. This ingot is then sliced into wafers. What you see here, the wafers, this is a plain wafer. Then you have the fabricated wafer. Then you basically design the entire chip on a wafer. So then each and individual chip is taken out and packaged. So what I wanted to share is the entire process now, all the ecosystem partners are in India. Practically all the equipment manufacturers are here. So the confidence of people is huge. The gas manufacturers, you heard from Merck, 500 chemicals, they are all setting up their units here. So the entire ecosystem is coming to India.
How strongly are we progressing in terms of enabling talent? India is known for its large talent pool. How close are we meeting to that 85,000 target that you had set for 2030?
Oh, 85,000 was for 10 years, but we have already achieved 60,000 out of that. We have 278 universities where the students are learning semiconductor manufacturing. And probably this is the largest talent development program in the entire world. And out of those students, many have actually designed their chips, taped them out, manufactured them, and today we presented 20 such chips to Honorable Prime Minister.
Well, that's Minister Ashwini Vaishnav there launching India's first indigenous chip, the Vikram. Sugar stocks, including Sri Lanka Sugar's Dhampur sugar mills, recording strong gains in trade today. This after the government removed all restrictions that curb ethanol production from sugarcane juice, sugar syrup and molasses for 2025-26 sugar season. Sugar mills will now be able to use inventory of B-heavy molasses. There won't be any quantitative restrictions. The curbs were imposed in December of 2023 on account of rising prices. The government is likely to ask insurance regulator to hand over all responsibilities of creating a unified insurance portal to the industry. Sources say the Department of Financial Services do not want IRDAI to have any involvement in Bima Sugam, which is a marketplace for insurance sales and service claims proposed by the regulator. The launch of Bima Sugam has also been delayed by 12 to 14 months. Market regulator SEBI has approved the initial public offer of Boat's parent company Imagine Marketing. This is the headphone maker's second attempt at listing after shelving its plan in 2022. The company filed papers under SEBI's new pre-filing route in April, which offers firms more flexibility in timing and pricing. It also allows a company to withhold public disclosure of details until later stages. Shares of One MobiKwik Systems up 12% in trade today. This after the Abu Dhabi Investment Authority exited the company via block deals on Monday. ADIA sold 2.1% equity in deals worth 39 crore rupees. The 56th GST Council will meet tomorrow. The Centre's proposal of a simplified two-tier tax structure and a special rate of 40% on some items will be on top of the agenda. Timsy standing by now to recap the kind of relief that consumers can expect. Timsy, the all-important, crucial GST meeting kicks off tomorrow.
Prime Minister Narendra Modi's vision in his Independence Day speech on next-generation GST reforms could soon be a reality. The GST Council is set to meet on 3rd and 4th of September to discuss the Centre's proposal to shift to a simplified two-slab structure of 5% and 18% with a special 40% rate for sin and demerit goods. If approved, the move will make a wide range of common use items cheaper. Daily necessities such as soap, shampoo, medicines, hair oil, toothpaste, biscuits, namkeen, bhujia, footwear and apparel below 2,500 rupees, along with ghee, butter, pencils and exercise books are expected to fall in the lower category of 5% or even in certain cases exempt. Aspirational goods such as television, refrigerators, washing machines, microwaves, small cars and motorcycles below 350cc, which are currently taxed at 28%, may move down to 18% slab. The proposal also includes a major relief for consumers and industry with life and health insurance premium, as well as reinsurance likely to be exempted from GST. While the centre is confident of a smooth passage, states have raised concerns over possible revenue losses. They have sought assurances of revenue protection, pointing out that they are not opposed to the rate rationalization but need compensation to meet their financial obligations. Also, a mechanism to ensure that the rate cuts are passed on to the end consumer and not result in any windfall gain for any of the companies. The September 3rd and 4th Council meeting is expected to be a crucial one, with the potential to usher in a new phase of GST, simpler, consumer-friendly and aligned with the Prime Minister's reform agenda. Something that we'll have to wait and watch for the Council as to what finally passes through.
Timsy, many thanks. And of course, track all the action here on the GST Centimeter right here on CNBC-TV18. And speaking of the GST, Indian Hotels MD and CEO Puneet Chhatwal has asked the government to raise the GST threshold for hotel accommodation above the current ceiling. He argues that
of the 21st Annual Global Investor Conference that Motilal Oswal and Ramdev ji have been regularly holding, and which has actually become a must-attend on the calendar of any professional engaged in the field of finance. In some sense, this is a very interesting time to hold this conference, full of volatility around the world, lots of uncertainty, question marks, concerns, but it's, as we always believe, it's a story of a half full glass. All of these issues bring out a lot of opportunities, open up the door to better efficiency, encourage us to work towards nation building, towards better businesses faster, encourages government also to relook at their way of working. So therefore, I would say this convergence of such a large gathering of professionals that I can see before me will hopefully not only inspire confidence amongst stakeholders and investors, but also come out with some concrete suggestions on what we in government can do to take the journey of investors to greater and better levels. I would have ideally liked to be amongst all of you, participate in person, but there's a lot of things happening in Delhi at this point of time. And regrettably, I had to be in Delhi both yesterday and today and could not join you in person. I seek your apology. I remember Narayan Murthy once had said, "In God we trust. Everybody else must bring data." And what better data point than a 7.8% GDP growth in the first quarter of financial year 25-26. The fastest growth in the last 5 years for a quarter. Private capex significantly up by 66%, showing renewed corporate confidence. Strong macroeconomic fundamentals, the lowest consumer price index inflation we've seen in a very long time. Domestic capital coming into the market in a big way. I was told millions of new demat accounts are being opened month on month. FDI has been up by 14%. But India today looks outward also. And we are investing in other parts of the world simultaneously. Banking sector has achieved probably the highest ever performance in many years and is today standing strong to support consumers, to support borrowers, to have safe deposits. All stakeholders today feel much safer with India's banking system. Of course, some of you must have made good money also in the way bank stocks have risen in the last few years. The rating of India has very recently been upgraded to BBB minus, one notch above the lowest investment grade, rather from BBB minus to BBB, one notch better. And while improving the rating, they not only gave us a stable outlook, but also spoke about robust growth and a very solid external finance with low external debt as indicators of a strong economy. In government, we have been working to expand our trading ties across the world. We've already settled FTAs with Mauritius, UAE, Australia. There are 4-nation EFTA bloc, Norway, Switzerland, Liechtenstein, and Iceland, United Kingdom. We are in active dialogue with the EU. My Commerce Secretary is in Brussels today. Their team is coming down next week or later this week, actually. The Commerce Minister, Trade Commissioner Marosh, is coming to India on the 12th. In every sense, one can see an excitement across the world to expand trading and business relations with India. We've had a little bit of a geopolitical issues overtaking trade issues in our negotiations with the United States of America. I do hope things will get back to track soon and we'll conclude a bilateral trade agreement by fall, November or so, as was discussed by our two leaders in February. We recognize that there's tremendous global turbulence. We are living in a very volatile, uncertain time, full of trepidation about the future. But at the same time, along with the government, along with the private sector, the government of India is working to fortify ourselves for long-term capacity building. We are working to further strengthen the macroeconomy. We are working towards ease of doing business and ease of living, deregulating wherever possible, reducing process, procedure and policy, decriminalizing laws so that truly the official term, which is often quite a hassle in doing business, can be reduced.
And welcome to Startup Street. I'm Ritu Singh, and with me are Arundhati Ramanan and Shruti Mishra from the Mumbai newsroom. Here are the top headlines from the startup space. Venturi Partners secures $150 million in the first close of its Fund 2 to back high-growth consumer brands in India and Southeast Asia. The fund is set to make initial investments of $15 to $40 million in 10 companies across high-growth consumer sectors. It aims for a final close of $225 million by June next year.
Startup ecosystem enabler BizData unveils 1,000 crore rupee Pulse Fund 1. The fund will prioritize investments in sectors such as AI, SaaS, fintech, health tech, deep tech, defense, EV mobility, and green energy. The fund will focus largely on opportunities in India's Tier 2 and Tier 3 cities.
Tech growth brand Tuco Kids lands an investment worth $4 million in Series A funding round led by RTP Global. The capital will be used to deepen the company's brand presence, product innovation, and expand its presence across both online and offline channels.
Former CoinDCX executives launch AssetWorks. It claims to be the world's first AI-native investment intelligence platform designed to help everyday investors make informed decisions in under 60 seconds. The beta launch took place in August.
And the market regulator, SEBI, has given its nod to Boat's parent company, Imagine Marketing, as well as Urban Company to raise funds from the capital market. They are among the 13-odd companies that have received SEBI's approval since August to go public.
Well, those were the headlines we've been tracking for you this evening. On the hot seat today, Aditya Birla Group's Tomorrow House of Brands has raised $50 million from ServiceNow Ventures to accelerate its tech-powered fashion vision. Now, the deal brings ServiceNow's agentic AI and automation platform into tomorrow's playbook, offering faster speed to market, sharper consumer insights and omni-channel experiences. From digital-first names like Bewakoof, Wrong and the Indian Garage Co. to building an AI-first model for scaling new-age fashion brands, Tomorrow says it's ready to blitzscale the next phase of profitable growth. Joining me now is Prashant Alluru, the co-founder and CEO of Tomorrow. Prashant, welcome back to Startup Street. First, tell us, what does ServiceNow Ventures' $50 million investment mean for Tomorrow at this stage of growth? Like I mentioned earlier, it isn't just capital. It brings AI and automation into the mix. How do you see this partnership reshaping the way you build and scale fashion brands?
Absolutely. Thanks a lot, Shruti, again, for having us on your show. I think in the last 3 years, I think you've been a part of our journey, and this is our first round of external funding. We've been well capitalized so far with the backing from Aditya Birla Group with more than 150 million funding before this first round of funding. So, of course, this is definitely growth capital for the foundation we've laid. We've got a portfolio of very strong brands that solve for Gen Z and millennials. Each of them have multiple growth engines, and this round gets us to fueling that to the next stage, not just for growth, but also profitable growth. But like you said, for us, this round is not just capital. It's all about taking our belief system that building new age brands was all about tech and data science and AI-led approach. How do we take that to the next level with the power of Gen AI and agentic AI? And we couldn't find a better partner than ServiceNow Ventures globally in terms of putting AI at the forefront of scaling fashion brands. And we are the first, possibly the first brands business globally that they've backed. And that is also a strong validation in terms of the foundation we've built on the capabilities on AI with the fashion value chain.
Okay, Prashant, you just spoke about Tomorrow's technology and data science-led playbook. If you could give us an example of how AI is driving speed to market or consumer insights today, where does tech give you an edge over traditional players?
Absolutely. I think if you think about the fashion value chain, right, it all starts with the power of design differentiation and product innovation. So one piece that we've always believed in is how do you spot the best trends, how do you sort of forecast demand, sense demand, and bring the best of fashion, both global fashion and regional fashion, to our consumers, which is the more ed model. We also take that across our value chain, whether it's in the decisions we take, pricing, marketing, etc., but all a deep efficiency around automation across the value chain, right? Whether it's sourcing operations, supply chain, across the back end and the front end of the business. And I think to us, this deepens our capability and takes us to the next level of agent automation, but also hyper intelligence when it comes to decisions that our teams make. And the next wave would be the shopping experience getting transformed in terms of how the shopping experience across online and offline is being fundamentally reimagined and reinvented with Gen AI.
All right, your portfolio spans digital first names like Bewakoof, Wrong and the Indian Garage Co. And fashion is still seen, like you mentioned, as a design and trend-driven industry. Quickly, if you could tell us your learnings about Gen Z and millennial consumers that's helping shape the next phase of growth. And based on those insights, are there any new offerings in the pipeline?
Sure. I think one of the biggest learnings for us is for Gen Z and millennials, the brand association is not just about the category of the product you're selling. It's all about the community and the brand love and the association with the community. Of course, brands like Bewakoof have been at the forefront of building these kind of communities. I think we're deepening that more broadly in terms of how the consumer looks at the brand, not just as a fashion lifestyle brand, but as a community that you associate yourself with, where the purpose is beyond the product you're selling. In terms of the next moves, I think one of the things that we're thinking about is how do we bring the power of many brands to the consumer in a more curated, more personalized experience. And we're starting to dabble with a shopping experience which is more curated, more personalized, but also with the promise of faster delivery. Of course, quick commerce has come to many categories, but we believe that fundamentally in fashion as well, the faster delivery promise will shape up quite nicely. And we're starting to invest in pilots which help us test. Of course, our individual brands are already investing in more curated shopping experiences and faster delivery. We'll bring all of that together under the Tomorrow umbrella as a multi-brand D2C platform, which will then allow for the consumer to find all the fashion needs that they're solving for at the fastest speed possible.
All right, so faster delivery in fashion. But Prashant, you've spoken about wanting to blitzscale the next phase of profitable growth. What does blitzscaling look like in fashion, and how do you balance that ambition with unit economics? What are your revenue targets going forward?
We've always believed in, not just unit economics-led growth, but, focusing on good growth and not just chasing bad growth. I think over the last 2.5 years, even post-acquisition, we've made a lot of strides in terms of improving unit economics. But now with the power of AI and Gen AI, I think we believe there's a lot of efficiency across the value chain in terms of being able to scale, not just with high hypergrowth metrics, but also with very strong unit economics and strong efficiency.
Okay.
That's one piece of the puzzle. The second piece, of course, is all about in the fashion business. It's about being able to predict what is likely to sell and being closer to demand signals. I think we're running a much sharper and tighter cycle, so our teams are able to make not just sharper decisions but faster decisions, more in real time. I think that'll just help us take the current unit economics focus to the next level. In terms of our ambition and targets, I think we're currently at a $125 million run rate. We'll close the year, $150 million run rate. We'll close the year closer to a 200 million run rate. Our ambition is to first cross the 500 million threshold, and then the journey is to get to the $1 billion longer-term ambition we've always had.
All right, getting to the $1 billion mark. On that note, Prashant, I'll have to wrap up our conversation. Many thanks for joining us on Startup Street today, and wish you the very best with all your aggressive growth plans.
Thanks again for having us.
And on what's brewing today, India's clean energy push is getting a battery boost. Off-Grid Energy Labs, a deep science startup from IIT Kanpur, has raised $15 million in Series A funding led by Archean Chemicals with participation from Ankur Capital. The company is commercializing its patented zinc gel batteries, a safer, non-toxic alternative to lithium-ion, and will use the funds to set up a demo facility in the UK and lay the groundwork for a gigafactory in India. With India targeting 500 gigawatts of non-fossil capacity by 2030, Off-Grid is positioning zinc gel as a homegrown solution to meet the country's massive energy storage needs. Joining me now to outline the firm's growth plans is Rishi K. Srivastava, the co-founder of Off-Grid Energy Labs. Rishi, thank you so much for taking time out and being here with us on Startup Street. You know, you've just raised this $15 million led by Archean Chemicals. What does this funding sort of mean for Off-Grid, and how will it accelerate your journey from lab innovation to, sort of large-scale commercialization?
Thank you for having me. Yes, so this Series A raise is essentially to help us get on the path of commercialization. So, zinc gel batteries, we've taken it from the lab stage, certified, and it's actually a product stage now and getting into commercialization. So we are setting up, as you rightly said, a demo facility in the UK, wherein we are going to basically use it as a test bed to validate the manufacturing of our batteries, and thereafter be able to launch the first gigawatt facility, which our plans currently include to be building in India.
Sure, and zinc gel is what is patented and is being pitched as a safer, sort of non-toxic alternative to lithium-ion, right? So what makes this chemistry sort of stand out, and how does it compare in terms of cost, safety, and scalability?
So very relevant. So, zinc is actually one of the oldest chemistries in the world. What we've done at Off-Grid Energy Labs, we are a deep science IP-led, R&D-led company. And so what we've done is we've taken the existing chemistry, which is around zinc bromide, and innovated, in three vectors. We've innovated on the chemistry itself to make it more reliable, scalable, and safe, and also most commercially viable, for stationary applications. The second thing is we've democratized the materials. So the materials that we use in our batteries are globally democratically available. They're available widely in India, in Europe, in Africa, in the United States. And the third thing is we've really done a lot of innovation in the area of manufacturing. So we've optimized the manufacturing processes in a manner which is very sustainable. So we use 50%. Our carbon footprint on manufacturing of zinc gel batteries would be 50% lower than what it is relative to lithium. And in terms of what's really different and what's unique, what excites us the most is that the energy storage market, especially for the stationary segment, is growing very, very rapidly. So, the International Energy Agency expects a 15x growth on sustainable energy storage, a renewable energy storage in the next by 2030. In India, it's a massive demand of about 411 gigawatt hour, and that's the gap that we're addressing. We're basically focused on really three applications. The first is the net zero applications for commercial and industrial enterprises, who today use conventional sources of energy as well as some renewable energy, but don't really have the storage for it. And we fit that gap and segment exceedingly well. Then peak shifting, which is India's blessed, for example, many parts of the world India's blessed with abundant
Absolutely.
And our batteries are making it commercially viable to restore that and use that at the peak hours in the evening. And
Sure, absolutely. We're running out of time, so if you could quickly tell us, you're also setting up a 10, megawatt demo facility in the UK before building a gigafactory in India, right? So why start abroad, and how does this fit into your global expansion strategy?
So the UK facility is basically a test bed for us because the ecosystem in the UK for precision manufacturing of battery technologies is very well developed. So we're a homegrown company out of India, and we now want to ensure that we use the world's best standards to be able to optimize, our manufacturing, and thereafter bring that back and set up the gigawatt facility. So it's really a validation point, and from an ecosystem perspective.
Sure. So it's basically a test bed for what you want to do globally. And in 10 seconds, what are the kind of revenues you're making, and where do you hope to end this year?
So we're a pre-revenue company. As I said, we have about 25 families of IP. We've created over 50 IP assets over the short reign that the company's been in being. So we hope to be commercial once we launch the batteries with the gigawatt plant, which should happen, post this, this facility. So currently we're pre-revenue.
All right. Okay, great. Rishi, thank you so much for taking time out and being here with us on Startup Street.
Thank you for having me.
Well, digital lending player Lend & Club Group has reported a 34 crore profit for FY25, which is a sharp turnaround from the loss of 14 crores in FY24. For the full year, the consolidated revenue came in at 236 crore rupees, which was up 28% year on year. They also reported a positive EBITDA of 50 crore rupees. For more on the company's financial performance, though, and the road ahead, joining me now is Bhavan Patel, the co-founder and CEO of Lend & Club Group. Bhavan, many thanks for your time here on CNBC-TV18. Before we get to those numbers, a quick word on what really life has been like since August of last year, when RBI lifted these restrictions, or rather imposed these P2P lending guidelines. How did you have to pivot business to really survive?
Okay, so last couple of years, we have been already working on how do we create more sustainable ecosystem around the credit facilities in the India, around the two products which we offer in the market. One is small ticket size personal loan and a merchant loan. So over the period of time, we already reduced our overall exposure at a group level on P2P lending. However, during last 1 year, there was a massive turnaround. As you rightly said, that minus 14 crores to 34 crores. So we took a lot of regulatory advisory calls in the financial year 23-24, and which resulted into minus 14 crore worth of losses during that financial year. However, things started recovering even before August 2024 guidelines coming into the place, and we were well prepared, well placed in terms of adapting the new set of regulations. Hence, while the regulations changed, a new amendment came into place, but we did not get hampered when it announced because we were already prepared.
Well, Bhavan, but let me ask you if you could, sort of give us a better sense of, even with these regulatory headwinds that have really shaken up the sector, how were you able to report the profit? I mean, it's come as a bit of a surprise.
Yes, absolutely. I think startups are there to surprise the traditional way of thinking, and hence we have registered such kind of revenue as well as the profit. So as you know that we have been operating two different brands under the Lend & Club Group umbrella. One is InstaMoney, which is our loan service provider platform. So that has been one of the major revenue driver in last financial year, with around 50% plus revenue at the group level. P2P has been around 30 to 35% revenue generator, though the growth is there in the P2P side as well. But definitely the main driver has been LSP, and in coming financial year also LSP is going to drive the major growth in terms of revenue. Second point, while the new amendment of the P2P regulations came in August 2024, out of 10, we were prepared with all 9 pointers out of 10. So on the very first day, we were compliant with 9. So we did not have to pause lending on our platform. It was merely a few days when we had to realign our workflows to comply with the new set of regulations. So we were way ahead in terms of thinking what could come, and our platform was already prepared to accept the new regulations which were supposed to come in August 2024.
Bhavin, I still want to understand how much of the disbursal of 16,000 crores that you've done to date has actually come since the new RBI P2P guidelines came into force, and also what happens now to your NBFC application that was returned by RBI?
So between August 2024 till March 2025, we disbursed roughly around 1,000 crore worth of loan through the P2P lending platform. So that is a kind of disbursement which we have achieved through P2P. The initial phase was little difficult. So between August to November, the numbers were much lower, somewhere around 50 crores per month. However, towards the end of the financial year, those started growing up. At this moment, we are disbursing anywhere between 150 crore to 200 crore per month through the P2P lending platform. In terms of our NBFC application, it was written by the regulator. And at this moment, we accepted that point, and probably we are more focused on building the platform business. So if you look at all the three domains where we are operating, P2P lending platform, LSP platform, and TSP platform, all our platform businesses. At this moment, we do not have any plan to go into on-book lending domain.
Well, Bhavin, many more questions, but hopefully we'll pick this up another time. That's all the time we had for today's show. Thanks so much for joining in, Bhavin.
Thank you.
Coming up, it's time for a short break. But on the other side, online retail giant Flipkart is gearing up for the festive season with its flagship Big Billion Days sale. The company is scaling up its supply chain and placing a big bet on its tech product pipeline. Details when we come back. Stay tuned.
Welcome back to Startup Street. India's online retail battlefront is shifting into high gear as festive season approaches, and Flipkart is pulling out all stops for this year's Big Billion Days. From a revamped app to scaling its supply chain, the e-commerce giant is betting big on tech to take on rivals and rising quick commerce apps. Shilpa Ranipeta gets you the inside track from Flipkart's Tech Day in Bengaluru. Take a look.
thick of India's festive season, and Flipkart is gearing up for what it calls its biggest Big Billion Days yet. Ahead of the mega sale, the company has unveiled a whole host of tech innovations that span the entire ecosystem. Now, the Flipkart app also has been completely refreshed with a new look right from the homepage to even the order details page. The company has also ramped up search, product innovations, haptic feedback, shoppable videos, all in a bid to capture a larger share this festive season.
Customers are going to see a lot of new features. For example, a lot of personalization has gone in, a lot of recommendations, a lot of innovations in terms of search. Search has moved from lexical to being very meaning-oriented. I think that's a big change for us. The entire app has been revamped. I don't know how many of you saw the app previously versus today. App has gone through a complete reimagination. It is very location aware.
For sellers, Flipkart has also revamped its seller app with AI-powered insights to help them manage their operations. Now, on the supply chain front, Flipkart says that it is placing delivery hubs closer to customers to cut down delivery times and also support growth in Tier 2, 3 and beyond markets. Now, Flipkart says ahead of the Big Billion Days sale, it is gearing up to scale its operations 12 times its usual capacity to meet the surging demand.
One is the physical layer of making sure that the hubs are located close to demand, both on the first mile and the last mile. Three aspects. What we did was we refreshed the seller app all the way through. We cleaned up the interfaces we had for listing management. We helped them manage their rate cards better. We made sure they can look at the settlement-based scoring algorithms correctly.
But Flipkart won't have it easy this time. Competitive intensity is at an all-time high, not just from rivals like Amazon and Meesho, but also from quick commerce apps like Blinkit, Instamart and Zepto, all of who are muscling into festive shopping with categories like beauty, snacks and even puja essentials. Now, Flipkart is countering this with its own quick commerce offering, Flipkart Minutes, which is now live in 19 cities and 2,900 pin codes. And the company says that all of the Big Billion Days sales offers and deals will also extend into minutes as the lines between e-commerce and instant commerce blur. Flipkart has also launched a new loyalty program called Flipkart Black, taking on Amazon Prime with a free YouTube premium subscription.
Any event which has an early access, Black members are going to be right up there with a red carpet welcome. These are some things on Flipkart, and like I said, YouTube Premium is unlocked. Free cancellation on Clear Trip is already unlocked. Inaugural early bird pricing of 990 rupees. This is the annual price. This is an early bird offer. But the regular pricing will be 1499.
The stakes are massive. According to a Datum report, India's online festive sales are expected to cross 1.2 lakh crore rupees this year, and quick commerce will account for a significant share there. For Flipkart, though, the Big Billion Days will be its ultimate stress test of its big tech bets, of its supply chain expansion, and its ability to hold its market share in India's most critical shopping season. In Bengaluru, Shilpa Ranipeta.
Okay, and on that note, we'll wrap up this edition of Startup Street. Thanks for watching. Stay with CNBC TV18. More news and updates will continue after this break.
Hello and welcome to this special broadcast. In the vast expanse of human endeavor, few pursuits are as vital or as complex as a quest for better health. We stand at a crossroads in that quest, where technology has become more than just a tool. It's a catalyst, reshaping how care is processed, delivered and experienced. To chart the way forward, we delve into technology as an enabler in healthcare innovation. The theme of our special panel discussion in the Optum Presents CNBC-TV18 Healthex Conversation series, which is a platform dedicated to fostering a more flexible and progressive healthcare ecosystem. Consider the strides we've made. AI algorithms now assist in diagnosing serious ailments. Advanced data analytics allow for more personalized treatment, while digital health has bridged gaps, offering equitable access to care across diverse populations. Yet, challenges persist. Disparities in digital literacy and infrastructure hinder equitable access to healthcare. Innovation in silos can blunt their impact, and evaluating technological interventions requires robust metrics to ensure continuous improvement. Fortunately, we have a panel of distinguished healthcare leaders here to help us understand the opportunities and complexities that exist at the intersection of technology and healthcare. They're here to not just help us understand, but also to innovate and transform. Ladies and gentlemen, please welcome Dr. Amit Kakkar, Managing Partner and Head of Asia, Novo Holdings, Harish Goody, Chief Information Officer, Optum India, and joining us virtually, please welcome Dr. Indu Bhushan, ex-CEO, Ayushman Bharat, Prashant Warrior, co-founder and CEO, Cure.ai, Satish Kannan, co-founder and CEO, MediBuddy. Gentlemen, thank you very much for joining us. Amit, let me begin by asking you, when you look at a 2030 horizon, give us a sense of the kind of innovations which you feel will transform the healthcare sector, not just globally, but here in India as well.
Now, look, absolutely, and a very pertinent question. So today, when you talk about healthcare, it's pretty much in silos. You have hospitals, you have diagnostics, you have patient treatment centers, but none of them focus with patient centricity. They all work in their individual ways and try to help the patient. So if I fast forward to 2030, I would see a complete patient-centric tool that's available, and that will be powered by AI and quantum. And AI today, it's already generating about $1 trillion in revenue. And if you look at one area that AI is making a big impact, that's in healthcare. You mentioned about AI's role in diagnostics. You mentioned about AI's role in detecting early diseases and then managing those diseases. So if I look at 2030 as a physician, I see a patient that's actually now benefiting from all these technological innovations we are talking about and really driving towards personalized medicine, which is now still a little bit of a pipe dream as we sit today in 2025.
Right. Harish, if I were to bring you in at this stage, if there were 2 or 3 healthcare innovations that excite you the most and where you feel we should be investing the highest amount of money, what would those be?
Okay, so look, first of all, it's a pleasure to be here. Thank you for the opportunity. And there are many innovations that's going on out there in the industry. And we can talk about value-based care, we can talk about affordability, we can talk about health prediction. But I think the one thing that really excites me is treating the patient or member as a consumer, that entire shift from treating them as members and patients to consumer. So a sea change is happening out there in the industry of giving the experience that people have come to expect. With all the new age platforms that are available in the retail industry, why should not we have the same experience? So how do I put the consumer in the center and surround the consumer with technology to make life much easier, right? How can I connect the dots on all the data that we have and personalize, like you said, not medicine, but also personalize experiences. If, let's say my kid is sick, and I want to go in there, search for care, find a physician, book an appointment, understand what the condition might or might not be. So using technology to be able to do interventions where I can go and say, hey, my kid has a stomach ache, and the system guides you through what plans you have, who's the nearest physician, who can you go to, can I fix an appointment for you? And doing that entire cycle, I think, is going to create wonders.
Right. Let me also get in Dr. Indu Bhushan at this point. Dr. Bhushan, when you speak about the Ayushman Bharat mission, how do you think it laid the foundation of health tech, healthcare innovation in India?
Parikshit, thank you very much for having me here. And let me tell you that Ayushman Bharat Digital Mission is creating the backbone for digital health in the country. And this is going to play the same role in revolutionizing the health sector as UPI has done for the finance sector. You know, it is doing three major things which will help take the digital health to a different level. One, it is creating opportunity for interoperability. And so right now, a lot of innovations are happening all over the country, all over the world. And to make sure that they talk to each other, they're interoperable. So this Ayushman Bharat Digital Mission is going to be creating that kind of a system where they can talk to each other, whether these are patient-centric applications or hospital-centric applications or provider-centric applications, they would all be talking together. Second thing it will do is make the verifiability much more easier. For example, suppose today someone goes with a prescription to a pharmacy doesn't have any way to assess whether this prescription is correct, whether the doctor which has been mentioned actually exists, or is it a fake prescription. And digital mission will help in terms of not only ensuring that this can be confirmed, but also the doctor that you're talking to through telemedicine or any other places, you can confirm that the doctor actually exists and is what the doctor claims to be.
Right. Thank you for those opening remarks, Dr. Bhushan. Let me also get in Prashant at this stage. Prashant, when you look at artificial intelligence and the use cases in the healthcare sector, what are some of the opportunities that you see on the horizon and certain challenges as we try to leverage those opportunities?
I think I can talk to some of the things that we have been doing at Cure, and we sort of built a technology where you can interpret an X-ray autonomously for detecting TB on that chest X-ray. And if you look at the TB screening protocol as per the WHO, which WHO guidelines came out in 2016, it said that the patient first goes through a symptom screening. So you ask for the symptoms of the patient, then you do an X-ray, and then if the X-ray is positive, you do a sputum test. And the sputum test is expensive, not available everywhere. It's hard to sort of scale. X-rays are easier to scale. But the problem is getting an X-ray read was a challenge. I mean, if you're looking at rural parts of India, you're looking at Africa, Southeast Asia, getting a chest X-ray interpreted, it used to take days, sometimes even weeks. One of our first customers, they used to run mobile man-based screening programs. It used to take them weeks to get an X-ray read. And we were able to make that happen in 30 seconds. So X-ray gets taken, AI is interpreting that X-ray, and within seconds you have a result. So AI can really change the workflow there, and that is how we have changed that workflow for tuberculosis. We have changed workflows for lung cancer. We have changed some workflows for COPD, stroke, heart failure. So again, working on multiple disease areas.
Okay, I'll come back to you, Prashant. But Satish, welcome to the discussion. Now, when we speak about the gaps and differences in digital literacy all across the country, differences in the scale of digital infrastructure, how does one navigate these challenges and making sure that if there are technological innovations that you're offering in the healthcare sector, you're able to deliver it to everyone across the country in the same manner, seamlessly?
No, absolutely. So let's just take a step back to understand the challenges in our country, right? So one, access to good quality doctors is a big challenge because the best doctors, I call them specialist doctors, are pretty much in the top 20 to 25 cities. Good healthcare infrastructure, which is good hospitals, good diagnostic machines, are all again in the top, let's say, 50 cities, which essentially means we need to use, first of all, technology to ensure that accessibility is taken care of. Which means anybody anywhere in India should be able to access a doctor in a big city, get the right advice. Now, can everything happen physically or can everything happen digitally? Which is not the case, right? We need to find a midpoint, and that's what we call as a phygital approach. Some of it can be digitally, done, and at the right point when the doctor has to examine you, or you need to actually go meet the doctor and get an X-ray done or MRI done, then that means you need to be physically present. And we need to make sure that both of these are available digitally as well as physically. So first is to provide the right information. Now that's exactly the question where digital literacy comes in. Now let's look at what are other technologies that have significantly penetrated this market. And we all know we use a lot of social media. It can be a WhatsApp, it can be any of the social media that we use. What's very interesting is there was no user guide to learn all of them, which means these technology platforms were designed such that they're sort of language agnostic and very easy to use from a UI and UX point of view. And that's exactly what, in a way, sort of Medibuddy is also doing. One, make the information available very easily. Two, make sure that you are able to provide them in multiple languages. So in India, we provide around 16 different languages that you can access the services and, of course, the product and talking to a doctor, getting the right information in that, right? The third one is to sort of design our ecosystem and the technology platform for low bandwidth conditions. So it's true, our bandwidth is getting better and better. Devices are also getting better and better. But having said that, from a technology point of view, make sure that all of this is accessible and usable at different price points of devices because and different bandwidths that we sort of see.
Please stay tuned as there is more to come on the other side. Welcome back to this panel discussion of Healthex Conversations presented by Optum Healthcare in association with CNBC-TV18. As we were speaking about healthcare innovations, the use of AI, quantum computing, and bridging the gap in healthcare delivery all across the country, what are investors also looking for? Amit, I'd like to bring you in at this stage. When you look at healthcare innovations being provided or being proposed by startups in the country or innovators, what is it that you're actually looking for? What's the benchmark that you have when it comes to solutions that will really help the people? What are some of the ethical benchmarks that you keep in mind and the long-term viability of it all?
Sure. So I think very key points that you've raised about all the aspects of where and how we should invest in innovation today. Now, there are a lot of startups out there, a lot of them trying to find solutions to few problems that exist in healthcare. So the first thing we look at it is, what is the addressable market that we are approaching with this new innovation or this new technology? Secondly, will this innovation and technology actually make a difference in patient care or patient management? Or is it, hey, by the way, this is another ultrasound, this is another X-ray system that'll add on to look after the patient, but doesn't bring in any breakthrough in terms of patient care or patient management? Third, we also make sure, I think you heard it from Prashant, you also heard it from Satish, that it follows the right regulatory guidelines. It has gone through the right approval processes, it has gone through the right case studies, and has actually proven benefit in looking at benefits to the patient. So that means you have gone through, if it's a clinical trial process, it has gone through that, it has gone through all the right regulatory checklist and taken care of.
Right. Harish, when we speak about value-based healthcare, what is your approach to that and what role can technology play there and really help us understand value-based care for our viewers right now?
Yeah. So let me simplify value-based care in a short way. If you look at how healthcare generally gets approached today, it's about fee-for-service, which means I'm doing episodic health condition treatment. So there's a challenge. You end up with an episode, you show up at the hospital, you're taken care of. Maybe I give you some tests, I run some diagnostics, I give you some medications, and that's it, you're out. Here is some follow-up that I give you. In this entire system, the focus is on managing the episode versus long-term health outcome and prevention. So value-based care is about shifting left and moving the focus from episodic intervention to a long-term health outcome intervention. That's what value-based care is all about.
Let me also get in Dr. Bhushan at this point. Dr. Indu Bhushan, when you speak about the Ayushman Bharat Health Mission and the learnings from that, if we look at the next 10 to 15 years and the kind of challenges, the kind of needs that we have in the healthcare sector as a country that we have, what would be some of the technological innovations or breakthroughs which you feel we need to do, which you feel the government should also focus on either on its own or in collaboration with private sector to make sure that healthcare reaches the last mile and we get those early solutions, even preventive healthcare to people all across the country?
Well, excellent question. So as you know that we are committed to providing universal health coverage by 2030. And that implies that we need to have affordable, not free, affordable healthcare, quality healthcare, accessible to everyone. And given that we are a vast country and we have a lot of gaps, and as earlier the panelists mentioned, that first thing that digital health can help is extending and providing services, making services more accessible. And that could be done by issues like telemedicine, but also AI. AI can bridge through many of the constraints that we have in terms of human resources, like it was mentioned by Cure AI initiative. So one thing is that first thing that we can do is improve access. Second thing is to improve quality, because quality access is actually there research to show that not using services is actually better than using bad quality services. So making the system more accountable, ensuring that we are providing quality services, and those services that can be audited and people can be held accountable. And digital health can help in doing that.
Prashant, if we were to ask you about the use of AI, yes, it's important, and every private hospital chain is coming up with their own apps or AI-led solutions to deliver healthcare. But how do we make sure that when we are using AI tools for diagnosis, for example, how do we remove inherent biases from the system and make sure that these models that we have, they work seamlessly across populations, across demographics in the country?
Reality is AI has biases, and AI also learns human biases from the data it is trained on, because data that AI is trained on is produced by humans, and humans have biases in our mind. So that goes to the AI as well, right? And so this is, especially in healthcare, it's a huge challenge. Like I also mentioned earlier, you cannot make mistakes in healthcare. I mean, it could be fatal. It could be fatal for a patient, right? So in healthcare, I really believe that, like I was mentioning earlier also, any products that are launched need to go through a rigorous evaluation, right? I mean, that is up to the regulatory body, CDSCO in India, to ensure that any AI technology has the same rigorous evaluation that is required for a hardware technology. I mean, for example, if you look at a Siemens or a GE, I mean, launching hardware devices in the country, or if you're launching drugs in the country, they go through so much evaluation before they are in the market. I don't know why AI should not have the same amount of rigor in evaluation of AI technology, because the impact could be similar. While it's a software technology, we feel like it's easier and it's probably simpler to deploy, and it's easier to manufacture. There is no manufacturing per se, right? And you can deploy very quickly. But I think the rigor that is required for AI should be very high, and products should be evaluated, and regulatory approval should be only given after there is enough evidence to the quality and the safety of the technology.
Satish, when we speak about the example of Medibuddy and the kind of experience it has working with corporates across the country, with hospital chains, how do we make sure? One thing is about coming up with the technological innovation, but then you already have resources available. You've got hospitals, you've got physical healthcare centers all across the country, in remote corners of the country. How do you integrate online technological innovations along with the brick and mortar infrastructure you already have in the country to make sure that you're able to optimize resources and give the right solutions to people?
No, absolutely, Parikshit. I think that's $1 million question that we all are trying to sort of solve. But let me tell you first a few challenges that we face, and then how do we sort of approach them. So first, where does the challenge come from, right? So there's a diverse device ecosystem, right? All of these machines are diverse. They are different companies, different makes. They send out data in different shapes and formats. then most of these softwares are what we call as legacy systems. So they have been there for very, very long time. And there is no reason why they would have to invest further in integrating this back into a system. So that's where also the integration cost. So who will foot the bill is an important question that every hospital or every diagnostic center is also asking. At the same time, there's a lot of questions on data privacy, data security concerns, right? Of course, we need to ensure that every data is important. Medical data is more sensitive because somebody knows that I have so-and-so disease, I have diabetes, I have kidney issue, right? So it's very important that the security and the data privacy is a big factor that is taken into account when you try to bring all of the players in the ecosystem together. And then there's a natural resistance to change. So these are all the challenges that we are saying, right? Multiple devices, data privacy issues that we have, legacy systems. But what's very important is people have started understanding that patient centricity in healthcare is starting to happen. Let's go back 10 years ago, it was sort of doctor-centric or provider-centric. Today, the change is that it is becoming patient-centric. The reason is they have more control, and all of these digital solutions are forcing the doctor or the provider to get on the platform.
All right. Thank you very much to all of you. And thanks to Amit, Harish and Satish, also Prashant and Dr. Bhushan for joining us on the program. It's been an excellent discussion, and we'll continue to track this story very, very closely because technological innovations in the healthcare sector will be critically watched by everyone.
Even after spending billions of dollars, we are unable to solve the cybersecurity problem. And one of the reasons for that was that we were always using yesterday's technology to solve today's problem.
So how long did it take to build the computer?
For quantum computer, we took around 1.5 years. The way it was so exciting was when the fridge came. Fridge was from glucose and we did fabricate outside. People were on the truck from the airport, Bangalore airport to office, and we were all waiting in the basement for this to arrive. And that moment, it was unbelievable. Okay, finally we have this here, because we were waiting for 3 years. And the bigger moment will be next few years when we fabricate it here.
And that moment is a couple of years down the line?
No, next year.
Next year.
As long as my data is encrypted using quantum keys, it is unbreakable. Even quantum computer, most powerful quantum computer,
he can't break into you.
Till the time the people don't encrypt it, he can break it. We built India world's first end-to-end SaaS quantum security SaaS platform. I went into US and presented this to few investors there, and they were little not convinced. But after some time, they said, we haven't heard this story anywhere. So that was the moment for me that India has arrived.
The US is far ahead. China is significantly ahead, especially as far as quantum, etc. is concerned. Where does India find itself?
There was an inventor of Wi-Fi. They did all the research. That's Bell Labs. And who became a leader in Wi-Fi is Broadcom. So similarly, it will not be that people who start first, they'll be leaders. IT era is over. Deep tech is where the next generation really has to focus. You have to build products. India has to move from services.
What are those ingredients that will ensure that we make that transition?
When you're in services, and I spent some time in the service industry, you try to solve somebody else's problem. When you say product mindset is all about looking at the problem. For the country like us, where we have largest population, I think the services will be one of the sectors. We can't eliminate that. And then the product will be the sector that creates the wealth of the nation. So these two should continue to coexist.
India is accelerating its push in the global quantum race, from building the nation's first superconducting quantum computer to securing critical digital infrastructure with quantum-safe encryption. At the forefront of the deep tech revolution are two Bengaluru-based startups. Hello and welcome to Young Techs Reloaded. I'm Shireen Bhan. Leading the charge in building India's quantum future are QPi AI with its full-stack quantum AI platforms and the country's most powerful 25-qubit system, and QNew Labs with its indigenous quantum communications technology safeguarding defense, government and enterprise networks. Today, we meet the men shaping India's national quantum mission roadmap, from taking quantum computing from lab to the market to ensuring that in the age of AI and quantum, India's data remains not just encrypted but unbreakable. I have with me today Nagendra Nagaraj, the founder and CEO of QPi AI, and Sunil Gupta, the co-founder and CEO of Q New Labs. Gentlemen, many thanks for joining us. You know, to start with, like, my mind overnight has been on superpositions and quantum cryptography and quantum supremacy, but I want to break this down for our viewers so we really understand what we're talking about. You don't just wake up one morning and say, I want to disrupt quantum computing. I'll start by asking you, Nagendra, how did this come about? I mean, you were working with NVIDIA. You could have continued to do that. What made you want to bet on quantum computing and bet on it in India specifically?
Yes. One of the things I observed early part of my life is, of course, I was very interested in quantum physics. At NVIDIA, there was DeepMind, which was doing some experiment in 2012. And they were playing this Atari game using their new model called DQN, double DQN. Okay. So I thought AI would not stop. And that was the thing. I tried to design that chip using AI then. Okay. So then I tried to do a chip which is agent-based compute. I was too early for the time in 2016 where I coined the word agent-based compute.
Huh.
Okay, so now everybody knows what agents are, but this was a different thing. Other problem I saw is, as in this endeavor, I saw like the classical way of doing AI is not going to be sustainable because it will consume a lot of energy. And of course, Google has really proved a point with their 2020 paper with Sycamore, where they told that what takes 26 kilowatt in quantum computer with 53 qubits would take around 15,000 kilowatt for classical one, and it consumes around 26,000 GPUs. Of course, people can call it as a bias towards quantum. Of course, it can do some workloads better, but we are knowledgeable that chemistry is quantum. All the chemical reactions are quantum, materials are quantum, and also optimization is quantum. And there are things like drug discovery, which is quantum also. In finance, they are going to move towards quantum. So in that way, the next generation of intelligence modeling, which requires high-dimensional data, it does require quantum computers. So for my journey in AI, it took a turn to my earlier interest in quantum physics. Now I am into this forming this quantum computer. In 2019, we formed this company with the aim to have better intelligence modeling, better intelligence compute.
Sunil, the same question to you. When you finally decided that this is what you wanted to do?
Hello and welcome. You are watching Global Lens and I am Parikshit Luthra. Hours after crucial meetings between leaders of Russia, India and China at the SCO summit and Prime Minister Narendra Modi's bilateral meetings with Xi Jinping and Vladimir Putin, US President Donald Trump has posted a message on India on Truth Social. Trump called the ties with India a totally one-sided disaster. He said the US does very little business with India, while India does a tremendous amount of business with the United States. He blamed India's high tariffs, the highest for any country, and in his words, for keeping American businesses out. Trump claimed that India has now offered to cut tariffs to zero, but warned it may be too late, saying this should have happened years ago. Our continuing focus now, Prime Minister Narendra Modi wrapped up the SCO summit in Tianjin after recalibrating economic ties with China and affirming a long-term partnership with Russia. Prime Minister Modi, Russian President Putin and China's Xi Jinping were seen exchanging warm gestures as they came together under the same roof for the first time since US President Donald Trump escalated his tariff offensive. PM Modi held a bilateral with Russian President Putin. We learned from sources that the formal meeting went on for around 50 minutes, where they discussed expediting an end to the Ukraine conflict and finding a durable peace settlement. They also discussed cooperation in sectors including trade, fertilizers, space and culture. PM Modi said India and Russia have always stood shoulder to shoulder, even in the most difficult situations. He added that India is looking forward to hosting the Russian president for a summit in December. President Putin remarked that both India and Russia are closely coordinating efforts at an international level. In a rare occurrence, both Modi and Putin were also seen traveling together in the car for their bilateral meeting, sending a signal to the US after the imposition of additional tariffs on India. The two leaders reportedly spent close to an hour in the limousine as well. Here is Prime Minister Modi and President Putin speaking at their bilateral meeting.
मैं हमेशा अनुभव करता हूं कि आपको मिलना मतलब एक यादगार मीटिंग भी होती है, बहुत सी चीजों की जानकारियों का आदान प्रदान करने का अवसर मिलता है। हम लगातार संपर्क में रहे हैं। दोनों पक्षों के बीच नियमित रूप से कई उच्च स्तरीय बैठकें भी हुई है। इस वर्ष दिसंबर में हमारी 23वीं समिट के लिए 140 करोड़ भारतीय उत्सुकता पूर्वक आपका इंतजार कर रहे हैं। एक्सेलेंसी हमारी स्पेशल एंड प्रिविलेज स्ट्रेटेजिक पार्टनरशिप की गहराई और व्यापकता का परिचायक है। कठिन से कठिन परिस्थितियों में भी भारत और रूस हमेशा कंधे से कंधा मिलाकर चले हैं।
Усилия по созданию в Евразии архитектуры равной и неделимой безопасности.
And could this meeting help in ending the Russia-Ukraine war? Joining us now to decode the meeting is KC